Welcome to Intermediate Financial Accounting 2, and I want to start by saying congratulations if you're here. It means you've survived your Intermediate Financial Accounting 1 course, which is a very challenging course, and you are to be congratulated. So I just want to give you the lay of the land. Here's what we covered in Intermediate Financial Accounting 1. It starts with a review. This is stuff everybody should know, things like journal entries, T accounts, time value of money. Then we get into more complex financial statements and financial reports. And finally, in our Intermediate 1 course, we go through assets in detail, right? We talk about accounting for cash, for inventory, for receivables, for investments. These types of things are covered in our Intermediate Financial Accounting 1, but we stop at the end of assets. Moving over to Intermediate Financial Accounting 2, we pick up where we left off. So this course starts with current liabilities. In fact, it starts with 3 modules on liabilities and equity. But then it moves into what I would consider the most challenging part of our intermediate suite of courses, and I'm just going to call this challenge topics. There's sort of a smattering of topics that are complex in accounting, starting with something called complex financial instruments. So we're going to learn about convertible bonds, convertible preferred shares there, and, we'll learn other topics. Intermediate Financial Accounting 2, to my mind, is one of the most challenging courses in the accounting degree, and it really is about these challenge topics. Leases, pensions, deferred income taxes, these are all notoriously difficult topics, and the best way to learn any of them is by practicing. So I'm so happy you're here with me. I offer lots of practice in this video series, and I hope you get a lot out of it. But we begin with one of the more straightforward topics. We begin with current liabilities. Let's go. Welcome to Module 13 of our Intermediate Financial Accounting class. This module on current liabilities and contingencies. So current liabilities, think of them as short-term obligations, short-term debts, things that we're expecting to pay back, usually with money, sometimes with a service if it's unearned revenues, within the next 12 months. And the big ones are like accounts payable, employee wages and benefits and bonuses, and some unearned revenues. And we'll explore all of those in this chapter, but this video, I'm going to hone in on the right word there, the one I've underlined, contingencies. Contingencies are maybe liabilities. Some event happened in the past that might cause us obligations in the future, but maybe not. And maybe not in the future is difficult to deal with from a perspective of an accountant. We like these past events that we summarize and we say, here's what happened. Well, if there's some future event that could mess with us, that creates challenges. So I'm going to tell you a quick story. This is you. Wow, my writing's messy. You are a shopkeeper. You've opened your shop. It's been going wonderfully. You're running a great business until this character enters your life. They trip and fall in your shop. They break their leg. So that's sad news already. Worse news arrives a few weeks later. Let's say this is on November 1st. A few weeks later, they send you a lawsuit. So let's say this happened on November 25th, right? They, on the road to recovery, they decide to sue you. They think you might have caused or your negligence caused this injury, and they're suing you for $100,000. Okay, so some relevant dates, and the court date gets set. You say no, and you lawyer up, and there's a court date set for February of the next year. So let's just say November 1st, 2031, they trip, fall, break their legs. November 25th, 2031, they send you a lawsuit. Important date, December 31st, 2031. Fiscal year-end financial statements. This is an accounting course. Of course, we're obsessed with fiscal year-ends. And then on Valentine's Day, Feb 14th, 2032 is our court date, our day in court. So those are all relevant dates. And of course, you call somebody very important to you, you call a lawyer, and it just so happens that around the same time, there is an accountant visiting you, an auditor, a young, keen auditor, and this lawsuit is relevant to both parties. So we're going to discuss, obviously, from an accountant's perspective, what's going on here and why this is tricky and why this matters and why this is a contingent liability situation. So an event happened in the past. The guy tripped, fell, broke his leg in your store. You might owe him $100,000. Or you might owe him $0. But it's an event that happened in 2031. It's an event that applies to our fiscal year end, 2031, but we won't know the outcome of the event until 2032. And when this auditor is auditing your financial statements, they're not sure whether there's a liability here or not. And this is our current liabilities chapter. That's what makes a contingent liability tricky, and that's what makes it contingent. It's a contingent on the outcome of this lawsuit. So, what does the accountant do? The accountant writes a letter and says, "Dear lawyer, please," he writes a letter for you. "Dear lawyer, please provide my accountant with all the information about the lawsuit." The lawyer then should inform the accountant. And let's just say there's 3 broad options. Option 1, the lawyer's sure we're going to lose. The lawyer says, we're cooked. We are hosed. We're guilty as charged. We're going to owe $100,000. In scenario 1, we do a journal entry. If it is probable that we're going to lose, we just say, okay, well, we have a liability. Debit lawsuit expense, $100,000. Credit lawsuit payable, $100,000. And it shows up in our 2031 financial statements, even though the court date hasn't happened yet. It hasn't settled, but we would just record a journal entry if the lawyer told us it was probable that we would lose. Scenario 2, if the lawyer thinks, well, I'm not sure, it could go either way. It's reasonably possible we could win. It's reasonably possible we could lose. So it's reasonably possible that we could lose. In that scenario, we don't do a journal entry. We don't debit lawsuit expense, credit lawsuit payable. In that scenario, what do? We disclose in the notes. We tell shareholders, this is what happened. We're getting sued for this much money. It's possible that we're going to lose. We don't know yet. That's scenario 2. So that's the auditor would be making those adjustments to your statements. Scenario 3, we ask the lawyer, are we going to win or lose? Lawyer goes, this guy, I got video of him tripping and falling at every store in town. Just happened. This is one where he broke his leg. We're going to win. This guy's an idiot and he's a fraudster, and I got him red-handed. We are going to win. If the lawyer thinks the chances are minimal that we're going to lose, in that circumstance, we do nothing. We don't do any journal entry. We don't do any disclosure. That's how we handle it. So in terms of U.S. GAAP versus IFRS, and Canadian GAAP's in line with US GAAP here, here's sort of our areas. It would say it's a 0 to 10% chance. The chances are slim. We would call these, I think, negligible. So the chances are slim that we're going to lose. In other words, 90% plus that we're going to win. We do nothing. No journal entry, no note disclosure, nothing like that. If it's reasonably possible that it could go either way, well, possible, I can't spell possible, notes. And if it's probable that we're going to have to pay, probable we're going to lose, journal entry, right? Disclosing the notes, journal entry. If it's probable you're going to lose, you just accrue the amount. You record the expense now and the liability now. What's the difference here between IFRS? IFRS has a lower bar to clear to do the journal entry. IFRS says more likely than not. And so it's anything over 50-50, where US GAAP and Canadian accounting rules say, no, you got to be stronger than 50-50. It's got to be like, probably we're going to lose. So, 70, 80%, something like that. So there you go. That's what a contingent liability is. And the key feature here is it's an event that happened in the past that we don't know the outcome of until the future, but we might be on the hook to pay some big amount of money. It's contingent on the outcome of the court case. One last point, and this is not really relevant to your accounting class, but just having been an auditor, I can tell you it's sort of a weird situation to be in. As an auditor, I owe a duty to this client. As a lawyer, the lawyer owes a duty to the client. The lawyer often is in conflict with the auditor, and here's why. The lawyer is never going to want to say, yeah, we're going to lose. And if they do say, yeah, we're going to lose, they don't want it in writing. And that's what we as the auditor want. We want a paper trail. Oh, the lawyer said they're going to lose, therefore I accrued this. The lawyer never wants to put it in writing that they're going to lose because they owe a duty to these people, and them writing down, I think I'm going to lose, is actually kind of bad for the client. So it's this weird, I don't want to call it a love triangle, but it's a weird situation where we both owe a duty to the client, but we are actually in conflict with each other. And there is drama between the lawyers not wanting to disclose things to the auditor trying to pull teeth, get information out of the lawyer. In accounting class, it's really easy. You just say, oh, the lawyer says it's probable that we're going to lose, or whatever the wording is. In real life, it's a tooth-pulling exercise a lot of the time. But there you have it. There is our intro to Module 13. I can't wait to get started the best ways to do examples, and I'll see you in the next video. Bye for now. We're about to tackle problem 13.2a on the current portion of long-term debt. I just want to show you where to grab that problem. Go to my website, tonybell.com. We're doing intermediate financial accounting 2. You'll notice no sign-in, no sign-up, nothing like that. You can have a copy of this and all of my problems for yourself. You'll notice that this one is a free video. That's why you're watching it free on YouTube. But there's plenty of problems that are members-only videos. If you're getting great value from the free stuff, I hope you'll consider a membership. Thanks for watching. Let's jump into the video. Let's jump into problem 13.2a, the current portion of long-term debt. On December 31st, 2031, Farley Company borrows $100,000 from the bank. The note requires 60 equal blended monthly payments, payable at the end of each month, beginning January 31st, 2032. The interest rate is 6% per year, compounded monthly. The bank provides the following loan amortization schedule for the first year, the first 12 payments. And so obviously this $100,000, this is long-term debt, but we got to figure out what is the current part of our long-term debt, the current portion of our long-term debt. And there's really a couple of options. We've got payments. We're going to make $23,000 in payments. We're going to have $5,000 of that go to interest and $17,000 go to principal. Now, the whole purpose of this exercise is just to say, when you have long-term debt, there's interest and principal that needs to be paid in the next year. What's the current portion of the long-term debt? It's the principal you're paying back. So let's read through the question. You can see it's a very short question. For 2032, determine the total cash paid. Well, that's the amount of our payments. $23,199. What's the interest expense? Well, again, I could have not totaled this and made you sum it up, but there it is, $55,919. And what's the principal to be paid back? $17,680. And it says determine the current portion of long-term debt that's going to go on our financial statements, and it's the amount of principal being paid in the next 12 months. It's $17,680. And there we go. We've solved 13.2a. Now, there's a bonus question, but really, if you don't feel like doing time value of money calculations, you can say goodbye. But if you're curious about like the math, like how did the bank make this table? Well, that's what we're going to solve for now. So it says show how to calculate the payment. And this is just an annuity, right? It's recurring payments, and we're going to pay back $100,000 in today's dollars. Present value is $100,000. We want to figure out the payment amount. We have the interest rate. We have the number of periods. We can do this. You could do it in a financial calculator. I'm going to do it by hand. I have my PV of an annuity formula here. We know the PV is $100,000. That's what we're borrowing today. We're solving for payment. We don't know that. Times 1 minus 1 over 1 plus I to the t. Now, the I here is interesting because there's 60 monthly payments. The interest rate is annual, so I got to make it monthly. So 0.06 divided by 12 months, it's 0.005. It's sort of a funny thing. It's 0.5% per month. So 1.005 to the power of n, which is 60 periods, all divided by 0.005. That's our, again, monthly rate. Okay, that's it. Then we just got to crunch the numbers. 1.005 to the power of 60. I need this x to the y button here, just right there. To the power of 60 is 1.3488. So I've done that. I got to go 1 divided by that. So there's a 1 over x button on my calculator. 1 over x, 0.74. 1 minus that. So I just put this in as a negative plus 1. 0.2586. Divide by 0.005. And I get 51.73, call it. Now I'm going to keep all those decimals because I want to be right to the penny. So I just go 100,000 divided by that number. And again, the way to do that is you go 1 over x times 100,000, and that's the same thing. 1933.28. So PMT equals 1933.28. I've solved it. Am I right? I am, like to the penny, right? 1933.28. Now it says show how the first interest expense, 500, and principal amount, 1433.28, were determined. So it's just saying, okay, we got the payment, 1933. What about these things? How do we get the interest and principal? Well, the interest is just the interest rate, which we said was 0.005, the monthly, multiplied by the beginning balance. So times 100,000, it's 500. So our interest, there you go, it's 100,000 times 0.005, and that equals 500. What's the principal amount? Well, if I'm paying 1933 and 500 is of it is interest, well, how much is actually going to pay down the debt? Just the difference. So that's how you got to the 1433.28. A little bit of debt math, but there you go. We've solved 13.2. Hey, I've got a bit of a cold. That's why my voice cracked. Otherwise, it's a very deep, powerful voice, as you know. Thumbs up if you think I've got a deep and powerful voice, and I'll see you in the next video. Thanks for watching. Bye-bye. Let's examine problem 13.3a. It's on sales taxes. Now, this was a tricky problem for me to develop because sales taxes are so unique to each jurisdiction, and I want to have universal problems. So this is as close as I could get to a universal problem. I've done my best. So part one is pretty much applies to everyone, and that is when you collect a sales tax. In other words, you're a business, you sell something to a customer, and part of it, on the receipt, you'll see they charge you sales tax. Well, if you collect that sales tax, it's not your money as the business. You got to pay it to the government. So here's how we deal with that. Part one, for everyone, US GAAP applies, IFRS applies, Canadian ASPE applies. On January 14th, Thompson sells inventory to a customer for $140,000 plus 5% tax. So in total, we collect $147,000, $140,000, the cost of the product, plus there's a $7,000 5% tax on top. That $7,000 extra dollars is not for us, though. That's for the government. So let's do the journal entry. January 14th, we're going to debit cash. Our customer gives us $147,000. We made a sale of $140,000. And that extra $7,000, that's payable to the government. We got the money, but it's just got to turn around and send it off to the government. And we'll call this, in our class here, sales tax payable. But more often, you will see this referred to by the name of the sales tax. So in Canada, we have something called GST. This would be GST payable. Europe, they have VAT, and in US, all kinds of sales taxes. So whatever the name of the sales tax is payable. That would be very typical when you collect sales tax for the government, when you charge your customer sales tax. Okay, so that's part one, and it's pretty universal. Oh, I forgot. We sold it. The cost of goods was $100. So debit COGS, credit inventory, $100K. Boom. We are all set. So, part two says we buy some inventory and we pay tax on that purchase. So this is where things get a little different. This would apply more to companies that are governed by Canadian and maybe some European taxes. I'm not sure, again, around the world. But the idea of a lot of taxes is they can be refundable. We buy, we pay the tax, and then we get our money back. In the U.S., you get these resale certificates. So the idea is if you buy the inventory and your intent is to resell it, you get a resale certificate, and you say, when you buy the inventory, you say, don't charge me tax because I'm just going to turn around and resell this thing, and leads to double taxation, tax on a tax. The way, again, Canadian GST, VAT deal with this is you pay it and then you get a refund. In the US, the way it works for this type of tax is you just don't pay it. So it's different in the two environments, and I can imagine around the world I cannot figure all of your sales tax systems out. In Canada, in the province I live in, we have GST, it's a refundable tax. We have PST, it's not. So we have two taxes on things and you treat them differently. What a nightmare, right? What a pain in the rear end. But anyway, let's do this with a refundable tax. So it's part 2. Maybe I'll do it in red ink just to separate the two of these. January 1st. We buy inventory from supplier for $100,000 plus 5% refundable sales tax. So 105, we pay 105 cash. So credit cash, 105, and we're going to buy inventory, 100. Now, had the sales tax been non-refundable, we would debit inventory for 105, like the full pull of what you paid because it's not refundable. But sales tax is refundable means we got $5,000 coming to us. We're going to debit sales tax receivable. And again, depending on the name of the tax, right? I'll use the Canadian example. We would call it GST. So I would have an account called GST receivable, that type of thing. There we go, though. January 1st in the books. January 14th, Thompson Company sells inventory to a customer for $140 plus 5% tax, receives $147. Inventory was on the books at $100. This is that exact transaction, and in fact, I can just copy it down. So let me copy, paste that January 14th one down. Maybe I'll change it to red ink. Boom. There we go. So again, we paid $140, or we got paid $147. Our sales revenue is $140, and $7,000 of extra tax needs to go to the government. So January 31st, we remit the amount we owe the government. How much do we owe the government? Well, I owe them $7,000 based on making that sale and collecting money, but they owe me $5 because I paid tax. So net, I owe them $2, and that's how much I would send off to the government. Here's how we do it. January 31st, I zero out my receivable and my payable. I go, okay, the sales tax payable, that's got to go. $7,000. I zero out the sales tax receivable. And again, this would have a different name in real life, name of the tax. VAT or GST or whatever, and you can see we're off by $2,000, and you just balance it through cash, right? And so you go, okay, well, I owe $2,000 cash, and that makes sense. I collected $7,000 extra, like $147 rather than $140. I collected $7,000 extra, but I paid $5,000 extra, so you net it out, and you go, I owe them $2. And that's how you do the journal entry when you owe them $2. So there you go. Sales tax can be complicated and convoluted. Like I said, in BC, we have 2 different sales tax. One is refundable, one is not. We tried to harmonize it for a couple of glorious years, and then the taxpayers voted against it. I can't believe it. I voted for it, but I was on the losing side of that vote. But you'll be on the winning side of my vote if you hit one of those buttons before you leave. Thanks so much for watching, and I'll see you in the next video. Bye-bye. Let's go through problem 13.4a on payroll. One of the challenges of developing a universal course is different countries will have different jargon for their payroll stuff. So in Canada, we deduct something from our check called CPP, Canada Pension Plan. Well, I'm guessing no other countries have CPP, Canada Pension Plan. In the US, they have something called Social Security, and in Europe, it's a different thing. So your countries will have different words. I've tried to use generic terms here, but just know when you go through your textbook that these generic terms will match up with something specific in your own country. So let's get into it. Hayes Company has a single employee who earns $30 an hour. Company runs weekly payroll. On January 7th, they ran a payroll. During the period, the employee worked 40 hours, so they've earned $1,200 in wages. The company withholds the following amount from the employee's pay. So if you ever looked at your own checks, you'll know you earn $1,200. You don't get paid $1,200. You get paid some amount lower than that. So they withhold taxes, government pension plan. So again, that's CPP in Canada, Social Security in the States, some other thing. Unemployment insurance, we call that EI, and they withhold some union dues. In addition to the employee's gross pay, the employer is subject to payroll taxes. Hayes Company is required by law to match the government pension plan 1-to-1. So they're going to pay $60 extra in government pension, and they've got to help out with the unemployment insurance. They got to chip in $21. You'll notice they don't chip into the union dues. That would be pretty unusual for the employer to chip in extra there, but it does come off the employee's check, and so the company does have to deal with that. It says record a journal entry to recognize the payroll and to pay the employee. Okay, so this payroll was on January 7th. And let's figure out how much we're paying this person. We're paying $1,200, but we're going to pull $240, so minus $240. We're going to pull 60 off the check. We're going to pull 15, and we're going to pull 25. We're actually only paying $860, even though $1,200 was what was earned. So we're going to credit cash for $860. That's the amount of the check. We're going to debit wages expense for the full amount earned, $1,200. And then the credits are all these amounts. So we got income tax payable, the person's personal taxes, $240. We got government pension plan, GPP, payable, again, Social Security in the U.S., CPP in Canada, and I'm sure a different name in Europe or wherever you happen to be watching this. Unemployment insurance, we would call this EI in Canada, but I'll call it UI, payable. Again, different names in different places. And maybe even different states and provinces will have different names here. And union dues payable. And if you add it up, debits equal credits, and there's our journal entry for the check. But we also have our own bookkeeping to do behind the scenes, because we are going to pay some money on behalf of our employee as part of just our benefits package, essentially. So we got to match the government pension plan costs. So that's $60. Match the government pension plan, so that's $60. And we got to pay this $21 in unemployment insurance. So those two have to be considered. And there could be other benefits and wages, like supplements on top that would be considered. Some, private pension plan where we're pulling out and matching, or 401ks in the U.S. These types of things would come out here. But in any event, this needs to be considered. And so it's $81 of extra expense. I'm going to call this benefits expense. Can be called payroll taxes expense, benefits expense. It's just like the additional costs in our payroll run, and it's $81. I'll do a separate date here, even though it's still January 7th. I'll just treat it as a separate transaction. And of course, we have GPP, government pension plan payable. On our side of it, $60, we're matching. And then we have the unemployment insurance. Is that right? Yeah, $21 in UI payable. UI payable, $21. Okay, the final piece. So that's our side of the, I guess I've called it payroll tax expense. Maybe that's a better explainer. I've called it benefits here. Payroll tax expense might even be better. Last one, it says record the journal entry to remit all the amounts owed to the government. So just wipe out the payables. So let's start with income tax payable let's assume this happened on January 7th. That would be a little weird. But let's credit cash, $240, debit income tax payable, $240. Government pension fund, 60 and 60 is $120. So credit cash, $120, debit GPP, government pension plan payable, $120. UI, debit UI payable, $15, credit cash, $15. You may be saying, well, what about the amount owed to the union, right? And we would pay that. It says remit all amounts owed to the government, income tax, pension, and unemployment. So we live off, we would ship the union their share of the money too. We're not withholding it from them. It's just not asked in the question. If it were, we would just obviously debit union dues payable in a separate transaction, and credit cash for that amount, $25. So there you go at that point. So that wasn't asked in the question, so I wouldn't include it here. It's not necessary for part C. There's A, B, and C, and you consider this one a little bit of a bonus, if I can spell the word bonus. There you go, though. We've solved 13.4a. As always, thanks for being here. Thanks for watching, and I'll see you in the next video. Bye-bye. Let's take a look at problem 13.5a, vacation and sick pay. Jones Company has one full-time employee who earns a salary of $2,000 a week. That's $104,000 per year. Effective January 1st each year, the employee is entitled to 3 weeks, that's 15 working days of paid vacation per year, and 1 week of paid sick leave. If the employee does not take a vacation, the unused days are carried over to the next year. Unused sick days are not carried over, they are forfeited. As of December 31st, the employee had taken 10 vacation days and had not used any sick days. Record any December 31st entries required to accrue the vacation and the sick pay. Well, we'll start with the easy side of this. Sick days don't accrue, so sick days, we don't need to do anything, right? They forfeit the unused sick days, so it's not like we have to keep an account for those. But we do have to keep an account for the unused vacation, and it looked to me like they got 15 days and they only took 10, means they got a week's worth of vacation. And what's the value of a week's worth of vacation? I should take a sick day myself. I got a little cold. I'm going to cough here. A week's worth of vacation is worth $2,000. So let's do that journal entry to accrue the fact that we owe them $2,000 worth of vacation. Here's what the journal entry looks like on December 31st. 2031. We're going to debit, and I would debit, the salaries account, so salaries expense, wages expense, and we would note it specifically as vacation pay. Now you might see an account called vacation pay expense, and I think that's very reasonable. I would follow your textbook here, but it's a $2,000 accrual. We're accruing a week's worth of vacation cost that we haven't paid yet. And what's the credit here? Well, it's salaries payable. And of course, this is vacation pay, VPay, $2,000. Marvelous. Okay, so we've done that first journal entry. So that's to accrue vacation, and to accrue sick, we don't. So there you go. We've done part 1. Part 2 says, effective January 1st, 2032, the employee got a 5% raise to $2,100 a week. On January 1st, 2032, they took a 1-week vacation from January 1st to the 7th, taking 5 vacation days. Immediately upon their return from vacation, they got sick, taking 5 days of sick days to cover the week of January 8th to 14th. Record any relevant entries. Okay, so the January 7th pay run, what's happening? Well, we're going to pay them their new wage, $2,100, so credit cash $2,100. And to be clear, actually, if you just did 13.4, look back to it, they would have all those same types of deductions for income tax, for unemployment insurance, for their pension. Those types of deductions would be taken off the check, and it would be very similar journal entry to that one. This is simplifying matters. I didn't want to have, 8-part journal entry, but that's what a pay entry is going to look like. We're just focusing in on the vacation element here. So they took a vacation. Well, they definitely would have taken their vacation from their allotment from last year, right? They had 3 weeks available last year. They took one of their weeks that they earned last year. They took it in the first week of this year. That's totally fine. We got to pay out their vacation from their payable last year. What we accrued last year is now being paid out. So debit salaries, payable, vacation pay for $2,000. Now, you'll notice it's mismatched. What's the missing 100? It's the fact they got a raise, right? We accrued it when their wage was $2,000 a week, and now it's $2,100. So this is just an additional wage expense. Nothing or not wage, but salaries expense. And again, it's very common that it might be called vacation pay expense, something like that, right? But I've been calling it salaries, so I'll continue to call it that. There you go. That's January 7th. Well, now they did take a vacation. There is a journal entry on January 14th because, again, we run payroll and we credit cash, $2,100. The debit would just be as if it was a normal payroll run, except for the one element, which is the salary expense. We would denote as sick pay, and we would need to track those sick days because, we don't want our employee claiming more than their entitlement, right? They're entitled to 5 days. They've taken their 5 days. They've used their sick days for the year. But, again, it would be just like our debits and credits for problem 13.4, where there would be other benefits taken from. It would just be a normal pay run. Like when you take your 5 days, sick days, you still get the check as normal. You still get the same amount of money as normal when you are a salaried employee. Okay, there we go, though. We've solved 13.5a. As always, thanks for watching, and I'll see you in the next video. Bye-bye. Let's examine problem 13.6a, unearned revenues. Unearned revenues are my favorite kind of liability. Why is that? It means our customer paid us and we didn't do any work yet. So we owe them. We don't owe them money, though. We owe them a product or service, but it also means my product or service is so in demand that people are willing to pay before I deliver anything, right? They're willing to give me the money first. That's a nice business to be in. During February 2031, Smart Magazine sells $60,000 in 12-month subscriptions. So that means we're earning subscription revenue at a rate of $5,000 per month. 60,000 divided by 12, right? $5,000 a month is what we're earning. To its monthly publication starting with its March issue. All cash is received in advance. So we got $60,000 and we start delivering magazines in March. By March 31st, 2031, the company had successfully delivered the first of the 12 monthly issues to all of these new subscribers. Record the journal entry, the summary journal entry for cash received during February. So obviously we're selling magazines individually. Maybe it's $20 per subscription and we sell to 3,000 different customers and we're going to debit cash $20, $20, $20, credit unearned subscription revenue each time. We're just saying do it in one entry because this is an accounting class and we're not going to do 3,000 of the same entry. In real life, you would. So I'm just going to date this February 2031, but each one would have its own entry, and we're going to debit cash for the total of 60,000, and we're going to credit unearned subscription revenue for 60,000. And the idea here is, again, we owe them magazines. We don't owe them money. We owe them magazines. If we deliver 12 magazines over the next 12 months, we'll be satisfied, right? We'll have satisfied our debt to this customer. Now, in March, we deliver, and I'll date this March 31st, 2031. But as we deliver the magazines, we can say, well, this is revenue that's been earned, right? We've delivered on what we promised. We've fulfilled our obligation here. So we fulfilled $5,000 worth of our performance obligations. So I can call this revenue. Not unearned revenue. I credit just plain old subscription. My writing's gone to pot here. My subscription revenue, and that's $5,000. And what do I debit? Well, I say it's not unearned anymore. Remember, unearned revenue is a liability, a current liability account. To make the liability go down, you debit it. So let's reduce our current liability. Debit unearned subscription rev, and the amount is $5,000. Just line this up better so my debits are aligned. Okay, so my unearned subscription revenue, if you look at that balance of that T account, it's going to be $55,000 of credit, and that's because I owe 11 more months of magazines at $5,000 a month. But there you go. We've done it. Pretty straightforward question. We've solved 13.6a. As always, thank you for watching, and I'll see you in the next video. Bye-bye. Let's examine problem 13.8a, unearned revenues on gift cards. When we sell gift cards, we know in our hearts not all of them are going to get cashed in, and that is free money to the company, right? The fact if you sell 100 gift cards and only 90 get cashed and 10 get lost or just sit in a drawer somewhere unused, that's good news for the company. There's a reason a lot of companies sell gift cards. It is free money. The question for us, the accountant, is when do I recognize that revenue as being earned? Because obviously it's unearned. They pay for the gift card in advance. When do we recognize it as being earned? And one way of recognizing it, most textbooks will do it this way, is they say, well, you make an estimate and you recognize revenue as the gift cards get cashed in. You recognize a little bit of extra revenue based on how many you think are never going to get cashed in, based on, tradition, track record, history. Let's jump into it. Following transactions occurred at Gow Day Spa. During October, Gow Day Spa sold 20 gift cards for $200 each. That's $4,000 in gift cards we sold. Historical trends at the Day Spa show a 10% breakage rate, meaning 10% of the total gift card value is expected to never be redeemed. So a lot of people just don't use their Day Spa gift cards, right? They forget about it. They put it in a drawer somewhere. It's gone. And 10% means of that 4,400 is pure profit. I don't have to do any work. But the question is, when do I recognize the revenue? During November, customers redeemed 9 gift cards. Assume Gow Day Spa uses the proportional method to recognize breakage revenue. We call it breakage, even though, again, it's good news for us, the company. And so breakage revenue looks like this. You go, okay, 20 gift cards were sold, 10% will never be cashed, meaning that we're only expecting 18 of these 20 to be cashed, right? 90% will be cashed, 10% will not be cashed, or a different way of saying it is there's $4,000 in value, while $3,600 is never going to be cashed. Well, if we had 9 gift cards cash in, that's $1,800 of gift cards, right? They're $200 gift cards. Out of, we expect $3,600 worth of gift cards to be cashed. 400 won't. We're expecting 3,600 to be cashed. That means 50% of the gift cards that are out there that we expect to come back have come back, meaning we can recognize 50% of that extra revenue, and that's what we're going to do here. So it's a funny situation, right? Because we sold $4,000 worth of gift cards, but we base our proportion based on what we think will be actually cashed in. We only think 3,600 will be cashed in. So that's the proportional method. Let's do journal entries. Record the summary journal entry for gift cards in October. Of course, every one of these gift cards would be a transaction. Debit cash, credit unearned revenue for $200. And we would do that 20 times. Different customers come to the till and we would do it 20 different times. But we're going to do one journal entry to summarize all of this. And I'm just going to date it October. And we'll be throughout October. We're going to debit cash, $4,000. And we're going to credit unearned spa revenue or unearned service revenue. Unearned revenue. 4,000, and I might even note that this is gift cards in the account name. And there you go. There's October. What happened in November? Well, a bunch of those gift cards came back and we earned the money. $1,800 worth of this has been earned. So I would call this, spa revenue or service revenue. $1,800. Those are the claimed gift cards. Now, what about the proportion of the breakage revenue? Well, we said that's 50% of the gift cards I expect to ever see come in. I can recognize 50% of this, phantom revenue, this breakage revenue. I can recognize it now. So my breakage rev that I recognize is $200, 50% of the $400 of gift cards that aren't coming back. And I debit unearned revenue to say, no, this has been earned now. Unearned service rev. And of course, this is on gift cards. And it's $2,000 that I'm recognizing. I'm recognizing half the revenue, even though it was less than half the gift cards that got claimed. And I'll recognize revenue slowly over time as those gift cards start to come in. But there you go. We've solved 13.8a. As always, I hope the videos help. And if they help you, I hope you'll help me. Thanks for watching. See you in the next video. Bye for now. Let's jump into problem 13.9a, contingencies related to litigation. Remember what contingencies are. There may be liabilities. Some event happened in the past, caused us to get sued, but we don't know whether we're going to lose any money pending the outcome of a future event, a lawsuit, right? And so it's a weird accounting situation because it's a past event, so it could be a liability that should be on our balance sheet, but it depends on the outcome of the lawsuit. So US GAAP and Canadian GAAP, called ASPE, have different way of looking at it from IFRS. And I just want to go over it big picture. So US GAAP, Canadian ASPE say if the loss of the lawsuit is probable, in other words, if we're probably going to owe somebody money, do a journal entry. Debit a lawsuit expense, credit a lawsuit liability. If it is reasonably possible, but not probable, possible, but not probable, you don't do a journal entry, you disclose in the notes. So you prepare note disclosure, just discussing what's going on, explaining the lawsuit, explaining how much you might lose, but, essentially saying it's a maybe. Now, if the chances of you losing are negligible, and there are plenty of times you get sued where it's just like, we're going to win. The lawyers will tell you, we think we're going to win. If that's the case, we do nothing. So the disclose, do nothing journal entry is the same under IFRS. The only difference is when do you do the journal entry under IFRS? It's a little bit stricter. You'll do the journal entry more often under IFRS. Their criteria is not probable. Their criteria is more likely than not. And the idea there would be like 50% plus 1 or 51%, just a little bit more likely than not. So they are more itchy trigger fingers to do a journal entry in IFRS than we are in Canadian GAAP or US GAAP. Let's jump into the problem. The following independent situations occurred during the fiscal year, December 31st, 2031. In August of 2031, a competitor filed a lawsuit against Horizon Logistics for patent infringement, seeking $4 million. As of December 31st, 2031, Horizon's legal counsel has reviewed the evidence and advised management that it is highly likely, a 95% probability, that the company will lose the lawsuit. The lawyer's single best estimate for a final settlement is $3 million. Okay, so this under US GAAP or ASPE or under IFRS clearly falls into the probable zone, clearly falls into the journal entry zone. We are going to have to do a journal entry. Our journal entry is going to look like this. Debit, lawsuit, loss account or a lawsuit expense account. I call it lawsuit loss expense, $3 million. You hear this, actually I'm just going to put 3M for $3 million. You hear this called litigation as well, litigation loss expense, something like that. And litigation, or I got to use the same language, lawsuit liability payable, right? This is a current liability. That's why this lands in our Chapter 13 on current liabilities. This would be in our, on our balance sheet under payables, like lawsuit liability, $3 million. This would also get some note discussion, right? We would have a note discussing what's happening with that lawsuit. Let's go on to situation 2. In October 2031, a former employee sued Vanguard Systems for wrongful termination, seeking $1.5 million. As of December 31st, legal counsel advises that the likelihood of the company losing the case is reasonably possible. So we're in the yellow zone, and they apply a 35% on, so less than 50-50 or somewhere in here. And what does that mean? That means note disclosure. So we're going to disclose no journal entry, but we do disclose the lawsuits in the notes. I always advise students, look up your favorite company on the internet. They're probably getting sued. Is it Nike? Is it Google? Whatever company you're interested in, just look up their annual report and read an actual lawsuit disclosure. And you'll see, they basically lay out, they'll tell the whole story. This happened. We're getting sued for this. This is the court. This is the expected date of the decision. And, we give some estimate of the expected outcome as well. And in this case, though, it doesn't rise to the level where we're going to do a journal entry, but we must disclose it in the notes. Situation 3. In December 2031, a customer sued us for $500,000, claiming the product caused minor property damage. The legal counsel considers the claim to be entirely frivolous and advises the chances of ruling against the company is remote, negligible, 2% chance. So it's in the green zone. If we're not going to lose the lawsuit, you don't have to do a journal. You don't even have to tell anybody. You just go nothing. Do nothing. So it said for each independent situation, do, a journal entry and state any disclosures that need to happen. So we've basically done that. Situation 4, it says all the above situations will be handled the same regardless of accounting framework, US GAAP, IFRS, or ASPE. ASPE's Canadian GAAP. The situation below would be different between the methods. I got to have a little cough. Okay, so... in November 2031, a supplier sued Meridian Manufacturing for breach of contract, seeking $800,000 in damages. As of December 31st, 2031, Meridian's legal counsel estimates that it is more likely than not, 55%, that the company will lose and be ordered to pay $800,000. All right, so we're in this zone here, 55%, so it's different, right? So Canadian GAAP, that's ASPE, and US GAAP do the same thing, which is disclose. And literally disclose just means like you write a paragraph that looks like that. You basically say, we're being sued, here's the reason, and here's our estimate of what's going to happen, and here's what we stand to lose if we lose. IFRS says, no, this is more likely than not, so we are in journal entry mode. So do a very similar journal entry, right? We're going to debit under IFRS lawsuit, loss, expense, and we could call it estimated lawsuit expense or loss expense, $800K. And we're going to credit lawsuit liability. And again, this goes under current liabilities, $800K. And not only that, there would likely be a note discussing this lawsuit that we're losing. That said, I mentioned at the start of the chapter, in reality, this is a place where lawyers and accountants come into conflict. We just want them to give it to us straight. Are we going to win or are we going to lose? The lawyer thinks, and I think rightfully so, it's bad for them and it's bad for their client if they're talking and in writing about how they're going to lose a case that's ongoing. So it brings the accounting profession and the law profession into tension. In accounting class, it's very simple. We'll just lay it out and we'll say, oh, it's more likely than not, or it's probable. We'll use some jargon like that. In reality, it can be tricky. But there you go. We've solved 13.9a. As always, I hope you like the videos. And if you do, I hope you hit a thumb or a sub. See you in the next one. Bye for now. Let's jump into problem 1310A, warranties. And we're really looking at distinguishing between two types of warranties. The assurance type warranty, which is just part of the product that you're selling, right? It's baked into whatever you're selling. You sell some machine or something and there's like a 1-year warranty just built into that sale. And then the second type is called a service type warranty, and that's what I think of as extended warranties, where the customer pays a little extra for a little bit of extra warranty service, and that's treated as an unearned revenue. Let's jump into the problem and kind of deal with these two different warranties. Cascade Commercial Kitchens sells high-end industrial espresso machines. On January 1st, 2031, the company sold 50 machines for $4,000 each, $200,000 in sales. All sales were for cash. So immediately I'm like, well, okay, Jan 1, 2031, debit cash, 200, credit sales rev, 200. We're going to have to do journal entries for this stuff. Now, this question's a little awkward because the time jumps back and forth and makes it a little bit difficult to answer, as you'll see. Included in the $4,000 purchase price is a standard 1-year warranty. Guarantees the machines against defects. Based on historical data, Cascade estimates the total warranty cost will equal 3% of cash sales. So our cash sales were $200,000. 3% of that is $6,000. $200,000 times 3% is 6,000. I have seen it done, and I actually prefer this way. When you make the sale, you debit warranty expense and you credit estimated warranty payable for $6,000, and you adjust from there. However, most intermediate accounting textbooks I've seen do it a different way. So I'm going to do it the way most intermediate accounting textbooks do. We end up in the same place. It's like not like wrong accounting. It's just a different way of doing it. So I'll do it the way most accounting texts do it. It goes on to say, during 2031, Cascade incurred $4,500 in actual warranty repair costs. I'm going to leave a little room. We're going to have to do a journal entry in here. So I'll do the journal entry for the warranty costs, and the journal entry looks like this. So during 2031, I'll just put during 2031 as my date, debit warranty expense, and the amount is $4,500, and credit cash $4,500. We're going to be asked to do a year-end adjustment for this, and I'm actually going to do that now. So on December 31st, 2031, we're going to want to adjust the rest of this. We said there's going to be $6,000 in warranty claims, and so we got to adjust for that amount. We debit warranty expense, and we credit estimated warranty liability, estimated warranty liability or payable for the other $1,500 that we think is going to come in and qualify for this $1,500 standard liability. And that would be, again, on December 31st at the end of the year. So that's sort of our standard warranty and how you would treat it. Like I said, I prefer to do the warranty expense, debit warranty expense, credit estimated warranty liability for $6,000, and then when warranties come in, debit estimated warranty liability, credit cash for whatever amount comes in. You end up in the same place. So it's all the same. On to the service type warranty. It says, in addition to the machines Cascade sold 2-year extended service contracts on 20 of the machines for $500 each, $10,000. I got a cough. I'm fighting a terrible cold. The service contracts provide preventative maintenance and begin on January 1st, 2032. So it's an extended warranty. Let's deal with that. So we get paid on the day we sell them. We're, pitching this extended warranty. We get paid extra cash. We get paid $10,000 in extra cash. And this $10,000 is unearned revenue for us, right? We got paid money for which we haven't done any work. I'm going to call this unearned extended warranty rev, and it's $10,000. Okay. Now, it hasn't even started by December 31st, 2031. Let's read on. On May 10th, 2032, a customer brings in an espresso machine covered by the extended service contract for a tune-up, and we pay $150 to tune the thing up. So this is May 10th, 2032. Of course, we're in the extended warranty period. We debit extended warranty expense for the amount $150, and we credit cash $150 for covering off that warranty. Okay, let's kind of read the questions. I haven't read the required yet. It says, record the summary journal entries for the sale of the machines and the extended service contracts on January 1st, 2031. That's this batch of entries. We've done it, right? We sold the machines, debit cash, credit sales. We would also debit COGS, credit inventory, but we're not given any of that information. And then debit cash, credit unearned warranty revenue for the extended plan. As warranty expenses come in, so it says next, record the journal entries for the actual warranty costs incurred. So that's this next one, debit warranty expense, credit cash. and the year-end adjusting entry for the assurance type warranty. So we're saying there's going to be $1,500 more we're expecting to come in. Now, if this never comes in, we just write off the liability. We just go, okay, we didn't service as many as we expected, and when we estimate our warranty liability next time, we estimate it a little lower. Okay, so there you go. C, it says record the journal entry for the extended service maintenance performed on May 10th, 2032. We've done that. So there's A, we did B here, we did C here, and then on to D. D says record the year-end adjusting entry required December 31st, 2032 to recognize revenue earned from the extended contracts. So we had $10,000 of unearned revenue. Well, by the end of December 31st, 2032, we've fulfilled a year of our extended plan, and it's a 2-year extended plan. So we've earned half of this money, right? We've earned 1 out of the 2 years. We've earned $5,000. It's not unearned anymore. The extended warranties are expiring. So we debit unearned extended warranty rev for $5,000, and we credit extended warranty rev for $5,000. And that is D. And at that point, we're done. And so you can just see the warranty, the assurance type warranty, is just sort of baked into the product. Like, it's just part of the product sale. And we do set up an outside liability with the service type one, the extended warranty. We actually have to debit cash, credit an unearned revenue account for just that specific one, and we deal with it as a typical unearned revenue over time. But there you go. We have solved 1310A. As always, thank you for watching. See you in the next video. Welcome to Module 14 of our Intermediate Financial Accounting course. This module all about liabilities, and the specific liability we focus in on this module is bonds. Now, you would have been introduced to bonds in intro accounting, but it's worth refreshing yourself. What is a bond? And a bond is simply a big group of notes payable. You're a large company. Large companies are the only ones doing bonds, or a large organization like MIT, Massachusetts Institute of Technology, one of the best universities in the world, and you want to borrow a huge chunk of money, and you go to the banks, and either they don't offer you a good interest rate, you don't like the interest rate, or the terms of the loans aren't what you're looking for. And if you're a huge enough company, you can say, oh, I'll just borrow the money from investors. I'll get investors to buy my bonds. And that's what MIT did here. It says MIT sells $500 million in taxable century bonds. Earlier today, MIT sold $500 million in Series E taxable bonds maturing in 2116 and yielding 3.885%. Let's call it 4%. Okay, so first comment here is they could say sells bonds, MIT sold bonds. A different way of putting this for the accountant is they borrowed money. Like, that's what we think they did, and that's what they did do. They borrowed $500 million, and they did it in the form of bonds. Now, bonds are notes payable, but rather than just borrowing like $500 million in a chunk from the bank, going debit, cash, credit, bank loan payable, $500 million, which a big company like MIT could do, they went to investors, and they sold the bonds. They don't sell $500 million at a time, they sell them $1,000 at a time. So they borrowed $1,000 pieces. And if you look at it, $500 million, that means they sold 500,000 $1,000 notes payable. That's essentially what happened. 500,000 different people, or maybe some people bought more than one, probably lots of people did, but they sold 500,000 notes payable for $1,000 each, hence borrowing $500 million. Now, a few thoughts here. What makes bonds unique or unusual compared to notes payable is a lot of the notes payable we've looked at, the company borrows the money, a few months go by, they pay back all the money. Bonds tend to be long-term, and they can often be very long-term. You can see this one matures in 2116. So MIT borrows your money today, let's say you give them $1 million, so you buy 1,000 of these bonds. You give MIT $1 million today, and they pay you back with interest in 2116. That's crazy, right? You're likely to be dead by then. I don't mean to be so morbid, but you're very likely to be dead by then. So why would you ever lend them the money? And a feature of bonds in our class is they're going to pay interest semi-annually. Every 6 months, they're going to pay interest. So you've lent them $1 million. They're paying, let's just say, 4% interest. So that's $40,000 per year, and it's every 6 months. So divide by 2, it's $20,000 every 6 months. And now you start to see why this might be an attractive investment. You are a retiree, you've saved your whole life, you have $1 million ready to invest in your retirement. You could, of course, buy stocks, but then you have to worry about, like, you know, if you buy Apple stock, well, what happens if there's drama between the US and China? Then your Apple stock goes down, or, you know, the president of the US does something crazy, or the president of some other country does something crazy and the stock market just tanks. You got to worry about that. If you buy MIT bonds, all you have to say is, MIT still in business? If the answer is yes, well, then I'm going to get 20 grand every 6 months for the rest of my life and into, you know, my grandchildren's lives, right? And so it's a nice investment if you want something stable. And so that's what the attractiveness of this is. But it also creates accounting challenges for us, because there's obviously these every 6 months, there's interest payments. Now, if it was just the interest payments, there wouldn't be a chapter on this. What makes bonds even more interesting and challenging for us accountants is that there's a market for bonds. So MIT offers 4%. Maybe that's attractive to investors. Maybe that's unattractive to investors. But investors will rarely pay $1,000. They'll often pay a little extra. If there's a lot of demand for the bond, they might have to pay a little more to get in. Or if it's unattractive, they might actually get the bond at a discounted price. So what happens is MIT doesn't just go to investors and say, hey, investors, give us your money. MIT will go to an investment bank like Goldman Sachs and say, hey, we'd like to borrow $500 million. Goldman Sachs will talk to its, you know, it has high-end investors. It'll talk to its high-end investors and, you know, pension funds and these types of investment companies. And Goldman Sachs will come back and they'll say, okay, well, we're thinking, you know, 4%. Some negotiation will go back and forth. And in any event, Goldman Sachs tries to find the market of investors for this. Now, at the same time, MIT doesn't exist in a black hole. There's other organizations borrowing money. This is Harvard's patch. Harvard might be borrowing money at the same time. The U.S. government is borrowing money, and the U.S. government might raise or lower their interest rate to really mess with MIT. But let's say MIT is trying to borrow at 4%, and Harvard at a similar time is borrowing at 8%, and maybe the US government is at 3% or some other number, right? And so investors will be choosing between these, and they'll go, okay, I think the Harvard one is like, oh, a great investment, and I think the MIT one is a mediocre investment, right? They'll make their own judgment about how they fit in. And let's just say the investor's sort of default position would be these types of organizations, this type of debt, the market price should be, or the market rate should be around, let's just call it 6%, right in the middle. So the market for this type of bond is 6%. Harvard's offering 8, MIT's offering 4. Well, what's going to happen? All the investors are going to go, oh my gosh, I can't get enough Harvard bonds, right? They're going to love that. And nobody's going to want to buy the MIT bond, because they'll just invest in other things. They'll invest in U.S. government bonds. They'll invest in municipal bonds. They'll find other businesses or organizations to invest in, and they'll go, we don't want this. Not interested, right? That number sucks. And so Goldman Sachs will, with MIT, reduce the price. They'll go, okay, you know, we're going to try to sell $1,000 bond, but you only have to pay $950. We'll give you a discount on it. Oh, nobody wants it there, $925. They'll find the number, right? They'll find the market price. The market will find the price. And so let's just say the bond sells and people get interested at $920, meaning there's an $80 discount. Well, this $80 discount is the challenge of the chapter. And let's say the Harvard one sells for $1,050, meaning there's a $50 premium, say. Now, it could be, a different number. I'm making the numbers up off the top of my head. Accounting for these discounts and accounting for these premiums are the challenge. And here's why. MIT wanted to borrow $1,000. They only got $920, but they were looking for $1,000. And at the end of the bond's term, they got to pay back the full $1,000. They don't get to say, "Oh, I only pay back $920 because you only gave me $920 today." No, they got to pay back the full $1,000. Not only that, but they're making 4% interest payments on the $1,000. So every year, $40, or every 6 months, $20 per $1,000 borrowed. But this extra $80, they borrow $920, you got to pay back $1,000. That's extra interest. And that's how you should be thinking about this. So when the company borrows and the bonds issue at a discount, they have to pay back extra interest. Well, when do I recognize, now we're in accounting mode fully, when do I recognize the interest expense? Do I recognize it all at the beginning? Do I recognize it all at the end when I pay it back? And as you might guess, we recognize it slowly over time. We're going to learn 2 ways to deal with discounts and premiums slowly over time. One is called the straight line method. That's not as recommended by US GAAP, IFRS, Canadian GAAP. They don't recommend it, but it is covered in most textbooks, so we will touch on it. And it's very straightforward. You just go, well, it's an $80 discount. How many years is this bond going to be out? You divide by the number of years, and you recognize the interest over that time period. The effective interest method is more complex, and that's the one we're going to spend a lot of time focusing on in this chapter. But the key to the chapter is companies want to borrow money. They don't always go to the banks. Big organizations can borrow money through investment bankers who find investors for their bonds. And because they're finding investors and because there's a market, they don't always pay face value. They don't always pay par value for this. Dealing with discounts, dealing with premiums, that's the challenge of bonds. I hope you're up for it. I've got so many great examples of bonds. The best way to learn it, though, is to do the examples together. Let's get started. I'm wrapping up. I've run out of words. I can't wait to get going, though. Thanks for watching. See you next video. Bye-bye. We're about to jump into problem 14.1a. To download the workbook, go to tonybell.com. It's a free, no sign-in, no sign-up PDF. Scroll down, you'll find 14.1a. You'll also find lots of other problems. Lots of ones like the one you're working on are free, but there are some members-only videos. If you're getting great value from the free stuff, I hope you'll consider a membership. Let's jump into 14.1a. Let's take a look at problem 14.1a. We're determining whether a bond is issued at discount, at a premium, or at par, and we'll discuss kind of why that happens. That's what this question illustrates. Sinker Inc. issues a bond that has a stated rate of 4%. The coupon rate is 4%, so that means they're going to pay 4% interest. It says the market rate of interest for similar companies, similar bonds, is 6.5%. So will this bond issue at a discount, at a par, or at a premium, and why? Well, if we're only offering 4, but you can just go on the market and similar companies to ours are getting or offering 6.5% interest, nobody's going to want to buy our bond. Our bond will have to get priced down for anyone to buy it because our interest is just not competitive. This bond will issue at a discount. And again, the reason why is because the coupon rate is lower than the market rate. Let's move on to Slider Inc. Slider Inc. issues a bond that has a coupon rate of 4, so same coupon, 4, but the market rate for similar companies to Slider is 3.5%. Okay, well in this case, we're offering 4. Companies similar to ours are only offering 3.5. Will we issue at a discount, par, or a premium? We're going to issue at a premium. Why? Because our coupon rate is higher than the market rate. Now, here's the $1 million piece of the question. Let's assume these two companies exist in the same universe. So Sinker's offering 4%, Slider's offering 4%. All the bonds have the exact same time frame, exact same terms, features. Everything about the bond is the same. Is it possible for one of them to issue at a discount and another to issue at a premium? That's what this question is getting at. It says, why would one issue at a discount and the other at a premium? What does the difference in market rates tell us about how the market perceives each company? And that kind of gives it away. Yes, it's very possible for this to happen. Even though it's like 4% interest rate on the bonds are basically identical, and it tells you what the market thinks of the underlying company. So if a big American retailer like JCPenney offers a bond, well, retail stores like JCPenney are thought of as fairly risky at this stage. People are doing more and more online shopping. JCPenney is a less attractive investment than MIT, right? The famous university. So when MIT tries to borrow money, if they say, hey, we'll pay 4%, people in the market go, oh, that's actually a pretty good rate for MIT. If JCPenney offers 4%, they go, no, retailers need to offer like 9 or 10% because they're riskier. Right? And so as a consequence, it's very possible for two companies on the exact same day to issue bonds that are identical, and one to get a premium and one to get a discount. So yes, that's possible. And it just speaks to what the market thinks of the relative risk of that investment. Is it possible in the real world for two companies to issue 4% bonds on the same day at the same time and have one issue at a discount and the other a premium? Yes, absolutely, for the reasons I've said. It's downstream of what the market thinks of the relative risk of the company. And if the features of the bonds are different, that can also, if the bond is one is 5 years, one is 12 years, well, maybe there's a different discount that the market would put on it, but here it's the same date, same time with identical terms. So it really is what the market thinks of the relative riskiness of your company. Even if you offer the same interest rate, one might get a discount, one might get a premium, even in real life. One last thing in real life, I put a premium on likes. Well, YouTube puts a premium on likes and subscribe, so I hope you'll consider dropping one on this video if it helped. Thanks for watching. Bye-bye. Let's jump into problem 14.2a on bond quotes. On January 1st, 2031, Never Company issues a 10-year, 5% bond with a $1 million face value at a time when the market rate of interest, aka yield to maturity, is 6%. We're offering 5%. The market for similar companies to ours is 6%. Therefore, our bond is not going to be attractive. Our bond will issue at a discount. If the stated rate, the bond rate, the coupon rate is 5, the market rate is 6, this bond is a discount bond. The bond will make semi-annual payments. The bond quote is 92.561. That means we're getting 92.56% of the money that we've asked for. We've asked for $1 million. We'll get 92.5% of that. Will the bond be issued at a discount or a premium? Discount, absolutely. If this number is below 100, it's a discount bond. But even if I didn't know the number, I could figure out it's a discount by the fact that our stated rate is 5 and the market rate is 6. How much cash are we going to get? Well, we're getting 92.56% of the cash we asked for, 0.92561 times $1 million means we're getting $925,610. How big is the, well, in this case, discount? Well, it's about $75,000, right? It's 75 grand less than what we asked for. $1 million minus 925,610. The discount is $74,390. And there we go. We have answered the question. A, B, and C in the bag. If you feel like leaving now, like and sub on your way out of here. But some of you may want to stick around for the bonus, which will take a little longer. You'll see the runtime of this video is a lot longer than 2 minutes, what we're at right now. Just a quick cough. The bonus says, show how we came up with that 92.561. So pretend we didn't know that. How would I have calculated that? And this is math of finance. So I'm going to solve this 3 ways. We'll do it by hand. We'll do it in a calculator. I won't do it in Excel. I'm going to do it in Google Sheets. I don't have Excel installed on this computer, but it's very much the same thing, just spreadsheet software. So let's solve it by hand, though, assuming we don't have access to a financial calculator. We don't have access to Excel. Well, there's 2 cash flows we're worried about. There's the lump sum. So remember how a bond works. We're borrowing $1 million. We're going to make regular interest payments, and then we're going to pay back the $1 million at the end. So we've got the present value of the $1 million at the end. So it's this one, present value of a lump sum. So it's $1 million at the end that we pay back after how many periods here? It's a 10-year bond, and bonds in our class, everything's semi-annual. So it's 20 semi-annual periods. So 1 plus the interest rate to the power of 10. Now, the I is the yield to maturity, that market rate, 6% in this case. And remember, that's an annual rate. Whenever you're quoted a rate, it's annual. We got to convert it to semi-annual, which just means divide by 2. So it's 1.03 to the power of 20. Again, 20 semi-annual periods. It's 10 years, but it's semi-annual, so times 2, that's 20 periods. So anyway, there's the formula. 1 million divided by 1.03 to the 20th power. 1.03 x to the y 20, 1.80, and then we go 1 million divided by that. To do that, you go 1 over x, just this thing here, 1 over x, and then multiply by a million. So 553,676, 553,676. That's the value of $1 million 10 years from now. Again, compounded semi-annually. What about the payments? Well, we've promised to pay 5%. So $1 million times 0.05 is 50 grand a year. But remember, we're doing 6-month payments, so it's 25 grand every 6 months. So that's our payment amount. Let's do it this way. 25,000 times 1 minus 1 over 1 plus I to the n, which is 1.03 to the 20th power, all divided by 0.03 are I. So 1.03 to the 20th power, let me do it this way, 1.03, I go x to the y 20, I get 1.80, 1 over that, so there's a 1 over x button, 1 over x. 1 minus that, I put this in as a negative number, plus 1. I'm at 0.44 as my numerator. I divide by 0.03. I get 14.8, almost 14.9. I multiply by 25,000. And I get 371,937. 371,937. And now I just got to add these two to get the present value of the bond. 553,676 plus 371,937. This bond is 925,613. And let's see if that matches. So I had 925,610, and the reason is there's a rounding thing going on here. Now, in terms of the bond quote, we divide that number by the face value of the bond. And remember, the bond quote is a percentage. So divide that by 1 million. And we get equals 0.925613, and we state it this way, 92.5613, and you can see that does in fact match. And the reason we're off a little bit in terms of dollar amount is because we've gone to one more decimal place here, and that's it. So yes, we do have the right answer. Yes, we have solved it. Show how the bond quote was calculated. We just showed it. If I have a financial calculator, I can do this a lot quicker. Here's my BA2 Plus. I'll use some calculator inputs. The N is the number of periods, 20. The IY, let's see. The IY is our market rate of interest, which is per period is 3%. PV is the present value, which we're solving for. PMT is the amount of the payment, which we said was $25,000. FV is the amount, and I'll put that in as a negative because I am making these payments. The FV is the amount we got to pay back at the end, which is face value of the bond. And begin for these things is always off or not applicable. Begin means, did you make the payment? Annuity, did you pay in advance or do you pay at the end of the 6 months? Well, we don't make our first interest payment today. We make it 6 months from now. So that means begin is off. Begin is unusual to have on. Okay, so let's go ahead and punch these numbers in. Let me go actually second function, clear. 20 goes in as my N. On your screen, it probably looks fine. On my screen, it's really small. I have to really lean in to see where I'm clicking. My calculator app is just teeny tiny. 3 goes in as IY. Don't know my PV. 25,000 negative goes in as PMT. 1 million negative goes in as FV. And then I compute PV, 925,613, 925,613. The number matches. I can get the percentage, 92.561, to match what's in the question. So yes, we solved it with the calculator. The Excel input's pretty much the same. And again, I'm going to be using, what's it called? Google Sheets, but it's the same difference as Excel. It's just a computerized spreadsheet program. Number of periods, 20. The rate, 3. The PV, we don't know. PMT, 25 thou. FV, 1,000,000. And the type, is it at the beginning or end of period? It's at the end of period, so it's end, but, not applicable. Don't worry about it. The default is end, so you don't have to change anything. So we bring down our spreadsheet program, and I've got it zoomed way in, and I go equals PV. And then it just tells you, like, okay, rate. Well, we know our rate is 3%, comma. Number of periods. Number of periods is 20, comma. Payment amount, 25,000. I put this in as negative, 25 thou, comma. Future value. Oops, I missed a zero there. It's 1,000,000. Sorry, missed a zero when I put this in, but of course it's the same. Negative 1,000,000, of course. And then I can close. It says end or beginning. I mean, it's end, but that's the default. I wonder if that works. If I just type end, usually it's 0 or 1. See what happens. There we go. And you can just leave it blank, though. You don't even have to put 0 or 1. 925,612.63. 925,613. Yes, indeed. We knew it was going to give the same answer because the math is the math, and we've solved the math. Okay, we made it to the end of the video. If you made it this far, thanks for watching. Hit me with a thumb or a sub, and I'll see you in the next video. Bye for now. Let's jump into problem 14.3a, bonds issued at a discount, and we are doing the effective interest method. That's good news because that's the one US GAAP, Canadian ASPE, and IFRS all recommend. If you're looking for the straight line method, that's 14.7a and 14.8. So let's jump into the effective interest method. On February 28th, 2031, Tiger Inc. issues a $1 million of 10-year 9% bonds. So our bond is promising to pay 9% interest. Annual interest. The market rate of interest is 10%. Okay, so we're promising 9%. The market thinks 10% is the right number for us. Therefore, nobody's going to buy our bond at 9%. They're going to take a discount. Because the market rate is higher than the bond rate, the bonds issue at a discount. The bond quote is 93.769. That means we asked for $1 million. We got 93.769% of the money, and $1 million times 0.93769 is $937,000. So I always start with a journal entry in these questions. So Feb 28th, 2031, let's debit cash, 93.769. We're going to credit bonds payable for the full $1 million. And the difference goes to an account called discount, or discount on bonds payable, to make this balance. Now, some IFRS related textbooks will actually just credit the bond payable for 937,690. They do it the net method. It's not very different from what we're doing. I think even if you're doing the net method, you can still follow along, and I'll comment as we go as to what's going to be different. So if you're doing the net method, debit cash, credit bonds payable 937,690, but we're going to do debit discount here for the difference. And the difference, well, let's put this in as negative, plus $1 million, 62,310 is the amount of our discount. Okay, so what the heck is a discount, right? Okay, we issue the bond, we go, okay, we're not paying a competitive interest rate in the market. You know, the people buying bonds won't pay full price. They pay a discounted amount. They give us $937,000. We got to pay them back $1 million at the end of this 10 years. This $62,000 is extra interest. That's all this is. This is just extra interest. If I borrow $90 from you and pay you back $100 a year from now, well, the $10 is interest. Well, this $62,000, this is interest. The question is, when do I recognize the interest expense? And the effective interest rate method says follow the table to recognize your interest expense. Straight line just says, well, it's 10 years, 10% per year. Divide by 10 and on you go. The effective interest method says, okay, we're going to recognize it slowly over time according to the results of this table. So I'll show you how to prepare the table. In fact, why don't we do it? So I'll just read on. The bonds pay interest semi-annually on February 28th and August 31st. In our class, in this chapter, it's everything semi-annual. And that means twice a year. The company's fiscal year end is September 30th. Prepare the bond amortization schedule for the issuance and the first two interest periods. Okay, the issuance was Feb 28th, 2031, and on the issuance date, there's no payment, there's no interest expense, there's no discount to be amortized, but there is a discount balance. We have a discount balance of $62,310, just looking at my journal entry, and the bond carrying amount, you can see it's discount, so I'll scratch out premium. It's the number you put in here is the face value of your bond, so it's $1 million minus whatever's in column E, $1 million minus 62,000. It's actually the amount of cash you got, $937,690. That's what goes in here. And if you do the math, $1 million minus 62,310 equals 937,690. Okay, this table will just cover 6-month periods. So February 28th, 6 months later is August 31st. 6 months later is February 28th. And 6 months later, or 2032, and 6 months later is August 31st, 2032, and so on. And it would go for 10 years. So that's 20 lines, right? These are 6-month periods. So it's a long thing. This is, done more quickly in Excel, but I think learning it, I learn better by hand, and I certainly explain better doing it by hand. The interest payment amount is the amount we've promised to pay. We've promised to pay 9%, but remember, that's an annual interest rate. We want to convert it to semi-annual, just divide by 2. So it's 4.5% that we're paying every 6 months. The interest expense is based on the market rate, the yield to maturity, and again, it's 10%, but we divide by 2 to get semi-annual, it's 5%. We've got discount amortization, not premium amortization, and we got a discount account balance, not a premium account balance. Okay, at that point, the table is set. These things, the challenge here is setting the table. Once you sort of start filling it in, it's not too bad. Interest payment, it says 4.5% of the maturity value. Our maturity value is $1 million. 4.5% of $1 million is $45,000. 5%, our interest expense, is 5% of the preceding bond carrying amount. The preceding bond carrying amount, $937,690. I'm going to take 5% of that. 4,688, I'll round here, 5. 4,688.5. Be careful about rounding. Your professor might want you to go to the penny. They might want you to go to the dollar. Read the question and sort of read the room in terms of what you're supposed to do. C minus B, 46,885 minus 45,000 is 1,885. Discount account balance is E minus D, 62 minus 1885, 62,310 minus 1,885. 64,25. And the last one, this is when people screw up. They go 937 minus 60. No. It's $1 million minus 60. $1 million minus 64,25. 939,575. And if we're doing it right, sorry, that's a little messy. 939,575. If we're doing it right, this discount number is getting smaller and smaller and smaller. The idea is after 10 years, after 20 lines of this, 20 rows of this, it's going to be 0. And the bond carrying amount is getting closer and closer to $1 million, closer and closer to that face value number, and it is. So we're on the right track. If one of those is going in the wrong direction, you know you did something wrong. Let's continue. Our second interest payment is $45,000 because it's 4.5% of the maturity value, and that number doesn't change. The investor who buys our bond wants that steady eddy cash flow. We as the borrower want the steady eddy cash outflow, right? We want certainty around our borrowing costs, and that's what a bond offers. Interest expense, 5% of the preceding bond carrying amount, 5% of 939,575 is 46,979. The difference here is 1,979. 60,425 minus 1979. 60,425 minus 1,979. 58,466. No, 446. And last but not least, we go $1 million minus 58,446 And we get 941,554. Okay. So it said prepare a bond amortization schedule for the issuance. That was the first line. And the first two interest periods, those are the next two. There's an extra line there. If you want to keep going, you can. Now it says do journal entries for the issuance of the bond. That's that one. And that's covered by this first line, right? This line is the issuance of the bond. And you can see the numbers are matching my journal entry. The next line is, well, the next journal entry is for August 31st. And look at that. We got an August 31st line on our table. If you have the line on your table, it's an easy journal entry. And this is an easy journal entry. Why is it an easy journal entry? We just pull the numbers off the table. So the table is the hard part. But once you get there, the journal entry should be easier. Although I will say, a lot of times when I get students to practice this for my class, they get really good at the table and then they forget the journal entry. So you got to know how to do both. Anyway, because it's just a number from the table, you just go, okay, my interest payment is $45,000, credit cash $45,000. Interest expense, $46,885. Well, of course, that's a debit. Interest expense, $46,885. And discount amortization, our discount was a debit. I'm trying to make it go to zero. So I credit the discount to make it go down, $18,885. Now, if you were doing the net method at this moment, you wouldn't credit the discount, you would credit the bond payable. So remember, you would have gone debit cash, credit bonds payable, $937, and now you credit bond payable for $18,885. That's the only difference here. Other than that, it's the same. Okay, what is happening though? So our interest, so we pay $45,000. But we recognize $46,000 in interest, $46,885. Why is my interest expense higher than what I pay in interest? And the answer here is the discount. I'm recognizing, I said, well, there's $62,000 of extra interest kind of built into this by the nature that I only got $137,000 of cash. I got to pay back $1 million. There's $62,000 of extra interest. I recognize it a little bit at a time over the life of the note. And so in this one, 6 months, the first 6 months, I recognize $18,885 of extra interest. So I pay $45,000. But I recognize $46,000 of interest because of the discount. If we have a premium, it works the opposite, where we recognize less interest than what we pay over time. But we'll deal with that in 14.4a. Let's continue. So it was August 31st, 2031. The next relevant date is our fiscal year end, which is September 30th, 2031. Kind of interesting. It's not a December 31st year end. That happens all the time. And that is 1 month later, right? So when we want to continue in the question, we actually want to look on to the next line. And remember, that line covers from August to February, August 31st to February. So don't count August. It covers September, October, November, December, and then January, February of 2032. And we're interested from August to September. We're interested in just the month of September, which in terms of what's going on this line, I might have drawn the line in the wrong spot. What's going on in this line? It's just 1 month. It's 1/6, right? Every line on this is 6 months. It's semi-annual chart, and this is 1/6 of what's going on the line. So let's deal with it. Our interest expense is the interest expense here, 46979, but 1/6 of it, 46979 times 1 divided by 6, 7830. So our interest expense, 7830. Our discount amortization, 1979, again times 1/6, 330. So I'm going to credit discount 330. And remember, our discount started as a debit. We're amortizing, so we're making it smaller, so we're crediting it each time. And then we credit not cash, we credit interest payable. And the reason we're crediting interest payable here is because it's not a payment date, right? We pay only on February and August. Well, it's not February or August, it's September. So we're not making a payment today. It's just interest that's accruing. And $45,000 would be our payment times 1/6. $7,500 is the first month that's payable. Okay, one more entry to do, and that's on February 28th, 2032. And what's February 28th, 2032? Well, it covers the months from September 30th to February. So October, November, December, January, February. It's 5 months. And look at that. We did 1/6. Well, guess what? Now we got to do the other 5/6. So let's get after it. Same line. We're just doing the rest of it. So 46,979 times 5 divided by 6. 39149 is our interest expense. 39149. Our discount is 1979 times 5/6, pardon me, 1979 times 5/6, 1649. That's the credit to discount. And now we credit cash, but we credit cash for the full amount because we pay $45,000 every 6 months. So we're going to have to pay these guys $45,000. And what we find is our journal entry doesn't balance. I have 45,000 plus 1,600, 46,649, just the sum of those two, minus 39149. I'm off by $7,500. I'm missing a debit of $7,500 to make this thing balance, right? Debits don't equal credits otherwise. Well, what's the missing debit? Hopefully you're yelling at your screen. Hey, it's the interest payable because, of course, I paid the interest, so it's no longer payable. I got to get rid of my interest payable, and that's what I've done. So at that moment, I think we've done a wonderful job. I'm busy patting myself on the back. If you got to the end and you feel like, yeah, I feel like I can do this, I hope you'll pat me on the back too. Hit that like, hit that sub button. And if you're looking for the straight line method, that's 14.7a. That's in the appendix to the chapter. Thanks for watching. See you in the next video. Bye for now. Let's jump into problem 14.5a. We are retiring a bond early. We're going to issue a bond and pay some interest on it and then decide, you know what, I want to just pay off the debt early. And some bonds have that feature. They can, the company can retire the bond early, and this bond has that feature. So on March 31st, 2031, May Company issues $1 million of 3-year 6% bonds. So we are going to pay 6%. Market rate of interest is 7%. The yield to maturity is 7%. If I'm paying 6 and the market for a company like me is 7, that means we're going to issue at a discount. And sure enough, the bond quote is 97.336. That's lower than 100%. So that means we're getting less money than what we asked for. We're getting 97.336% of what we asked for. 0.97336 times $1 million means we got $973,360 cash. So let's do that first journal entry. I always like to do that. March 31st, 2031, debit cash, 973,360. Of course, we credit bonds payable. Now, if you're doing it the net way, you just credit bonds payable for 973,360. We'll do it the way where we have a separate premium or discount account. So we credit bonds payable for $1 million. And we will have a discount here. And the discount is the difference between the two. It's 26,640. And that is discount on bonds payable. Okay, so there's our opening entry. It says the bonds pay interest semi-annually, September and March. Company's fiscal year end is December 31st. Then, this is the new information here. On September 30th, after the first payment, the company calls the bonds at 102. Now, you notice we issued at 97. We call them at 102. Generally speaking, you're going to have to call them back at a higher price. To have that feature, nobody's going to buy the bond if you can call it back for less than they paid for it. So you generally have to pay a little extra to recall the bond. And that's what happens, and we retire the bonds. So it says first, prepare a bond amortization schedule for the issuance in the first period. We'll have to do that, and then we'll do the journal entries to pay the interest and retire the bond. So let's set this table up. Interest payment is, of course, based on what we promised to pay, 6%. We divide that by 2, 3%, right, semi-annual. The yield to maturity is 7%. And we divide that one by 2 also, we get 3.5. It is a discount, not a premium. And this one, you put in the face value of the bond, $1 million minus E for a discount. So the first date is the date we issued the bond, March 31st, 2031. Our discount account balance, 26,640. $1 million minus E, $1 million minus 26,640. The amount of cash we received on issuing the bond, 973,360. Then 6 months go by. On September 30th, 2031, we make an interest payment. 3% of the maturity value, 3% of $1 million is $30,000. The interest expense, 3.5% of the preceding bond carrying amount, 3.5% of 973,360. 973,360 times 0.035, 3.5%, 34068. 34068. C minus B, 34,000 minus 30,000 is 4068. E minus D, 26 minus 4, 26,640 minus 4068 is 22,572. And last, $1 million minus 22,572 is 977,428. Okay, so we're expecting again this discount account balance to get smaller and smaller and smaller, the bond carrying amount to get closer and closer to the face value, closer and closer to $1 million. Certainly that is happening here. We've got to do the journal entries for the issuance of the bond. That's done. The first interest payment, September 30th. And so, okay, what does that payment look like? It's just this line. So credit cash for $30,000. Debit interest expense for $34,068. And the 4068 goes to discount amortization. And you can see it was started as a debit. We want to whittle that down to 0. So we credit discount. As with the other questions, if you're doing this the net method, you just credit bonds payable here. Okay, so we've done the September 30th entry for the first payment. Now we got to get rid of the debt. Well, what does that look like? We extinguish the debt at 102. So we pay back 102% of the face value of the bonds to get rid of it. And the idea here, again, for the investor, right? We're the borrower, but for the person who lend us the money, if we want to get rid of it early, we got to almost pay a little bit of a penalty to get rid of it early, because they bought the bond. They thought they were going to get interest cash flows for 3 years. They're not, because we're paying early. Realistically, these early repayments don't kick in until after a year or two, but we're doing it early. So on September 30th, 2031, we credit cash for 102% of the face value, which is 1020000. So it's $1 million. $1 million times 1.02, 102%, and that's what we credit cash for. We get rid of the bond payable, debit bond payable for $1 million. We get rid of the discount. Now the discount was a debit of 26,640. We credited 4068, so it's sitting at 22,572. We got to get rid of that discount, 22,572. Credit it to get rid of it. It was a debit account sitting in a debit. And then we're not balanced, right? We're off by 20 plus 22. We're off by 42,572. This thing doesn't balance. It's missing a debit. Now, when you extinguish debt, you can experience losses and gains. Not loss on sale, gain on sale, like selling an asset. It's loss on extinguishment or loss on, retirement of the debt. So I'm going to call this loss on extinguishment. Generally speaking, it's going to be a loss. And the reason is, you kind of have to overpay to get rid of the debt. Like that's they loaned you the money. They want to get those cash flows over years. You're trying to pay back early. You pay a little extra to do that. So the loss on extinguishment, let me have a little cough, is 42,572. And there we have it. I think we've done it. We've solved problem 14.5a. We issued some debt, we paid some interest, and then we extinguished the debt early. That's it for 14.5a. As always, if these videos are helping you, I hope you'll help me by hitting one of those buttons. Thanks for watching. See you in the next video. Bye-bye. Let's take a look at problem 14.6a. We're going to pay back our bonds early, and that payment is going to happen between interest dates. So this is really a bit of a kitchen sink problem, a challenging problem, but we are up for it. Let's get started. On January 31st, 2031, Bob Company issues $100,000 of 3-year 5% bonds. The market rate of interest is 4. Okay, so we're offering 5%. The market rate is 4%. These are going to be attractive bonds. They are going to fetch a premium, and sure enough, they do. 102.801 is our bond quote. And sorry, I'm getting a call from spam. I always like getting calls from spam. 102.801 is the bond quote. And what I'm going to say here is you should be able to recalculate this yourself, right? The present value of the $100,000 lump sum in 3 years plus the interest cash flows. You should be able to figure out how we got that 102.801, but that's not asked for here. What is asked for, though, is the journal entry on this January 31st issuance date. So we got cash of 102.801, and that's just $100,000 times the bond quote stated as a percentage, right? $100,000 times 102.80 or 1. Let me do the math in my calculator. 1.02801. There you go. That's how we got there. And this is on January 31st, 2031. The credit here is to bonds payable. Now, if you're doing this the net method, you just credit bonds payable for 102.801. I like to split out a premium or a discount account. Here we got a premium. So we're going to credit our bonds payable for 100, and we're going to credit premium for 2801. Okay, so there we've set the table. It notes that the bonds pay interest semi-annually, as every bond in this course does, on this chapter anyway, on January 31st and July 31st, and the company's fiscal year end is December 31st. On August 31st, 2031, the company calls and extinguishes the debt at 104. You'll notice that's higher than the premium that people paid, and the reason is because if you want to repay debt early, your investors will penalize you for it. They'll say, okay, you can repay the debt early, but you got to give us a little extra money. So that's us giving them a little extra to get out of this debt early. It asks us to prepare a bond amortization schedule, discount or premium amortization schedule, and that's what we're going to do here, a premium, I suppose. So we'll start with our first item, January 31st, 2031. We have a premium balance of 2801, just looking at the journal entry, and our bond carrying amount is the face value of the bond plus the premium. It's how much money we got, 102.801. So there's no discount here. I'm just going to scratch out the discount references. We know our interest expense is based on the market rate of interest, 4%, and we divide by 2 because this is a semi-annual table. And our payment is based on our promised amount, which was 5%. And again, we divide by 2 to get 2.5%. Let's fill in the rest of the table. That's January. The next date is July. And then on this table, I just want interest dates. And you might say, well, the bonds retired before then, but when we first made the table, we weren't planning to retire the bond early. So we would have had this table for the full 3 years. So let's just, oops, I threw my pen. Hopefully it still works. Let's make the table as if we didn't know we were retiring the debt early, which we wouldn't know. Quick cough. Okay, so our interest payment, 2.5% of the maturity value, 2.5% of $100,000 is $2,500. Interest expense, 2% of the preceding bond carrying amount, 2% of 102.801, 2056. We'll round to the nearest dollar here. 2,500 minus 2056, B minus C equals 444. It's got to be lucky. Discount account balance, 2801 minus 444. 444. I don't plan any of these things. I always like when a number comes up like that. It feels serendipitous. It feels like my lucky day. Hopefully it's my lucky day. Premium, 100,000 plus E. Hopefully it's your lucky day. 102,357. Well, really, hopefully it's my lucky day. And if you have a lucky day, okay, that's okay. I'll allow it, but I'm really hoping for myself. Okay, next one. Interest payment, $2,500. Interest expense, 2% of the preceding bond carrying amount, 0.02 times 102,357, 2047. 2,500 minus 2047. 453. Okay, we didn't get any repeating digits like the last one. The luck seems to have run out. 2357 minus 453, 1904. And 100,000 plus 1904, 101,904. Is that right? Yeah. Okay. So we've prepared the bond amortization table. We've done the journal entry for the issuance of the bond. Now we got to do that first interest payment, which is just this line. Oh, that was weird. My pen didn't work for a second there. I threw it earlier. Maybe it's an unlucky day. July, seems like it's working now. 31st, is my recording working? Yes. 2031. Sometimes things go south on the tech side of this YouTube channel. It's drives me insane sometimes. Okay, we got to do everything on this line. So interest payment 2,500, credit cash 2,500. Interest expense, 2056. We're going to debit interest expense. Of course, that's a debit. 2056. And we've got premium amortization of 444. Well, the premium was a credit. We want to reduce it down to 0. So, of course, we debit our premium by 444. And there is our first interest payment. The extinguishment of the debt here is the hard part, right? Everything up to here we've kind of seen before and done before. Extinguishing the debt is the hard part, and we have to accrue interest up to August 31st, right? Because we also have to pay any unpaid interest up to that date. So August 31st, 2031, we want to do an interest journal entry. And it's based on, I got a cough again. Excuse me, my goodness. It's based on this line, and we say, well, between July and August is 1 month. So we take all the information on this line. We're just going to take a sixth of it to get us up to from July to August. So it's, again, let me highlight the line for my own purpose so I don't lose sight of where we are. And we're just going to take a sixth of it. So our interest payment is not 2,500. It's 2,500 times 1/6, or divided by 6, 417. And here, normally we're crediting interest payable, but because we're extinguishing the debt, we're paying out the interest. We can just credit cash. You could credit interest payable and then in a separate entry, credit cash, like debit interest payable, credit cash for 417. I just do it now. Our interest expense, 2047 times 1/6 is 341. And the premium amortization, 453 times 1/6, 75.5. I'm going to call it 76. And that is a debit to our premium. Okay, so now our debt is up to date. Everything's up to speed. And now we retire the debt for 104. So on August 31st, 2031, we're going to credit cash for 104% of the face value, which is $104,000. We get rid of our bond payable, or bonds payable, which was $100,000. So debit it to get rid of it, of course. And we got to get rid of whatever's left in the premium. Our premium was $2,801, but I reduced it by $444, and now I've just reduced it by $76. So our premium sitting at $2,281. It's a credit account, so I debit it to get rid of it. $2,281, and now my journal entry doesn't balance. That's everything, right? I got rid of the bond, I paid to get rid of it, and I'm off. Generally, I'm going to be missing a debit here because what happens is when you retire debt, you will have a loss or a gain often on the extinguishment of debt. And most often it's a loss because you got to pay a little extra to do it. So, it's almost like a penalty for early retirement. I've actually retired some debt early in just my real life. And yeah, I had to pay a little bonus penalty because they want to get their interest. So in any event, we have $104,000 in credits, we have 102,281. Just in debits, just 100 plus 2,281. So I'm off by 1719. I'm missing a debit of 1,719. If we're missing a credit, and it is possible we could gain on extinguishing debt, it's unusual. It's possible, but unusual. More often than not, you will have a loss on extinguishment of debt, which I'll just call a loss on extinguishment. What a word, extinguishment. It's a word I've never used outside of debt, but there we go. We've done it. We've solved 14.6a. If you made it to the end, thank you so much for watching. Thanks for being here, and I'll see you in the next video. Bye for now. Let's jump into problem 14.8a, a bond issued at a premium. This time we're doing the straight line method. So the straight line method is discouraged under US GAAP and Canadian ASPE, and it's not allowed at all under IFRS. So I like it less because the standard setters have said we prefer effective interest, but some textbooks do use the straight line method. So I want to show you how to do the straight line method. It's easier than the effective interest method. Let's jump into it. So this is a repeat of problem 14.4a, but that one we did effective interest. This time we're going to do the same problem, straight line. On April 30th, 2031, Ryan issues $10 million of 10-year 7% bonds. Market rate of interest is 6. So my rate is 7. Market thinks it should be 6. Therefore, this is going to issue at a premium, right? My rate's higher than the market. Because the market rate is lower than the bond rate, the bonds issue at a premium. The quote is 107.439, means we got 107% of what we asked for. 1.07439, 107% converts that as just a number. And we asked for $10 million, so we got a premium of $743,000. That is extra money we got that reduces our interest cost over time. We got an extra $743,000. So the journal entry here on April 30th is the same whether we were doing straight line or effective interest. We're going to debit cash of $10743,900. We're going to credit bonds payable, $10 million. And we're going to credit premium, $743,900, and that reduces our interest expense over time. Okay, so that's April 30th. It notes the bonds pay interest semi-annually, October 31st and April 30th, and the company's fiscal year end is December 31st. It asks us to prepare a bond amortization schedule for the issuance in the first 2 interest periods. So the issuance happened on April 30th, and of course we had a premium, and the premium balance was $743,900. That was our starting point, and the bond carrying amount is $10 million plus whatever's in E, $10,743,900. And if you look back to problem 14.4a, you'll see this is exactly the same starting point, but once we get into the table, you see it's a little different, and the straight line table is easier. Bottom line, it's just an easier table, and it's so easy, in fact, that a lot of times textbooks don't even have you do a table. They just say calculate the number and keep the number straight in your head. I like the table because I don't like keeping numbers straight in my head. I get confused. So this table should help for that. Okay, so let's actually complete the table. So it asks for the issuance, that's this one, and then the first 2 interest periods. So the first interest is from April 30th to October 31st, 2031. That's 6-month period. Our interest payment is based on what we promised to pay, 7%, but of course it's semi-annual, so it's 3.5% of the maturity value. 10 million times 0.035 is $350,000. Our discount premium amortization, well, it's not a discount, it's premium. It's the initial premium divided by the number of interest periods. Our initial premium was 743. Our number of interest periods, it's 10-year bond, it's 20 interest periods because it's semi-annual. So we're going to go 743,900 divided by 20. So 37195. And the idea is that's a reduction in our interest cost, but we don't want to record this $743,000 as like revenue on day one. We record it over the life of the bond, and straight line just says do it straight line over the life of the bond. Effective interest says no, there's a little bit more to it than that. Okay, so our interest expense then, B minus C, if premium, 350 minus 37,195, 312,805. And the thing that makes straight line is I actually can ignore the right two columns for now. I can do the April 30th, 2031, and I can do the rest of the bond right now because I can go, well, if my payment 3.5% of maturity is 3.5% of 10 million, it's still 350. My premium amortization, the initial premium is still 743,900. The number of periods is still 20, so it's still 37195. This is just the same number. And then B minus C, it's the same B and the same C, so it's still 312,805. And what makes it straight line is this will be the same number for the whole thing, right? So that's easier. Certainly that's easier to deal with. Our discount or our premium account balance is E minus C, 743,900 minus 37,195. 743,900 minus 37,195 is 706,705. Now this number is just going to get lower and lower. It's going to reduce by 37,195 for the next, 10 years, so 20 rows here, but it's just going to keep going down by minus 37,195 because that number doesn't change. So it makes it straight line, 669,510, and so on. 10 million plus whatever's in column E, so this is 10, 706, 705. This is 10, 669, 510. And again, we would just continue on down the page. So straight line, you can see the table. Once you sort of get that starting point, because it's straight line, it's just like the same again and again and again. Not too hard. And knowing how to use the table means we know how to do the journal entries. Let's do them. October 31st, 2031. That's this row. And it's a full 6-month period, so we're taking 6/6 of this line. We just take the whole line. Our payment is 350, so let's credit cash. 350. Our interest expense 312,805, so let's debit int expense 312,805, and let's debit the premium for 37,195. Beautiful. That's October 31st done. Now from October to April, well, there's a date in the middle, December 31st. This is a 6-month period covered in this line, November, December, January, February, March, April. So it covers those 6 months between October and April, but we are only interested in 2 months, right? 2 months later, it's December 31st, 2031. So we take this information and we take the first 2/6 of it. We've already done this line. We've already done this one. So we're on to the next one and we're taking 2/6 of that. Our interest expense, 312,805 times 2/6. 104,268. That's our interest expense, 104,268. Our debit to our premium amortization is 37,195 times 2/6, 12,398. And our credit to interest payable is 350 times 2/6. And again, I think I'm off by $1 here. I'm just going to go 116,666. I know I should round up to 7, but to make this journal entry work, we'll call it 666. When my students are off by $1, no big deal. It happens all the time in this type of question. If we went to the penny, it wouldn't be such an issue. Let's continue. So that's it. And again, we credit interest payable here on December 31st because we don't actually make any payment today, right? We're just accruing the interest for our own accounting records to say that interest belongs in 2031. We can't wait till 2032 to record the interest because it's, debt that's outstanding in 2031. Okay, let's do interest and everything up to April 30th, 2031, which is 4 months, January, February, March, April, So that's 4 months. So we're on the same line, but we're just going to take 4/6. So let's go ahead and do it. Our interest expense is 312,805 times 4/6. 208,537. 208,537. We're going to do our premium, which will be 37,195 times 4/6. 24797. We're going to credit cash, and we credit cash for the full amount because they don't know our fiscal year and they don't care. They just know they get a check for $350 every 6 months. So we got to deliver that check for $350 every 6 months. And then we look at this and we go, it doesn't balance. $350 on the debits, 208,537. And 24,797 on the credit. So I just subtracted them, and look at that, 116,666. What is that? That's my interest payable, and that's the missing debit to make this thing balance. Debit interest payable, 116,666. Now, if you had done 667, you'd be off by $1. No big deal. We've solved it though. We've solved 14.8a. What is a big deal? Is you hitting that button for me. Really helps me in the algorithm. If these videos are helping you, I hope you'll help me, and I hope you'll have a great day. Thanks for watching. See you in the next video. Bye-bye. Let's jump into module 15 of our intermediate financial accounting class. This module all about equity. We're going to learn 6 types of items here, 6 mostly transactions. We learn how companies issue shares. A big topic this chapter is buybacks, when they buy back their share and cancel the share, or when they buy back them and keep them as treasury shares. How do we account for that? Cash dividends, actually pretty simple transactions, but we'll review those. Stock dividends and stock splits are something new for the course, and I want to introduce them a little bit later in this video. And the last thing we'll learn is the statement of changes in equity, a financial statement devoted to shareholders' equity. But let's discuss stock dividends and stock splits, because I do think they're an oddball accounting transaction. And they strike me as a funny transaction. So here we've got you and me. We've each paid $50,000 for 50 shares of the company. So, we own it 50-50. I own 50 shares, you own 50 shares. And the company, after it's operated a little while, has assets of 150, liabilities of 20, and shareholders' equity of 130, meaning there's been some retained earnings here as well. The company's made some money. And we decide to declare a stock dividend, declare and pay a stock dividend of 10%. And that means all the shareholders get a nice maybe we don't have the cash flow, but we want to reward our shareholders, so we give them shares. We say, oh, you can have some extra shares. Well, to me, it's a weird transaction because I don't think it's much of a reward, but companies do this occasionally. So let's just say we reward our shareholders with 10% new shares. So I go from 50 to 55, you go from 50 to 55 shares. Now you'll notice, well, now the company has 110 shares and we each have 55 of 110. We're still 50% owners of the company. The company's assets and liabilities don't change here. Their equity accounts within equity change. We reduce the retained earnings, we increase the common shares, but overall, none of these totals change. And in fact, if you're thinking like, what's the value of the company? It hasn't changed at all. If we paid a cash dividend of $10,000, our assets go down, our equity goes down, our retained earnings goes down. In this case, assets don't move, liabilities don't move, equity doesn't move. The company is unmoved. And the same thing, even more so, if we declared a stock split. In a stock split, none of the accounts change whatsoever. So we're going to learn about the mechanics of these transactions, but I just want to say at a high level, stock dividends, and particularly large stock dividends and stock splits, they're kind of weird transactions, but we'll learn the mechanics of it this chapter. Lots of practice ahead for you. I can't wait to get started. Thanks for watching. See you in the next video. We're about to tackle problem 15.1a from my workbook. You can download the workbook from my name, TonyBell.com. Go to that website. You click the PDF, Intermediate Financial Accounting 2. No sign-ins, no sign-ups, nothing like that. And you get a free workbook with hundreds of problems. Now, lots of them, like the one we're watching now, are free, but there are plenty of members-only videos. If you're getting great value from the free stuff, I hope you'll consider a membership. All right, let's jump into the problem. Let's take a look at problem 15.1a. We're issuing common shares for cash. One of the more straightforward equity-related transactions we can have, but there still are some quirks. So the following situations are independent. On January 15th, Everstone Inc. issued 50,000 common shares for cash at $8 per share. So 50,000 times 8, that's $400,000 cash received. And it says, assume the shares are no par. This is very much the default in Canadian and international context. In the American context, I think more often in your textbooks, you're going to see par value. So it'll be a bit of a different scenario when we get to B. But certainly American companies can have no par shares. Here's how you will deal with this regardless of where you are in the world. On January 15th, 2031, you're going to be debiting cash for $400,000. And you're going to credit common shares, maybe common stock, depending on where you are, but it's the same thing. Debit cash, credit common shares for $400,000. The second scenario, exact same situation, except this time the shares have $1 par value. So what does that look like? Let me change my ink color here. Well, on January the 15th, we're going to debit cash, and we still get $400,000, but we credit common shares for their par value. And so we issued 50,000 shares, par value $1 a share, so $50,000 of common shares. What's the other $350 to make this thing balance? And the answer is it depends where you are in the world. Because this is a primarily U.S. concept, these par value shares, we're going to use the American terminology here, additional paid-in capital, or APIC. But if you're in Canada, you're going to call the excess over par value, you're going to call it contributed surplus, and if you're in an IFRS context, you're going to call this share premium. They're all talking about the same thing, though, and we have solved 15.1a. One language that's universal is likes and subscribes. No matter where you are in the world, hit the button, and I'll see you in the next video. Thanks for watching. Bye-bye. Let's jump into problem 15.2a. We're issuing common shares, and this time we have some issuance costs. What we find with issuance costs is it just reduces the amount of share capital that's out there in the world. So it's a reduction in our equity accounts. And let's jump into the problem. You'll see what we're up against. On July 1st, 2031, Novastra Inc. issued 75,000 common shares for cash at $20 a share. 75,000 shares, $20 a share. That's $1.5 million in cash we're receiving, right? We're getting the cash, we're issuing the shares. The company incurred and paid $45,000 in legal underwriting and promotional costs directly related to the share issuance. These are share issuance costs. They reduce the shareholders' equity, and we'll do that in a journal entry. Assume the shares are no par shares. That's the difference between Part A and Part B. Part B, it's going to be $2 par value. So no par shares is absolutely the default outside of the U.S. I think par value issuances tend to be the default inside the U.S., but you have to know both in any context. So let's get to our no par shares. July 1st, so this is Part A. July 1st, 2031, debit cash, credit common shares, aka common stock, for 1.5 mil. What about those issuance costs? Well, that'll be a separate entry. You can combine these. I like to do them as separate entries. It keeps it real simple in my mind. And here we're going to credit cash, of course. Our legal cost was $45,000, and it says we paid them. So credit cash to pay our legal. Now, this isn't legal expense. It just reduces our equity. We go, okay, the net proceeds on our equity was less than 1.5 million, so we got to reduce our common shares by that 45,000, and debiting equity accounts reduces them. So fairly straightforward there. Part B, exact same problem, but this time there is a par value. So what does that look like? Well, when we issue the share on July 1st, 2031, we still debit cash for the same amount, 1.5 million. We credit common shares for the par value of common shares issued. So in this case, our common shares were, $2 par value, 75,000 shares. So that's 150,000, right? 75,000 times 2. I should be able to do this in my head. I couldn't. 150. And that means this other 1,350 goes to another account. We're going to assume the American context here, in which case we use the account name additional paid in capital. My Canadian cousins who use accounting standards for private enterprise, ASPE, you're going to use contributed surplus, or if you're in an IFRS context, easy for me to say, you use share premium, but we'll just use the good old American APIC, additional paid in capital. So that's the share issuance. Well, what about the issuance cost? Well, credit cash, of course, that doesn't change here, 45,000. And then what do we debit? Do we debit common shares as we did up here? The answer is no. Our shares are still, the par value remains the same. We got $150,000 par value worth of shares. It comes out of the additional paid in capital, or if you're in Canada, contributed surplus and IFRS share premium, but we're just going to debit APIC here for 45,000 to cover those costs. And there we go. At that point, we've solved 15.2a. Thank you for watching. Bye for now. Let's jump into problem 15.3a. We're buying back and canceling, retiring a bunch of common shares. So don't confuse this with treasury stock. If you're interested in treasury stock problems, that's in the appendix to this chapter. I do have a good treasury stock problem waiting for you there. This is we're buying back the shares and canceling them, which I think is more common, honestly, than holding as treasury stock. Part 1. No par shares. So Luco Company's December 31st, 2030 balance sheet shows the following. They've got common shares, 10,000 no par shares issued and outstanding, $100,000. So that means our average issue was $10 per share, right? That's what's sort of implied by the math there, $100,000 for 10,000 shares. On May 1st, 2031, the company buys back and cancels 1,000 shares at $8 a share. Okay, when we buy back for above, as we're going to do, it goes to retained earnings. It's almost like a loss, right? You've issued something for $10 and you buy it back for $13. You're losing money on that deal. It goes to retained earnings. When we buy back and it's kind of like a gain, it goes to, in Canada, contributed surplus, in the US, additional paid in capital. And we'll look at that in our journal entries. And we'll look at that now, actually. May 1st, we buy back 1,000, and we can cancel 1,000 shares at $8 a share. Okay, let's do it. So this is part 1. And this is May 1st. My table is shaking on me right now. I don't know what's going on. I'm writing very powerfully today. Hopefully this is a powerful answer. Okay, we bought back the shares for 8 times 1,000, $8,000 cash, right? Like that's how you buy back shares. You pay $8,000 cash. We're getting rid of, though, 1,000 $10 shares, right? So it's $10,000 worth of common shares that are being canceled. How do you cancel or retire a share? You debit common shares or your share capital account here for $10,000, and then we're off by $2,000. As I said, we're kind of like on the gain side, right? We're missing a credit, almost like gain on sale, gain on repurchase. If this were on the loss side, we would debit retained earnings. Since it's on the gain side, the credit side, we don't credit retained earnings. We credit, if you're in the U.S., additional paid in capital on repurchase. In Canada, contributed surplus on repurchase. So we'll do the U.S. terminology, APIC repurchase, I'll say. And it's 2 $4,000. And there we go. We've got our May 1st item in the bag. Now on August 31st, and the reason you'll notice in these questions, I always do a sort of gain version and then a loss, and you'll see why in a second. So we repurchase and cancel 2,000 shares at $13 a share. So it's $26,000, I think. Yeah. So credit cash, $26,000. We're going to cancel those common shares. And the amount of common shares was 2,000 shares. The average, again, price is $10 a share. So that's $20,000 worth of shares getting canceled. So this represents like a loss situation, right? I paid $26,000 to buy back $20,000 worth of shares, according to my books, $6,000 down the tubes. You would think, okay, well, debit either APIC or retained earnings here for the difference, 6,000. But actually, if we have this account that says, oh, we've got this surplus from buying back our shares, $2,000, we wipe out the surplus first. So we got to get rid of that account. So again, my Canadian brothers and sisters, you're going to be using a contributed surplus account here. Americans will use this paid-in capital repurchase account. We'll wipe that out, and then the balance goes to retained earnings. So 4,000 to retained earnings. And there we go. We've finished part 1. Part 2 is the exact same problem, just with par value. So we got par value of $1, and you can see $10,001 par share. So it's $10,000, 10,000 times 1. And then they already had an additional paid-in capital, or if you're in Canada, contributed surplus account with $90,000 sitting in it. In that same capital, right? $100,000 in total. So on May 1st, the company buys back and cancels 1,000 shares at $8 a share. So this is May 1st, 2031. We're going to credit cash. Leave a bit of room for some debits here for $8,000, $8 a share, 1,000 shares. We got to cancel those shares at par, so we debit common shares to get rid of them. And the amount here was, well, it's 1,000 shares. The par is $1, so this is $1,000 to cancel those common shares. We also have to get rid of the paid-in capital on those common shares, the additional paid-in capital. So you can see it's 10,000 shares. We have $90,000. This is $9 per share in additional paid-in capital. Well, we're getting rid of 1,000 shares, so that's $9,000 of additional paid-in capital needs to go away. And then we're in the exact same position we were up above. We got rid of $10,000 of share capital. For $8,000 cash, we're left missing a $2,000 credit, and it goes to the same account as it did above. Credit additional paid-in capital on the repurchase APIC, which I would treat as a different account than just sort of our additional paid-in capital on the sale of shares. So I would not net these two. Okay, so there you go. And again, my Canadian cousins, this was all going to contributed surplus accounts. Let's continue now on August 31st, 2031. We buy back the shares for more than their initial issuance would have been, right? $10 on average is what we issued them for in the past. So let's credit cash. $13 a share, 2,000 shares, that's $26,000. Let's get rid of the common shares. We're canceling 2,000 common shares, par value $1 a share, so that's $2,000 worth of shares to be canceled. We're also canceling 2,000 shares worth of additional paid-in capital, which is $9 a share. It's $18,000 of additional paid-in capital, aka contributed surplus, to be written away. And we're, as we were up above, you can see debits of 20, credits of 26. We're off by 6,000. Now, had we not done this entry, we would debit retained earnings for 6,000. Because we have this repurchase paid-in capital account sitting there, we got to wipe it out. So I'm going to get rid of the additional paid-in capital from my earlier repurchase that was just sitting there. It's got to go. And the balance goes to retained earnings, $4,000. And there we go. We have balanced journal entries 15.3a is in the books. One thing left to do, smash one of those buttons and say goodbye. Goodbye. Let's take a look at problem 15.4a. We're paying a cash dividend. Fairly straightforward question. Stern Company has 1 million outstanding common shares. On May 3rd, it declares a 50-cent per share cash dividend. So that's going to be a $500,000 dividend, right? 1 million times 0.5. Payable on June 15th to shareholders of record on May 21st. Pays the dividend on June 15th. Record all relevant journal entries. Okay, two relevant dates. Well, they're all three of them relevant dates, but the two that are relevant for journal entries, May 3rd is the day we declare the dividend. We got to do a journal entry there. And then June 15th, the day we pay the dividend, we got to do a journal entry there. We don't have to do a journal entry on the day where shareholders of record are declared. That just determines who is going to get the money, who is getting the dividend check. But there's not a journal entry on the date. It's totally relevant to the shareholders, but not relevant for our journal entry purposes. So, May 3rd, 2031, we declare a $500,000 dividend. The debit here to dividends or retained earnings. Very common. Now, in class, I do dividends. I just debit dividends every time. When I was a practicing accountant, I would debit retained earnings for dividends. So either way, they're both commonly done. But I'm going to encourage my students to debit dividends. I would follow along with your textbook or your professor there. Debit dividends, $500,000. We don't pay them that day, so we're going to credit dividends payable for $500K. Okay, June 15th, we pay the dividends. What does that look like? Well, credit cash, of course. $500,000, and the debit is to the payable. Divs payable is going to 0. So debit dividends payable to get rid of it, and there we have it. We've done it. We've solved 15.4a in just over 2 minutes. Well, 2 minutes and like 25 seconds because you're going to be busy smashing those buttons for me. Thanks for watching. Bye. Let's jump into problem 15.5a, a liquidating dividend. What's a liquidating dividend? It's when the company pays a dividend or declares a dividend that's more than they have in retained earnings. And that's what's going to happen here. We have $40,000 in retained earnings. We're going to declare a dividend that's more than $40,000. Why might that happen? The company could be wrapping up business and they're just like, okay, time to return all the money to our shareholders and be done with this business. And so we're paying dividends more than what we have in our retained earnings account. It's unusual, but it happens. So here's how we account for it. We just say, okay, we're going to pay a dividend more than 40 grand. Normally dividends reduce retained earnings, but we can't reduce them below 0. We got to reduce this shareholders' equity in some way. So we just start reducing the other equity accounts, whether it be common shares or additional paid in capital or contributed surplus. We're just bringing our equity accounts down to 0. Zenith Corporation's December 31st balance sheet shows the following items in the equity section. They got common shares of 1.5 million, no par shares here, and retained earnings of 40,000. They declare a $1.20 per share cash dividend. So that's $120,000, right? That times 1.2 is $120,000 cash dividend. Payable on January 20th to shareholders record of Jan 10th. So Jan 3rd, we're going to declare a dividend, and Jan 10th, we're going to pay it. So first of all, we're promising to pay $120,000. This is a dividend payable, $120,000. Now, normally we would just debit dividends or debit retained earnings. Here, we're going to, for the full amount. Here, we're going to debit dividends or retained earnings for the amount of the retained earnings. That's the max you can put in the account, $40,000. So what of the other $80,000? It's got to reduce their shareholders' equity, right? We're paying out, the dividends come out of shareholders' equity, and the only other account they hit here is common shares in this case. And the common shares are $80,000. On January 10th, we pay the dividend, so just credit cash, debit divs payable, and we're done. 120. Okay, so that's it for part 1. Part 2, exact same question, but now we have a par value of $5. How do we deal with it? It's all very logical. So on January 3rd, we do want to declare that dividend, so we're going to have divs payable of 120. We debit, well, we have $40,000 in retained earnings to pay, so we're going to debit dividends or retained earnings. Again, do whatever it does in your textbook for 40, and we're off by 80, but this time it all comes, we don't have to do some proportional thing. It all comes out of additional paid-in capital, right? It just comes out of there. We want to keep our common shares at par value, and so it's just going to come out of additional paid-in capital, $80,000. So additional paid-in capital for my American cousins, and again, for my Canadian brothers and sisters, it is contributed surplus that you'll be hitting there. And then when we pay the dividend, January 10th, we're going to credit cash for 120, and we're going to debit dividends payable 120. And at that point, we've done it. We've solved 15.5a. As always, thank you for watching, and I'll see you in the next video. Oh, before you go, though, hit one of those buttons. Bye. Let's jump into problem 15.6a, a stock dividend. Paying stock dividends, I always think is odd mathematically, or what's going on the accounting records, because at the end of the day, not much changes about the company. Retained earnings goes down, common shares goes up, and our equity section remains the same. The theoretical value of the company remains the same. So what's going on here? Well, let's account for it and discuss as we go. Vanguard Dynamics, December 31st, 2030 balance sheet shows the following items in equity. Okay, they got common shares, 200,000, no par shares, issued and outstanding for $3 million total, retained earnings, $850. On September 15th, they declare a 5% stock dividend. So 5% of 200,000 means they're going to issue 10,000 new shares. So for every 100 shares you own, you get 5 extra shares now. And all it does, it ought to just dilute the value of the shares. And that's what it theoretically does anyway. So we're issuing 10,000 new shares. Now, let's read on. So the stock dividend to be distributed on October 15th to shareholders of record on September 30th. On the date of declaration, the market price of the shares is $25 a share. You can see that's different, right? If I do the math here, it's $15 a share. Well, that's the average we've issued it at over the years, but the market price is higher. It's $25 a share. So 10,000 times 25 means there's $250,000 of shares, like fair value shares, being issued out there into the world. Here is our journal entry on September 15th. We debit, no, if it was a cash dividend, we would just debit dividends or retained earnings. Here we just debit stock dividends or retained earnings. So I'm going to call this a stock div, but again, you can call it retained earnings, $250,000. And because we haven't paid it, we credit stock dividends distributable or payable. I think payable is fine here, but I've seen it in books called a stock dividend distributable. So it means we haven't issued the shares yet. A couple weeks go by, maybe a month goes by, and let's see, it's going to be distributed on October 15th. It doesn't matter. The shareholders record thing doesn't matter for our journal entry. So on October 15th, 2031, we issue the shares. How do I issue shares? I credit common shares, 250, and I debit stock dividends distributable because they are distributed now. Stock divs distributable. Should just call it payable. It's easier to write. But there you go. We've done part one. Part two says shares with a par value, and this isn't any harder. So assume instead of no par shares, Vanguard Dynamics shares had a par value of $2, and everything else is the same. But obviously, if they have a par value of $2, they have got some contributed surplus. But it's the same equity section, right? $3 million in share capital in total, and $850 in retained earnings. Okay, so what does this stock dividend look like? Well, on September 15th, 2031. Again, it's 5%. There's 200,000 shares, so there's 10,000 shares being issued, just the same as above. And the market price is just the same, $25. So 10,000 times $25 is a $250,000 dividend. Our journal entry is debit stock dividends or retained earnings, $250. Now, we don't credit stock divs distributable for the full $250 here. We're going to distribute par value common shares, and the par value of our shares is $2 a share. 10,000 shares being distributed, it's $20,000 worth of par value shares. So stock divs distributable is $20,000. Now, what about the other $230? Well, I'm sure you've guessed, if you've been following along this chapter, our American cousins, and you're the ones most concerned with par value shares. You're going to do additional paid-in capital. Canadians and IFRS folks will have different account names here, but I'll use the American name, additional paid-in capital, $230. And there you go. Now, on October 15th, when we distribute the shares, we credit common shares for the par value, common stock or common shares for the par value of $20,000, and we debit stock dividends distributable for the $20,000. Now, that's a small stock dividend. We'll look at large stock dividends in a future problem, but that's it. I hope that helped. We've solved 15.6a. I'm looking for my like and subscribe button. Hopefully you're looking for your like and subscribe button too. Thanks for watching. See you in the next one. Bye. Stock splits are a very strange animal in an accounting class because there's no journal entry for a stock split, and stock splits are the same as a very large stock dividend, and any stock dividend above 25% will be treated like a stock split. So let's jump into it. Strata Communications, December 31st, 2030 balance sheet shows the following items in the equity section. Okay, we got common shares, 300,000, no par shares issued and outstanding, $6 million. Retained earnings are 4.5, and it says on November 12th, we do a 4-for-1 stock split. The market price is $80 a share. We kind of don't care about the market price. This is an internal accounting exercise. We don't need to look at the world of the markets. So we're going from 300,000 shares, 4-for-1 split means we're going up to 1.2 million no par shares issued and outstanding. Now, does this value change? And the answer is no. So if this isn't changing and this isn't changing, we don't do a journal entry. We update this line. It's not going to say 300,000 when we prepare our balance sheets. It's going to say 1.2 million. And, there's accounting behind the scenes like that, but there's literally no journal entry. We say there's a memo that needs doing, and that's the memo. So it says record journal entries for the stock split. No journal entry required. Just an update to the number of common shares issued and outstanding, and we've done that. Part 2, very similar. Assume instead of no par shares, they have $4 par shares. Well, isn't that convenient? We did a 4-for-1 split. So exact same situation where we go, okay, there's 300,000 $4 par shares issued and outstanding. Well, now there's going to be 1.2 million of these $4 par shares? No. We have to change the par value. We have $1.2 million in equity. That doesn't change. We have 1.2 million shares. So what's the par value per share? It goes down 4-for-1 as well. It goes down to $1, right? So it just reduces in the amount of the split. No change to our additional paid-in capital. No change to our retained earnings. No change to our common share dollar amount. And therefore, no journal entry needed. Again, questions like this in a text will say, there'll be a memorandum or an update to the account. The big change is how we disclose our common shares on the balance sheet. We have 1.2 million $1 shares after the split. There you go. We've solved 15.7a. As always, thanks for watching. If these videos help, I hope you'll help me. Bye. Let's jump into problem 1510A, a statement of changes in equity. We list all of our equity accounts across the top. We say, what did we begin with? How did they change? What did we end with? Let's jump into the problem. New tech. So part 1, no par shares. Part 2 is going to have shares with par value. I trust you can skip around to whatever thing you think most applies to your class. New Tech Solutions reported the following equity balances on January 1st, 2031. Common shares, 100,000 no par shares issued and outstanding for $1 million. Retained earnings are 800,000. Those are going to be our opening balances here. During 2031, the company completed the following transactions affecting equity. They issued 20,000 common shares for $15 a share. 20,000 times 15, that's $300,000 in new shareholders' equity. Debit, cash, credit, common shares, $300,000. They declared and paid a $1 per share cash dividend on all outstanding shares. Now, the trick to this question is we had 100,000 shares, but we just issued 20,000 more. So a $1 dividend is actually going to be $120,000, right? Because we pay all the shareholders. So there's $120,000 in cash going out to our shareholders. And remember, that affects our retained earnings. Debit dividends, credit cash. And we also say, well, the dividend closes into retained earnings. So sometimes we just debit retained earnings directly. Declared and distributed a 5% stock dividend. All right, so how many shares? Well, we got 120,000 shares outstanding. 5% means, I think that's 6,000, but let's do some calculator math. 6,000 new shares are being issued. So 6,000 new shares. And it says on this date, the market price was $18 a share. Because it's a 5% dividend, it happens at market price, right? If it was a big dividend, we might do it at par value or consider it like the equivalent of a stock split. If it's no par, then no transaction. But because it's a small stock dividend, it happens at market value of $18 a share. 6,000 times 18 is $108,000 of a stock dividend. Last thing, we reported net income of $450. Okay, we've got all the information we need. Now we got to prepare a statement of changes in equity. Let's go. It starts with a 3-line title like all good financial statements do. New Tech Solutions Statement of changes in equity for the year ended and then the date, December 31st, 2031. Now, our opening line here is the first day of the year. We start and end with dates here. And so the first day of the year, I'm actually going to minimize the calculator. I feel like it's getting in my way. I'm going to move this over just a touch. There we go. So our opening line is a heading, I should say, and we list across our equity accounts. So common shares and retained earnings. I'm getting a little ahead of myself there. And total. Then we're going to say, okay, how many common shares did I have at the start of the year? And the start of the year is a date, January 1st, 2031. So how many dollars worth of common shares did I have? I had $1 million worth of common shares. That's just given information. It's typically going to have to be given to you in these types of questions. So my total shareholders equity when I combine common shares and retained earnings is $1.8 million. That's my starting point. And that would come from last year's statement of changes in equity, the bottom line of last year's. Okay, now how did it change? Well, let's just go through time by time here. So on March 1st, we issued 20,000 shares, $15 a share, $300,000. How does that affect my equity? My common shares go up by $300,000. So I'm just going to say common shares issued. See, this is sometimes called issuance of common shares. And that's the total. The issuing common shares does not affect our retained earnings. Declared and paid a $1 per share cash dividend on outstanding shares. Okay, so cash dividend, I typically would just say dividends, but because we have cash dividends and stock dividends, I'll distinguish between cash and stock. $120,000, that's a reduction to my retained earnings. closes to my retained earnings. So there we go. The stock dividends. $108,000. What does that do? Well, I have $108,000 more worth of common shares in the world, but it reduces my retained earnings, and the effect on my equity is nothing, right? Stock dividends don't affect our shareholders' equity in total. They just affect the accounts within it. The last one, net income on December reported for the year ended December 31st. $450,000. What does that affect? It affects your retained earnings. We add $450 to our retained earnings, and yes, $450 in total. Does not affect the common share values. So that's it. Now we need totals, and our total for the year column is just the date, December 31st, 2031. I guess it's a row. And there we go. So we just need to total and we're done. So 1 million, 1.3, 1.4, 1408000, double underline, $sign. That's a bottom line here. Oh, I'm not going to be able to do this one without my calculator. Come on back, calculator. 800 minus 120 minus 108 plus 450, 1022. Again, $sign at the top and bottom. Then I just add across 1408 plus 1022, 2430. You may be wise, now that's good, you may be wise to also add down just to make sure you haven't done an arithmetic error. 1800 plus 300 minus 120 plus 450, 2430. So it worked both ways. Just a sensible thing to do. So there you go. We've solved part one of this exercise where we had no par value, but now let's look at it when we do have a par value, and that does change a few details. The key one being that there's going to be another column for additional paid-in capital / contributed surplus if you're in Canada. Assume instead of no par shares, New Tech Solutions shares had a par value of 4. Their January 1st equity balances were, and there they are, 100,000 common shares, $4 par. So 100,000 times 4 is 400,000, and that means if I had $1 million in common shares equity, 600,000 was additional paid-in capital, and the same 800,000 retained earnings. It says assume the March 1st, June 15th, October 1st, and December 31st transactions, assume these things occurred the same as above. Prepare the statement of changes in equity. Okay, there's a few differences because of the additional paid-in capital account, because of the par value on common shares, but the title is not different. Let's do it. New Tech Solutions. That W isn't up to my high standards. New Tech Solutions. Move this. That's in my way. That's the problem. Statement of changes in equity. For the year ended then the date, December 31st, 2031. Okay, so we want to give our account headings across the top. We got common shares, we got additional paid-in capital, retained earnings, and total. And again, if we had more accounts like preferred shares, AOCI, those would all go across the top. This could become a very wide financial statement, and it is for a lot of companies. But let's start with common shares. We will use the American terminology of additional paid-in capital. My Canadian brothers and sisters, you know you're going to use contributed surplus and our retained earnings. And we've got a totals column here. Okay, so we start with January 1st balances. Those are the balances that are just given in the question. 400,000 was our common shares. Additional paid-in capital of 6, and retained earnings is 8. I'm just reading them off there and going from memory. I remember which one was which. And you can see the total is 1.8 million. And then we just say, what happened? Well, we issued common shares. Now, when we issue common shares, whenever any common shares are changing hands here, we've got to contend with the par value. So it's going to be a little different from what we had done previously. Here we said, oh yeah, it's $300,000 of new share capital, and there is, we got to break it down to par and additional paid in capital. We issue 20,000 shares for $15 a share. The par is 4, so that means there's $80,000 of par shares, which that's what we credit common shares for, and the rest, 220, is going to be additional paid in capital. So let's get to it. My common shares go up by 80,000. My additional paid in capital goes up by 220. Common shares issued, I should say. I just said common shares. Common shares issued, 80,000, 220. No retained earnings change there. And so overall, we're up $300,000. And I think you're going to see our totals are going to match up here, like the totals of the column should line up, I think. We'll see. Next up is cash dividends. And it's just that June 15th, we declared and paid a $1 per share dividend. And again, same as above, we have 120,000 shares. Yeah, the par values are different, but it's still a $120,000 dividend. So retained earnings goes down by the amount of the dividend, and the total goes down. Does not affect additional paid in capital, does not affect common shares. But our stock dividend will. We distributed a 5% stock dividend. We said there's 6,000 new shares. Market price is $18 a share. Okay, so what's happening here? Well, 6,000 new shares, $4 is par value, so let's multiply by 4 for the par. 24,000 goes to common shares. And I guess if it's $4 is par, then $14 is additional paid in capital. 84,000 goes to additional paid in capital. And there we go. So let's fill that in. Stock dividend. And we said 24,000 goes to common shares. 84,000 goes to additional paid in capital. And it comes out of retained earnings. So 24 plus 84 is $108,000, and that's zero, right, at the end of the day. And so very similar to what we've got up there, we just split the plus between common shares and additional paid in capital. Our net income is the next line down, and it's just going to be the same as what's up there. Net income doesn't affect common shares, doesn't affect additional paid in capital. It helps our retained earnings, so plus to our retained earnings and plus to total shareholders' equity. And then now we're ready for totals all the way around, and our total line here is the year-end date, December 31st, 2031. So 400 plus 80 plus 24 is 504. 600 plus 220 plus 84 is, I need a calculator, 600 plus 220 plus 84, 904. I put 905 for some reason, 904. Our retained earnings column isn't any different, but let's just confirm that. 800, I'll leave off the last 3 zeros, minus 120, minus 108, plus 450, 1022, it is the same. And our grand total ought to be the same here, 504 plus 904 plus 1022, 2430, it is the same. Double underlines under all of these bottom lines, dollar sign at the top and bottom of each column. And there we have it. We've got ourselves a beautiful, well, two beautiful statement of changes in equity. Statements of changes in equity, I suppose, says it because it's plural. Thanks so much for watching. That wraps up 1510A. If you make it to the end of these, I'm always looking for a like or a sub. It helps me out a lot. Thanks for watching. See you in the next video. Bye-bye. Let's jump into problem 1511A. We're talking treasury stock. The company buys back its own shares but doesn't cancel them. It hangs on to them, keeps them in the treasury. How do we account for that? How do we account for it when they buy them back? How do we account for them when they eventually sell them back into the market? That's what we're going to learn in 1511A. Part 1. The December 31st, 2030 balance sheet of Jonas Company shows the following equity section. So you can see the stockholders' equity, paid in capital. This is American question, so we're going to use American lingo throughout. $20,000 of common stock. Well, that's the par value. Additional paid in capital of 180. Total paid in capital 200 grand. They got retained earnings, and you can see the total. So no treasury stock yet, but there's going to be in 2031. On Valentine's Day, 2031, the company bought back 2,000 shares for $13 a share. How's my math? 2,000 times 13. I should be able to do this in my head. 26,000, right? Yeah, $26,000 worth of shares got back into the treasury. And it says the company will hold the shares as treasury shares. Assume they use the cost method. That's the one we're going to learn. And it says do a journal entry. Pretty easy journal entry. On Feb 14, 2031, we credit cash, of course. We're buying back shares for cash, and the debit is to treasury shares. $26,000. And so this account is like a negative equity account because your common shares are the scoreboard of what your shareholders, your outstanding shareholders are holding on to, and these 26,000 are shares you've got back in the company, so they're not part of the outstanding shareholders scoreboard. So there you go. That's the February 14th entry. Now, what's more interesting is part B. It says, assume that this was the only stock transaction during the year, and the company had 100 grand in net income, declared and paid $20,000 of dividends during the year. Prepare the equity section on December 31st, 2031 balance sheet. All right, so again, this is the December 31st, 2031 balance sheet, and we're doing the stockholders equity section. I'm just going to use the same headings that I've got up there. Stockholders equity. We've got paid in capital. And we've got common stock. Now, the issue here, when you get to this intermediate level, is you really have to lay out what the common stock situation is. It's not enough to say common stock and a number. You have to have this bit. So we have 20,000 shares issued. We didn't issue any new shares here. So 20,000 $1 par shares issued. But now we have a different number issued as we have outstanding because we bought back 2,000 shares. So those shares are issued because we didn't cancel them. So we have 20,000 shares issued. We only have 18,000 shares outstanding. So 18,000 shares outstanding. Maybe I'll write it out. Outstanding. Okay. And it's $20,001 par shares issued. That's the number that matters. That's $20,000 worth of shares out there in the world. Our additional paid in capital, no change. Still $180,000 of additional paid in capital. And it shouldn't be lost on you, therefore, that our total paid in capital is just the same as it was. But this important detail is different, right? What's in the brackets there is different and it's important. Total paid in capital, and the total here is 200,000. Okay, next up is retained earnings. Just following along here, retained earnings. And our retained earnings was 250, and we say, how did it change during the year? And it increased by the net income, so 250 plus 100 is 350, decreases by the dividends, minus 20, 350 minus 20 is 330. So our ending retained earnings here is 330. I've seen a subtotal here sometimes. I've seen it sometimes not. I'm going to use the subtotal in this one. I think in the next one I won't, just to show you what it looks like. But the subtotal is total shareholders' equity before treasury stock. I've also just seen it, they just go on and do treasury stock. Sort of like income before taxes, total shareholders' equity before treasury stock, 530, and then you just take away your treasury stock, less treasury stock. And then in brackets, how many shares we bought back, 2,000 shares. And use the phrase at cost. 2,000 shares at cost. So what is the cost? 26,000. So we take away 26,000. And that brings us down to our total stockholders' equity. 530 minus 26 is 504. And there we have a beautiful stockholders' equity section, a couple dollar signs there, and there is where I would put them. And yeah, I think we've got a beautiful stockholders' equity section. We've done a wonderful job on part 1. On to part 2. Part 2 is where this gets more exciting. On June 1st, not that it wasn't exciting so far. On June 1st, 2032, I'll do this in blue ink. Let me change my pen. The company sells 500 shares of treasury stock for $15 a share, and then it sells 500 and it sells 500. So we're going to be doing journal entries for each of these. So we're selling back our treasury stock into the market, and we're going to have 3 journal entries to do. 1, 2, 3. So let's go ahead and sort of see what we're up against. So the first one, we sell 500 shares at $15 a share. 500 times 15 is at $7,500. So that's how much cash we get. But remember, the stock's carried at cost of 13. It's almost like we have a gain, right? We got paid more than the stock was worth. This brings in a new additional paid-in capital account. Let's do the journal entry. And I think you'll see it's not too hard. It's just knowing what to do. And you're going to know what to do by the end of this video. So debit cash. 7,500. How much cash did we get? How much stock did we sort of put back out there? Now, the stock's sitting there in a debit. We're putting it back out in the market. We put our stock out at cost, treasury stock, and the cost was $13 a share, and it's 500 shares, so 500 times 13, $6,500 of treasury stock goes back into the world. And we got paid cash above the paid-in capital of our treasury stock. So this is additional paid-in capital treasury stock. It's important to distinguish that from just our normal additional paid-in capital. And it's $1,000. Okay, on to the next transaction, which is September the 3rd. September 3rd, what happens? We sell 500 shares at $12 a share. That's below, right? Shouldn't be lost on you. $13 is our cost. $12 is below. If that was our only transaction, it's almost like a loss, right? These additional paid-in capital is like almost like a gain on our treasury stock. When we have a loss on our treasury stock, you debit retained earnings. But if you already had a gain, you have additional paid-in capital, you draw down that additional paid-in capital until it's 0, and then once it goes negative, then it goes to retained earnings. So that's the trick here, and you're going to see here it's going to go, obviously we sell it for $5, it's going to go below 0. Okay, let's go ahead and deal with this though. We got paid $6,000, debit cash, $6,000 for 500 shares. We think 500 shares are worth $6,500. Well, that's their cost on our books, so we credit treasury stock for that. 6,500, and then we kind of have a loss situation, right? Credit APIC when you have a gain. Well, when you lose on this, you're going to debit APIC to bring it down to 0, additional paid-in capital. I don't know if anyone else calls it APIC. I just read it that way. I'm in Canada. We don't really deal with APIC in this way, so it's a new acronym for me. I would call it APIC, though, if I were your teacher, but maybe I sound weird saying that. Okay, there we go. We've got our journal entry, September 3rd. December 31st, we got one more of these to deal with. December 31st, 2032. We get paid very little, real bad time for our company, $2,500 cash for treasury stock that has a cost, again, it's 500 shares, so it's $6,500, $13 a share. This is like a $4,000 loser for us, but our additional paid-in capital account has $500 still sitting in it, right? Credit 1,000, debit 500. It's still sitting a credit of 500. We got to get rid of that. So let's get rid of the additional paid-in capital, only down to zero. So our additional paid-in capital account, credit of 1,000, debit of 500, debit 500 goes to zero. And then what do we do with the rest of it? It goes to retained earnings. So I guess that's 3,500 goes to retained earnings. And there we have it. We've done our journal entries. It says, assume those were the only stock transactions during the year, and that the company had $50,000 in net income and declared and paid $25,000 in dividends during the year. No other transactions or items that directly impacted stockholders' equity. Prepare the equity section as of the December 31st, 2032 balance sheet. So same idea as before. It's the December 31st, 2032 balance sheet, and we are doing the stockholders' equity section. Okay, so we'll start with our paid-in capital. I'm just copying the headings from up above because it's essentially the same headings with different details and numbers. Our paid-in capital begins with, of course, common stock, and still 20,000 par shares issued, $1 par shares issued. Now, how many are outstanding? Well, it was 20,000, then we bought back 2,000, so we're at 18. We issued 500, 500, 500. We issued 1,500, so we went from 18,000 up to 19,500. We're sitting at 19,500 outstanding. I guess I could say shares outstanding, but this is fine as well. Okay, so that's $20,000. And our additional paid-in capital was not touched. Our additional paid-in capital account. Now, I know you're thinking, well, we have this APIC treasury stock, but our original additional paid-in capital of 180 was not touched. That brings up the topic of the additional paid-in capital treasury stock. How much is in there? APIC treasury, credit of 1,000, debit of 500, debit of 500. It's zero. So we don't need it here. We would just list it as another line, but unnecessary. So 20,000 plus 180, 200,000. Oops, not 20,000, 200,000. And this is our total paid in capital. Okay, beautiful. So what comes next? Well, after total paid in capital, retained earnings. What's our retained earnings? I began the year at 330. We had net income of 50. That brings us up to 380. We had dividends of 25. So 330 plus 50 minus 25. We're at 355, right? That's where we're at. And don't forget, we debited retained earnings by 3,500. Oh, great. So 355, I'm going to need the thousands, minus 3,500, reducing our retained earnings there to 351,500. All right, on we go. So our subtotal here, total shareholders' equity before treasury stock. $200 plus 351 is 551,500. We're going to deduct our treasury stock. And remember, we said we had 2,000 in the treasury. We released 1,500. We sold 1,500 back out. So we still have 500 shares. I always want to do the at sign, at cost. And our cost, of course, was at $13 a share, I believe. Yeah, $13 a share. So 6,500 is what's left in our treasury stock, bringing us down to total shareholders' equity, 551,500 minus 6,500 is $545,000. double underline there, $sign at the top of each column, $sign beside anything with the double underline. I'll put them both on screen at the same time. So we're going from 2031 to 2032, and I think we're done. 1511A. If you made it all the way to the end, thanks for watching. Smash one of those buttons, and I'll see you in the next video. Bye for now. Welcome to Chapter 16 of our intermediate financial accounting class, Dilutive Securities. So you are an investor, congratulations, and you have $10 billion and a full head of hair. That's $10 billion more than I have and a lot more hair than I have. Congratulations to you. And you decide, hey, there's this fancy tech co, and they have 100 shares outstanding, and they're worth $100 billion. Why don't I use my $10 billion and buy 10% of the company by buying 10 shares? And that's just what you do. You buy 10 shares, 10 out of the 100 shares, and you now own 10% of this high-flying tech co. Now, you didn't realize, and you didn't do your due diligence. This is not a realistic example, of course, but let's just go with me on it. The tech co has 100 employees, and they all have what are called restricted stock units, and in fact, they vest tomorrow. Each of those employees is going to get one share of stock. Tomorrow, the company is going to issue one share to each of their 100 employees, and the company tomorrow goes from 100 shares to 200 shares outstanding because each employee got a share for being an early employee in the company. Now you still own your 10 shares, but unfortunately it's now 10 out of 200 shares. You own 5% of the company, and the company's still the same company. It's still just worth $100 billion. Well, you just got diluted, right? That's the terminology we use for when a company issues new shares, and it reduces the relative value of each individual share. Now, there's a million contractual reasons why that wouldn't happen in real life, but the gist of it does happen, just not so severely. So employee stock option plans and employee restricted stock units, these types of things happen, and we'll learn to account for them this chapter. But it's not just the employees who can dilute the shareholders, it's also the debt holders. Lenders can dilute the shareholders. So we could have a 6% bond, or we could have a 6% convertible bond, and a convertible bond converts into shares. Not surprisingly, a 6% bond will typically sell for less than a convertible bond. There's a bit of a premium to have that option. If I'm a lender, say, okay, I'm lending you money. Oh, now I'm a shareholder, right? And having that option to convert has value. So typically a similar convertible bond will sell for a little bit more. In this case, $30 more. Now, this is a very interesting part of the course because it's a part where there's a significant departure between US GAAP and IFRS. IFRS says that extra $30, that's equity because you're paying $30 extra to get what could convert into shares. US GAAP says, no, that $30 extra, don't worry about it until they actually convert. I actually side with US GAAP on this, but if you're learning IFRS, you're going to need to learn to account for this as partial debt and partial equity all in one item. So it gets fairly complex. But the best way to learn anything in accounting is to practice, and that's just what we'll do. Stay tuned for our next video. Bye for now. We're about to jump into problem 16.1b from my workbook. If you want to download the workbook, go to myname.com, tonybell.com, click the free PDF link. There's no sign in, no sign up, nothing like that. Scroll down, find the problem. You're going to see lots of free problems like the one we're working on now, but there's plenty of problems that are just available for members. If you're getting good value from the free stuff, I hope you'll consider a membership. Downloading problems are really useful in a problem like this where we have templates and tables to be filled in. Okay, enough of the promo. Let's jump into the problem. Let's jump into problem 16.1b. We're converting shares. We're going to have an induced conversion at the end. Let's jump into it. On December 31st, 2030, Cobalt Industries issued $5 million of 8% convertible bonds at par. So how much cash changes hands? Well, we assume par means 100 would be the bond quote, and 5 million at 100% means $5 million in cash changed hands. Interest is payable semi-annually on June 30th and December 31st. The bonds mature December 31st, 2040, so these are 10-year bonds. The company recently issued identical bonds with without the conversion feature at 97. So 5 million times 0.03, right? The difference between 100% and 97% is 3%, means $150,000 of the bond value is due to the conversion feature. This is where US GAAP and international GAAP kind of part ways. International GAAP says that extra 150 grand you got for the conversion feature, that's equity, and we should treat it as equity. US GAAP says it's not equity until they convert, it's debt until they convert. I actually side with the Americans on this one, and maybe I'm biased because it's easier, it's simpler. So let's solve this the US GAAP way, and then in part 2 we'll come back and do it the international way. Now, my Canadian friends, lucky us, we got to learn both ways. Canadian companies can opt to do it the US way, or they can opt to do it the international way. So you got to learn both. Lucky you. But let's do it the US way first. So the US way couldn't be more straightforward. On December 31st, 2030, we issue bonds at 100%. We ignore the value of the conversion feature. We just go, okay, I got $5 million cash. 5 million times 100% is 5 million. And I credit bonds payable. Now, because of that, there's no discount or premium on the bonds, and therefore, par bonds are easy to account for. In 16.2, we do this at a discount or at a premium, so you can have a look at that. It is more challenging. Even the US GAAP, which is simpler than IFRS, is more challenging when we've got a discount or premium to contend with. But here, couldn't be more straightforward. It notes, at the time of the issuance, Cobalt's common stock was trading at $35 per share. We ignore the price of the shares, even though there might be a conversion coming. And the reason is when we convert at our cost. We say, well, how many dollars were the bonds at our book value converted? That's the value of the shares. You don't convert at market. Each $1,000 bond is convertible into 25 shares of Cobalt's no par common stock. If it had par, we'd have an additional paid-in capital account to contend with. We don't here, just making it a simpler problem. On June 30th, 2031, semi-annual interest was paid. Well, we got to do a journal entry for that. And I'm sort of jumping ahead here, but that's these journal entries we're kind of just doing as we read. June 30th, 2031, we got to pay interest. Well, it's $5 million bond. It pays 8% interest, so $400,000 a year, but this is half a year. Things are semi-annual, so 6/12 or half is 200 grand. That's how much interest gets paid. Credit cash, 200, and the debit here is the interest expense. Again, if we add a discount or premium, this gets more complicated because there's a discount or premium to be amortized, and therefore the interest expense will be higher if it's a discount and lower if it's a premium. The cash is the cash, though. Continuing, July 1st, Canada Day, 2031. Immediately after the first semi-annual payment, holders of 1,500 bonds converted under the original terms. At the time, the common stock was $45 a share. So again, this is like the trap a professor will set for their students. Some bright student is going to look at this and go, okay, well, 1,500 bonds are going to convert to 25 shares. So they'll go, okay, there's 37,500 new shares at $45 a share. That's $1.6 million in new equity. And the answer is no. It's actually simpler than that. You go, how many bonds converted? Well, we had 5 million and 30% of them converted. Is that right? 1,500 converted, so 1.5 million converted. Well, I guess I've done the math there. Oops, not times 3, times 0.3. It's $1.5 million worth of bonds converted, right? How many bonds? 1,500 bonds. They're $1,000 each, so $1.5 million worth of bonds converted. So let's get rid of those bonds. I was overcomplicating matters there. To get rid of them, you debit bonds payable for their value, their book value, which is $1.5 million. The way I was doing it was I was going 5 million and 1,500 out of 5,000 bonds converted. So times 0.3, it's same number, 1.5 million, but easier to just go 1,500 bonds converted, $1,000 a bond, 1.5 million. Anyway, over explaining here, credit common shares for 1.5 million. That 1.6 million number I calculated just isn't anywhere to be found, even though like you could logically arrive at that number. Remember, we ignore the fair value of the common shares when we're doing this. Okay, December 31st, 2031, another interest payment is made. This time we got to figure out, well, how much interest? We don't have 5 million bonds outstanding, $5 million worth of bonds. We only have 3.5 because we took in $1.5 million of bonds. So I only have $3.5 million worth of bonds. The interest rate is still not 80%, 8%, $280 per year. But again, times 6 months is $140 for a 6-month period. Debit interest expense, $140. Credit cash, $140. And we're on to the last piece. So, last piece. On January 1st, 2032, in an attempt to reduce interest costs, the company pays $31 per bond. Now, how many bonds do we have? We have 3,500 bonds, right? We had 5,000. We converted 1,500. So we have 3,500 bonds left out there in the world. We do it at $31 a bond, so 3,500 times 31, 108,500. Let me read the whole thing. I feel like I didn't read it. I've written this question, so I know where it's going. But on January 1st, 2032, in an attempt to reduce interest costs, the company pays $31 per bond, a $31 per bond premium to induce, now this is called an induced conversion, to induce the remaining bondholders to convert their common shares, to convert to common shares. All bondholders accept the deal. At this time, the company's common stock had fair value of $40. Well, hopefully you're getting to the habit of like, ignore that. We will ignore that. And so now we're just going to convert these bonds. So the way to convert the bonds, though, is to say, okay, well, how much do I have in bonds January 1st, 2032, and how much do I have in bonds? And the answer is 3.5 million, right? That's the value. 5 million minus 1.5 million. I got $3.5 million worth of bonds. And now I'm saying, well, I want that to go to zero. So I debit bonds, payable, 3.5 million. I credit common shares. I'm issuing common shares, 3.5 million. But what about this conversion cost, right? I converted 3,500 bonds, 3,500, not 350,000, at $31 each. I spent $108,000 to induce these people to convert, right? I wanted those bondholders to become shareholders so I don't have to keep making interest payments because maybe I have cash flow issues or whatever. So I induce them to convert, and I credit cash, of course, for that amount, that inducement, 108,500. Now the debit here is to conversion expense. This is just the cost of doing business. Conversion expense, 108,500. So there you go. It doesn't add into the value of my equity. It doesn't reduce the value of the bond. It's just an expense related to the transaction. And we have solved part 1 of 16.1b. If you're doing US GAAP, I think now is a great time to smash the button and get on out of here. But if you're doing Canadian GAAP or IFRS, well, stay tuned. Lucky you, our way of doing it is more complicated. Hooray. So part 2 says, redo items A through E under IFRS or Canadian ASB, assuming the company elects to measure the equity component. So it's this difference between the 100 and 97 I talked about very early on in the question, where we said, oh, there's an extra, 3% of 5 million. There's an extra $150,000 that bondholders are willing to pay because of the equity feature. IFRS and Canadian ASB, if they opt to do it the IFRS way, they account for this $150,000. They separate it out, and that creates complications for us. Again, hooray for us. The way I do this, though, so we're going to redo the December 31st, 2030 entry. The way I do it is I pretend that we issued the bond for 97. So I pretend we issued the bond without the equity feature. So I go, okay, well, had I done that, my cash would be $5 million times 0.97, 48.59. I'm going to erase this in a moment. So maybe don't you write this because I'm going to erase this in a couple seconds. So this is what I would have done. Debit cash, 48.50. I would have gone credit bonds, payable, 5 mil. And of course, I would have had a discount of the 150K. Now, A lot of textbooks will combine these two. They'll just go debit cash with 4850, credit bonds payable 4850. They don't separate out the discount. I prefer to do it this way, but if you're doing it following a textbook that doesn't do it that way, then just credit bonds payable 4850. Wherever I debit or credit discount going forward, you just hit the bonds payable account, and that's fine. Okay, so that's what I would have done had I issued the bond without the conversion feature. But I didn't, and I ended up getting paid $5 million for my bond. So all of a sudden this doesn't balance. The credit is the equity portion, and we credit for $150,000 contributed surplus. We call these conversion rights, right? There's an equity account to track this transaction called contributed surplus. And then why do I have a contributed surplus? Well, because people paid extra for the equity of the conversion rights. That's what this account tracks. You don't do a lot with this account until people convert, but there you go. We've solved the first part. Now, you likely got a peek of what's coming up. Because our bond issued at a discount, not at par like the American version of this, but because our bond issued at a discount, well, unfortunately, just the reality is we have to amortize our discount. And to amortize a discount, use a bond amortization or discount amortization table. So let's do that. Before we can do our June 30th entry, which was for the first interest payment, we gotta make one of these tables. So let's start with what we know. Well, we're going to do the December 31st, 2030 bond issuance. So no payment, no interest expense, no discount amortization on day one. It's a discount, though. I can scratch out any references to premiums. And how much is the discount on December 31st, 2030? Well, we did the math. It's $150,000. What is our bond carrying amount? Well, it's the face value of the bond minus whatever's in column E, minus the discount balance. It's $4,850, and that's sort of our starting point. Now, bringing us up to June 30th, 2030, we're going to make an interest payment, and the interest payment is based on the face value of the bond and the stated rate of 8%. But remember, we divide those by 2 because this is a semi-annual table, so we take 4% of the maturity value. 4850 times, not 4850 rather, 5 million times 0.04, 200,000. Our interest expense is based on the market rate of interest for our bond, and that's given in this question. It's this yield to maturity number, 8.45%. However, I could make you calculate this. I didn't want to because you'll see this question is going to take long enough as it is, but we have the PV of the bond, 4850. We have the FV of the bond, 5 million. We have the N, which is, how many years is this? It's a 10-year bond, so N is 20. We have the PMT, the payment amount, 200,000. So you got everything except I. You can solve for I, right? You can use a financial calculator. You can do it by hand when we've learned that all like way back in, I don't know, chapter 3 or something. I'm not going to demand that of you here, but I think it would be reasonable for a professor to demand you come up with this 8.45%. Anyway, there's 8.45% is our market rate of interest. We divide by 2 to get it into this chart. 4.225%. And so 4.225% of the preceding bond carrying amount times 4.85 mil. 204.91, we'll round to 3, 204.913. Discount amortization, C minus B, 204.913 minus 200,000 is 4.913. Discount balance, 150 minus 4.913, 145,087. And bond carrying amount, 5 million minus that, 5 million minus 145,087. 4854913, 4854913. Okay, we're set to do our journal entry here on June. My goodness, June 30th, 2031. We're going to credit cash for the amount of the payment. The amount of the payment is $200,000. We're going to debit interest expense. And the amount here is 204,913. we're going to debit or credit rather discount. Now again, if you're doing this net, you would just credit bond payable for 4913. Okay, so we've done a beautiful job up to June 30th. Next relevant date here is our conversion on July 1st. On July 1st, immediately after the semi-annual payment, 1,500 bondholders convert under the original terms. So we have to say, okay, well, we had 5,000 bonds out there, right? There's $5 million worth of $1,000 bonds is 5,000 bonds. 1,500 of them converted. So do a little ratio here. 1,500 of my 5,000 bonds convert to shares. So that's, I won't do it in my calculator, it's 30%. So I just take every bond related account and conversion related account and I go 30% of this disappears into my shares, right? So I wipe out the bond value, I wipe out the discount, I wipe out the conversion rights, and I put whatever the balance is into shares because I convert at book value, not at market price, but at book value. So what are my key accounts here? It's the bonds payable, which again, I'm accounting for in its own account, 5 million, and I'm going to convert 30% of them. When I convert 30% of the bonds, well, guess what? The discount, 30% of that converts. Now, the discount was 150, but then I just credited it by 4913, so the discount is carried at 145087. And again, 30% of that's going to convert. My discount was a debit, so when I zero out that amount of the discount, I credit it. My bonds were a credit, so to reduce it, I debit it. And last, I got the contributed surplus conversion rights. I know it's a lot to write, so I abbreviate a bunch there. And it's going to debit, and the amount was 150. Sorry, it's a credit balance. When I zeroed out, I debit it. 150 times 30%. Okay, so let's figure this out. So these are the account balances I want to take away, times 0.3. $1.5 million worth of my bonds that are sitting at a credit convert. 145087 times 0.3. 43526 worth of my discount converts. And 150 times 0.3, that's 45,000 of my conversion rights are exercised here. So they don't exist as conversion rights. They're going to exist as common shares once the exercise takes place. Exorcism? No, I don't think that's the right way to say it. Okay, let's do it. So it's July 1st, 2031. I'm going to make those bonds payable. They were a credit balance. I want to zero out the amount that converts, 1.5 mil. I'll do the conversion rights because they're a credit, so I'm going to debit them. CS, contributed surplus, rights, 45,000. I get rid of the discount, so credit the discount to make it go to 0. 43526. 526, easy for me to write. And then you just go, okay, I've wiped out the accounts that are converting, put it into common shares. So 1.5 million plus 45,000, 1.545 on the debit side minus 43,526 on the credit side leaves us 1,501,474 to be credited to common shares. There, we've done a conversion. There we go. So July 1st in the bag, but we got another payment coming up on December 31st. And guess what? We have to update our table. Now, we have to update it on July 1st, 2031. I think I put the wrong, I know I put the wrong year here. It's June 30th, 2031, of course. July 1st, 2031, we don't make a payment on that day. We don't have interest expense on that day. We don't have discount amortization on that day. But our discount balance changed and our bond carrying amount changed because our bond we just wiped out $1.5 million worth of bond. So our bond, when it matures, it's going to be $3.5 million now, not 1.5. So when I'm calculating interest on the bond, well, a bunch of the stuff that used to be a bond isn't a bond anymore. So I reduced the bond to $3.5 million, the maturity value of the bond. The second thing I got to do is I got to change the discount. The discount was sitting at 145,087 debit, and now I just credited it by 43,526, so minus 43,526. My discount is 101,561, and therefore my bond is on my books for 3.5 million minus 101,561. It's on the books for 3,398,439. Okay, 6 months go by. December 31st, 2031, we make another payment. 4% of the maturity value, 0.04 times not 5 million, but 3.5 million, 140,000. This should match up with what our American cousins did long ago, and it certainly does. Interest expense, 0.04225 times the preceding bond carrying amount, which is now 3,398,439. 143,584. C minus D, so 3,584, 143,584 minus 140,000. E minus D, 101,561 minus 3,584, 97,977. And then 3.5 million minus E minus 97,977 is 3,402. 023. Whew, okay. So we're ready to do the payment on December 31st, 2031. I'm going to erase this and write it in here because I want my journal entry to go down there. Okay, we're going to credit cash, of course. We're making a cash payment to bondholders, $140,000. The interest expense, 143,584. And 3584 needs to be credited, and that is the discount amortization. And again, if you're doing this net, just credit the bond. Last one, holy, we got our induced conversion on Jan 1, 2032. This is, I think, under IFRS, like, I would just logic my way through it. Canadian GAAP, actually kind of weird, honestly, if I think about how I think about the ASPE one. But the first part is the same under both. So I'll do it in blue ink under both. I don't know how I'll do it in ink, but let's just solve it IFRS way, and then we'll look at the differences for Canadian GAAP. So IFRS says, all right, let's read the thing. On January 1st, 2032, I'm reading up here. On January 1st, 2032, in an attempt to reduce interest costs, the company pays $31, and there's 3,500 bonds left, $31 per bond to induce the remaining bondholders to convert. So 31 times 3,500 is 108,500, and that's the same number we had previously when we did the US GAAP. All bondholders accept the deal. So this is an induced conversion. IFRS, pretty straightforward. We sort of wiped out 30% of our bond here. Now we're going to wipe out the rest of the bond, and we put it to common share. So let's do that. We'll do it the IFRS way. And then we'll do it the Canadian ASPE way. So the IFRS way says, all right, let's get rid of the remaining bonds payable, which are 3.5 million. We'll get rid of the remaining conversion rights. Sorry, I should have said CS, contributed surplus conversion rights. It was 150 grand. We got rid of 45,000, so we got to get rid of $105,000 worth of conversion rights. We got to get rid of the discount on the bond, and there it is, 97,977. And the balance simply goes to common shares. So 3.5 million plus 105 minus 97,977, 3507023, 3507023. 023. And that's the same under IFRS or Canadian ASPE. So maybe I should scratch that out. Dealing with the inducement payment is different. So I'll do the IFRS way in blue ink and the Canadian ASPE way in green ink over here. So IFRS way, I think, again, this is one place I just think the Canadians, my fellow Canadians, I don't know. I find it unnecessarily complicated, but that's just me. The IFRS way, though, of course, either way, we're crediting cash, right? 108,500 is the amount of the inducement fee. The IFRS way just says, well, this is a loss on induced conversion. This is a loss. I'm just going to call it loss on conversion. Maybe I have to say induced. Loss on induced conversion. 108.5. Beautiful. The Canadian ASPE way, and that's it. So we're done. IFRS, you're done. IFRS, like and subscribe, say goodbye. Canadian ASPE, though, one more little step. So Canadian ASPE, it says the fair value, it says note for ASPE in part E, this is what makes us different. We got to know the fair value of the bonds because we want to know, well, how much did I lose on converting the bonds and how much did I lose on just the general conversion? And part of this is debt and part of it is equity. And we're saying, well, what amount applies to the debt loss and what amount applies to the equity loss? So the fair value of the bonds, 3462023, and the carrying value of the bonds, 3402023. So let's just take the difference there, 3402023, and you can see we're $60,000 apart. In other words, fair value of bonds, 3462. What was the number? 3462023. And the book value of bonds, 3402023. And the difference is $60,000. This is our loss on induced conversion. So, okay, we're going to credit cash, 108,500. The difference between the fair value and the book value of the bonds is our loss on induced conversion. So very similar to IFRS in terms of the language here. 60,000. And then the missing amount, just the amount that makes it balance, 48,500, it might be behind my head there. 48,500. We just debit to retained earnings. It's sort of an equity loss. So the debt loss is 60, the equity loss is 48.5. The debt loss flows through to net income. The equity loss just comes straight out of retained earnings. So Canadian ASPE, by far the quirkiest of the three, but there you go. I do prefer the US GAAP. I hate to say it. I know there's only Canadians left. Don't want to compliment the Americans too much and glaze them too much, but I think they get this one right, at least from a student and professor's perspective. That's the end, though, of, what is the problem? 16.1b. If you stuck around till the end, thanks. You're a real one. This was a challenging problem for sure. Thanks for watching. Bye. Let's jump into problem 16.3a. We're working on a convertible bond that is going to get retired. On December 31st, 2030, Atlanta Company issued $4 million of 6% convertible bonds at par, meaning 100%, no discount, no premium. They got 100% of the money they were asking for. Interest is payable semi-annually on June 30th and December 31st, and the bonds mature December 31st, 2040. Note, identical bonds without the conversion feature would have sold at 99% of the asking price, and the yield to maturity there is 6.14%. Now, this difference, this 1% difference, 4 million times 0.01, this $40,000 difference is a key difference between IFRS and US GAAP. US GAAP says the debt is the debt. Worry about the conversion when they convert. IFRS says that 1% difference, that $40,000 that we're willing to pay for the conversion feature, and that's what we are, that's equity, and we need to treat it as equity. we're going to do the US GAAP way first. It's simpler. Now, my lovely Canadian students, you need to learn US GAAP and IFRS way of doing this because both are allowed in Canadian accounting standards. But let's do the US GAAP way. It is pretty straightforward. December 31st, 2030, we're going to debit cash, of course, and we just got the full amount. We don't worry about the equity component here. We just got paid $4 million and we issued bonds payable at $4 million. Okay, now we make an interest payment, $4 million at 6% interest is $240 a year. But of course, we're not a full year later. We're 6/12 of a year later. And again, if we had discounts or premiums, we would have to amortize those, and our interest expense would be a little different here. This is June 30th, 2031. We're going to credit cash for $120. And we're going to debit interest expense. I left an extra line thinking I had a discount or premium to amortize, but we don't with this bond because it was issued at par. Then July 1st, we retire all the bonds. July 1st, 2031, get rid of all the bonds payable. Debit bonds payable for $4 million. But what did I pay to retire the bonds? Well, I paid $102. July 1st, immediately after the first semi-annual payment, Atlanta Company retires all the bonds for cash at $102. So these are $4 million worth of bonds, and I pay 102% of face value to retire them. I pay $40.80 in cash to get rid of these bonds. And what's the difference? The $80,000? That's a loss on retirement. And there you go. We've done this the US GAAP way. And if that's all you're learning, well, hit the like and subscribe and see you later. If you are an IFRS person or a Canadian that has to learn both, stay tuned. We'll do part 2 right now. It says redo A through C under IFRS or Canadian ASPE with, they make the choice to do it. Canadian ASPE people have the choice to do either one, but let's assume they choose to do the IFRS way with the following assumptions. On July 1st, 2031, fair value of the bonds excluding the conversion was $39.85. That's useful for the retirement, but we don't need that information right just yet. So here's how I like to deal with this. And this is the real key paragraph for IFRS. I like to pretend we issued those identical bonds because we're going to treat these bonds as if we issued them at 99, and then the extra 1% that was, we said, equity, we'll just treat it on its own. So we pretend like we have 99% bonds here, bonds issued at a discount at a 99 quote. So we debit cash, of course. Now, I'm going to change this number, but let me do this in blue ink, actually. So it is December 30th. I thought I switched to blue. I clicked the thing. Okay, there we go. It's December 31st, 2030. And we debit cash for $4 million times 99%. I'm going to change this number in a second, but will go with me for now. $39.60. So we're pretending we issued these bonds at 99. We're going to credit bonds payable, of course, for $4 million. And then the balance goes to the discount, right? If we issued them at 99, there's a $40,000 discount on bonds. Okay, so that's what this would have looked like at 99. But remember, we didn't issue at 99. We actually got $4 million cash, $4 million of cash changed hands. This doesn't balance anymore. And the $40,000 difference, what is that? That is, of course, the equity portion that we were discussing, that extra 1%. We said that's an extra $40,000, and we call that contributed surplus conversion rights. Okay, and so we've done our first piece. The second thing we were asked to do is the June 30th, 2031 interest payment, but we can't do the interest payment because we don't know the interest expense because we need to do the effective interest method when we're amortizing bond discounts or premiums. So let's get going with that. December 31st, 2030, our discount account balance is $40,000, and our bond carrying amount is $4 million minus $40,000. It's $3960,000. The next relevant date, June 30th, 2031. Our interest payment is based on what was written on the bond, 6%, the bond rate, 6%, and we divide by 2 to get 3 for semi-annual payment. Our interest expense is based on the market rate of interest, the yield to maturity, which is 6.14%. I've gone to great lengths to remind people I could make you calculate this, right? With a financial calculator, it's trivial, and even with a doing it by hand is not too bad. Okay, so we're 6.14% divided by 2 is 3.07% per semi-annual period, and now we can fill this in. This is, of course, a discount, not a premium. So 3% of the maturity value, 3% of $4 million is $120,000. 0.0307 times the preceding bond carrying amount times 3960 is 121,572. So to fill this thing in, 121,572 minus 120 is 1,572. And my discount account balance, 40,000 minus 1,572, 38,428. 4 million minus 38,428. 3961,572. And there's our table. The June 30th entry just falls out of the first 3 columns here. Our interest payment, credit cash, 120. Debit interest expense, 121,572. And the difference goes to discount amortization, which is just the discount. Credit our discount by 1,572. All right, now we're on to the last piece, the real key cornerstone element here. July 1st, 2031, we retire the bonds, and we retire them at 102, meaning we're paying 4080, right? 4 million times 102% is 4080. So let's start there. Let's credit cash. I'm going to leave a lot of room for more debits and credits because there are a lot more with this one. We're going to credit cash 4080, and what are we getting rid of? Well, we're getting rid of the bond, right? So debit bonds payable for 4 million. We're also getting rid of the contributed surplus on the bond. I'm just going to say contributed surplus, CR, conversion rights, 40,000. We're getting rid of the whole thing. We're also getting rid of the discount on the bond. Now, the discount was carried at 38,428, so let's credit the discount, 38,428. And now we are unbalanced, and there's 2 accounts we need to be worried about. 1, is there a gain or loss on the retirement of the bond? And 2, is there a gain or loss on the equity retirement here? The fact that we ditched this contributed surplus account. And the answer is generally there's going to be a little bit of both. So here's how we figure that out. The first step is just to say, okay, what's the fair value of the bond on the date of retirement? So it says on July 1st, 2031, the fair value of the bonds excluding the conversion feature was $39.85. And you can see the bonds are sitting here on our books at $39.61. That's a loss, because when we retire them, of course, we're having to retire at fair value, so we're losing here. So 39.85,000, that's the fair value. The book value, 39.61,572. We're going to subtract the two, 39.85,000 minus 39.61,572 is 23,428. That's a loss on retirement, so let's debit that. Loss on retirement. 23,428. And now this isn't going to balance, I don't think. If it balances, we're done. But if it doesn't balance, plug retained earnings, and that's our equity gain or loss on this disposal. So I'll add up the debits. I get 4063428 on the debit side. On the credit side, I get 41. I got to add this in my calculator. I'm doing it in my head. That's never a good sign. Plus 4080. 4118. 428. My credits are bigger than my debit, so I'm missing a debit. I'm going to have to debit retained earnings for the difference here. 4118428 minus 4063428 is $55,000 debit to retained earnings. And there we go. So the retirement, much tougher under IFRS than under US GAAP. That's why it's a question in most Canadian accounting textbooks. We have to learn both ways, and you can see it is more challenging. But we did it. We're up for the challenge. If you made it to the end of this, my goodness, smash one of those buttons on your way out. Thank you for watching, and I'll see you in the next video. Bye for now. Let's jump into problem 16.6a. We're doing stock options. We're not gifting our employees stock. We're not giving them stock grants. We're giving them options to buy the stock at a later date. On January 1st, 2031, Sentinel Technologies granted 30,000 stock options to key executives. The options allowed the executives to purchase the shares of Sentinel's $5 par value common stock at an exercise price of $50 per share. Because executive turnover is low, Sentinel estimates that none of the options are going to be forfeited. Bad news, the bonus question, they're going to be wrong. Some of the stock options are getting forfeited. The options are contingent upon the executives remaining with the company and vest evenly over a 3-year service period ending December 31st, 2033. The options expire on December 31st, 2035, so these options don't last forever. There is an expiry date on them, and we're going to have face that in this problem. Using an option pricing model, Sentinel Technologies determined the fair value, this is a key number, the fair value of the options on the grant date is $12 an option. So we're giving them compensation. All these numbers, they're going to come in handy later, but they're red herrings at this point. We're not going to use them now. We're granting our employees, well, I'll write it here, 30,000 options, and they have a value today of $12. 30,000 times 12 means we're giving them $360,000 extra on top of their normal comp package, their compensation package. Now, we don't recognize the expense all today because they earn out over the next 3 years. We got to recognize it over 3 years, so that's $120,000 extra in our compensation expense per year. So in 2031, that's $120,000 of extra compensation expense. 2032, 2033, it's $120,000 each year, adding up to this $360,000 in additional compensation because the fair value of the options is $12 per option. Okay, I'm actually ready to do journal entries, the first 4 entries. There's a bit of a subsequent events thing here. December 31st, the market price is this. The next year, the market price is that. And the next year, the market price is that. The market price does not matter to our entries. What matters is the fair value of the option on the date it was granted. That's all we care about. And at some points, these options are going to be not very valuable at all. Like in 2032, the options actually have literally no value, right? It's a $50 option. The stock is trading at 48. These options have like negative value. They might have some value theoretically in some tradable market, but they don't have very much value. The option value is fluctuating. We don't have to worry about that. We worry about the fair value on the date the options were granted. That's it. That's what we're concerned with. Okay, so let's do our first 4 here. For part A, we are granting $360,000 worth of options, like the value of the options on January 1st, 2031, but there's no entry because they haven't earned any of them yet. It's just a promise. It's a conversation, essentially, at this point. No entry on the grant of options. Now, if we granted them stock, It's as we will do in 16.7. It's a little different. That's why why I put that there. B, December 31st. 2031, well, there's $120,000 of comp expense each year, and that's what we're going to do. Debit, I'm going to just abbreviate this to compensation expense, $120,000. Our credit here is to additional paid-in capital, stock, options, and of course, my Canadians will know we don't use that account name. We call this contributed surplus. So additional paid-in capital, generally an American company thing, but we're talking about the same thing. So I'll use the American jargon, but you Canadians will know contributed surplus. And around the world, I think it's contributed surplus also. Follow your textbook. C, December 31st, 2032. Comp expense, 120. It's like straight line depreciation. Same entry each year. Credit, additional paid-in capital, stock, options, 120. D, same entry, December 31st, 2033. Debit, compensation expense, credit, additional paid-in capital, stock, options, 120. Okay, the easy part's done. Hopefully that was an easy part. The rest is not too bad either. So E says the July 15, 2034 exercise of options. Let's read that. It says executives exercised 20,000 options when the stock price was $70 a share. Okay, so they're making good money off their options, right? Basically printing money for themselves, but we don't care about what the stock price is even when they exercise the options. We just care, okay, they've exercised some options. What has happened? Well, from a journal entries perspective, they exercised 20,000 options. The exercise price is $50 per share, 20,000 times 50, that's $1 million of cash that they have to give us to exercise these options. So we're going to debit cash for $1 million, July 15th, 2034, debit cash for $1 million. Now they also have exercised options. These options don't exist anymore. So we got to get rid of the options. How many options got exercised? 20,000 of the 30,000 options. 2/3 of the options got exercised. Therefore, 2/3 of the additional paid-in capital related to options needs to go, right? 20,000 divided by 30,000 is 0.66667. And the total additional paid-in capital on the options, 120, 240, 360. So I multiply this by 360. $240,000 worth of options don't exist anymore. These options are gone. They've been exercised. So I got to get rid of the exercised options. 240. And what do I issue for those? Common shares, right? They turn cash and options into shares. Now, they might turn around immediately and just sell them on the market. Not my problem, right? That's different people from me dealing with them at market prices. I just issue at this price, and whatever the market's doing, I don't care. So I credit common shares. Now, if we had no par shares, I would just credit common shares for $12.40, right? Just the total here. Because we have par value, though, we're going to credit common shares for the par value, which is $5 a share, 20,000 options. It's $100,000 in par shares, and the rest just goes to additional paid-in capital, the traditional account, and again, contributed surplus for my Canadian friends. There you go. So that's E. F says stock market crashes. The price falls to $35 a share and the remaining unexercised options expire. So December 31st, we've got to do an expiry journal entry. Again, this one's like, it's not obvious what to do, but once you see it, it's like, oh, it's not hard. It's just not obvious what to do. Well, the options got to go away, right? We had $360,000 in total options sitting on our books. We have an account called options for $360,000. We exercised $240. So now the account's down to $120. And now we're saying, it's gone, right? Those options, poof, they're gone. So we got to get rid of the additional paid-in capital stock options, 120, get rid of the rest of them. And the credit here, kind of a weird one. I wouldn't have known to do this. Additional paid-in capital expired options. So we just have an additional paid-in capital account that tracks our options that have fallen off the table. It's just a reclassification from being valid stock options to being expired stock options. And there we go. We have completed the question up to the bonus. If you're done, though, you don't want to deal with forfeitures, that's fine with me. See you in the next video. But if you want to stick around, here's the bonus question. Stock option forfeiture. Assume the same information up till January 1st, 2032. On January 1st, 2032, two executives leave the company forfeiting 2,000 unvested options. Calculate the compensation expense that they should recognize for 2032 and 2033. I'm going to do 2031, 2032, and 2033. So here was our initial plan. 2031. Oh, let's do it this way. 2032, 2033, the plan. And the plan was we had 30,000 options, $12 an option. The plan was our total comp here was going to be 360. I'm going to use Ks here. 360K, and that's 120K per year. At the end of year one, on January 1st, year two, two of our executives leave. And they take their 2,000 options and they basically say, well, I'm never going to cash these in because I'm gone from the company, and they're forfeiting their options in so doing. So what we do is we say, okay, I wish we had known that. We had a plan that was 30,000 stock options, fair values $12 each, $360,000. I wished I knew that before, because I wouldn't have granted these guys their 2,000 options. I would have only had a plan that had 28. I would have excluded these two from the option pool, and 28,000 times 12 is 336,000. So if I could do it again, these numbers aren't going to be relevant. Well, they're relevant for me to explain it, but they're not going to come into our answer. The do-over plan, which is like get rid of those two guys from the plan. I thought nobody was quitting, but I had two people quit on me, would be 336, and 336 over 3 years is 112 per year. So here's the correction now. Now this is the answer, so I'll call this the correction. I already did 2031. This has already happened. So we're existing in the year 2032. I already did 2031. And I'm $8,000 too high in 2031. I know I want to end up with 336K of total compensation. That would be the right number. And I just have to adjust to that number. And so I'm going to fix 2032. How would I do it? Well, this one, 2031 was 8K too high. So I'm going to make this one too low. I'm going to say, okay, I'm going to reverse that out. Now, there are certain errors that we would make retrospectively. We would adjust it through retained earnings. We'd say, oh, shoot, I should never have done that. This is one that's made prospectively. We go, okay, let's just adjust going forward. Let's adjust this to the right number, and we'll fix it in 2032. So to fix it in 2032, we make our comp expense not 112, what it should be. We actually make it $8,000 too low because we were too high last year. We fix it by going $8,000 lower than what you would think, 104K. And then in 2033, it is just the 112. And if I did it right, hope I did, 120 plus 104 plus 112 is 336. So this is the answer to the question. Let me zoom in on that because I'm a little bit messy there. So the question says, calculate the compensation expense Sentinel should recognize in 2032 and 2033. They should do 104K in 2032 and 112K in 2033. Kind of a weird situation. US GAAP will say fix it right in the moment as soon as they quit. IFRS says wait till the end of the year to fix it. They both end up in the exact same place. There you go, though. We have solved 16.6a. If you made it to the end, smash the button, and I'll see you in the next video. Thanks for watching. Welcome to Module 17 of our Intermediate Financial Accounting class. This module, earnings per share. Just one number is the answer to a lot of our questions this chapter. Not a ton of journal entries. In fact, no journal entries at all. We are just calculating this very important number. It's so important. Like the biggest companies in the world, when they talk about how they're doing, look at this. Apple reports second quarter results. In like the headline, they talk about earnings per share. In the first paragraph, they'll talk about earnings per share. The most important companies in the world, when they report their earnings, they highlight the earnings per share. And why do they highlight the earnings per share? Because shareholders really care about it. Here's Microsoft, same deal. In the first paragraph, they talk about their earnings per share. And so we've got to learn how to calculate earnings per share. We'll start by learning how to calculate something called basic earnings per share. And basic earnings per share, here's the formula: net income minus preferred dividends divided by the weighted average number of common shares outstanding. That's the formula. You'll hear me say that 800 times this chapter. I'm going to say it a lot. But let's even make it more simple. Let's assume we're calculating this basic earnings per share for a company that has no preferred shares and therefore no preferred dividends, right? So no preferred dividends. And let's further assume they don't issue any common shares. So the common shares is just the same number all year. So the average common shares is just one number. So our company made $1 million in profit. And let's say we had 200 common shares. So divide by 200 shares. And so again, no preferred dividends, so minus 0, and no shares were issued or bought back during the year. So it's just these 200 shares. Well, let's do some math. I should have done math I could do in my head. I believe our earnings per share here is $5,000 per share, if I've done the math in my head properly. Now that's a huge number. You saw like Microsoft and Apple were like $3 or $2 or something. 5,000 is a huge number, but it's a number I can wrap my head around. So let's say I owned 20 shares in the company. I would go, okay, 20 times 5,000. My shares in the company have earned $100,000 for me. So you, as an owner of the company, you own the profits of the company. And what this is saying is your share of the profits is $5,000 per share that you own. That is a very useful number to know. Now, keep in mind, the board of directors and the company may not just pay you the dividend. They might not give you the money, but it's a nice like scoreboard number. It's a single number that summarizes how you did, and you'd compare, this year to last year, right? So when we look at Apple or Microsoft, every time they talk about their earnings per share, they say it's this number, but then they say, it's 23% higher than last year. And Apple's was very close, 22% higher than last year. And so as a shareholder of this company, you go, it's 5,000 this year. Was that up or down from last year? And you'd see how you were doing. So this chapter, we'll start with that very basic earnings per share calculation, and we'll just layer on complications. So what are the complications? Well, one, what if we do have preferred shares? Here we said we didn't have any preferred shares. Well, what if we do? What if the company issues shares during the year or does stock buybacks during the year? How do I deal with that new average number, right? We don't just take the year end, we take a weighted average. So we'll learn how to do that this chapter. And the other key point of the chapter, and this we'll spend more time on, is these companies don't report their basic earnings per share. They report their diluted earnings per share. So when I look up at Apple's, it's diluted earnings per share. Well, what the heck is diluted earnings per share? And diluted earnings per share is, for example, if I have a bunch of employees that have stock options that are going to turn into common shares, but they haven't exercised their options yet, well, what would my earnings per share be when those people finally decide to exercise their options? And of course, it'll be lower because there's more shares, right? The number of shares is higher because, our employee stock options cash in. They end up issuing new shares to the employees because the employees have options. Well, this denominator, this number gets bigger, and therefore my diluted earnings per share is lower. And that, as a shareholder, is what I'm interested in. I'm not interested in the basic earnings per share. I want to know, well, what happens if all the stock options come in? What happens if the convertible bonds convert into shares? What if that happens? How does that affect my earnings per share? Well, that's called the diluted earnings per share. and that will be a major focus of our chapter. But as I always say, the best way to learn this is not to hear me blah, blah, blah about it. The best way is to do examples. And I've got tons of great examples this chapter. I can't wait to get started. Thanks for being here, and I'll see you in the next video. We're about to tackle 1718. You can download the problem from my website, tonybell.com. No sign in, no sign up, nothing like that. You just click the PDF link. You can have a copy of the problem for yourself. Let's jump into the problem. Let's jump into problem 1718, an earnings per share calculation. They don't get much more straightforward than this one. Let's go through it. Laser Company has net income of $100,000 and 20,000 common shares issued and outstanding throughout the year. The company didn't issue or repurchase any shares and doesn't have any preferred shares. Okay, so the earnings per share, very straightforward concept. It's your net income divided by the number of shares. And so, in this case, it's $100,000, our net income. Now, it says minus preferred dividends. Well, we don't have preferred shares, so no preferred dividends. So $100,000 minus 0 divided by the number of shares, 20,000 shares. So $100,000 divided by 20,000 shares. Our earnings per share is $5 per share. So mechanically, pretty easy question. What we're going to find this chapter is it's not the numerator, it's not the net income minus preferred dividends that's hard, it's the denominator, and we're going to spend tons of time on that. But this question, the weighted average number of common shares is 20,000 because we only had 20,000 shares. But if a company's issuing shares, buying back shares, there's stock dividends, it gets complicated. This one, though, not that complicated. So we've solved part A. It's $5 per share. I didn't even need my calculator for that one. Part B says, assume the exact same facts above, except the company did have 10,000 preferred shares outstanding all year, on which a $1 dividend was declared and paid. Okay, so net income is $100,000, same as it was before, but the preferred dividends are $10,000, right? It's in dollars, 10,000 shares, $1 dividend per share. The denominator stays the same, 20,000 shares. So the math here is $100,000 minus $10,000. Net income minus preferred dividends, 90, divided by the weighted average number of common shares outstanding, which in this case is 20,000 common shares all year. The preferred shares, the fact there's 10,000 preferred shares doesn't come into the calculation. So it's just going to be 90,000, the numerator, divided by 20,000 shares, the denominator, and that's 4.5. $4.50. So our answer to part A, $5 a share is our earnings per share. Our answer to part B, $4.50. We're done, 17.1a. In 17.2, we'll spend quite a bit of time going over how to calculate the weighted average number of common shares outstanding. I'll see you there. Stay tuned for that one. Thanks for watching, and I'll see you in the next video. Oh yeah, if this helped, for goodness sakes, hit the button. Bye. Let's jump into problem 17.2a, the weighted average number of common shares outstanding. The denominator of our earnings per share calculation is more complicated than we've let on in previous problems. And here's the first step. Large S company began 2031 with 90,000 common shares issued and outstanding. The following events occurred during the year. They issue some shares, they buy back some shares, they issue some more shares, and it says, what's the weighted average number of shares outstanding? Because you wanted to go, okay, earnings per share, net income divided by the number of shares. Well, how do you get the number of shares when we had 90 to start the year and we issue and buy back a bunch? Like, what's the number to use in the denominator? That's what we learn in this video. So here's how you do it. You sort of go, okay, I started the year with 90,000 shares outstanding. How many months did I have just 90,000 shares before I issued the new shares? And I had it for January and February, because on March 1st, I issue a bunch of new shares. So for 2 months, for 2/12ths out of the year, that's how many shares were issued and outstanding. Then on March 1st, I issue 60,000, meaning I have 150,000 shares total. 90 plus 150, or 90 plus 60 rather, is 150. How many months did I have 150? Well, March, April, May, June. 4 months. 4 months I had 150. Next up, I buy back 30,000 shares. So 150 minus 30, I'm down to 120. And for how many months did I have 120? Well, July, August, September. Don't count October because it's October 1st. 3 months. And last, we issue 75,000 more shares, bringing us up to 195. And that's for October, November, December. That's also 3 months. You multiply these through, you'll get the weighted average number of common shares outstanding Let's do that. 90,000 times 2 divided by 12 is 15. 150 times 4/12 is 50. Quick cough. 120. I should be able to do this one in my head. Times 3/12 is 30. 30,000. And 195 times 3/12. There's no way I can do this one in my head. 48,750. Okay, so then we add them up. 15 plus 50 plus 30 plus 48,750 is 143,750. That's our answer. That's the weighted average number of common shares outstanding. And when we go to calculate earnings per share, that's the denominator, right? 143,750. Part 2. It says compute the number of shares issued and outstanding that would be on the balance sheet. Well, that's easy. You just go, okay, I had 90,000 shares to start, went up by 60, went down by 30, so minus 30, and then went up by 75. It's just this number, right? 195,000. That's the number we tell our shareholders are issued and outstanding, but that's not the number we use in our earnings per share calculation. And there you go. You've solved 17-2A. Thank you for watching, and I'll see you in the next video. Bye for now. Let's jump into problem 17-4A. We're doing basic earnings per share calculations, and basic doesn't mean easy. Basic means we're not doing diluted earnings per share calculations, which we're going to do later in the chapter. Let's jump into the problem though. Tannis Company began 2031 with 200,000 common shares issued and outstanding. Following events occurred during the year related to its common shares, and we issue some shares, we buy back some shares, we have a stock split. Now, when we have a stock split, the math is when we're calculating our weighted average number of common shares outstanding, which we need to do, right? It's related to an earnings per share calculation, so we're always calculating this weighted average number of common shares outstanding. We pretend the stock split happened at the start of the year. We apply it almost retroactively in our calculation. So we didn't have 200,000 common shares to start the year. We just act like, oh no, we had 400,000. Okay, so that's what makes the math work here. And on December 1st, we issue some more shares. All right, so let's do our weighted average number of common shares outstanding. This is the key calculation to any earnings per share question. Let's get it out of the way here. So we started the year with 200,000 common shares out there, but remember, we know there's a stock split coming on October 1st. I often cross this line out because I don't want it to confuse me in my number crunch, but I just have to remember, oh, anything that happened before the line, double its effect. So 200,000, no, I actually had 400,000 common shares issued and outstanding as of January 1st. And how long did I have that number? Only for a month. Then I issue some new shares. So that's for 1/12 of the year. On February 1st, I issue 60,000 shares. Well, I'm going to act like I issued double that. I'm going to act like I issued 120, and 60,000 times 2 is 120, leaving me with 520. I need a running tally here. So 520,000 common shares issued and outstanding. And for how long? Well, something weird going on with my screen here. How many months? February, March, April, May, June, July, August. Don't count September. It's 7 months later. 7/12. Then I buy back some shares on September 1st. So I buy back 30,000 shares. Again, this is before the split date. So we doubled the effect here. We go 30,000 times 2. Now it's a buyback, so it's going to reduce this by 60. We go from 520 down by 60. We're going to go to 460 in our running total. How many months do I have 460? Well, from the repurchase to December 1st. So September, October, November, don't count December. 3/12 of the year, I have 460,000 outstanding. And then in December, I issue shares. Thankfully, it's after the split. I don't have to worry about doubling it. I just go 120,000 new shares. I had 460. Add 120, I'm at 580. And that's for 1 month. That's for the month of December, 1/12. Okay, let's crunch the numbers. 400,000 times 1/12, 3333. 520 times 7/12, 303 333. 460 times 3 twelfths. 115, nice even number there. And 580 times 1 12th, 48333. 48333. Okay, so I can see a funny math thing's about to happen, but let's calculate the number. 33,333 plus 303,333 plus 115 plus 48,333, 49,999. It's 500, right? These are all 0.33, and if you add them up, it is 500. So I'm going to use the number 500, pretend I didn't round it. Probably you shouldn't be rounding. If you were off by 1 share, I wouldn't penalize you, but maybe your professor isn't so wonderful and kind as I am, so be careful there. But 500,000 is the true number. I can just see it looking at all those 0.333s. That's what's happened. Okay, let's continue. So that's our denominator. Our weighted average number of common shares, we're going to be dividing everything by 500,000. That's the correct denominator in our earnings per share calculation. It notes the company had 100,000 non-cumulative preferred shares issued and outstanding for the year. The company declared and paid a $2 cash dividend per share on preferred shares, so $200,000 of preferred divs. That's going to be in our numerator here. And it also says the following information comes from the company's income statement. The income from continuing operations was 600 grand. We had a loss on discontinued operations of 150 and net income of 450. If you have discontinued operations, you actually have to calculate 3 earnings per share. Start with the top one though. Income from continuing operations, 600K. We go 600 minus 200 is 400 divided by 500, 0.8. So this goes in as 0.80. Interestingly, when we do our discontinued operations one, the 150 here, it's, well, negative 150. We do not deduct our preferred dividends. Why? Well, we only want to deduct it once. We didn't pay 2 preferred dividends here. We didn't pay our preferred dividend from our continuing operations and a preferred dividend coming from our discontinued ops. There's only 1 preferred dividend to go around, and we want to apply it to our continuing operations because that's, shareholders are going to see that continue, right? The preferred dividend would be expected to continue even if we shut down our, some foreign subsidiary or something like that. So we don't take away the preferred dividend here. We just go 150 divided by the number of shares, negative 150 because it was a loss, divided by the number of shares, and we get negative 0.30, usually a loss from discontinued operations. Not always. You can make money from a discontinued operation. Now this one, the math works 2 ways. You can go 0.8 minus 0.3 is 0.5. That's probably the easiest way to do it. Or you can go 450, our net income, minus the preferred dividends, 250 divided by 500, and yeah, sure enough, it is 0.5. So we got it 2 ways. How would this appear on the income statement? It would appear at the bottom of the income statement. We would have like basic earnings per share as a heading, right? And then you just do these 3 lines. Income from I don't know why I put a point there. Continuing operations, and it would be 0.80. Then we'd have loss from discontinued operations, it'd be negative 0.30, and then you'd have net income, and it would be 0.50. And there you go. That's what your earnings per share would look like on the income statement. That's what we were asked for. Prepare the basic earnings per share as it would appear on the company's financial statements. It would appear at the bottom of the income statement, and it would look like that. All right, there's one more thing I'd like you to look for. Look for the thumbs up button. Maybe look for the subscribe button. Call your friends, call your neighbors. Say, this is a great channel. I recommend it. Thanks for watching, and I'll see you in the next video. Bye for now. Let's jump into 17.5a, diluted earnings per share. So we're always answering the question in these types of problems. We're answering the question, what if they convert their convertible shares? What if they convert their convertible bonds? What if these stock options cash in for shares? What if they exchange their options for shares? What if this happens? What does it do to our earnings per share? And if it brings our earnings per share down, we recalculate it and we call it diluted earnings per share. Let's jump into the problem. Kevin Company reported net income of $600,000 for its 2031 fiscal year. So I'm already thinking, okay, these earnings per share questions. You're going to be calculating basic earnings per share. So when I get a number like the net income 600,000, I'm already thinking of this formula: net income minus preferred dividends divided by weighted average number of common shares outstanding. Well, we have the net income 600,000. The company has the following share information for the year 2031: 200,000 common shares issued and outstanding for the whole year. Well, that's our weighted average number of common shares outstanding. We didn't issue or buy back any shares that we have to do some weighted average calculations. That'll come later. We will have to do that, but for now, just 200,000 is it. 20,000 non-cumulative convertible preferred shares issued and outstanding for the entire year. The company declared and paid a $5 per share dividend on the preferred shares. Well, it's 20,000 shares. There's a $5 dividend. That's $100,000 of preferred divs. Each preferred share is convertible to 4 common shares. Because they didn't convert anything, it doesn't affect our basic earnings per share. This is the calculation. So it's 600 minus 100, that's 500, divided by 200, $500,000 divided by 200,000 shares. Our basic EPS is $2.50 per share. That's our earnings per share. That is our answer to part A. Part B, we say, well, what if we converted? Now, we could do this very easily in one step, but I actually prefer to do it in 2 steps because future questions are going to require us to do this. We got to answer the question first: is it dilutive? The answer here is yes, this is dilutive. I phrase the question in that way. In future questions, we'll have some things that are dilutive and are not dilutive, and we'll even mix and match them together. So it's important for us to do this first step, even though it's going to take a little extra time here. The step is we answer the question: is it dilutive? It's like a game show. Is it dilutive? So here's how we deal with that. We say, okay, if we diluted, how would it change the numerator, the top part of this question? So if they all converted, 20,000 shares preferred shares converted into common, would it change anything in the numerator? And the answer is yeah, it would change the preferred dividends, right? Our preferred dividends would go to 0. They were 100,000, they're going to go to 0. So if we converted, the numerator would go up by $100,000. We wouldn't have this minus 100 in there. It would be 600 minus 0 equals 600. What about the denominator? Would that change? And the answer is yeah. If they converted 20,000 shares, 4 shares per preferred, 4 common shares per preferred, that would be plus 80,000 to our denominator, right? There'd be plus 80,000 shares. So $100,000 divided by 80,000 shares, 1.25, I think. My math, yeah, okay, my math did work there, 1.25 per share. And so to answer the question, is it dilutive? The answer is, if this number we calculate is lower than our basic EPS, and it is, it's dilutive. And if it's dilutive, it means you run the number, you compute diluted earnings per share. If it was higher, if this was like 3, we would just stop there and we'd go, 250, that's our diluted earnings per share also. But because it's lower, and of course it's going to be in these examples where we're learning this, if it's lower, then we have to do the calculation. So we redo this earnings per share calculation. Maybe I'll use green ink or something. And we redo it as if they had converted. So our net income, if they converted, is still 600,000. Our preferred dividend is 0 because our preferred shareholders are converting, and we divide by the new weighted average number of common shares outstanding, which we said was 280,000 common shares outstanding. And just to reiterate that, that's 200,000 converts 4 shares per, so that's why there's 80,000 new common shares if all our preferred shareholders convert. 600 divided by 280 is 2.14. We'll just round to the penny for these ones, $2.14. That is our diluted earnings per share. Now, if you or me, if I were you and I was a student, I would go, I'll just do this. Like, why did I do this whole is it dilutive bit at the bottom? You have to do this in future questions, so it's good to get in the habit of doing it now. And the other thing it's good to get in the habit of is hitting one or both of those buttons. Thank you for watching, and I'll see you in the next video. Bye for now. let's jump into problem 17.6a. We are doing diluted earnings per share on convertible bonds. So we'll start by calculating the basic earnings per share, and then we'll get on to the diluted earnings per share, which answers the question, we have these bonds that convert to common shares. What if they converted? What would that do to our earnings per share? Well, we'll find out. Mason Company reported net income of $720,000 for its 2031 fiscal year. Well, we've already got a good chunk of our numerator here. We remember the basic earnings per share formula by now. I hope you've memorized this. I would not rely on my professor to give me a formula sheet for this one. Net income minus preferred dividends divided by weighted average number of common shares outstanding, and they've given us the net income. The company's tax rate is 25%. Well, net income taxes have already come out. They give us the tax rate because it's going to be relevant for our convertible bonds. The company had the following information related to its capital structure. I just implanted the word topic into that sentence for no reason. And they have 250,000 common shares issued and outstanding for the entire year. So the weighted average number of common shares outstanding is 250. Now, you can already imagine, I bet you've already seen it in your class, calculating, the weighted average number of common shares becomes a challenge. And so if you sort of layer these things on top of each other, right, we've got some dilutive security. The weighted average number of common shares has to be calculated because there's issuances and repurchases of shares. These questions can get more and more complicated, and we'll do that in this chapter. But this is a straightforward one where they just said, we only had 250,000 shares. They were issued and outstanding the whole year, so they gave us the number. That makes our life easy. $1 million of 6% convertible bonds issued and outstanding for the entire year. Interest is paid annually on December 31st. Each $1,000 bond is convertible into 40 shares. Okay. So compute basic EPS. Well, net income is 720. Preferred dividends, there's no preferred shares, so that's 0. The weighted average number of shares is 250. This bond paragraph, totally irrelevant to basic earnings per share. It doesn't come into the calculation at all. We've got the numbers. 720 divided by 250, 2.88. So our basic earnings per share, $2.88. Now we got to do diluted earnings per share. Before we do diluted, though, I want to encourage you to answer the question, is it dilutive? Again, when we do this, you might look at this and go, I can cut a corner here and I can just calculate the diluted earnings per share. Is it dilutive becomes super important in future questions. It's a good thing to do. It's a good thing to practice. So let's practice answering the question, is it dilutive? So how do I know if it's dilutive or not? I check if they converted, how would it change the numerator and how would it change the denominator of this, this ratio here? So if these convertible bonds converted into common shares, let's start with the denominator. I got $1 million worth of bonds. They're $1,000 each. So $1 million divided by 1,000 is 1,000. $1 million divided by 1,000 equals 1,000. So I have $1,000 bonds. They can each convert into 40 shares. So if they converted, multiplied by 40, I'd have 40,000 more shares. I wouldn't have 250,000 common shares. I would have 290, right? Plus 40. So the denominator, if everybody converts, the denominator is going up by 40,000. There's 40,000 new shares in the world. What about the numerator? How does the numerator change? And the answer is, oh yeah, these things, they're interest paying, these bonds, 6% interest. So $1 million times 0.06, that means I would save $60,000 in interest. And you might think, oh yeah, I saved $60,000 in interest. Therefore, my net income is $60,000 higher, right? $60,000 less cost. The issue here is the interest is pre-tax. We need after-tax. So how do I get the after-tax number here? You multiply by 1 minus the tax rate, 1 minus 25%. So 1 minus 25%, so 0.75. So 60,000 times 0.75 net of tax. The net savings here is 45 grand. Again, it saves us 60 grand in interest. And if we save 60 grand in interest, of course, your pre-tax profit goes up by 60 grand, but then your taxes go up by 15,000, meaning overall you're only saving 45. So our numerator, our net income is going to go up by 45,000. So plus 45,000 45,000 divided by 40,000 is 1.125. So is it dilutive? Whoa, I just stretched out my calculator. Things went crazy on my screen. I don't know if it looks that way on. Holy mackerel. I'll fix this later. My calculator just went insane. So sorry, I'm totally thrown by that. We want to compare our calculation here to the 288 above. If it's lower, it's dilutive. So we said 1.125 down here. It's lower than the 2.88. It's dilutive. So we can then calculate a diluted earnings per share. Same formula, net income, but it's the new net income. If we converted, our new net income would be 765. That's plus 45 above what our net income was, 720. So 765, 720 plus 45. Still 0 for the preferred dividends. And our new weighted average number of common shares is plus 40. So it was 250. It's going to be 290. 765, my calculator really did something crazy, divided by 290 is, I can't even see the number. Can you see the number? This is the weirdest thing that's ever happened in the history of calculators. 2.64. Okay, 2.64. Thank the Lord I could find it there. I do have to adjust something. Something went weird. $2.64. So that's our diluted earnings per share. We've done it. We've solved despite the tech difficulties. If you were impressed with how gracefully I handled that tech problem, did I even handle it gracefully? Can you even see the number? Let me see. Pull it down. I'm going to move it over. Look at that. There it is. 2.64. I'll fix this later. Thank you so much for watching. Thanks for suffering through it with me. If you made it to the end, hit one of those buttons and I'll see you in the next video. Bye for now. Let's jump into problem 17.8a. Finally, a question with multiple items that we need to consider for dilution. Let's jump into the problem. Ottoman Company reported net income of $400,000 for its 2031 fiscal year. So we start all these questions by calculating the earnings per share because you need to know the basic earnings per share to know if something's dilutive. So you always start by calculating basic EPS. Otherwise, it'll have to be given in the question, but I make students calculate it. The tax rate is 25%. We know we use that for our bonds and interest and things like that on dilution. The company had the following information related to its capital structure for 2031. 200,000 common shares issued and outstanding for the entire year. So again, they've made this easy on us. We're not having to calculate the weighted average number of shares outstanding. It's just given 200,000. It goes on to say 5,000 non-cumulative convertible preferred shares issued and outstanding. The company declared and paid $3 dividends, so 5,000 times 3 is 15,000. So that's our preferred div. And at that point, we have the information we need to calculate basic EPS. Net income minus preferred dividends. There's nothing I'm going to read that's going to change my opinion about that, so I can just stop there and do it. 400 minus 15 divided by 200,000. 1.925 will round to the nearest cent, so 1.9. Well, I'll put 1.925 and then 1.93. Okay. It says for each of the 3 potentially dilutive securities, determine whether it's dilutive or anti-dilutive. Show your work. Okay, so we'll start. We're going to do preferred shares, then convertible bonds, and last we've got some stock options. So let's go through each of these and determine if they are in fact dilutive. So I've done a little table here. Is it dilutive? And we'll look at the bonds, the shares, and the stock options. Bonds and shares, you do them the same way. So let's start with those preferred shares. And we say, okay, if they converted, how would it change this equation? How would it change the numerator and denominator of the equation? So if the preferred shares converted, of course, the most obvious thing is there's no more preferred dividend. The numerator is no longer 385,400 minus 15. It's just 400. The numerator goes up by 15,000. So let's note that. Numerator change plus 15,000. If my preferred shares convert, my numerator goes up 15, but also my denominator goes up because I got a bunch of new shares. How many new shares? Well, it just so happens they convert at a rate of 3 common shares, so it's actually 15 also. That's a little weird, but the denominator goes up by 15,000 common shares. So my answer is 1, right? That's the level here, and I have to compare to this number, and if it's lower, it is dilutive. So the answer is yes. Dilutive. let's continue. Let's read the bit about the bonds. $500,000 of 8% convertible bonds issued and outstanding for the entire year. Interest is paid annually, and each $1,000 bond is convertible into 10 shares. So I got 500,000 bonds. They're $1,000 bonds, so I have 500 bonds, and they're each going to convert into 10 shares. So potentially 5,000 new shares. So my denominator is going to go up by 5,000. If everybody converts, I'll have 5,000 new shares. They're 8% bonds, so 500,000 times 0.08 is $40,000 of interest that's going to be saved, but we want to net it of tax. It's 25% tax rate, so you go 45,000 times 1 minus 25% times 1 minus the tax rate, which is 0.75. So 45,000 times 0.75 is 30,000. So our numerator goes up by 30,000. We save 40,000 in pre-tax income, but that's an additional $30,000 in post-tax net income. So my numerator goes up by 30,000 as a result of this. So 30,000 divided by 5,000 is 6. Is this higher or lower than our basic EPS? We're always comparing to our basic EPS, and the answer is it's higher, therefore it's anti-dilutive. It is not dilutive, anti-dilutive. The last one. 20,000 stock options issued to employees and outstanding for the entire year. Each option allows the holder to purchase 1 share. Okay, so there could be 20,000 new shares out there at an extra price of $30. The average market price of the shares is $24. Okay, if the exercise price is higher than the market price, nobody is going to exercise their options. It's anti-dilutive. These are not in the money. They're out of the money. So no, and therefore it is anti-dilutive, and therefore we don't consider it. So in terms of what's dilutive here, just this one. Now, in future problems, we're going to have multiple dilutive items, and then we have an order of operations that we need to go through. But here, since we only have one item that's dilutive, we just deal with it. So we're going to increase the numerator and denominator by 15,000, and we're going to solve. So all I do is I go, okay, well, if these diluted, plus 15,000 here, let me do this different color ink maybe just to make it stand out, plus 15,000 here and plus 15,000 down here. There's obviously there's no more preferred dividends, so that's why we plus 15. These two kind of cancel each other out. We just have 400. And then we have 15,000 more common shares as they converted at a rate of 3 per share. And there was 5,000 preferreds, 3 per share. So 15,000 new shares. So what does my new diluted EPS look like? 400,000 divided by 215,000, 1.86 is my diluted earnings per share. Like I said, in future problems, we're going to dilute multiple things at the same time, and it does get a little harder than this. But we've made it to the end. You've solved 17.8a. Now solve finding the like button, and see you in the next video. Thanks for watching. Bye-bye. Let's take a look at problem 17.9a, a really big earnings per share question. So Belmont Company reported net income of $3.2 million for its 2031 fiscal year. The company's tax rate is 25%, and the company had the following information related to its share capital. Looking at the required, we're always asked to do basic earnings per share first, and we already have some basic earnings per share info. You, of course, have this formula memorized. If you don't and you're taking an intermediate accounting class, you should. Net income minus preferred dividends divided by weighted average number of common shares outstanding. That is our formula for basic earnings per share, and we've just been given the net income. So let's sort of get this thing started. 3.2 million minus the preferred dividends divided by the number of shares, and let's read on. 2 million common shares were issued and outstanding for the entire year. So the weighted average number of shares outstanding is 2 million. That's easy. Again, future questions, we're going to have share issuances, stock buybacks. We're going to have to deal with the weighted average number of common shares changing. But here they've made it easy on us because you'll see the question's complicated enough. This will probably take 15 or 20 minutes. You can look at the timestamp in the video and see how accurate I was. But it's a substantial question even without having to wrestle with this. But future questions we will. they'll have to. Okay, so we're just missing preferred dividends, and look at that. The next bullet down talks about that. 100,000 non-cumulative convertible preferred shares issued and outstanding for the entire year. Company declared a $5 cash dividend. So, okay, we got 100,000 shares. I don't need the calculator for this, but I multiplied by 5 and got my $500,000 in preferred dividends. And I think we're there. All the other stuff, these are potentially dilutive securities. We've got 4 of them. We got preferred shares there. We've got Series A bonds, convertible bonds. We've got Series B convertible bonds, and we got some stock options. We're going to have to test these for their dilutive properties, but for basic earnings per share, they're just not relevant to our calculations. So I'll jump ahead and just do the basic earnings per share calculation. 3.2 mil minus 500,000 divided by 2 million. Can I do this in my head? You think I could do it in my head? I can't. I just realized I can't. Why did I even threaten to? 1.35. Let's go. I pulled it out of the fire there. It was rattling around in there somewhere. 1.35. Let's go. Okay, so our earnings per share is $1.35. Is this good or bad? We have no idea, right? We'd have to see the previous year. The next step, and sort of this is, I do these 2 in 1, well, really 3 in 1. Basically, we're trying to get to diluted earnings per share. And how do we do it? We look at each of these items, 1, 2, 3, 4, and see if they're dilutive and how dilutive are they compared to each other. And we rank them. So let's start with our convertible preferred shares. It says 100,000 non-cumulative convertible preferred shares issued and outstanding. The company declared and paid a $5 per share cash dividend on preferred shares. Each preferred share is convertible into 4 common shares. Okay, 100,000, if they all convert, that's going to be 400,000 new common shares. And you'll remember, is it dilutive for convertible shares? You just go, okay, well, how would it change our formula? And the answer is, our denominator is going up by 400,000. There's going to be 400,000 new shares, 100,000 times 4. But our numerator also goes up because we're not going to pay the dividend, which reduced our numerator by 500K. Well, our numerator goes up by the amount of that preferred dividend, 500K. So the math here, 500 divided by 400, it's 1.25. Is it dilutive? Well, 1.35 is the number of basic earnings per share, so it's under 1.35. It's 1.25. It looks dilutive to me. Let's continue. Now, there may be a little asterisk beside that. We will see how things go. Next up, 5 million of 4% convertible bonds issued and outstanding. Each $1,000 bond is convertible into 100 shares. Okay, so $5 million worth of bonds. They're $1,000 each, so that's 5,000 bonds. Each bond changes into 100 shares, so that's 500,000 new shares potentially. So our denominator change, if we were to convert all of those bonds, would be 500,000 new shares. Our numerator change, if they all converted, we'd have interest savings, right? That's the benefit here. 5 million times 0.04, $200,000 interest reduction, but we know that's not the after-tax amount. That's pre-tax. We got to take out the tax. The way you take out the tax is you go, okay, I'm saving $200,000 in pre-tax dollars, multiply by 1 minus the tax rate, 1 minus 25%. So we're going to multiply by 75%. It's not $75,000, it's $150,000. That is our net savings, right? We save $200,000, but that juices up our tax bill by $50,000, so we only save net $150,000. But that does increase our net income by $150,000. 150 over 500. Can I do this one in my head? 0.3, is it? 0.3? It's got to be 0.3. 150 divided by 500. 0.3. I am on it today, folks. I am on it. I'm going to screw it up. I just know it. I can't. You can't talk like that. You're jinxing yourself. You're talking bad things into existence when you're like, oh, everything's going so well today. And then, like, an anvil hits you on the head. Okay, well, this is dilutive, right? It's more dilutive than the convertible. because it's lower. The lower it is, the more dilutive it will be. The convertible preferred share, I should have said. Next up, $2 million of 9% convertible bonds issued and outstanding. Each $1,000 bond converts into 20 shares. Okay, so $2 million worth of $1,000 bonds means there's 2,000 bonds out there, and they convert at a rate of 20 to 1. So if I have 2,000 bonds, it means I could have up to 40,000 shares if everybody converted. So it's a plus 40 in our denominator. What is it to our numerator? Well, it's the interest savings, right? We're going to save 2 million times 9%, 180K. Oh yeah, it is 180. My calculator failed me. 2 million times 0.09. 180,000. We do the same thing, multiply by 1 minus the tax rate. I'm just going to multiply by 0.75 here. 180 times 0.75, 135,000. That's what our numerator will increase by. We have a significant savings here. 135 divided by 40,000, 3.375. This is anti-dilutive. So it means we're not going to use it in our calculations. And why is it anti-dilutive? It's above the basic earnings per share. Last one, the stock options. The question we answer on stock options are they in the money? Would a rational employee that has the stock option exercise the option? That's the question we need to answer. So it says 300,000 stock options issued to employees. And outstanding for the entire year. Each option allows the holder to purchase one share at an exercise price of $20. The average market price of the company's common shares was $25. Okay, so these are in the money options. These are absolutely dilutive. A reasonable person would exercise these options because you're making money. You're printing money for yourself as somebody holding a $20 option to exercise on something that's worth $25. Yes, these are absolutely in the money and therefore dilutive. And therefore, they are the most dilutive of anything on our list because the answer here is going to be 0. But let's do the numerator and denominator change for this one. So our numerator doesn't change, right? So it's going to be 0 over something, which is why it's a 0, which is why it's the most dilutive, because stock options don't affect your net income or your preferred dividends. An exercise of stock options. But they do affect the number of common shares outstanding. If everybody converts 300,000 options and each one, there's going to be 300,000 new shares in the world. But we don't simply take that number because there's not only the new shares, the company gets a ton of new cash. And we make the assumption, it's a weird assumption, it does make sense, but if everybody converts and if we get a pile of new cash, the company's better off. What if they used all that cash to buy back stock? How many new shares would there be then? So there's going to be 300,000 new shares because of these options, right? If everybody exercises their option as they rationally should, we're going to get 300,000 times $20, their exercise, $6 million in cash. What if we use that $6 million in cash to get rid of, to buy back any shares that we could? Well, we would have to do it at the market. So divide by 25 means we can cancel or we can buy back and put in our treasury $240,000 of buybacks. So net, we're up 60,000 shares, right? That's the sort of net effect of this. That's the number we use. Now, again, 0 divided by whatever number was in that denominator would have been 0, but there you go. 0 divided by 60,000 is 0. Okay, so we've got this figured. So we can ignore bond number 2 at this point. This bond is anti-dilutive. No matter what we do, it's going to be anti-dilutive. I got a cough. So now we rank them in most dilutive to least dilutive and smallest number to biggest. Let me maybe change my pen color here. 1, 2, 3. Those are our most to least dilutives. And we just go up the ladder one at a time and apply each one at a time to our formula. So, okay. here was our formula to calculate basic earnings per share. 3.2 million minus 500,000. That's 2.7 million in my numerator. In our denominator was 2 million. Oops, missed a zero. 2 million. And we did the math, and that's 1.35. So now we just use this, and we go, okay, well, if we are saying how do our stock options dilute, the numerator goes up by 0. Then maybe I'll do this different color. The numerator goes up by 0, and the denominator goes up by 60,000. We crunch the number again. 2.7 mil divided by 2060,000. And I'm at 1.31. So we ask ourselves, is this still dilutive, number 2? And is this still dilutive? And the answer is, yeah, number 2 and number 3, they're both still dilutive. So then we go on to number 2 and we go, okay, well, plus 150, and the denominator is plus 500. So let's crunch that number. 2.7, well, it's 2.85. And the denominator is 2.560, 2.560,000. Do the math, and I get 1.113. And I say to myself, okay, so this is done, this one's done. I'm on to number 3. Is number 3 still dilutive? And the answer is not in this context. It is anti-dilutive. Now I'm at 1.113. If I were to convert those, they would become, the number would go up, and that makes them anti-dilutive, and therefore this, I stop now, I don't convert this one, I go, okay, this one's now anti-dilutive. My diluted earnings per share is 1.113, and on the face of my balance sheet, it's just going to be shown as $1.11 diluted EPS. That's my answer to the question. So my basic EPS, $1.35. My diluted EPS, $1.11. And one thing left to do. You know what you got to do. If you got through the end of this long problem, you got to hit one of those buttons on your way out. Thank you so much for watching. I'll see you in the next video. Bye for now. Let's jump into problem 1712A, a comprehensive diluted earnings per share problem. We're going to have weighted average earnings per share calculations. We're going to have to rank securities in order of how dilutive they are. We got a lot of work to do. Let's get started. Hartwell Corporation reported the following for its 2031 fiscal year end. I didn't even say we have discontinued operations. That always makes things tougher. Income from continuing operations before tax, $4 million. Income from loss from discontinued operations, 1.2, and our tax rate is 25%. Let's figure out what these are after tax. So we take out 25%, and the math here is you go 1 minus the tax rate. So multiply this one by 75% and this one by 75%. So our income from continuing operations net is 4 million times 0.75. It's 3 million, right? You take out 25%, which is $1 million, you end up at 3 million. After tax, the after tax, and this is the numbers that we really care about, 1.2 million times 0.75, 900,000. This was negative, of course, and therefore our net income is 2.1 mil. That's our net income after tax, after discontinued operations. That's our bottom line. The key number actually is income from continuing operations. That's going to be a number that drives a lot of our computations going forward. And when we calculate earnings per share, we got to calculate 3 earnings per shares, right? This one, and this one will all have their own separate earnings per share. The one to sort of like key in on is the top one, 3 million. So I'm going to use that as my net income in calculations. I know it's income from continuing operations, but just go with me on this, that this will be a key number. We'll get the net income one also as we go. Okay. The company had the following information related to its share capital: 1.8 million common shares issued and outstanding as of January 1st. And then on April 1st, 2031, they issue more shares. So we're going to have to do the weighted average number of common shares outstanding because we had shares, we issued shares mid-year. The question is, did we issue any more shares? Here's our potentially dilutive securities here. did these result in any share issuances? That's the first question I want to know, because part A of this says compute weighted average number of common shares outstanding. If we're issuing shares in the middle of the year, that affects the calculation. So we had convertible preferred shares. Did they result in any conversions? It says 50,000 non-cumulative convertible preferred shares issued and outstanding for the entire year. So no conversion. They paid a $4 dividend. So 50,000 shares times a $4 dividend is $200,000. Okay, fair enough. So there's a $200,000 dividend. So net income minus preferred divs, $3 million minus $200,000. Each preferred share is convertible into 4 common shares. Okay, but they didn't convert. That's useful for a diluted earnings per share calculation. But we're going to start by just weighted average number of shares outstanding and basic earnings per share. So we don't need to worry about dilutions that didn't happen. $5 million of 6% convertible bonds. My pen is misbehaving. $5 million of 6% convertible bonds were issued and outstanding for the entire year. So again, no conversion, no worries. $2 million of 9% bonds were issued on July 1st. So we did issue new bonds this year, but did we convert any of them? No, they're outstanding through year end. So no conversion, no worries for our weighted average calculations. Again, that's going to be highly relevant when we calculate diluted earnings per share, but not in the first part of the problem. 300,000 stock options were issued to employees and outstanding again the entire year. Okay, so none of these will affect our weighted average number of shares outstanding because none of them resulted in share issuances, but these two did. So let's do our weighted average number of shares outstanding, and then we'll sort of sort out the rest of the problem. We had 1.8 million shares outstanding from January to April, January, February, March. That's 3 months. On April 1st, I issued an additional 240,000 shares, meaning my new total for shares is 2040000, just 1.8 million, plus the 240 new shares that exist in the world. I have 2040 shares outstanding for 9/12 of the year. So 2040 times 9 divided by 12, 1530, meaning my weighted average number of shares outstanding for the year, 1980. A good year. 1980 is the number of shares I had outstanding, weighted average for the year. So that's the number that goes in as my denominator here. We had 3 million net income. I get net income from continuing operations minus 200,000 our preferred dividends divided by 1980,000, and we're going to get our first earnings per share calculation. 3 million minus 200,000 is 2.8 million. Divide that by 1980, and we get 1.41414141, 1.41. And so that number is our income from continuing operations. Our basic EPS is 1.41. Well, what about our discontinued operations? You take the same calculation, but you go, okay, discontinued, don't get preferred dividends. So I just take this negative 900,000. I don't subtract the preferred dividends. So I just have 900,000 divided by 1980. I get negative 0.454545. So I guess I'm just thinking of how to round this. I guess it's just 0.45 in the negative. Now, we can calculate this last number a couple of different ways. 1.41 minus 0.45. We end up off by a penny due to rounding. We get 96 cents here, 0.96. I think that's a totally reasonable way to do it. Another way you might do it, though, is take the net income number, which was 2.1 million. This one, you do have to deduct 200,000, our preferred dividends, and you divide by 1980. It's just the same calculation, basically 3 times in a row. The only difference is the discontinued operations, you do not deduct preferred dividends. So 2.1 minus 200,000 equals divided by 1980. 1980, and you get 0.959595, so 0.96. And is that what we got? Okay, good. Yeah, we got the right answer. Phew. I always hate when I get to those and I calculate a totally different number. I'm like, oh, I got to remake the video. I don't have to remake the video here. So we've done parts A and B. Compute the weighted average number of common shares outstanding. It was, what was the number? 1980. How could I forget? And compute the basic earnings per share presented in a 3-line format. That's these 3 lines. We would go income from continuing operations, 1.41, loss from discontinued operations, 0.45 negative, and net income, not income tax rate, but net income, 0.96. There you go. There is our basic EPS presentation / calculation. Ta-da! We've done it. On to the harder part, which is the diluted earnings per share. So we have these 4 dilutive securities, 1, 2, 3, 4, potentially dilutive, I should say. And first we want to see, are they dilutive? And 2, how dilutive are they, and rank them. So let's start with the first one and just go through and say, is it dilutive? 50,000 non-cumulative convertible preferred shares, and they convert at a rate of 4 shares. Each preferred share is convertible to 4 common. So if everybody converts, we make the assumption everybody converts at the start of the year, we're going to have 200,000 new common shares out there in the world. So that's going to change our denominator. We're going to have plus 200,000 to our weighted average number of shares outstanding. Now, what does it do to our numerator? Well, there's no more preferred dividends. And the amount of the preferred dividend, well, it was 200,000, kind of a boring number to calculate here. So our numerator goes up by 200,000. The EPS effect here is 1, right? It's 1.00. Now, what was our earnings per share? And this one's interesting. We use this number, not this one. This is the one we're sort of comparing ourselves to, this 1.41, not the net income. And we'd come up with a different answer, right? Because 1 is right in between them. So this is why it's a good number to use to sort of illustrate the point. And I think the question leads us to it. It says, compute the company's basic earnings per share presented in, next line down. For each potentially dilutive securities, compute its incremental EPS. Determine which securities are dilutive against income from continuing operations. So it does sort of lay that out. That's our control number, and rank them. So our control number here is 1.41. Well, comparing 1 to 1.41, we would say this is dilutive. Now, again, had we used the net income number, 0.96, we would have said, oh, it's not dilutive, but we do income from continuing operations, so it is dilutive. Okay, let's move on to the first convertible bond. $5 million of 6% convertible bonds, Series A, were issued and outstanding for the entire year. Interest is paid annually on December 31st. $1,000 bond. Each $1,000 bond is convertible into 6 shares. Okay, so we have 5,000 bonds, right? 5 million divided by 1,000. We have 5,000 bonds. If everybody converts, that's 60 new shares per bond. That's 300,000 new shares. So convertible bond number 1, it's going to be plus 300,000 shares. How does it change our net income? Well, 5 million times 6% is 300,000. Now you might think, oh no, it's another 1. It's not though, because this is pre-tax. So 5 million times 6% is $300,000 less of interest that we're going to be paying. And that means $300,000 more in profit we're going to be getting, but that's pre-tax profit. We got to multiply this by 1 minus the tax rate, 1 minus 25%. Multiply it by 0.75, right? 300,000 times 1 minus 0.25 is 0.75, so 300,000 times 0.75. You know this by now. I feel like I'm over-explaining, but 225,000. It's useful to over-explain, I find, as a professor. 225,000. 225 divided by 300 is 0.75, and this too is dilutive because it's below our magic number of 1.41, and you know, in the dilutive power rankings, this one's more dilutive than the preferred shares. Let's continue to the next convertible bond, number 3. $2 million of 9% convertible bonds were issued on July 1st, so mid-year issuance kind of changes some calculations, as you'll soon see. Interest is paid annually on December 31st. Each $1,000 bond is convertible to 25 shares. So there's 2,000 bonds. They're $1,000 bonds, so 2,000 times 1,000, it's 2 million. There's 2,000 of these, and they convert to 25 shares, meaning there's 50,000 new shares. But they're only out there for half a year, so we got to do weighted average, and so this is an incremental 25,000 weighted average shares outstanding. So again, weighted average number of shares outstanding will go up by 25,000 if everybody converts on July 1st as soon as they're issued. So plus 25,000 to my denominator. What about to my numerator? And it's the savings. It's the interest savings, right? So it's $2 million at 9%. $180,000 would be my annual, but I got to cut that in half because these are only out for half a year. So it's 90,000, and that's pre-tax savings. I got to multiply that by 75%. So 90,000 for my half year worth of interest times 75% to get the after-tax effect, $67,500. That is my savings here. 67,500 divided by 25,000, 2.7. This is highly, the word is anti-dilutive. Why? Because it's above 1.41. It's anti-dilutive. We're not even going to need to use these in our calculations. Okay. Next on the hit list is our stock options. And the general rule of thumb is if the stock options are in the money, they are going to be the most dilutive. Let's see if they're in the money. 300,000 options were issued to employees and outstanding for the entire year. Each option allows the holder to purchase one common share for an exercise price of $20. The average price is $25. So we can exercise at 20. The average price is 25. These are in the money. Right? You would be a fool as an employee not to take them up on the offer. You are printing free money if you take them up on these stock options. You buy them for 20, you can immediately sell them in the market for 25. You're making money. So these are dilutive. These are in the money. So in the money, yes. Dilutive, yes. How dilutive are they? Well, again, the numerator change here is going to be 0. It has no profit implication, but it has a stock implication. So the number is going to be 0 here, right? I can already write 0 dilutive, but let's figure out what the denominator change is because we're going to use that in numbers going forward. How many new shares are going to be in the world? Well, 300,000 is how many shares are going to get issued. So we're going to go up by 300,000, but the company gets a lot of cash because the employees have to pay for these $20 a share. So the company gets $6 million of new cash. The way we deal with the new cash is, again, it's hypothetical new cash. Not everybody cashes in all their options all at once. But if they did, the company could do something that's anti-dilutive and buy back stock. If they use this $6 million to buy back shares, how many shares could they buy back? And the answer is $25 a share. We divide it by 25, we could buy back 240,000, meaning on net, if we get the $6 million and immediately buy back any stock that we can, we'd end up with 60,000 new shares. That's how dilutive this is, because we have to account for the fact that the companies get $6 million more in cash. This is how we deal with that. So it's going to be plus 60,000 to our common shares. Now, again, the math is still 0 divided by 60. Whatever number we put here, it would have been 0, and this would be the most dilutive of the items. Let's rank these in order of dilutativity, the most dilutive to the least. Let me change my ink here. This is always going to be number 1. This is number 2. This is number 3, and this is number 4, and of course it's anti-dilutive, so we don't even have to worry about it. So let's dilute these in order, and we'll start with our stock options, of course. So here was our old formula, right? 300,000. I'm using my old basic EPS formula, and I'm doing just the top line one. I'm doing this one. So we had 3 million minus 200,000 divided by 1980. So this was the formula that we used. 3 million minus 200,000 divided by 1980. Okay, so that was our formula to get basic earnings per share. And now we just adjust the numerator and denominator based on what we've added in here. So plus 0, plus 60,000, plus 0, plus 60,000. What's the number we arrive at here? So still 2.8 million in the denominator, or the numerator rather, divide by 1980 plus 60, which is 2040 in the denominator, and I get 1.373. Are these items over here still dilutive? We go on to number 2 and we go, yeah, this is definitely still dilutive, so let's do the number 2 stuff. So we plus 225 in the numerator, and we plus 300 in the denominator, and we run the numbers here. So that's calculation number 1, calculation number 2. Let's do it. 3 million minus 200,000 plus 225,000 is 3025,000. I hope my math here is good. I'm doing it in my head. 1980 plus 60 is 2040 plus 300 is 2340. And I get 1.293. Now is this one. So it's 1.293 would be my fully diluted earnings per share if I had nothing left to dilute. Now we go, is this one dilutive? And the answer is, yeah, that's still dilutive. Plus 200 on the top, plus 200 on the bottom. And away we go. So I'll actually crunch these through because this is the last one, so I can actually kind of get numbers here. 3 million minus 200,000 plus 225 plus 200, 3,225,000. I divide by 1980 plus 60,000 plus 300 plus 200, 2,540,000, and this is my earnings per share, my fully diluted earnings per share, and again from continuing operations. 3,225,000 divided by 2,540,000. 1.27, 1.2697, we'll call it 1.27. That is the key number. So that's it. Now we don't do number 4 because it's, again, you just revisit and you go 2.7. Is that above 1.27? The answer is of course. So at that point, we've kind of calculated it. That is our fully diluted earnings per share. Got too many circles up here. So this was our basic EPS. This is our diluted EPS. And we've just said from continuing operations, it's 1.27. Now, what about the loss from discontinued operations? Okay, how am I going to deal with that? Well, fortunately, it's not too hard. You take your negative 900,000 and you divide by the weighted average number of common shares outstanding. You don't let any of these adjustments come into play, so you're just going to go, our loss was 900,000, and we're going to divide by our weighted average number of common shares outstanding. After all adjustments are done, 2,540,000, 900,000 negative divided by the same denominator, 2,540,000, and I get negative 0.35. So let's punch that in up here. And then we can just math it down, 1.27 minus 0.35, and that's 0.92. Oops, 92. That's our diluted earnings per share, and that's the answer to the question. If you wanted to sort of recalculate this one, the way you would do it is you just sub in 2.1 million for this number here. So you just sub in 2.1 million for that number there, and you're off to the races. Let's actually do it. So it's just this, the numerator is 900,000 lower. So let's make the numerator over here 900,000 lower, 3,225. Minus 900,000. So if you crunch this numerator across, you would get 2,325 divide by 2,540 and 0.9153 which rounds to 0.92, which is, I hope, when this loads, yeah, 0.92. Okay, so there you go. We calculated diluted earnings per share 2 different ways. But there you go. That was a challenging and pretty comprehensive problem. As always, I make these videos hoping they help you. If you make it to the end, I do hope it helped. And if it did help you, if it wasn't a total dud, I hope you'll hit me with the thumb, and I'll see you in the next video. Bye for now. Thanks for watching. Welcome to Module 18 of our Intermediate Financial Accounting class. This module, as the name suggests, it's all about taxes. But not just taxes. The concept that students stumble on in their intermediate accounting class when it comes to taxes is the concept of deferred income taxes. That's going to be the key topic of this video and the key topic of the chapter. So what are deferred income taxes? Well, they're differences between the tax code and GAAP, the rules of accounting, and they're created by something called temporary differences. So let's say we buy a car for $20,000, and for GAAP purposes, we go, I'm going to depreciate this straight line over 4 years. And so we go, okay, it's $20K over 4 years, and that creates a tax or accounting expense rather of $5,000 a year in depreciation. Well, you'll know, and you'll learn anyway, for tax purposes, typical tax codes force companies to use declining balance, and they'll tell you the rate. They'll say, oh, you bought a car, congratulations, you get to take 30% per year. So let's just look at our first year. In our first year, $20,000 times 30% means you get a $6,000 tax deduction, but your accounting records say, no, it's a $5,000 expense. Now, over the life of the car, it will work out even. These two are going to come out to $20,000 in total, the cost of the car. It's not going to come out to more. It's not going to come out to less. It's going to come out to exactly that amount. But you can see every year, it's a little bit different. We call it a temporary difference because it works out to the same number in the end, but each year in between is a little different. And that creates this concept of deferred taxes, which creates headaches for intermediate accounting students. But your head need not ache. I'm going to explain the concept here by looking at our car. And let's further say our tax rate here is 20% tax rate. Okay, so what's happening here? For accounting purposes, we say it should be $5,000 expense. For tax purposes, we say, no, we're going to take a $6,000 deduction, right? Because you would obviously, and you'd be happy about that, right? You're taking a higher deduction, which means what? Lower taxes. So in year one, my taxes are lowered. I get to take a bigger deduction than my accounting income would indicate. So I take an extra deduction now. Now, unfortunately, because I took $6,000 now, and because the max I can take is $20,000, the cost of the car, it means I get to take $14K later, right? Down the road, this adds up to $14K. For accounting purposes, though, we're saying, no, we take $15K later. So we're taking a bigger deduction now to take worse deductions or less deductions later. That creates something called a deferred tax liability. And it just means, yes, I got a good deduction now, but I got a bad deduction later, a worse deduction later. How much worse is it? Well, it's $1,000 worse, right? I took $1,000 extra now. I get $1,000 less later. Well, what is the tax impact of having $1,000 less in deductions coming my way in the future? It's 1,000 times 20%. It's a $200 difference. It's a $200 deferred tax liability. And it shows up on the balance sheet, right? We're going to debit deferred tax expense. We're going to credit deferred tax liability. It is a balance sheet account. It creates an extra expense account, an extra $200 in tax expense on our income statement. This concept is the cornerstone concept of the chapter. And we don't just have deferred tax liabilities. We can have deferred tax assets. Let's look at the situation where for GAAP purposes the expense is higher and for tax purposes the expense is lower when it's temporary differences only. So If this year I take a littler deduction for tax purposes, and in the future I get to take a big deduction for tax purposes, we call that a deferred tax asset. We'll look at these temporary differences this chapter, and that's the cornerstone of the chapter is really temporary differences that create deferred tax assets, and as we've looked at here, deferred tax liabilities. We'll also look at permanent differences, and when there's a permanent difference, for example, the government fines us, right? They fine us $1,000, and we go, okay, well, that's an expense. A fine is a GAAP expense. For tax purposes, you don't get to deduct fines a lot of the time. They just go, no, you don't get to take a tax deduction. It's sort of a perverse incentive. You pay the fine, but you reduce your taxes. They go, no, it's a penalty for that reason. And so they're just different. They're permanently different, though. It's not like 2 years from now, it's all going to even out, the fine expense. No. Permanent differences do not create deferred tax assets or liabilities. They're pretty straightforward. We'll cover them this chapter, but I really want you to hone in on these temporary differences, different from one year to the next, but the same in total. They create deferred tax assets, deferred tax liabilities. The best way to learn it, though, is to do examples. So I've got lots of examples on this key concept, and I can't wait to get started. Thanks for watching. See you in the next video. We're about to jump into problem 18.1a from my workbook, which you can download from tonybell.com. This is Intermediate Financial Accounting 2. Click the link. No sign in, no sign up, nothing like that. Scroll down, find whatever problem we're working on, and you'll see lots of the problems like this one are free and available to everybody, but there are plenty of members-only videos, members-only problems. I hope you'll consider signing up if you're getting good value from the free stuff, but regardless, I'm happy you're here watching. Let's jump into the problem. Let's jump into problem 18.1a. We're looking at permanent versus temporary differences, and temporary differences create deferred tax assets and deferred tax liabilities. The way best to learn those is to do examples. Let's jump into it. Nicola Valley Manufacturing prepares financial statements using accrual accounting. For tax purposes, certain revenues and expenses are recognized differently. So there's differences between GAAP or IFRS than the tax law of whatever country we're looking at. And so that difference in tax treatment potentially creates these deferred tax assets and liabilities, a big topic of our chapter. The items in the table below are drawn from the company's records for the current year, and we're going to complete the PTN column. P is for permanent differences, T for temporary differences, and N is not a difference, and those temporary differences are going to create deferred tax assets and deferred tax liabilities. So if we're deducting more expenses later for tax purposes, well, if down the road I'm going to have some huge tax deductions coming, well, that saves me money. That's a deferred tax asset. If, on the other hand, down the road I have fewer tax deductions coming, in other words, I deducted them all now and I don't get those deductions later, that creates a deferred tax liability when I have temporary differences. Let's jump into it and you'll see what I mean. Tax depreciation, CCA in Canada, I think it's called MACRS, makers or something in the US. I don't know what it's called every country in the world, but every country has a different name for it. Tax depreciation is often different from accounting depreciation, and it is here. Tax depreciation of $72,000 was claimed on the company's equipment this year, compared with $45,000 depreciation expense recorded in the books, in the accounting record. So this is a classic temporary difference. So by the end of the asset's life, it's going to be the same because the asset's going to be worth zero at the end of its life, but it's different in the years in between. So we took more tax depreciation than we did accounting depreciation. What does that mean? It means I took a higher deduction now, and it means in the future, I'm going to have to take a lower deduction. By definition, this is a reversing thing, right? So now I took a high tax deduction. I saved tax dollars today. In the future, I'm going to actually owe more in taxes because I took the higher deduction now. So this is a temporary difference, and it's a deferred tax liability. I don't have tax savings in the future. My tax savings are lower in the future. Let's look at the next one. The company accrued $20,000 of estimated warranty expense based on this year's sales. Warranty costs are deductible for tax only when the repair work is performed. So I took a deduction now for accounting, and I'm going to get to take that. I don't get to take it now for tax purposes. I'm going to get to take it down the road for tax purposes. So some future tax deductions. This is temporary temporary difference, right? I took a $20,000 expense now in accounting. I'm going to take a $20,000 expense later for tax purposes, but the fact that the expense is coming later, it means it reduces my taxes later. That's good for me. That's a deferred tax asset, and this indeed is temporary. Nicola Valley earned $10,000 of interest revenue on provincial government bonds. These map onto like municipal bonds in the U.S. And it says under the relevant tax legislation, this interest is exempt from tax. Okay, this is not a temporary difference because it doesn't reverse. You just get some tax exempt revenue now and you don't have to pay tax on it later. So this is a permanent difference and therefore no deferred tax asset or liability. The company recorded $12,000 of depreciation on its head office building using the same method, rate, and cost base for accounting and tax purposes. Well, I actually had a client that did this. They just said, I don't like my accounting and my tax depreciation mismatching. I'm just going to use the same method for both. If that's the case, there's no difference, right? So not a difference at all, right? They're the same. So no difference and therefore no deferred tax asset or liability. The company accrued a $30,000 liability for a lawsuit that is probable and estimable. The amount will be deductible for tax only when it's paid. Okay. So we took like a $30,000 expense. We accrued a $30,000 liability for our accounting records. We're not going to be allowed to take a tax deduction until later. Well, a future tax deduction means in the future, I'm going to pay less in taxes. That's good for me. That's a deferred tax asset situation. And this indeed is temporary. This difference, right? I've recorded the expense now and the liability now. Well, in the future, the tax and the accounting is going to line up when I actually pay the lawsuit that I'm looking like I'm going to lose. The company received $24,000 in advance for a 2-year service contract and recorded it as unearned revenue. The full amount is taxable now. So I got the money now. I paid tax on it now, but I'm not going to record accounting revenue until later. Well, if I pay the tax now, I got it out of the way. In the future, I don't have to pay it. I'm going to record the revenue in my accounting books, but I don't have to pay tax on that revenue in the future. This is a deferred tax asset. It's good for me it's bad for me in the now, right? It's a current tax liability, but it's a deferred tax asset. So it is temporary once this unwinds, right? Once we've earned the unearned revenue. The company recorded $9,000 allowance for expected credit losses. Bad debts are deductible for tax only when a specific account is written off. So we've done an allowance for doubtful accounts. But so in accounting records, we've recorded an expense. In tax, we can't record the expense until we actually write it off. That's in the future. And therefore, it is a temporary difference, right? In accounting, I've already recorded the expense. I'm going to record an expense for tax in the future. If it's an expense in the future, again, it reduces my taxable income, reduces the amount of tax I got to pay. That's good for me. It's kind of a weird thing. Lower income is good for you. This is a deferred tax asset for tax reasons, right? You want to show as little income as possible so you pay less to the government. 8. Right? See, there's 2 8s there. The company recognized $48,000 of gross profit on an equipment sale this year for accounting purposes. For tax, the profit is reported as receivable and is going to be collected over the next 3 years. I just have to cough. Okay, so we recorded revenue right now. We recorded profit right now, $48,000. For tax, we're going to record it over the next 3 years. Well, unfortunately, then I'm going to be paying tax over the next 3 years, right? My income in the future, in the present, is higher for accounting purposes. In the future, it's going to be higher for tax purposes. Well, if my expenses are higher in the future for tax purposes, we said, oh, that's a deferred tax asset. Well, if my revenues are going to be higher in the future for tax purposes, that's a deferred tax liability. I'm going to have a higher tax bill in the future. DTL, deferred tax liability. The company paid a $5,000 annual premium on a life insurance policy covering its CEO. The company is the beneficiary, and the premiums are not deductible, and proceeds would not be taxable. Okay, so immediately we have a difference here, but is it temporary or permanent? And the answer is it's permanent, right? This is not going to reverse. The premiums are never, it's not like, oh, I deduct the premiums for my accounting purposes now and for tax purposes later. No, the premiums are never deductible. This is just a permanent difference. The company prepaid $18,000 for 3 years of property insurance and deducted the full amount for tax in the year of payment. For accounting, the cost is expensed evenly over the 3 years. So again, what's our difference? Well, for tax purposes, I deducted all up front. For accounting purposes, I'm going to deduct some later. That means if I deduct it all up front for tax purposes, I've got there's a timing difference for sure, a temporary difference. This is a liability. I'm deducting it all now. Currently, in the future, when I deduct it for accounting, I'm going to be mismatched because my tax is going to be higher than the accounting, right? Than the accounting income would indicate. This is a deferred tax liability. We're taking the deduction now, and therefore in the future, we're not taking the deduction. The company paid $7,000 in fines to a provincial regulator for a workplace safety violation. These fines are not deductible. Okay, so if it's not deductible, it's permanently going to be different. The accounting records will not match the tax records. Permanent. The company accrued $4,000 of interest receivable on a loan it made to a supplier. The interest is taxable only when the cash is received. Okay, so we've recorded revenue now. In our accounting books, we're going to record the revenue later in the tax books. Future revenue means future profit. Higher taxable income in the future means higher tax liability in the future. This is DTL, and it is indeed temporary. The company incurred $16,000 of business meal and entertainment costs, of which half, $8,000, is not deductible. Okay, so the half that is deductible, it's not different, right? It's treated the same for tax and accounting. It's an expense on both sides. The half that's not deductible is just a permanent difference. So it's not temporary. It does not create a deferred tax asset and liability. $8,000 is not different between the two. $8,000 is permanently different between the two. There you go. Company declared and paid $40,000 of cash dividends to its shareholders. Okay, well, a dividend paid to shareholders is not an expense, and it's not a taxable item on our tax records, right? So it's not an expense for accounting. It comes out on the statement of retained earnings or statement of changes in equity. So it's just like not applicable, I guess not different between the two. It doesn't apply here. No difference. Last one. The company accrued $28,000 of employee bonuses at year end. That will be paid 10 months later. The bonuses are deductible only when paid. Okay, so there's a difference. It's temporary. We record the expense now for accounting purposes. We record the expense in the future for tax purposes. Because it's a temporary difference, it creates a deferred tax asset or liability. Well, it's a deduction we'll get to take in the future. We don't get to take it now. We get to take it in the future. A deduction is good for us, right? For tax purposes, this is a deferred tax asset situation. And there you go. If you made it to the end, don't be shy about hitting me with one of those thumbs. Thanks for watching. See you in the next one. Let's jump into problem 18.3a. We're doing all sorts of tax calculations, deferred tax assets, deferred tax liabilities, current tax liabilities. Let's jump into it. Monashi Manufacturing is in its first year of operations and had pre-tax accounting income of $400,000. The tax rate's 25%, and the following items were identified from the accounting records and tax schedules. And there's 1, 2, 3, 4, 5, 6, 7. They're going to be full of permanent and temporary differences. We're going to have to determine which differences are permanent, which differences are temporary, and if they're temporary, do they create future tax assets or future tax liabilities? First, reconcile pre-tax accounting income with taxable income. Okay, so planning ahead here, we're going to start with our pre-tax accounting income, and it was $400,000. We're going to have a bunch of permanent differences, and down here we're going to have a bunch of temporary well, I guess I'm writing it out, temporary diffs. And down here somewhere we're going to have taxable income. So we're going from our accounting income, and we're saying here's the differences to get us to our taxable income. Let's start with the first one, and we'll have 7, and some of these might not be different at all. We'll see. Depreciation expense of $50,000 was recorded for accounting purposes. Tax depreciation deduction was $80,000. Okay, so whenever we're dealing with depreciation, this is like the main temporary difference you're going to see in these types of problems. And so let's first think like, all right, it's a $50,000 deduction we're taking for accounting purposes, $80,000 deduction we're taking for tax purposes. It means it's a temporary difference. It's a $30,000 difference between the two, right? 50 versus 80. And it's going to reduce our taxable income. Now, it reduces our taxable income now, and that means it's going to create more taxable income later when it reverses, when this temporary difference resolves. And that means it's going to create a deferred tax liability. So we'll call this depreciation. And I'm just going to note, now this isn't the amount of it, but this is going to create a deferred tax liability. I just want to note that as I go through because it'll be useful to know that information down the road. Now, the deferred tax liability is 25% of this because we apply the tax rate, but just in the back of my mind, I'm saying this will create a deferred tax liability. If I take extra depreciation now, it means I'll take less depreciation later. That's the issue. Next, the company paid $12,000 of fines that are not deductible for tax purposes. Okay, if it's not deductible, this is a permanent difference. So we'll call it fines under permanent differences. It's a $12,000 difference. Now we got to say, is it a plus or a minus to go from our accounting to our tax? And we paid it, so we would have taken away $12,000 from our accounting income. We got to add it back in to get to our taxable income. Our taxable income is $12,000 higher because we're not allowed to deduct the fines for tax purposes. Next, the company accrued $15,000 of warranty expense. No warranty costs were paid during the year. Warranty costs are deductible when paid for tax purposes. So this is temporary difference. Once we start paying the warranty expense, it's going to even out. But it's a temporary difference. And it's a $15,000 difference. Now we're going to say, is it a plus or a minus to go from the accounting income to the tax income? Well, let's see. We deducted it for accounting purposes. We got to add it back to get to the tax amount because we wouldn't deduct it for tax purposes. Now, does this create a deferred tax asset or liability? Well, let's think about it. I'm recording an expense now for accounting. I'm not going to, and I'll record the expense later for tax purposes, meaning my taxable income is higher now, but it's going to be lower later. If it's going to be lower later, lower tax profits later, means there's lower taxes later, creates a future tax or a deferred tax asset. Sorry, the old school Canadian jargon, we would call it future tax asset, future tax liability. We're talking about the same thing. That's old school jargon though, and some Canadian companies still use it depending on circumstance, but deferred tax is the preferred nomenclature. Okay, let's continue. The company earned $4,000 of interest income. It's exempt from tax. Okay, if it's exempt, it's a permanent difference. So I'll call it interest. And when we do permanent differences, we don't worry about deferred tax asset and deferred tax liability. It doesn't create them. And it was $4,000. So this is revenue for accounting purposes. It's not going to be revenue for tax purposes. So we take it out for tax purposes. It's included in the accounting income. It's excluded for tax. Next, the company recognized $20,000 of profit on an installment sale for accounting purposes. For tax, the profit will be taxed as the receivables collected in future years. Temporary difference for sure. Installment sale, and the amount is $20,000. Now the question is it a plus or minus? We included it in our accounting profits now. We excluded it from our tax profit, so it's included up in the 400. We got to take it out to get to our taxable income. And that, of course, because it's a minus, creates a deferred tax liability. I want to be clear, though, the number of our deferred tax liability is not $20,000. It's the tax rate times that 25%. We'll get to that in a minute, but I want to remember that. Now, again, going back to first principle, rather than saying, oh, it's a plus or it's a minus, therefore a deferred tax asset or deferred tax liability, I like to sort of think of the situation. So we got paid $20,000. The accountant counted as profit now. For tax, we're going to count it as profit later. Well, something we're going to count as profit down the road, of course, increases our taxable income down the road, increases our tax bill down the road, and that's why it creates a deferred tax liability, a future tax obligation. That's what we're talking about here, and that's why we called it DTL. Next, the company received $25,000 of customer deposits for services to be provided next year. The amount is taxable when received, but is recorded as unearned revenue for accounting. Okay, so this is one where we're calling it revenue today for tax purposes, but we're not going to call it revenue yet for accounting purposes. So this is going to be a plus to our accounting income. Our accounting income is $400,000. We wouldn't have included this 25. It would have gone into unearned revenue. For tax, though, it's got to be included. So let's plus $25,000 for customer deposits, and of course a plus creates a deferred tax asset. And why would that be? Well, we're going to pay tax on it now, but we're going to recognize revenue on it later. If you're paying now, but the revenue's not coming until later, it means you're saving on taxes later, right? It's a benefit to you later to pay now. Okay, 7. The company incurred meals and entertainment costs, $8,000, of which $8,000 is not deductible. Okay, if it's never deductible, it's a permanent difference. It's meals. Now, what does this do to our income? Well, 8,000 got taken out to get to 400. We got to add it back in. We got to say that 8,000, we can't take a tax deduction for it. And that's the last one. So let's add these up and figure out our taxable income. 400. Actually, I'm going to just go 400 plus 12 minus 4 plus 8, 416 minus 30 plus 15 minus 20 plus 25. We land on 406. 406,000, that's our taxable income. That's our answer to part A. And we've done a reconciliation here. Maybe squish it together if you want it formatted better, but I think that's fine. Compute the income tax. That's easy if you have taxable income. Just a little cough. Excuse me. Taxable income, 25%. So multiply this. I don't know why I've written it twice there. Multiply this by 25%, our tax rate, and you're going to get the current income tax, tax payable, tax, income tax payable. This is our current income tax payable, 406 times 0.25, 101, 500. Okay, so that's it for part B. Part C says compute the deferred tax asset and deferred tax liability arising from the temporary differences and the net deferred tax expense. Okay, we've done a lot of the work here. We just got to multiply all this stuff by 25% to figure out what the deferred tax asset and liability for each is. We already talked our way through it, so I'm not going to talk through it again. 30,000 times 0.25, it's going to create a deferred tax. This is our actual deferred tax liability on depreciation, or on the depreciation timing difference, is 7,500. Deferred tax asset on the warranty, 15,000 times 0.25, 3,750. Deferred tax liability on the installment sale, 5,000. And deferred tax asset on the customer deposits, 6,250. And now we just have to combine them. So not DTT, DTA. Our deferred tax asset in total is 10,000, just 3,750 plus 6,250. Our deferred tax liability in total is 12,500. And there we go. So those numbers will appear in journal entries and appear on financials. Let's figure out our net expense. The question asks for it. I don't know if I read that properly. It says compute the deferred tax asset and deferred tax liability, done, right? 10,000 and 12,500 arising from these temporary differences. And the net deferred tax expense. Well, the net is 2,500. Now, is this a deferred tax expense or a benefit? Well, if the asset's bigger, it's going to be a deferred tax benefit. Here, it's deferred tax expense because the liability is bigger. So, D tax expense is 2,500. Okay, next up, it says determine the total income tax expense for the year, and E says do the journal entry. I actually like to do the journal entry first. That's how I make sense of this world. So let's go ahead and do that. And the way I do it is I go, okay, our income tax payable is 101,500, so I'm going to credit I tax payable for, what was it, 101,500. I want to deal with the deferred tax liability, so I'm going to credit D tax liability, DTL. Deferred tax liability is 12,500. I've got a deferred tax asset of 10, so I debit D tax asset, and that's 10,000, and then the difference goes to expense. Now, I've seen this split. I've seen certain questions that they'll do this in two pieces. They'll say our current tax expense is 101,500 and our deferred tax expense nets out to 2,500. But I've also seen it combined into one. So our income tax expense is 104,000, right? I got $114,000 of credits. I got $114,000 of debits. I have seen this split where they just go, okay, well, our current is 101,500 and our deferred is 2,500. And you can just take those two numbers and split them. I think either way is okay. It's just going to depend on the textbook and your professor's preference, but they're both totally appropriate ways of doing it. And there we've done it. So it says, what's the total income tax expense for the year? Well, the total is 101,500 plus 2,500. It's 104. So that's the answer to D. Our answer to E, the journal entry we've done. And now it says, prepare a reconciliation of the 25% statutory tax rate to the company's effective tax rate. So the effective rate is basically, okay, let's actually, here's how I think about this question. Our taxable income is 400 grand and we have a 25% tax rate. So like our tax expense should be 100 grand according to that just simple assessment of things. And remember, our journal entries kind of eliminate the temporary differences from our total tax expense, but they don't eliminate the permanent differences. That's why we have a difference here. So we have these three permanent differences: fines of 12,000. So I'll go 12,000 times 25%. 12,000 times 0.25 is 3,000. So I pay an additional 3,000 due to fines. I'll do the other plus 8,000 times 25%. 8 times 0.25. An additional 2,000 because of the meals. And then negative 4,000 times 25%. 4,000 times 0.25 is 1,000 negative from the interest. So you sum it all up and you land on 104, which is our actual tax expense. And if you sum this up, what is this? 400 plus 20 minus 4, it's 416 times 25%. Is 104, and let's just make sure 416 times 0.25, 104. So our income tax expense is basically our pre-tax accounting income plus or minus any permanent differences, and then you apply the tax rate to that, and you can see that we had $16,000 in net temporary differences. 16 times 25% gives us the 4,000. That's why we paid $4,000 more, or our current tax expense was $4,000 more than you might have thought based on pre-tax income. So that's the reconciliation. This is the reconciliation. Now, one other thing you might do is say, well, what was the tax rate? Well, we had $400,000 in pre-tax accounting income. Our tax expense is $104,000. 104 divided by 400. Our tax rate was actually 26%. It wasn't 25%. So it says prepare a reconciliation of 25% tax rate to the company's effective tax rate. Our effective tax rate was 26%. We paid 1 extra percent of tax. This extra $4,000 in tax was 1 extra percent of a tax rate. But there you go. We've made it to the end. We've solved 18.3a. As always, thanks for watching. Let's jump into problem 18.6a. We're doing tax loss carry forwards. Here's how it works, and here's sort of the rationale of a tax loss carry forward. Let's say you start a new business and your company, as often happens, loses money at the start as you're getting your feet underneath you. And let's say you lose money for several years and eventually you make a little bit of profit. The tax loss carry forward rule says, well, if you lost money all those previous years, you can use those losses and write them off against your gains this year, right? You can carry forward those losses to be written off against future gains. And so in the moment when you have a tax loss, if you predict that you're going to have future gains, you have to say, well, doesn't that look like a deferred tax asset? At some point in the future, I'm going to be able to use these as write-offs against future income. Well, if it's more likely than not, or if it's likely, depending on the tax jurisdiction, I should recognize a deferred tax asset now. And that's what this topic's about. 18.6a says, Smithers Company began operations in 2031. The company has the following pre-tax profits or losses for its first 2 years of operation. Because the company has no temporary permanent differences, this list is also the taxable income, 100 grand in 2031. Negative, it loses 100 grand in 2031. Then the company makes 250 in 2032. The relevant tax rates for our problem are 20% for 2031 and 25% for 2032, and they had been enacted in early 2031. The company expected 2031 would be unprofitable, but expected after that would be highly profitable, and certainly looks like things lived up to expectations. And so that means it sort of hits the threshold of like, okay, I lost money in the first year, but it's likely I'm going to be making money in future years. And if it's likely I'm going to be making money in future years, it's likely I'm going to be able to use this 100 grand against my future profits. And that means I have to recognize a deferred tax asset now. So, prepare journal entries for 2031 and 2032. Let's get to it. The math here isn't too hard. In 2031, we lost 100 grand, and the tax rate's 20%. But remember, we don't pay any tax in 2031. We lost money, and in fact, when we use this $100,000 write-off essentially in a future year, it gets used against the future year profit, which are taxed at 25%, meaning our deferred tax asset is happening at 25%, right? We're using 100 grand as a future write-off. The tax rate that we're going to be writing off is 25%. So we're going to be saving $25,000. This loss is going to give us future tax savings of $25,000. What's the journal entry look like? Well, on whenever we do our tax journal entry, I'm going to say December 31st, 2031, we debit deferred tax asset for $25,000. Our deferred tax asset is going up, some future tax benefit we're going to be enjoying, and we credit deferred tax benefit, $25,000. Quick cough, and then a quick clarification. So this deferred tax benefit account, I've seen it frequently called deferred tax expense. You just credit a deferred tax expense. Totally fine, an appropriate way to do it. I would follow along with how your professor is doing it or how your textbook is doing it. Deferred tax benefit is one of the commonly used ways, but different texts use different phrasing here. So just be a little bit careful to match with your own course. Okay, so that's our December 31st, 2031 entry. Now we want to do 2032. So December 31st, 2032. We've done the 2031, on to 2032. What happened in 2032? Well, we made money. We made $250. And remember what we said? We said, okay, well, it's $250 that we made, but I'm going to be able to have a write-off of 100 grand with my previous loss that I'm carrying forward into this year. So I'm actually only going to get taxed on 150. So that's actually my taxable income. Maybe taxable is not a good word there. 150 is what I'm actually going to get taxed on. And 150 at 25%. I don't have my calculator out, but let's pull my calculator out. I think it's 37.5. 150, is this showing up properly? Yes, it is. Times 0.25, 37.5. Okay, that's the only thing I need the calculator for. So I'm only going to have to pay $37,500 in taxes. So let's deal with that piece first, because of course that's going to create my income tax payable, $37,500. And that is going to be, we'll call it current, not deferred, income tax expense. It's my current income tax expense. But I'm not done, because I've got this deferred asset sitting on my books, $25,000 asset, saying, oh, I'm going to have saved tax dollars in the future. Well, we're not going to save tax dollars in the future. We've just saved our tax dollars. So on December 31st, 2032, that's the ugliest two of my life. And I've had some ugly twos before. We got to get rid of this deferred tax asset. So let's get rid of that. D-tax asset goes to 0. And we debit D-tax expense. My deferred tax expense this year is $25,000. I've certainly also seen these combined, right? You could combine them and have just an income tax expense for the year of $62,500, and we'll see that in our disclosures in a minute. But that's how I would do my December 31st, 2032 entry, and there we have Part A in the books. Part B says, prepare the income tax section of the income statement for each year. So we'll start with income, or well, I guess in year one it's loss. Loss before tax. And our loss before tax is $100,000. Then we have income tax benefit or deferred tax benefit, I-tax benefit, deferred. And it's just like the one income statement account here, right? D-tax benefit. Maybe I should have called it D-tax benefit. Anyway, it doesn't really matter. $25,000. And we're down to $75,000 negative, and that is our net loss after tax, $75,000. Now, important to note, like, the government doesn't send me a refund for this $25,000 because I haven't paid any taxes to be refunded. It's just $25,000 like future income taxes that I'm not going to have to pay. Okay, let's look at the next year. Next year, you can see my income, not loss, income before tax is $250,000. I have these two tax accounts, current income tax expense, deferred tax expense. So let's do a heading here. Income tax expense, current, deferred, total income tax expense. My current income tax expense, $37,500. My deferred income tax expense, $25,000. The total here, $62,500. Income before tax minus income tax equals net income. Our net income, $250 minus 62 is $187,500. And we've done ourselves a beautiful job. We've completed 18.6a. Just a couple of side comments. The first is like, okay, if the company expects it's more likely than not, or likely that it's going to be profitable going forward, we treat it this way. But what happens if the company isn't sure or doesn't think it's going to be profitable in the future years? How do they deal with it then? Well, we'll look at that in problem 18.7. One other comment. There's something called a loss carry back, where you've been profitable, and then you make a loss. Can you carry that loss back? And the answer is depends on the country. In the US, no. In lots of other countries, yes. So I've put those types of questions in the appendix to this chapter. So if you're thinking, oh, he's talking about loss carry forwards, but my textbook has stuff about loss carrybacks, that's in the appendix to the chapter. Why is it relegated to the appendix? Most of my audience is in the US and they won't have to deal with that. So if you're looking for loss carrybacks, that's in the appendix to the chapter. Other than that, the one other thing to look for, the thumbs up button. Thanks for watching. See you in the next video. Bye for now. Let's jump into problem 1898. We're looking at a comprehensive tax problem. Takes us through 2 years of a company's taxes, and they have lots of deferred tax stuff. They have temporary differences, permanent differences. There's a lot going on. Let's jump into it. Fraser Valley Industries has operated for several years. At the beginning of 2031, it carries the following deferred tax balances, and the relevant tax rate here, is 25%. It's got some deferred tax liabilities, some deferred tax assets. It says Part 1, 2031. In 2031, the company reported pre-tax accounting income of $780,000 and had the following permanent differences and changes in temporary differences during the year. And there's our permanent and our temporary differences. We know that permanent differences change, from our pre-tax accounting income to our taxable income. They're relevant there, but they don't create deferred tax assets and deferred tax liabilities. That comes from our temporary differences. Part A says compute taxable income and current income tax. Let's do it. So our pre-tax profit was $780,000. My screenshot captured a little line there. That won't be in your question, but you can ignore that. And let's look at how each of these temporary and permanent differences will have affected our move from accounting income to taxable income. So, it says non-deductible fines. Well, what does a non-deductible fine do? Well, we deduct it for accounting purposes, but we don't get to take the deduction for tax purposes. So I would have deducted it to arrive at 780. I got to add it back in to get to my taxable income. Tax-exempt dividend income included in accounting income. So we've included 44 grand into that 780 in our accounting income. We got to take it out to get to taxable income because it's tax-exempt. So minus that. Tax depreciation in excess of book depreciation. So our book depreciation was one number, our tax depreciation was higher. We're likely using some accelerated depreciation method for tax. Well, what does that mean? It means that my tax income is going to be lower because I've depreciated my assets more, right? I have higher expenses for tax purposes than book purposes. So it's a minus here. Minus. There we go, to go from book to tax. Again, we're going from book to tax. It says installment profit recognized taxable on future collection. So we've recognized some profit here, but we don't want to recognize it for tax purposes. We want to take it away for tax purposes. Warranty expense accrued in excess of amounts paid. Okay, we've recorded a warranty cost, but we haven't paid it yet. Well, we don't recognize it for tax purposes until it's paid. So it's included as an expense here, but it's not included as an expense here yet, or it shouldn't be included as an expense here yet. So we add it back for tax purposes. Remember, expenses reduce our income, so we're taking away the expense, which adds to our income. I think you know it by this point, I hope. Cash received in advance, so unearned revenue in excess of revenue earned. Okay, so if we got the money for tax purposes, often you are counting it as taxable. But for accounting purposes, we're saying, no, the revenue is not earned yet. We got the money, but it's unearned revenue. If that happened, well, what is the effect here? It's going to be a plus, and the reason is we got the money now. We're going to be taxed on it now. So in accounting, we wouldn't have counted it as our income. We would have called it unearned revenue. For tax, though, it's going to add in. Okay, so those are our differences. Let's add up the list to get our taxable income. 780 plus 24 minus 44 minus 48 minus 36 plus 28 plus 16, we end up on 720 as our taxable income. So that's the answer to that, 720 grand. And what's our current tax? Well, we're going to multiply this by our tax rate of 25%. What is it? 200? No, 180 maybe? 180? I feel like it's 180. 720 times 0.25. Yeah, 180. That is our current income tax. So there you go. We've answered part A. That's light work compared to part B. Part B says determine the ending deferred tax asset and liability balances and the deferred tax expense or benefit. Okay. So each of these temporary differences affects deferred tax assets and liabilities. Let's look at each of them. Tax depreciation in excess of book, and it says minus 48,000. What's happening here? Well, we're taking a tax deduction now, and remember it's a temporary difference, meaning we're going to take less tax deductions later. We're going to have higher taxable income later and pay more taxes later because we took a big deduction now. This creates a liability, a deferred tax liability. So each of these multiplies by 25%. 48 times 0.25 is 12. And this is I'm just going to put K's here, 12K DTL, right? It increases our deferred tax liability by 12K. This one's going to be 9K. Now, what does it do? Installment profit recognized taxable on future collections. So once again, we're going to be taxed on something in the future, right? It's going to increase our taxes in the future, deferred tax liability. Pay the tax now, deferred tax asset. If we're paying the tax later, if we're reducing taxes now to pay tax later, deferred tax liability, that's a deferred tax liability. Warranty expense accrued in excess of amounts paid. That means, again, because we didn't pay it yet, we didn't deduct it for tax yet, we're going to be deducting it for tax later. We're going to reduce our taxable income later. We're going to have a benefit from that, right? We lower taxes down the road. That creates a deferred tax asset. And the amount here is 7K DTA. Last one, cash received in advance in excess of revenue earned. So we receive the money, we pay tax on it now. It means later when we declare our accounting income on it, we're not going to have to pay tax on it. And that's a benefit for later. That's a deferred tax asset. 4K DTA. Okay, now if we were just starting this question new, we would go, oh, there's our deferred tax liability and deferred tax asset balance. But this question, the company already had deferred tax liabilities. It already had deferred tax assets. We've got to add to them. So tax depreciation in excess of book, we said, oh, our deferred tax liability is going up by 12K. Well, it was already 30. 30 plus 12 means it's going to sit at 42. Same with the installment. It was a deferred tax liability of 20. It's going to increase by 9 to 29. Warranty was 8, and it's going to increase by 7. And last but not least, the unearned revenue is going to increase by 4, and it's an asset going up by 4. So 14 plus 4 is 28. No, it's 18. Jeepers creepers. Don't do math in your head, folks. It's dangerous. Okay, so there we go. It said, determine the ending deferred tax asset and liability balances. We could net this as well, and we may, I don't know if we net this. Anyway, those are the balances. I don't want to say the wrong thing in the heat of the moment here. So what's the deferred tax expense or benefit? Well, we look at the changes here, right? Our deferred tax liability went up by 21K. And if that's all that happened, we would have a deferred tax expense, right? When your deferred tax liability grows, that's a deferred tax expense. Our deferred tax asset grew by 11K, and that would be a deferred tax benefit. Well, on net, what happened? We had an expense of 21, a benefit of 11. On net, 10K DT expense. And there we have it, our deferred tax expense, 10K. So expense, 10K. So determine the ending deferred tax asset or liability balances. We got a 42K asset or liability, a 29K liability related to the installment, 15K asset related to the warranty, and a 18K asset related to unearned revenue. That's how I would answer that. I would literally have 4 answers there. And then our deferred tax expense is 10,000. Last thing, it says determine the total income tax expense and prepare a journal entry. I'm going to do it right here. Let's see if that'll fit. Do my best anyway. So we calculated 180 grand as our current income tax. Remember, we're always going to credit income tax payable for that amount, 180K. And then we just adjust up or down these temporary differences, these deferred tax liabilities related to our temporary differences, DTLs and DTAs. So we'll start with the deferred tax liabilities just because they're credits. So DTL depreciation is a credit of 12K. It went up by 12K. DTL installment and it's another credit, and this time of 9K. Our DTAs are going up, so we debit them. DTA warranty. And that's 7K. And DTA unearned rev, so I'll just say DTA unearned, and that's 4K. Now, you'll see this doesn't balance. Our debits don't equal our credits. We got 180 on the credit side plus 21. So 201 total on the credit side, 11 total on the debit side, minus 11 is 190. That's our missing amount. That goes to income tax expense, and it's 190. Now, this can, and often textbooks will split this. They'll say, oh, wait, we already did the math. We said there's a DT expense of 10K, so debit deferred tax expense, and then debit current tax expense or income tax expense for 180. And rather than having one debit, you have two. These are both totally fine, totally appropriate, just choices that textbook authors make. The textbook I'm following along with does it in one line, so I'll do it in one line as well. Okay, we have finished part one. Now on to part two. Part two says, and I'll change ink just so we can distinguish the 2 years. Part two says, in 2032, pre-tax accounting income was $700,000. The same differences recurred. Okay, so we have $700K in pre-tax profit. We have the same plus 24K related to the non-deductible fines, and we have the same minus 44K related to the non-taxable, what was it, bond or something? Dividend, tax-exempt dividend. And temporary differences reversed as follows. So our temporary differences are reversing here. Now, what does that mean? Well, our book depreciation is higher than our tax depreciation. That's what a temporary difference means, right? We had said, oh, our tax depreciation is really big this year and our book depreciation is smaller. Well, it has to reverse eventually. So now it's saying our book depreciation is really big. Our tax depreciation is smaller. What are the implications of the book depreciation being high and the tax depreciation being low? Well, the first is to go from book income to tax income, we're going to have to add the depreciation, not deduct as we did up there. We're going to have to add it because it's reversing. Now, if this was in a vacuum, I would say, oh, this creates a deferred tax asset. But we already have a big deferred tax liability related to depreciation. So here's how I'm going to treat it. I'm going to say, okay, 25%. So that's $8,000 to affect our DTA, DTL. Because we already have a deferred tax liability related to this, I'm going to say this is going to reduce our DTL. If we didn't have any account already set up, I would say, oh, this is a DTA, right? This creates a DTA if it was a new account. But because we already have one, it's reducing the DTL. It's reversing out the DTL. Installment receivable collected in full, now taxed. Okay, so again, what's happening here for accounting purposes, we already recognized this for when the money was when it was earned. For tax purposes, we recognize it all when the money comes in. So again, a big plus between our accounting income and our taxable income, because again, we recognize this big chunk of money coming in. 25% of that, I should be able to do is 25,000 plus 4, 29, I think. 116 times 0.25, 29. Let's go. And again, simple way to look at it is we know it's reversing. So this was an increase to our DTL before. It's going to decrease our deferred tax liability now. Warranty costs paid and excessive amounts accrued. Well, if we pay more than we accrue, it means our accounting number is lower than our tax number, our accounting deduction lower than our tax deduction. So this is a minus to go from accounting income to tax income, because again, our warranty expense for tax purposes is higher than our warranty expense for accounting purposes. That's what that's telling us. And again, 25% is $6,000. Now, having the tax expense be higher than the accounting expense would normally create a deferred tax liability. In this case, though, we already have a deferred tax asset. We're just going to reduce our DTA, and that's what we're going to be doing for the last one. 40 grand times 25% is $10,000, and it's going to be a reduction in our deferred tax asset. Now, let's just think about why. This is unearned revenue or revenue earned in excess of the cash received. So it's the flip side of this: cash received in excess of revenue earned. Here we're flipping it on its head, and so our accounting income is higher than our taxable income. If your accounting revenue is higher than your tax revenue, you've got to reduce from your accounting number to get to your tax number. And if you're reducing to get from your accounting number to your tax number, typically that creates a deferred tax liability. But since, as we've said, we already had a deferred tax asset, we're going to reduce that deferred tax asset that exists. Whew. I think I'm over talking it. I think it's not as complicated perhaps as I'm making it sound, but let's add up the numbers. 700 plus 24 minus 44 plus 32 plus 116, big plus there, minus 24 minus 40. I end on 764,000. That is our taxable income, 764, and take 25% of that, multiply by 25% to get our current income tax. So our current income tax, 191, our taxable income, 764. Okay, determine the ending deferred tax balances. Well, we've just said this DTL is going down by 8. We have a DTL balance from before, and now I'm going to say minus 8 is 34. We said this DTL is going down by 29. Well, its balance was 29. It's going down by 29. It goes to 0. And it does make sense given the statement, right? Installment receivable collected in full. So whatever was there has fully reversed now. It's over. And so it's got to go back to 0. That's again, the idea of a temporary difference. The temporary difference is now closed, right? They're both in the same place. So 0 DTL after that adjustment. Warranty costs, minus 6K to our DTA. So minus 6K is 9. And last but not least, minus 10K from our unearned revenue. Minus 10K is 8. So those are our balances. Determine the ending balances, and we've done that, just the red numbers, 34, 0, 9, and 8. Next, it says, what's the deferred tax expense or benefit? All right, well, what's the change? Now, the change in DTLs, the DTLs went down by 37K, and if a liability is falling, that is actually a benefit. Now, our assets are also falling. That is an expense, 16K. That is an expense. So let's net the two. We got a 37K benefit, a 16K expense. We're left with a 21K Benny overall deferred tax benefit of 21K. So what is the deferred tax benefit? It's 21K. There we go. Last piece here. Determine the total income tax expense and prepare the journal entry. We'll do the journal entry, and then the total income tax expense will come out in the wash. We're going to credit current income tax payable. So income tax payable for 191, the amount we calculated just a moment ago. Now I'll look at my changes here and figure out what's going to be credited. It's these deferred tax assets. So let's credit DTA, unearned rev, and the amount was 10K. We're going to credit DTA warranty, and the amount there is 6. We're going to debit the installment DTL and the amount there was a big one, 29. We're going to debit the DTL for the depreciation difference, and the amount there was 8. And then we're left with debits not equaling credits, and the balance is going to go to income tax expense. Now, it's split. We can do it two different ways. We can just make sure our debits equal our credits, or we can say, well, we just said we had a $21,000 Ben. Isn't too far behind my head. And we have a $191,000 current income tax expense, right? Just the current income taxes. 191 minus 21 would mean the net income tax expense here is 170. So we could split this, right? This would be a credit of 21. This would be a debit of 191. We could have it as two lines. We've been doing it always as one. Let's make sure our debits equal our credits before we say goodbye. Credits are 191 plus 10 plus 6, 207. Remember that number. 170 plus 8 plus 29, 207. It is the same number. Debits equal credits. We've got ourselves a good journal entry, and we've completed 18.9a. If you made it to the end, smash one of the buttons. Thanks for watching, and I'll see you in the next video. Bye for now. Welcome to Module 19 of our intermediate financial accounting class. It's all about leases, and accounting for leases is so interesting because the whole scaffolding, all of the rules around accounting for leases are built to prevent game playing. So let's discuss the game that the rule setters are trying to prevent. And here's the game. So you decide to lease an asset, to rent an asset, and let's just say you rent a car, and you rent a car for the weekend. Okay, what's the journal entry for renting a car for the weekend? And let's say it's $500. So I go, okay, it cost me $500 cash. So of course I credit cash, $500, and I debit rent expense, $500. There, I've rented my car. And some smart, scammy maybe person saw that and thought, oh, this is a great idea. Why don't, rather than buying assets and, taking out bank loans, why don't I just lease assets? And if I lease them, I don't have to put them on my books, right? Because when I rent the car, I debit an expense, I credit cash. It never lands. There's no liability on my books, and there's no asset to be depreciated on my books. It doesn't mess with my ratios. So why don't I play a game, and rather than buying assets, I can just lease them, and I don't have all these debts on my balance sheets. All my debt to equity ratio doesn't get screwed up, but I get all the benefits of having this asset. And the rule makers didn't like it because they were like, people were formulating leases such that they were leasing the asset for the whole life of the asset. The person was using the asset, and they had what it was essentially debt, and they weren't showing up on the books because debit, rent, expense, credit, cash. It was too just scammy almost. It was just it wasn't reflecting what was really going on at the company. Maybe that's a better way of putting it. They called it off balance sheet financing. They were essentially borrowing money to buy an asset, but the borrowing wasn't showing up on the books and the asset wasn't showing up on the books. So standard setters said, we got to step in. We got to make some rules around this to prevent this from happening. Lucky us, the accounting for it is a little weird because of this quirky situation. So there's really 5 ways that the standard setters have said, if this happens, you got to account for this differently. You got to account for it as if it's your own asset, even though it's not, it belongs to the leasing company, and you got to account for the liability as if it's a debt, even though it's, just an annual payment or something like this. You can't just call it rent expense each year. Here are the 5 criteria. 1, if title transfers at the end. So you're leasing the asset. 2, with the intention of owning it at the end of the lease. Well, if title transfers, you qualify as, we call it a finance lease in US GAAP, a capital lease in Canadian GAAP, but same difference. So if title transfers at the end, it's a finance lease. You're financing an asset. Number 2, if there's a purchase option, and often this is called a bargain purchase option, a purchase option that's likely to be exercised, it's the same as title transferring. So, you've leased a car, and at the end of the lease, there's an option to buy it for $500, and it's for sure the car is going to be worth more than $500, so you're going to exercise that option. Well, it's the same as title transferring, and basically, again, the standard setters are saying, treat it as if you bought it. Put the car on the books. You don't get to just debit rent expense. You're going to put the lease leased asset on the books. You're going to depreciate that leased asset over the life of the lease. You've got to deal with it as if it's your own asset. The 75% test. Is the lease term more than 75% or more of the useful life of the asset? So if, the car is going to last 10 years and I go, I'm leasing it just for 9, well, that's 90% of the life of the thing. The accounting standards have said you bought it at that point, put it on your books, depreciate / amortize it over its life. 90% test. If you add up the present value of your payments and that adds up to 90% of the value of the asset, guess what? You bought it according to accounting standard setters. You can't just call it, again, rent expense and keep it off the balance sheet. Finally, if there's no alternative use for the asset, so you lease somebody a piece of equipment that is just for them and nobody else could possibly use it. Maybe I lease a sign that says Tony Bell's Accounting YouTube channel, right? Well, nobody else is ever going to need that sign except me. And because there's no alternative use for the asset, I essentially have bought it at that point. And so from the lessor perspective, that's the person leasing me the asset. From the lessee perspective, we would consider this a different classification of lease, and it has to go on the balance sheet. So our chapter will distinguish between finance type leases, called capital leases in Canada, and operating leases, and accounting for them is different and tricky, and this is a famously difficult chapter. I would suggest to you every single student who takes an intermediate accounting class will have these 5 things memorized and well understood if you want to survive the chapter. But we're going to do tons of examples where we look at what type of lease is it and how to account for it. The best way to learn it, though, is to do the examples, and I'm glad you're here with me. I can't wait to get started. See you in the next video. Bye for now. We're about to jump into problem 19.1a. Before we do, I just want to remind you, you can download the workbook for free from my website, tonybell.com. Go to tonybell.com, you click the PDF link, no sign in, no sign up, nothing like that. Scroll down, find whatever problem it is we're working on, and you'll notice along the way, there's lots of free videos like the one we're watching now. There are plenty of problems that only have members only videos. If you're getting good value from the free stuff, I hope you'll consider a membership. Let's jump into the problem. Let's jump into problem 19.1a. We're classifying leases. Is it an operating lease or is it a finance type lease? In Canada, we would call it a capital lease. Is it operating or finance type? Now, this question for my IFRS students, irrelevant. All leases are finance type leases under IFRS. Under US and Canadian GAAP, you do want to distinguish, is it operating or finance type? And we'll go through a bunch of criteria to figure that out. So that's the goal is it finance or is it operating? And explain why you made that determination. So step 1 for finance versus operating is, did ownership transfer? If ownership's going to transfer at the end of the lease, it's a finance lease. Step 2. Something weird happened on my computer there. Step 2, hopefully the recording's working. Is there a bargain purchase option such that it's like ownership's going to transfer? Like it's such a cheap price that they're just going to buy the thing anyway. So it's essentially the same as ownership transferring. If that's the case, well, again, it's a finance lease. Step 3. Are we leasing it for more than 75% of the useful life of the asset? So if it's an 8-year asset and we're going to lease it for 7 years, well, then we're basically owning the thing and it becomes a finance lease. Step 4, are our payments covering 90% or more of the fair value of the asset? Are we essentially buying this asset with our payments, the present value of our payments? If it's more than 90%, it's a finance lease. Less than 90%, it could still be considered operating. And the last one's a unique one to US GAAP. I think it's a good criteria, though. Is there any alternative use for this thing that's being leased? Is it just unique for the lessor and nobody else is going to be able to use it anyway? If that's the case, it's a finance lease. Okay, let's go through them. Delivery van. So 4 out of 8 years. Well, I should start with ownership transfer. That's sort of your first one. Does ownership transfer? The answer is yes. We can stop there, right? If ownership transfers, it is a finance lease. Ownership. I'll just say ownership. Exfer. So there's a transfer of ownership. Now, let's go through other criteria here. There's no bargain purchase, 4 out of 8 years, so this is 50%. So it needs to be over 75% of the useful life. 52 out of 64, there's 81%, needs to be over 90%. So it's not hitting any of those other criteria. We don't know about the last one, a delivery van. I guess it isn't unique, right? It doesn't fit the uniqueness criteria. So it didn't fit any other criteria, and there's no bargain purchase option because ownership transfers. So therefore, it is a finance lease, so because ownership transfers, but it didn't hit any of the other criteria. Let's look at the forklift, our second one here. Does ownership transfer? No. Is there a bargain purchase option? Yeah. There's a purchase option. No, that's not enough. It has to be a bargain, and $100 for, a $45,000 forklift. Yes, after 5 years, the term of the lease. But yeah, $100 is a steal. Of course, you would 100% exercise this, and therefore it might as well be a transfer of ownership. So yes, it's a finance lease because of the bargain purchase, right? There's a bargain purchase option at the end, and therefore 5/9, that's not over 75%, so it didn't qualify there. And 38 out of 45, this is going to be close. 84%, no, it's not over 90%, so that one didn't qualify. So the only way it qualified is under the bargain purchase. The rest it didn't. Next up, there's no ownership transfer. That's step 1. There's no bargain purchase. That's step 2. Step 3, I think we're going to hit. 7/8 of the useful life is 87%. 75% is our magic number. So once it's over 75%, it is a finance lease. And I'll just put 75% of the useful life. Next up, the packaging line. No, ownership doesn't transfer. No, there's no bargain purchase. 6/10, that's 60%, so it doesn't hit the useful life threshold. 93 out of 100,000, that's over 90%. It's 93%. Okay, so it is a finance type lease. Again, Canadian students will call this a capital lease. IFRS students didn't have to care about any of this, but it is a finance lease because it's over 90%. I'll put 90%, not 93%, but 93% is greater than 90%. The present value of the payments more than 90% of the value of the asset means it's a finance lease. Hits that criteria. E, commercial printer. Does ownership transfer? No. Is there a bargain purchase? No. Is it more than 75% of the useful life? No, it's only 30%. Is it more than 90% of the value that we're making in payments? No. Doesn't hit any of these. A commercial printer, I think it has other uses. Like it's not just unique to this one person. You can find somebody else to lease a commercial printer from you, especially it's only 3 years old. So no, I think this is absolutely not a finance lease. This is an operating lease, and it didn't hit any of those criteria. Last one, the warehouse rack system. Does ownership transfer? No. Is there a bargain purchase? No. Is it more than 75% of the life? Almost, but no. And is it more than 90% of the present value of the lease payments, more than 90% of the fair value of the asset? 51 out of 60, it's 85%, so no. So it didn't hit any of the criteria. Oh, and the last one, a warehouse racking system. Again, is there an alternative use for the lessor? If they take it back, can they take it back and release? And I think the answer is yes here. So as a consequence, this one clears the bar. This is an operating type lease. And there you go. We've identified them all as finance or operating, and I hope I've briefly identified which criteria it's hitting along the way. You've solved 19 1A, and you got to solve your way to the like button. Thanks for watching. See you in the next video. Bye for now. Let's jump into problem 19.2a. We're looking at a lease liability on a finance type lease and just measuring it and calculating it essentially. So this is a finance question. It's a present value question. Let's read through it. Selkirk Printworks, a commercial printing company, leased a printing press on the following terms. It's a commercial printing press. We're leasing commencing January 1st, 2031. The lease term is 5 years, $20,000 annual payments. Payments are due starting due each January 1st, starting today, January 1st, 2031. Now, this is the thing that will screw students up. Let me draw a number line here. So we are doing 5 years worth of $20,000 payments. So $20,000 today. This is times zero. After 1 year, we make another $20,000 payment, but we're paying in advance, right? So this is called an annuity due. Time 2, 20,000. Time 3, 20,000, for 20,000. So 1, 2, 3, 4. Yes, we made 5 payments, 3, 4, and we use the asset until the end of the year. Now that's unusual. Normally, when we look at present value cash flows, our payments come in at the end of the year. Here, our payments are going out at the beginning of the year. And as a consequence, when I do present value, I need to do the present value on this one, this one, this one, and this one. I don't need to do the present value on that one because it's already today. It happens on day one. So it's a little bit quirky in terms of the math, but it's just annuity due, if you remember what those are from previous chapters. Okay. The remaining life is 6 years. The fair value of the press is 105 and the discount rate is 8%. Okay, so show why this is a finance lease. Okay, first question is, did title transfer? And it's certainly unclear here. So under the absence of information, we're going to say no. Step 2, is there a bargain purchase option? They don't discuss anything. So again, we're going to say no to that. Is this more than 75% of the useful life? Well, 5 out of 6 years, yes. So yes, it's a finance lease. Yes, because greater than 75% of useful life. The lease term. Lease term, my writing is so good, is, so our lease term is more than 75% of useful life. It's 5 out of 6 years. Therefore, it is a finance type lease. It says calculate the initial lease liability and the right of use asset. We got to figure out the present value of these payments. That's really what we're after. And so because of that, we could do like 4 different calculations. So this is $20,000 divided by 1 plus the discount rate, 1.08 to the power of 0. And you'll find that's just $20,000. This is divided by 1.08 to the 1, divided by 1.08 to the 2. And you could do that, right? Just for these calculations. But I think we should do PV of an annuity. If you have a finance calculator, you can do that. I'm going to do it by hand. And the formula is PV equals C, which is our payment amount, plus, I don't know why it's C. It's just what I've seen in finance books, times 1 minus 1 over 1 plus R, which is our discount rate, to the T, number of periods, all divided by R. So I know it seems complex, but I've got it memorized. I'm not a genius, that's for sure. You are probably seeing that. Let's go ahead and solve then. So C is the payment amount, $20,000. Times 1 minus 1 over 1 plus R, so that's 1.08, to the power of T. Now, how many payments are we discounting? It's a 5-payment thing, but we're only discounting 4 because this payment doesn't need to be discounted. We'll add it in at the end, but it's 1.08 to the 4th power to get our discounted cash flows, divided by 0.08. And let's do the math. Clear. What is going on here? 1.08 to the power of 4, x to the y 4 is 1.36. So I'm doing the 1.08 to the 4th power. Then I go 1 over x. I get 0.73. Then I go 1 minus that number. So I put in as negative plus 1. So my numerator is 0.26. I got to divide that by 0.08. I get 3.31. I multiply that by 20,000. And it's $66,242. That's the value of these 4 payments that I've highlighted in red. But what's the value of this $20,000 at time 0? It's $20,000. So I'm going to add $20,000. So 66,240, we'll call it 243, plus 20,000 is at 86,243. That's the present value of my future payments, and that's the value of the equipment. It's what I'm paying for the equipment. I'm paying $86,000. I pay $20,000 today, and then $66,000. That's the present value over time. So I'm paying $86,000 for this equipment that needs to land on my books. Therefore, that's what we put it on the books for. So what's the journal entry look like? Well, we're going to debit on Jan 1, 2031, we're going to debit right of use asset. That's the American terminology. I like it, actually. And it's just saying this is an asset. We're putting it on our books, but we don't own it. Technically, we're leasing it. Right of use asset, 86,243. We are going to credit cash, of course, $20,000. And we're going to credit the lease liability. for the amount we owe on our lease, which is just like the balancing item here. It's like, well, it's the 4 future payments that are going to come out, which is 66,243, the amount we had calculated earlier, net of the cash. So there you go. That's how we solve it the finance lease way. And now it's the same under IFRS, same under US GAAP. Canadian GAAP will use slightly different terminology here, but if you don't need that, you can say goodbye. I'm trying to get out of the way of my numbers. But for you Canadian gappers, it's pretty simple. We just don't call it right of use asset. We just call it equipment under lease. It's just like, might as well be the same thing. Under lease. And we call cash, of course. And rather than lease liability, we call it a lease obligation. But for my money, it really doesn't make a huge difference between the two. There you go. We've solved 19.2a. We've done it 2 ways. If you made it to the end, thanks for watching. See you in the next video. Bye-bye. Let's jump into problem 19.3a. We're going to do a lease amortization schedule. So the first few journal entries and figure our way through this lease. Chilcotin Freight is a regional trucking company and it leased a highway tractor on the following terms. And the first question is saying, show that this is a finance lease. As I show that I know how to find my pen. So, okay, we're going to show that it's a finance lease. So what are we on the lookout for? Is there a change in ownership at the end of this thing? Is there a bargain purchase that essentially makes there to be a change of ownership? Is it leased for more than 75% of the economical life of the asset? Are the present value of the lease payments more than 90% of the fair value of the asset? And finally, is there any alternative use at the end of the lease, or is it such a unique bespoke product that it can't really be returned for the lessor, and therefore, constitutes essentially a purchase. So it's a highway tractor, January 1st, 2031. It's a 7-year lease, and I'm already looking ahead going, well, 7 years on a 10-year economic life, that's 70%, so it doesn't clear that bar, the 75% bar. The annual payment's $25,000. Payments are due January 1st, so just looking at this on a number line here, we got time 0. We start paying at time 0. We pay, what is it, $25,000, 1 year, 2 year, 3 year, 4 year, 5 year, 6 year, 7. So $25,000 year 1, $25,000 time 2, $25,000. Just drawing a number line of this. There's 7 payments, time 3, time 4, time 5, time 6. That's when we're making our payments, and we're owning this for 7 years. 1, 2, 3, 4, 5, 6, 7. Yes, we're owning it for 7 years, but our first payment happens at time 0. So for our PV calculations, which we'll be inevitably doing, these things need to be present valued back to this time. This one does not need a present value because it's happening on day 1, which is typical of leases. Okay, so we've gone through the first bunch of these, but we still haven't established that it's a finance lease. We're actually going to need to do the present value here and figure out if the present value of all the payments is greater than the fair, or not greater than 90% of the fair value of the tractor. Let's do some quick math here. What's 90% of this? 160 times 0.9. That can't be right. 160 times 0.9. So it's $144,000. So if the present value of these $25,000 future cash flows is greater than $144,000, we've got a finance lease. And I think we're going to have that situation here. So what's our discount rate? 6%. So this is present value of an annuity stuff. I'm going to do it by hand, the old-fashioned way. If you have a financial calculator, this shouldn't be hard for you to do at this point in your intermediate accounting class. But here we go. Present value equals the amount of the payments times 1 minus 1 over 1 plus r to the n, or to the t, I guess. Well, n or the t. 1 plus r to the t divided by r being our discount rate, t being the number of periods. Now remember, we're only discounting 1, 2, 3, 4, 5, 6 future cash flows, even though there's 7 payments, because the last payment we just add at the end, because this is, again, an annuity due. We're making the first payment at the start. So PMT is $160,000. Is that right? No, PMT is $25,000. What am I saying? And that's the fair value is 160. 1 minus 1 over 1 plus r to the t, 1.06 to the power of 6. All divided by 0.06. Whew. All right, this is easier to do than the way I'm making it sound here. 1.06 to the power of 6 is 1.4. Divide 1 by that, so I use the 1 over x button on my calculator. I get 0.7. 1 minus that number, I put this in as negative, plus 1. 0.29 is the numerator. Divide by 0.06, my denominator. I get 4.9. I'm going to multiply that by 25K. And I get 122,933. I should have made that. I'm going to just multiply this by 1,000. I multiplied by 25. I should have multiplied by 25,000. 122,933. 122,933. So the value of this stuff is 122,933, the present value of that. But the present value of the first payment, which I do have to make, is 25,000. So let's just add those two sort of cash flow streams together, the 25,000 plus 122,933, and we land at 147,933. Okay, so the present value of our future payments is 147. Well, 90% of this is 144. Another way of looking at it is if I divide this by 160, you can see it's 92%. So show why this is a finance lease. PV of payments is 92.5% of fair value, which of course is greater than 90%, which is our threshold. Okay. So there you go. Now it says calculate the initial lease liability and right of use asset. Good news, we've done it. This is our initial right of use asset, 147, the present value of the future payments. This is the initial lease liability, 122,933. I think it takes shape when we do our first entry or entries. Let's go ahead and do our first entry. We're going to debit, of course, right of use asset. For the present value of all the payments plus including the 25 grand, the initial one. So it's 147,933. We're going to credit, we can do this in one step or two. I'm going to do it in one step here. Credit cash for the first payment of 25 grand. And we're going to credit lease liability, lease liab for the difference there, which is 122,933. This was January 1st. Okay, so we're off to a flying start. Let's continue. It says prepare, so calculate the lease liability and right of use asset. Now it says do a lease amortization schedule. This one's a little quirky in the layout. The initial balance before we even make our first payment is 147,933, but then we immediately make a payment of 25,000. There's no interest on that first payment because it happens at time 0. So we reduce our liability by 25, 147,933 minus 25,000, 122,933. So on January 1st, after having done that first transaction, we have a lease liability of 122,933. We have a lease asset of 147,933. Everything is kind of as it should be. Let's continue on to the second payment. A year later, we make a $25,000 payment. There is interest. We had a liability of 122,933. It accrues interest at a rate of 6%, 73.76 in interest. So of that 25 grand payment, 73.76 pays off interest. So 17,624 pays off to reduce the liability. So I had 122,933. I just reduced my liability by 17,624. My liability is now 105,309. And again, we just make this fixed payment of 25 grand. This time the interest is a little lower, 105,309 times 6%. 63, we'll call it 63.19. So I paid 25 grand, 6,300 went to cover interest, 18,681 goes to reduce the debt. My debt was 105,309 minus 18,681, 86,628. And what we would do is continue on here, right? I trust that you could do another 3 years of this, but I just don't want it to, the question to be something you could do in an Excel sheet in 10 seconds. So it would go down to 0 after the lease term of 7 years is up. So I guess that would be Jan 1, 2037. And that's where we would expect to end up. So it says prepare a lease amortization schedule for the first 3 payments, which we've done. Those are the first 3 payments. Then it says prepare all of the journal entries for January 1st, 2031 through January 1st, 2032. We did January 1st, 2031. Let's go ahead and do all the rest. So I'm just... The next relevant date here is December 31st, 2031. And why is that a relevant date? Well, the reason that's a relevant date is because it's a fiscal year end. So we have to do interest accrual. We have to do depreciation. Let's start with depreciation. We have a $147,000 asset. It's going to depreciate over the term of the lease, not the remaining economic life, because we're getting rid of this at the end of this. Just the term of the lease. So 147,933 divided by 7 years, 21,133 is our depreciation expense. So debit.
Quick comment for US GAAP users. You're going to debit not depreciation expense, you'll debit amortization expense. And you'll either credit accumulated amortization or just credit the asset directly, depending on what your textbook does. In the videos, I use depreciation expense. That's the common thing under IFRS and Canadian GAAP. But you want to use amortization expense. Okay, back to the video.
Depreciation expense. Now there's no residual value, nothing accruing to us. So 21,133 and credit AD 21,133. What about the interest? Well, also on December 31st, 2031, we've said interest is 73.76 for the year 2031. Again, December 31st, 2031 at midnight. January 1st, 2032 at 12:01 a.m. Same interest. So debit interest expense 73.76. We credit lease liability here. Canadians will call this a lease obligation. 73.76. Next day, January 1st, 2032, we make a payment. We credit cash for 25 grand, and the debit is just to lease liability, 25 grand. And I do like to double check and say, is the lease liability where I think it should be? So it started at 122,933, right? That initial credit. Then we just increased it by 73.76, the interest, 73.76. Then we decreased it by the cash payment, the 25 grand minus 25,000. And I think as of January 1st, 2032, I should have a lease obligation of 105,309. And sure enough, I do. Everything is as it should be. We've completed 19.3A. As always, thanks for watching, and I'll see you in the next video. Bye for now.
Let's jump into problem 19.5A. It's a bargain purchase option question. Tofino Excavating, a site preparation contractor, leased a hydraulic excavator on the following terms. So they've leased a hydraulic excavator January 1st, 2031. It's a 3-year lease term. I always look for how long the economic life of the asset is. The asset lives for 9, so 33%. We're not anywhere close to our 75% threshold here. The annual lease payment, $16,000. Payments are due January 1st, meaning it's an annuity due. We pay at the start, which is very normal for leases. So in terms of, it's a 3-year lease, so this should be pretty straightforward to number line. At time 0, we pay $16,000. After 1 year, we pay $16,000, and that covers year 2. After 2 years, we pay $16,000. That covers us through, so first payment covers year 1, second payment covers year 2, third payment, third payment covers year 3, brings us up to here. And that's sort of where we sit by the end. And there's no lease payment at the end of year 3. We just use it till the end of year 3, and then we're done with it. Tofino may purchase the excavator for $20,000 on December 31st, 2033. So there is a potential payment at the end of 2033. The excavator's fair value on that date is expected to be $34,000. Okay, so this is the type of deal where even if we don't need the excavator for more than 3 years, we're a fool not to take the deal, because we can pay $20,000 for something we could turn around and sell for $34,000. We'd be a fool not to take the deal. We should take this. This is a bargain purchase. So if that's the case, if we're going to take the deal, well, at the end of year 3, we're going to have a cash flow of $20,000 to buy the thing. So, first question is, show that it's a finance lease. Bargain purchase means finance lease. So we don't need to go through all of the others. Does title change hands? Well, not officially, but it's going to change hands because step 2, there's a bargain purchase. Present value, not present value, 3 out of 9 years, it doesn't hit that threshold. Present value of future payments. Well, let's go through the present value of the future cash flows. And we want to PV each of these cash flows. So it's an annuity due, which means we can do PV of an annuity on these 2 or PV of an annuity due on these 3. We're going to have to do present value of a lump sum on this one. And because of the nature of this, there's just not that many. I'm just going to present value each of them individually. So to do a present value, you just divide by 1 plus the discount rate, 7%, to the power of whatever year you're discounting to. So 1.07 to the 0, 1.07 to the first power, 1.07 to the second power, and 1.07 to the third power. And you just add up these present values. So 16,000 divided by 1.07 to the 0 is 16,000, because 1.07 to the 0 is 1. 1.07, why did that go 0? It's 1. So 1.07, or 16,000 divided by 1 is 16,000. Next one, 16,000 divided by 1.07 to the first power. So divide by 1.07, 14,953. 16,000 divided by 1.07 squared, 16,000 divided by 1.07 to the power of 2 is 13,975. And last but not least, 20,000 divided by 1.07 cubed, x to the y 3, 16,326. So what's the present value of these future cash flows? 16,000 plus 14,953 plus 13,975 plus 16,326. Now, had this been longer, I might have done some PV of an annuity. I just did this because it was the quickest way I could think to do it. But the present value here is 16,254. I'm going to cough. There we are. Okay, so step 1 in the books. Is this a finance lease? Yes, because of the bargain purchase. Step 2, it says calculate the initial lease liability right of use asset. Well, a right of use asset's worth $61,254. So you know me, I always want to do a journal entry here on January 1st, 2031. We're going to debit right of use asset. Canadian students will call this asset held under lease or something like this. 61,254. On day 0, we credit cash for the first payment because it comes out on day 0, 16,000, and the rest will go to lease liability. 61,254 divided by 16,000. Not divided by minus. It should not be a decimal. 61,254 minus 16,000. What was I thinking? 45,254. I can tell you what I was thinking. I was thinking about depreciation, and that's a divided by. I got my brain befuddled. The other thing that's on my mind, and now it's not going to come into play that early in the question, but we do have a 61,254 asset. How long do we depreciate over? Over 3 years or over 9? Those are sort of the two numbers that should be floating in your head. And the answer here is 9 years, because we're going to experience this asset for 9 years because we're buying it, right? So the expected useful life here is 9 years, not the lease term of 3. So divide by 9 years. And again, we could overcomplicate this or, pump in residual value at the end of our life or whatever. There's all sorts of things we could add to it, but given the information, I would just divide this by 9. We get 6806 as our depreciation per year, right? Our annual straight line depreciation. Okay, so calculate the initial lease liability right of use asset. We've done that. Right of use asset 61,254. Lease liability on time 0 is 61,254, but as soon as we make that first payment, it's 45,254. So could be either of those. It says prepare the lease amortization schedule. Let's do it. Our opening balance here, 61,254, before we make our first payment. Then we make a payment of 16,000. At time 0, there's no interest, so the reduction of the liability is 16,000, and 61,254 minus 16,000 is 45,254. Now we're going to make another payment on the 2032 and another one in 2033, and then at the end of 2033 we make a big chunk, a lump sum of $20,000 to buy the thing, and those are our payments. So what's our interest in between January 1st, 2031 and January 1st, 2032? What's that 1 year of interest? We have a liability of 45,254. We have an interest or a discount rate of 7%. So 3,168. So our liability was 16,000. It reduces by there's interest of 3,168. So if I'm our payment was 16,000. Of that payment, $3,000 goes to interest, and about $13,000 goes to reduce the liability. 12,832. I started with a liability of 45,254. I've reduced it by 12,832. 32,422 is where I end up. Okay, interest for the next year. I start with 32,422. I take 7% discount rate. 2270 is my interest. So again, I make a $16,000 payment. 2,000 goes to interest, so around 13,730. Did the math in my head. Hopefully that's right. 16,000 minus 2270. Yeah, 13,730 goes to reduce the liability. So 32,422 minus 13,730 is 18,692. Okay, last one, 18,692. The interest on that, 0.07, is 1308. So 20,000, 1308 goes to cover interest. 20,000 is my payment minus 1308. 18,692 goes to cover the liability. And look at that, it was 18,692. I reduced my liability by 18,692. Of course, we would expect our liability to be 0. Okay. So it says prepare the lease amortization schedule for the full term, including the purchase option. Done. That's the table below. Over how many years should we depreciate? Briefly explain, we should depreciate over the economic life. The lease term doesn't make sense because we're going to own this beyond the lease term. Prepare the journal entry or entries for December 31st, 2033 when we exercise the purchase option. Okay, so December 31st, 2033. A few entries. The first is we depreciate our asset. So let's do that. Debit, depreciate.
Quick comment for US GAAP users. You're going to debit not depreciation expense, you'll debit amortization expense. And you'll either credit accumulated amortization or just credit the asset directly, depending on what your textbook does. In the videos, I use depreciation expense. That's the common thing under IFRS and Canadian GAAP. But you want to use amortization expense. Okay, back to the video.
Expense, 6806. Credit accumulated depreciation on our right of use asset, 6806. Okay, then we make this payment to buy out the asset. So let's do the payment. So also December 31st, 2033, we credit cash, of course, for $20,000. Since I'm probably behind my own head here, we credit cash for $20,000. The debit is to interest expense. 1308, and lease liability, lease obligation 18692. Okay, so we've wiped the lease off our books. The one problem we have is we have this asset called a right of use asset, or asset held under lease, some leased asset descriptor, and it shouldn't be called that anymore. It should just be called equipment, right? This is just normal equipment now. It's not held under lease, and so we don't need to indicate it. So we have to move it from a right of use asset account just to a normal equipment account. So we got to reclassify it. December 31st, 2033, I get rid of my right of use asset, credit right of use asset 61254, and I debit equipment. Is this an excavator or something? I'm going to call it an excavator. 61254. So now I have this excavator account. It's just amongst my normal equipment. I have to do the same thing with AD. We've done AD, or depreciation, for 6806 a year for 3 years. Remember, we've owned this for 3 years before we make this transition. So my AD up to this point, 6806 times 3, would be 2418. I got to move it from AD right of use asset to AD equipment. How do I do it? I just debit AD right of use asset for 2418, all of the depreciation so far, and I just say it goes in AD equipment, and I can have like excavator as like a sub account to my AD equipment, 2418. And there we go. I think we've solved it. There's one thing for you left to solve. Solve your way to the like button. As always, thanks for watching, and I'll see you in the next video. Bye for now. Let's jump into problem 1978. We're doing an operating lease from the perspective of the lessee, the person taking out the lease, leasing some kind of asset. So this is unique in our course really so far, where the differences between US GAAP, IFRS, and Canadian GAAP, we call it ASPE, are just totally different. Normally there's huge overlap between the three accounting rules, but this one, no, they're just totally different. So let's jump into it. That's why we take it on in 3 parts. We'll do US GAAP first, IFRS second, and Canadian ASPE, which is actually a really easy method. We'll do that third. But let's start with US GAAP and work our way through. Castle Outdoor Center, a sporting goods retailer, leased a delivery van on the following terms, and then just discusses that the 3 frameworks are totally different here. We're leasing a delivery van. We're leasing commencing January 1st, 2031. It's a 3-year lease, $10,000 payments. Payments are due each December 31st. Now, we're leasing it January 1st. Our first payment isn't until December 31st. That's unusual for a lease payment. Like, usually you have to pay something up front, but okay, we'll live with that. So here's the lease, time 0, time 1, time 2, and time 3. At the end of years 1 and 2 and 3, we're going to make $10,000 payments for a total of $30,000 in lease payments. The remaining economic life is 8 years. The fair value of the van is $34,000, and our discount rate is 6%. It says show that this is an operating lease under US GAAP. Okay, so step 1, as you'll recall, is did title change hands? If title's going to change hands at the end, it's a finance lease. Well, title's not changing hands. Is there a bargain purchase? No, there is not. And how do I know that that's not happening? Because it would have to say it in the question. If it doesn't say it, you assume it's not happening. The third criteria, is the lease term more than 75% of the remaining economic life, or 75% or more of the remaining economic life? And the answer is no, it's 3/8, right? 3 out of 8, it's 37%. So no, 38%, say, rounded up. No, it's not. Doesn't hit that criteria. Is the present value of the lease payments 90% or more of the fair value of the asset being leased? Well, let's take the present value of these payments. So I got to PV that one, and that one. Now, this is an annuity. We could do PV of an annuity. I find when I have like 3 or fewer, I just do individual PVs. So divide this by 1.06 to the power of 1, divide this by 1.06 to the power of 2, and divide this by 1.06 to the power of 3. And I present value each of those individual payments and then add them together, and we get there. I think this is faster. That's the only reason I'm doing it this way. divided by 1.06. You could PV in your calculator. 9434 plus 10,000 divided by 1.06 squared. 8,900 actually rounds up here. 10,000 divided by 1.06 cubed. 8396. Okay, let's add them all up. 9434 plus 8900 plus 8396. 26730. 26730. And so is that more than 90% of the fair value of the van? Well, the fair value of the van, 34,000. 78%. So no, we didn't hit that criteria. So again, criteria 1, does title change hands? No. Bargain purchase? No. 75%, lease term 75% of the remaining economic life? No. Present value of the lease payments more than equal to or greater than 90% of the fair value of the asset? No. The final US GAAP criteria is the asset, does it have an alternative use once it's returned to us? Is it such a unique asset that we couldn't lease it out or do anything with it? And answer, it's a delivery van, so yeah, it's fine, right? So that's not an issue either. It fails that criteria, and this therefore is not a finance lease. This is an operating lease. It says calculate the initial lease liability and right of use asset and do the journal entry. Okay, well, we have the values here. The journal entry is pretty simple, and it's very similar to what we would have done in previous questions. On January 1, 2031, we're going to debit right of use asset, and we're going to credit lease liability for 26,730. Easy for me to write. 730. Okay. So that's our first entry. Now it says do a lease amortization schedule for the full term of the lease. Okay, so we know our lease balance, 26,730, our lease liability initial balance. We know our interest is 6%. We know our payments, can't remember what they are, $10,000, and we just work our way down here. Okay, so 26,730 times 6% means our interest is 1,604. We make a $10,000 payment. 1,604 covers the interest, so 8396 goes to reduce the liability. So we were at 26,730 minus 8396 means we're at 18,334. Okay, we're at 18,334, 6% interest for the next year. It's $1,100, meaning this has got to be 8,900, 10,000 minus 1,100, 8,900, and we were at 18,334 minus 8,900 is 9,434. Okay, we're at 9,434. We take 6%. Our interest expense is 566. 10,000 minus 566 is 9,434, and look at that, it worked out to the penny. Okay, so there is our schedule. Now on to, I think, the key element of this, the future journal entries, the payment or journal entries. And it is a little quirky, so let's get to it. It's December 31st, 2031, and we make a payment, $10,000. So let's credit cash, $10,000. I'm leaving room for lots of debits here and lots of other things. $10,000. Now we reduce our liability by $83.96. So let's reduce our liability, debit lease liability for $83.96. Now we have a different expense here when we have an operating lease. We don't do interest expense, we do something called lease expense. And our lease expense is the lease payment total, so $30,000 in total lease payments, divided by the number of years. So divided by 3 years worth of lease payments. So it is $10,000. Now, this is going to be a little weird here because it's the exact same as our lease payment, our lease expense. I don't want you to think the lease expense is the same as the lease payment. It's the total of the payments divided by the number of years, because there are certain times where we have uneven lease payments where that just doesn't work, that the payment and the expense are the same. It happens that they are for this question. So our lease expense is $10,000. And again, not because it matches the amount of the cash, but because it's the total payments divided by the number of years. That's why. So $10,000. So the balancing plug here, we got $18,000 of debits, we got $10,000 in credits. We're missing a credit of $83.96. This is a balancing plug, and it goes to right of use asset. And why do I credit my right of use asset? Well, remember, we are saying we have an asset on our books for $26,730. It's going to go down over the next 3 years. It's got to go down to zero at the end of this because I've got to return the asset to the lessor. And so I have to reduce the value of the asset. Now, we don't depreciate our asset in this method, right? There's no depreciation expense in AD. This is how we're going to reduce the value of our assets. It's a balancing, like in terms of the journal entry, it's a plug number, right? We have the cash amount. We know that for sure. We know the reduction of lease liability amount. We have the lease expense from here. The right of use asset is a plug. Now, it happens in this question, it's always going to match the lease liability. But again, if we have uneven payments, that amount's going to be different. Okay, so that was the 2031. I'm going to do 2032 just in blue ink beside, because it's the same debits and credits, just different numbers. So my lease expense for 2032 is $10,000. So debit lease expense for $10,000. My credit to cash, well, it is $10,000. My reduction of my lease liability in 2032 is $8,900. And therefore, to make it balance, I credit the right of use asset for $8,900. 2033, very similar. I'm going to debit lease expense for $10,000. And again, that's downstream of this. The lease expense is going to be the same every year. We would expect it to be the same every full year. My credit to cash, $10,000, the amount of the payment. Now, we don't expect the payment to necessarily be the same every year. There could be uneven payments, so this doesn't always have to work out. And if the payment doesn't match, then the debit to credit to lease liability and right of use asset won't match either. They do in this case. My reduction of my liability, $94.34. And my credit to right of use asset is $94.34. And there we have the US GAAP method done. So prepare the entries, done. IFRS, we just treat it as we would a finance lease in previous questions. So IFRS is just like, all right, let's see. Calculate the initial lease liability and right of use asset. Done. Like, that's this calculation, and that would have been how we would have normally done it if this was a finance lease. The journal entry on January 1st, 2031 is the same entry, debit right of use asset, credit lease liability, as I cough. Okay, so this is done, right? We did it in part one, like same answer. Then do the December 31st, 2031 entries. Well, there's two entries, and I don't want you to lose sight of this. On December 31st, 2031, we would record an entry based on this lease amortization table. So credit cash, I'm just reading the first line of the table here, $10,000. So this is IFRS. Credit cash, $10,000. Debit interest expense, $1,604. And debit lease liability, $83.96. But we also have to record the fact that our asset is falling in value, right? We had this right of use asset, and we're saying our asset's falling in value. Now, under IFRS, we would treat it like a finance lease, and that means we amortize or depreciate our asset. So, right of use asset was $26,730. We're depreciating it over 3 years, so $89.10. We debit depreciation expense. We credit accumulated depreciation for $89.10. and that's on December 31st, 2031. Okay, one more to do, and this is by far the simplest. Canadian ASPE, when you have an operating lease, Canadian ASPE says, treat it like you are renting a car, like for the weekend. And how would we do it if we were renting a car for the weekend? You'd go debit, rent expense, car rental expense, credit cash, like when you make the payment. So you don't have some asset sitting on your books that you're depreciating over time. You just treat it like you're renting a piece of equipment for the week, right? And in those cases, it's very simple. You don't do anything on January 1st, 2031 when you've leased the thing. So again, Canadian ASPE, you just go, okay, well, at the end of the year, I paid $10,000 because I'd rented a vehicle, or was it a vehicle? What was it? A van. Yeah, I rented a van for the year. So, like, van rental expense, 10,000, credit cash, 10,000. And then you do that the next year and the year after. So very simple. You don't have to do PV of future payments or any lease payment table. I guess you do have to do PV to figure out that it's an operating lease. It's all the same steps for Canadian ASPE as US GAAP in terms of figuring out if it's operating versus capital. But once you figure out that it's operating, boy, is that easy. I don't think it's the best way, but it is the easiest way. So I like it. That's it, though, for problem 19.7a. As always, thanks for watching, and I'll see you in the next video. Bye for now. Let's jump into problem 1910A. We are looking at a sales type lease, and we're going to do the lessor accounting for that sales type lease. So Revelstoke Machinery, a forestry equipment dealer, leased a log loader to a customer directly out of its inventory on the following terms. And so we have this log loader. The inventory cost to us is $48,000, and you can see the fair value is higher than that because obviously we're selling it at fair value or leasing it at fair value. And it notes that the fair value $62,548 is equal to the present value of the payments discounted at 6%. Just a quick comment here. It's very fair for me or your professor to say, well, show me this fair value. They don't give you the number. They just give you like, oh, it's $12,000 payments over 6 years, and you have to do a discounted cash flow calculation. I'll do it at the end of the video just to prove the number, but it wasn't asked for. In this one, it was a given number. Our lease commences on January 1st, 2031. It's a 6-year lease, $12,000 payable each January 1st starting now. So again, if we think about this as time 0, year 1, year 2, year 3, year 4, I put the 5 on top for some reason, year 5, and that's 6. We make our payments here of $12K, 1, 2, 3, 4, 5, and 6. We make our payments at the beginning of each year, and that's pretty typical of these leased assets. So if we had to do a present value, it's an annuity due, right, with a payment at time 0. But we've been given the number. Okay, 7-year remaining economic life, 6% discount rate, no residual value. That's important, right? The key element in US GAAP is that there's a guaranteed residual that pushes you over the 90%. That's what distinguishes a sales type lease from a direct finance lease. But there is no residual, so that's not going to be happening here. And collections profitable, reasonably assured. So from the lessor's perspective, classify the lease. Okay, so first we got to say, is this an operating or finance lease? So same rules apply as they've applied all chapter. Is title transferring at the end? No, doesn't look like it. Is there a bargain purchase or just a purchase that's likely to be exercised at the end? No. Is the term of the lease more than 75% of the remaining economic life? Well, it's 6/7. It's 85%. So yeah. So greater than 75%, so it's a finance lease. Now for Canadian GAAP, for US GAAP, we want to further distinguish, is it sales type or direct financing? Now, of course, we can just like read the question title and know it's a sales type.
US GAAP says there needs to be a guaranteed residual value that pushes us over the top. So we have to qualify as a finance type lease on the 90% present value of future payments. And the reason we qualified on that 90% was because there was a guaranteed residual value by a third party that pushed us over the top. Kind of a quirky situation causes direct financing lease. I got a cough. So I think it's pretty unusual. You kind of have to concoct a scenario. In Canadian GAAP, it's actually just that you're not making any profit on the deal. So your cost is equal to the fair value. And so you don't make any profit selling the thing. You're making the profit on the financing of it. I think the Canadian GAAP one is more coherent, actually. A rare case where I side with the Canadians on this one. But in either case, this is a sales type lease. Because one, there's no guarantor for US GAAP and for Canadian GAAP because there is profit built into it. And for IFRS, it doesn't matter. Everything's, if it's a finance lease, you account for it the same way. You don't need to distinguish. Okay, calculate the gross profit that Revelstoke's going to recognize here. Very straightforward. It's our fair value, the present value of these payments that we're receiving is $62,548. Our cost is $48,000. So how much money are we making? How much gross profit? $14,548. Okay, next up, just making sure I have a key up here. I'm like double checking the math because I did it in my head. Next up, it asks for that first journal entry. January 1st, 2031. What happens? Well, we enter into this lease. Debit lease receivable. And the fair value, the present value of the future payments is $62,548. And this is sales revenue. This is us making a sale. This is a sales type lease, $62,548. Now, when we make a sale, there's an inventory component, debit COGS credit inventory. For the asset cost, $48,000. And as the name suggests, this is like we're selling the asset, essentially. It's not exactly a sale, but it's kind of is. Okay, let's continue. Now, on that day, we received the first payment. So we've done the sale, we've done the COGS. We got to do the journal entry for the first payment. Well, that's a pretty easy journal entry as well. January 1st, 2031, debit cash, $12,000, and credit lease receivable. That's $12,000 less we're going to be waiting on. $12,000. Okay, so that's that. Now it says complete the first two payments of the net investment amortization schedule below. Well, we know the payments are $12,000 each time. We know the interest is 6%. It's interest revenue in this case. So we go, oh, wait, the first payment happened on January 1st, 2031. There's no interest on that because it happened at time zero. So our net investment goes down by $12,000. So from 62 to 50. 548. Then our next one, the interest is 6%, so 50 548 times 0.06, 3033. That's our interest. 12,000 minus 3033, 8967. So 50 548 minus 8967 means our investment, or well, call it investment, but our lease receivable is going to fall to 41,581, and each payment is going to fall and eventually will be zero. Okay, so that was January 1st, 2031, and we've done the amortization schedule. Next, we got to do the interest accrual on December 31st, 2031. Well, how much interest is built up? We've already done this line, right? So cancel that, right? We don't need to use that. We're going to use the next line down, and it's just like, how much interest is there? Credit, interest, revenue. This is us earning interest on the lease. 3033. And the debit, you can go two ways with it. I've seen it most commonly done this way, and I think this is the simplest way: debit lease receivable. You could also debit interest receivable. I like debit lease receivable better. I think it's simpler, but I've certainly seen credible textbooks debit interest receivable for this amount. But I like the debit to lease receivable. And there you have it. We've solved the problem. And you could keep going, right? I could imagine this table continuing down, and I just keep on doing those journal entries. At the start of this, though, I said, well, you can say goodbye if you don't want to do a present value calculation. I said, oh, well, normally we have to do these present values. This question didn't ask us to, but let's prove that number. Let's prove that 62,548. Let's flex our present value calculating skills. Remember how this works. We divide each by 1 plus the discount rate, so 1.07 to the power of how many years we're discounting, in this case 0, divided by 1.07 to the 1, divided by 1.07 squared, and so on, and we just would add it up. Now, obviously, that's a lot of work, and we have an annuity here. It's an annuity due. The way I deal with annuities due is I just take the annuity portion, which is everything not at time 0 that needs to be discounted. I do a present value of a 5-year annuity, and then I add in this $12,000 afterwards. So I'm going to go $12,000 plus the present value of this 5-year annuity. Let's do the present value of our 5-year annuity. Present value equals PMT outside of 1 minus 1 over 1 plus R, our discount rate, to the T, the number of discount periods, divided by R. And I might have missed some brackets there, but we've done this often enough. You should know what to do. 12,000 times 1 minus 1 over 1.06 to the power of 5. We're only doing a 5-year annuity. Remember, that other $12,000 payment just gets added. It doesn't get discounted. Divided by 0.06. So 1.06 to the power of 5. 1.33. I go 1 over that number, so 1 over x, 0.74. I go 1 minus that, so I put that in as a negative, plus 1. I'm at 0.252. I divide by 0.06. I get 4.2. I multiply by 12,000. I get 50. So the present value of the 5-year annuity is 50,548. I'm going to add 12,000 to that, and I'm going to get 62,548. And look at that. That's the number I was seeking. So we've solved it. So that wasn't asked for. That was a little bit of bonus content at the end of 1910A. As always, if this video or the bonus content helps, I hope you'll help me with a thumb or a sub. Have a great day. Thanks for watching. Bye-bye. Let's jump into problem 1912A. We're looking at a lease, and we're doing it both sides, the lessor and the lessee. Hope Logistics leased a truck from Ashcroft Equipment, a truck dealer. Details are below. So we're leasing a freight truck starting January 1st, 2031. It's a 5-year lease. $16,000 annual payment starting on January 1. So it is an annuity due type of a lease. Let's see, there's $16,000 payments, and we're doing 5 of them. So 1, 2, 3, 4, 5. And at time 0, we're making a payment because it's due on January 1st, day 1 of our lease. So, you know, at the start of time 0, we make a payment, and then those are the 5 payments as time goes on. So in terms of discounting cash flows, we're going to discount these 4 cash flows back to time 0, and that's an annuity, right? Like, these 4 years are an annuity. This first $16,000 is already discounted. So when we discount our cash flows, we'll discount 4 years worth and then just add in the $16,000 at the end. Let's see, remaining economic life, 6 years, $70,000 is the fair value of this asset, $40,000 is the company, the lessor's cost. Now, the lessee, of course, doesn't know this $40,000. That's just, you know, the lessor knows what their cost is. Our discount rate we're going to use across the board is 7%, and collection is probable with no weird uncertainties around the lease. So we're going to start by accounting for the lessee, and first we're going to classify this and do a journal entry. So first, is this a finance or an operating lease from the perspective of the lessee, the person leasing the truck? Well,
One, is title changing hands? No. Two, is there a purchase option at the end? And if so, is it likely to be exercised? Is it a bargain purchase? No, there's no purchase happening at the end of this. Three, is the lease term more or equal to or greater than 75% of the remaining economic life of the asset? And the answer here is yes, it's 5/6, right? It's 83%, so greater than 75% of life. Econ life, so the lease is greater than econ life the lease term is greater than 75% of the econ life, therefore it is a finance type lease. Now, what about the present value of those cash flows? Do we hit the 90% threshold also? The answer is going to be yes, but let's crunch those numbers. So we want to discount it back at 7%. So again, we could just divide by 1.07 to the 0, this divided by 1.07 to the 1, this divided by 1.07 to the 2, and so on, and add those all up, and you'd get the discounted cash flow, and that's an easy way to do it. I always like to do the PV of an annuity, so these 4 years are an annuity. This is not, because we're not needing to discount it, so let's do the PV of our annuity. PV equals PMT times 1 minus 1 over 1 plus R to the T, all divided by R. I know that formula is annoying. Hopefully at this point you've got it, you're getting there with it. I find it easier than actually doing a PV in a financial calculator, but that's just me, maybe. Maybe I'm a quirky guy. Minus 1 over 1.07. Now, we only go to the fourth power here, even though there's 5 payments. The reason is one of those payments just doesn't need to be discounted, 0.07. Okay, so 1.07 raised to the power of x to the y 4 is 1.31. I go 1 over x for that number. I go put that in as a negative, plus 1. It's 0.23, divide by 0.07. 3.38, and I multiply by 16,000. 54,195. And that's the present value of what's in the box here, 54,195. I have to add the $16,000 undiscounted payment to that, so plus 16,000, and I get a PV of 71.95, and that happens to be the same as my fair value. You'll find a lot of these questions where you do less or lessee at the same time, you end up with this, and the reason is it gets convoluted otherwise from a question design perspective, so you'll see this a lot. But in terms of is this 90% or more, the answer is yeah, it's 100%, right? The present value of future payments is 100% of the fair value, no more, no less in this case. Okay. So classify the lease. The last criteria for US GAAP is there a function for this outside of the lease, like for the lessor? And yeah, it's a truck. They could definitely take it back at the end and find some use for it or sell it or whatever. Okay, so it is definitely a finance type lease. In Canadian GAAP, we would call it a capital lease. What's the January 1st, 2031 journal entry? Well, we're going to do 2 entries. One, just for the lease, present value of future payments, $71.95. So we're going to debit, credit lease liability. I was trying to think of the word. Debit right of use asset is the word I was struggling for. Credit lease liability for $71.95. Debit right of use assets, $71.95. And the other thing that happens at time 0 here, I'm going to leave a bit of room here, January 1, 2031, we pay, right? We make our first payment. Credit cash, how much is it? Our payment is a $16,000 payment, and we debit lease liability. Now, you've seen in previous questions, I've done this in one step. You can certainly do it in one step. You get the same place whether you do it in one step or 2 as I've done here. And to do it in one step, you would just like put the credit cash up here and reduce your lease liability immediately by 16. Let's continue. So that was part A. Part B, complete the lease amortization table for the first two payments. Okay, well, the first payment happens at time 0, so it's a $16,000 payment, but there's no interest on that first payment because it happened at time 0. So we go from $71.95 down by $16,000, and we end at $54,195. Now, we make another lease payment of $16,000. There is interest on this. $54,195 times 7% is $37.94. So our liability was paid down by $16,000, but $37.94 in interest. So we only get to pay down $12,206 of the liability. Again, a $16,000 payment was made. $37,000 pays off the interest. $12,206 pays down the liability. $54,195 minus $12,206 is $41. That can't be right. Is that right? No, I did something funny here. Maybe I did it right. $54,195 minus $12,206. I had a little brain thing there. $41,989. I don't know why I was feeling like I was doing something wrong, but that looks good to me. Okay, so we've done part B. We've completed the table. Part C, prepare Hope's December 31st, 2031 journal entries. First, we have this asset on our books that is losing value over time, right? $71.95 it depreciates / amortizes over the term of the lease, so over 5 years. $71.95 divided by 5 is $14,039. That's going to be our amortization / depreciation. US GAAP calls it amortization. Canadian GAAP and IFRS call it depreciation. US GAAP will win the day here. We're going to debit amort expense, but again, you Canadians, depreciation expense. The credit here, sometimes under US GAAP or in certain textbooks, they'll credit the asset directly. They'll just credit right of use asset. I would prefer to credit accumulated amortization. They're both accepted and acceptable, right of use asset. 14,039. And of course, Canadians and IFRSers debit depreciation expense, credit AD, accumulated depreciation. Same difference though, same idea at play here. Okay. One more entry on December 31st, and that's the accrual here. Now, we don't make a payment. I know the payment's dated January 1st, 2032, so there's no payment on December 31st, 2031, but interest has been building, and we got to record that. Debit interest expense, $37.94, and we're going to credit lease liability or interest payable, and I think lease liability is definitely the way to go. It's the more commonly used account, but interest payable is certainly, in my view, acceptable. There we go, though. We have done our entry for December 31st, 2031, and we've completed the lessee side as much has been asked for. And obviously, you could keep going on this lease. Let's go ahead and move over to the lessor side. First, we got to classify the lease. Well, if it's a finance lease for the lessee, it's going to be a finance lease for the lessor because it's all the same criteria. So it hits the 75% rule. And it also hits the over 90% rule. Once we say it's a finance lease, we want to further say, is it direct financing type lease? A little more uncommon, or is it a sales type lease, which is much more common? Different criteria. Now, IFRS doesn't care. IFRS just isn't interested in distinguishing, so it just says it's a finance type lease and it's done. US GAAP says, is there a third party guarantor on a residual value, and is that pushing us over the 90%, right? If there's a third party guarantor who pushes the 90%, pushes it over the 90% rule, it's a direct financing lease. There's no third party guarantor. There's no residual value here. It doesn't matter here. So we're a sales type lease. Canadian GAAP says, is the company making money on it?
is the cost, is the fair value higher than the cost? So we've got a finance lease, capital lease we call it in Canada, is the cost less than the fair value? If so, it's a sales type lease. Either way, it's a sales type lease here. So fair enough. So if it's a sales type lease, and most of them will be in your class, I imagine, here's how you deal with it. You deal with it like you sold some inventory. So we're going to debit lease receivable, sort of like an AR type account, for the present value of the future payments, $71.95. Now that does not have to match the fair value, but it will in a lot of examples. It does not have to match though. So just a heads up. Doesn't change anything we're doing here. The credit is to sales, right? This is a sales type lease, so we're going to treat this as a sale. Now, when you have a sale of an asset and you're an inventory sale, or you're a company that sells this type of equipment, debit COGS, credit inventory. We're going to call this stuff inventory. And what's the cost? 40 grand given in the question. That's what makes this a sales type lease. All right, what else happens on January 1st, 2031? So we've established a sales type lease, then it says do all the journal entries. I don't know that I said that, I just jumped into it. Well, if we were the lessee, we paid $16,000. Well, the lessor received $16,000, right? There's that initial $16,000 payment, debit cash 16 grand, and credit lease receivable. So it's just two sides of the same coin is what this is. This part of the exercise is meant to show you. Like, just flip over the books and, it's the flip side of that transaction. On December 31st, 2031, does the lessor record amortization or depreciation as the lessee did? No, because they don't have the asset, right? They got rid of the asset. They credited the asset, got it off their books. They don't have a right of use asset sitting on their books, so they have nothing to amortize or depreciate related to this asset. They do, however, have interest. Oops, let me write that in line here. I'm trying to line up the answers, so no entry for that. Just as we match these up, there's interest revenue for us, $37.94. So we credit interest rev or interest income, $37.94, and the debit is to either interest receivable or lease receivable. And I prefer lease receivable just as I preferred lease liability here. All these things, though, really do follow what your textbook or your professor conventions are. So just be careful around that. These things are different. I've got a bunch of accounting textbooks and they all do them slightly differently, but the way I'm showing you is certainly a reasonable way. Part F, so that's the entries. Part F, compare Hope's lease liability with Ashcroft's net investment. Okay, so lease liability, credit $71.95. Actually, let me use a highlighter. Credit $71.95. Lease receivable, that's our lease investment. Debit $71.95. Debit $16,000. Credit $16,000. Right? They're just flip side of the same coin. And the last entry, credit $37, debit $3,700. So they are the same balance, and the balance is $71.95 minus $16,000 plus $37.94. The lease liability / lease receivable. Oops, I thought I changed my pen here. Lease liab / lease receivable on the December 31st balance sheet is going to be $57,989. Obviously, it's a liability on one company's books and an asset on the other company's books. What's the interest expense and interest income? Well, that one's easier. There's only one item, and it's this last one. It's $37.94. And again, it's an expense on this side and a revenue on that. Where does the truck live? Well, who has the truck on their books? And the answer is these guys. The lessor, the person leasing the thing. I guess in this case, that's Hope Logistics, who leased the truck. But there you go. We've solved it. Well done by you. Hopefully well done by me. Thanks for watching. See you in the next video. Bye for now. Welcome to Module 20. It's all about pensions, and this is Steve, and today is Steve's 35th birthday. Happy birthday, Steve. Steve works for our company, and this is Steve's life all laid out on a timeline. Steve was born, and when he was born, he was age 0, just like all of us. He started working at our company at 25. He's 35 today again. Happy birthday, Steve. Steve is going to retire at 65, and he's going to die at 85. There is Steve's life on a number line. Isn't that beautiful? Well, pensions, you do have to look at take a long-term view, because pensions are the income that Steve expects to earn in retirement, or expects to receive in retirement. And so accounting for that becomes tricky, because there's all sorts of time value of money things. There's going to be payments here that are going to apply to Steve today and apply to our liabilities today, potentially. So pensions are complicated, but they need not be. Most companies have defined contribution pension plans, which are very easy for us accountants. We will not spend a lot of time in this chapter on defined contribution, because they're very straightforward. Defined benefit pension plans, those will complicate our lives. So let's break down the two. Defined contributions, like the name suggests, tell the company what it's going to do, and it defines the contribution. The company makes a promise of what it's going to put away for Steve. We say, when Steve signs his employment contract, we will pay 4% of your salary into a pension, some number like that, based on a formula. Maybe it's an employee match. Maybe there's some other element to it, but let's just keep it simple. We're going to pay 4% of Steve's salary into a pension, and that means he makes, let's just say, $100K per year. And so if in his 35th year, he earned $100,000, and we said, well, we're also going to put 4% away for pension, we go debit pension expense, credit cash, $4,000, because we're putting away 4%. That's it. If the stocks do amazing, good for Steve. It's not our problem. If the stocks do terrible, too bad for Steve, but it's not our problem. And defined contribution is just that simple. We say what we're going to put away, we put it away, and we have a pension expense related to it in the moment, right? Like, it will have that pension expense at 25, 26, 27, 28 as we're putting it away. We will debit pension expense, credit cash as we go. It's almost like as straightforward as salary expense from an accountant's perspective. What is not so straightforward, though, is a defined benefit plan. And a defined benefit plan we are making a promise, not of what we're going to put away. We're making a promise of what Steve will receive in retirement. And that's what makes this harder, because we're making a promise of what Steve's going to get from age 65 to death. Now, I've said we know Steve's dying at 85 because I said so, but we don't actually know when our employees are dying. Some are going to live to 90, some are going to live to 70, some unfortunately will pass away even before they retire. That gets complicated, right? The fact that we have this big employee group, we don't know when they're going to die. But Steve, we know when he's going to die. He's dying at 85, and that means we're going to have to make payments to him every year until he dies, right? So we have this annuity of payments, this schedule of cash flows. We're going to have to present value that annuity back to 65, but he's 35 today. This is today. We have to present value that back to today. And, it's complicated enough for Steve, one employee. We got to do that for our employee group. These companies that have defined benefit plans have hundreds, thousands, tens of thousands of employees. They're all different ages. They're all going to die at different times. They're all going to retire at different times. They all have different wages and salaries. It's complicated. And so as a consequence, this is one area that actuaries are used. Actuaries are mathematicians that, one of their jobs is the math around these types of pensions. So this is a typical pension plan. 2% times it's usually best 5 years of average salary times the number of years the employees worked for us. So Steve, if he works for us until 65, his average salary is $100K. His number of years is going to be 40 at retirement. So you go 2% times $100K, that's $2,000 times 40, it's $80K. And that formula says Steve gets $80K from the day he retires, 65, to the day he dies, $85K or $80K per year for that time. And so we could present value that and figure out what it's worth. But if we're actually calculating the obligation to Steve, it's only what he's earned so far between 25 and 35. So our obligation would be not for 40 years, but for the 10 years he's worked. And he'll earn out the rest of that obligation as we go. So 2% times 100K is 2K times 10. He's earned, right now, if he stopped today, he's earned 20K a year from us from age 65 to the day he dies. So we present value that and we get an obligation. And we would do that for all of our employees. And again, we have thousands of employees, not just Steve, earning different salary amounts, different life expectancies, although I've talked to an actuary and they don't sort of look at each individual employee in that way, but different life expectancies, different salaries, and different retirement obligations. And they come up with one number. They add together all the employees and they say, here is the present value of what you owe. And we call this the pension obligation. And let's say for us, it's $50 million. Like, these are big orgs. They can be billions and billions of dollars. But for this example, it's going to be $50 million. Well, in the meantime, I got a cough. In the meantime, Steve's been working for us for the last 10 years. Well, we are socking money away to get ready for Steve's retirement, right? We would be stupid, and we're not legally allowed, I think, not to be putting money away for this purpose. So we're putting money away, and we're putting it to a trust to hold the money and to invest on our behalf, a pension company. And so we would have, actually not pension assets, it's called plan assets, building up. And let's just say at this point, based on stock market returns, the plan assets are $48 million. And we would say, okay, we've got an underfunded pension of $2 million. We have a net pension liability of $2 million. Well, I hope you're seeing this is already way more complicated than this one, where we just go, Steve worked for us, debit pension expense, credit cash, $4,000. And the reason is because let's say these plan assets, let's say the stock market is ripping and these plan assets do amazingly well. How does that affect our profits, right? And the answer is it's complicated. How does that affect us when the stock market has a downturn, right? COVID hits and we have a sudden dip in the stock market. Well, all our plan assets go down. How does that affect us? And the answer, again, is it's complicated. So it's complicated to come up with this number for the plan obligation. Thankfully, actuaries will do it for us. We're not going to do a lot of present value calculations this chapter. It's complicated to deal with the fact, though, that the obligation can change, right? We can have a new union contract. We hire and fire people all the time. How does that affect our journal entries? Well, that's what we explore this chapter. Also, how does the fact that, these are investments in the stock market and bond market and whatever else our pension fund is investing in, how do we deal with the swings in that asset? And the answer again is we're going to learn it this chapter. Too much to explore here. So we're going to spend about 5 minutes on defined contribution, and probably in these videos I'm going to spend several hours discussing defined benefit, and I bet your class will be the same. The best way to learn, though, is to do examples, and I've got lots for you. I can't wait to get started. Thanks for watching, and I'll see you in the next video. Bye for now.
Let's jump into problem 21A. As we do it, I'll remind you can download this problem for free from my website, tonybell.com. You just click the PDF link. There's no sign in, no sign up, nothing like that. Scroll down, find the problem, and work through it with me. Let's jump into the problem. Let's jump into problem 21A. We're looking at defined contribution pensions, the easy one. So here we are promising our employees will contribute a certain amount to their pension, but whether it goes up or down or how well it does is not our responsibility. What they're getting when they're age 65 to 85, not our problem. What they're getting in retirement is not our problem. We're just promising to contribute an amount. This is the easier one of the two types of pensions. Chilcotin Freightways sponsors a defined contribution plan. Under the plan, Chilcotin contributes 5% of gross salaries to a fund each month. Employees direct the investment of amounts to their individual accounts, and Chilcotin has no obligation beyond those contributions. Gross salaries were 8.4 mil. Okay, so 8.4 mil, we got to pay 5%. That's $420K that we are on the hook for. We gave $385, so we didn't give all $420 to the trustee, covering January through November. The December contribution will be remitted in the future, but today's December 31st. What's the pension expense? Pension expense is the total salaries, which is 4.8 mil, times 5%, the pension expense, $420,000. Do the journal entry. Okay, so the journal entry is debit, pension. So this is December. My pen is really thick. I'm noticing thicker than what I'd like, but we'll live with it. Debit pension expense, $420,000. Now we don't get to. We didn't pay it all, right? So credit cash for the amount we paid, which was $385. And what's the difference? 420 minus 385. 35,000. I'm just going to call this pensions payable, right? Or pension. Yeah, I'm just going to call it pension payable. Like it's the amount we owe that we haven't paid up, right? They earned 420 grand. We only paid 385. We owe, or we're accruing 35 grand in unpaid pensions. Indicate how this balance is reported on the balance sheet. Just a current liability. So just under current liabilities, because obviously we're going to be settling this up in like a week, pensions payable. $35K and nothing else, right? Like this is pension expense, the other one to cash. No. Okay, briefly explain why Chilcotin reports no pension obligations beyond the unpaid contribution, even though the employee's ultimate pension benefits are unknown. This is basically saying, do you know the difference between defined contribution and defined benefit? We are obligated to make contributions. So our liability is to catch up the contribution that we didn't fully make. Our liability isn't to pay them in retirement. Our liability is to pay them in the current year. And again, whether the stock market goes up or down, whether their pension assets perform well or don't, that's their problem, not ours. Our problem is to contribute the amount that we agreed on. So that's why this is the only liability related to the pension. And that's why we finished 21A. If this video helped, help me with a thumb. Thanks for watching. See you next one. Bye for now.
Let's jump into problem 24A. We're working with a new thing called a pension worksheet. And this is just a helpful way to work through a pension. There's a lot going on with pensions. So if you sort of can organize your thoughts, this is one way to do it. You don't have to do this, but I think it will help. And in fact, it gets big and complex. We're just going to do kind of half of a pension worksheet now, and in future problems, we'll do the whole thing. Slocan Mining sponsors the defined benefit plan for its unionized workforce. The following information relates to the plan for the year ended December 31st, 2031. We're going to deal with how the obligation and how the assets of the pension change over the year. And the notes complete only the unshaded cells in the worksheet. The shaded cells will be addressed in subsequent problems. So we're basically doing half of this worksheet. And it says indicate whether each amount is a debit or credit. The other thing I'd caution you, your professor might not give you like headings and labels. They might not give you any of this. So just, use it with some caution. In future questions, I think I'll take away some of these labels. Okay, we got an opening balance in our pension obligation of 16 mil. And look at that, there's an opening balance, and we're really obsessed here with our pension obligation and assets and the net pension asset liability. By the way, when I see these top two lines, I always look at them. I just can't help but compare them, right? Our assets are 14.5 mil, our obligation 16 mil. It means we got an underfunded pension. We're underfunded by 1.5 mil. We have a net liability, aka underfunded, right? We don't have enough money socked away for our obligations. Okay, well, our obligation 16 mil, and obligations, of course, our liabilities, therefore a credit. Our assets 14.5 mil, and since they're assets, the default position is for them to be a debit. On net, where are we? Well, we are 1.5 mil underfunded. We're 1.5 mil on the credit side of the ledger. Okay, next line down, I just go down line by line. 5% discount rate. Why do they give us that? Well, because our obligations grow by 5% every year. They got discounted back at 5% a year. Now a year went by, we got to grow them back by 5%.
What's 5% of 16 mil? What is it? 800K maybe? Let's go. It is 800K. So our interest cost is 800K. Now what, so that's the interest cost. That's the amount the obligation grows by. Now what is that? On the obligation side or on the asset side? And the answer is it's on the obligation side. Our obligation grows by 800K. So 800K credit, right? It makes the obligation grow by 800K. The debit would go on the pension expense side when we get to it in our shaded area. Current service cost is another one where it grows our obligation. Your obligation gets bigger as a result of the employees working and earning another year's worth of pension here, 1.15 million. And of course, it's a credit on the obligation side, and it would be a debit in the pension expense when the time comes. Next problem, I think, 25A. Okay, so we've dealt with this one. We've dealt with this one. We've dealt with this one. Actual return on assets, 870. Well, what does that change? It changes your assets. Actual return on assets. Our assets grow by 870, so debit the asset to make them grow. Next up, let's see, where were we? Contributions remitted to the trustee. What does that do? Well, it's us putting money away to service the pension. The pension assets grow. These are contributions. 1.2 million debit to our assets. What about the benefits paid? Last one. Well, when we pay benefits, our obligation falls. So 900K debit to your obligation. And when you pay benefits, you pay them out of the plan assets, right? You don't pay them out of your own pocket. You put the money in trust or with the trustee. The trustee pays them, but your assets fall. So this is a 900K credit to our assets. That's it. So let's total this up. Now you can see this line total for journal entry. We'll worry about that when we fill in the gray side, the journal entry side of this beautiful template in the next problem. But let's add everything up. Let's add up our assets. 14.5 mil debit minus 900,000 credit plus 870 debit plus 1.2 million debit. We end up at 15,670. And of course, that's in thousands, so 15,670,000, and that is a debit. On the obligation side, we're going to add our credits, deduct debits, so 16 million credit plus 1150, 1.1 million, plus 800,000 minus 900,000, and we end up at 17,050. 17,050,000 credit. Okay, so I can see my obligation is bigger than my asset. My pension is underfunded, but by how much? 17,050 is how much I owe. 15,670 is the assets that counteract that. I'm at 1.38 million, 1380K credit. I'm still underfunded, but it is getting better, right? It was 1.5 million at the start of the year. It's 1.3 at the end. We're certainly trending in the right direction here. That's it for the problem. One more thing that would trend in the right direction if you'd hit the thumbs up button. Thanks so much for watching, and I'll see you in the next one. Bye for now. Let's take a look at problem 25A. We're doing the full worksheet this time, and we add to it another quirk, and that quirk is, and it's largely a US GAAP quirk, although we'll deal with it under IFRS and Canadian ASPE as well, the expected return on our assets doesn't match the actual return on our assets, as we'll soon see. And so that creates some accounting challenges for us also. So there's sort of a double challenge baked into this one, which is we're doing the full table and our returns don't match up. Actually, let me just discuss that real briefly, because it is a factor under IFRS as well. When your actual returns don't match the planned returns, well, what is that? That's an unexpected return. And standard setters have said, we don't want our profits swinging wildly because the stock market had a good year or a bad year. We don't want that showing up in net income. We'd rather put that in OCI. So those unexpectedly high or low returns will land their way into OCI.
US GAAP and IFRS treat it differently. So we're going to solve this thing top to bottom in US GAAP. Then I'll show you the tweak to get it to IFRS, and then one further tweak for us Canadian GAAP ASPE people, and you'll go last. Let's get into the problem. Quesnel Plywood sponsors a defined benefit pension plan for its mill employees. The following information relates to the plan for the year. And there's all of our information. And of course, we're going to be slotting it in here. And if you follow it, do it my way, I always do the obligation and assets first and kind of do the journal entry side of this table last. So let's start with our opening balance. We're given an opening balance of our obligation, $20 million, by the way. Our assets, 18 mil. We're underfunded by $2 million. Our obligation, $20 million credit balance, of course. Our asset, an $18 million debit balance, of course, meaning our net is a credit, right? We net this out to a $2 million credit, and that is, if you got a credit in your net pension asset liability account, it's, of course, a liability. Okay, let's see how this obligation or plan assets change. And the first line there, so we've dealt with those two. The next line is our discount rate. Well, we know our discount rate grows our obligation. We have a $20 million obligation growing by 5% a year. That's $1 million in interest cost, and that makes our obligation get bigger. The expected return on plan assets, this is a US GAAP only thing, and it's used in the journal entries. It's part of pension expense, and it's used here, but we'll deal with that in just a moment. It's not used anywhere on this side of the table, so we'll just leave that to the side, and we'll come back to it later. We can calculate the number. It's 18 million times 6%, right? That's our return on plan assets, and it's 1080, which is our expected return on plan assets. Okay, so that's going to come in handy later, but we don't need it now. And that's going to come in handy for US GAAP only later. Canadian and IFRS people won't need that number at all. Current service cost, 1.3 mil. Well, everybody needs that number, and everybody knows it goes here, and it grows our obligation by 1.3 mil. Actual return on assets, yes, our plan assets did grow by 600K. Debit, make them grow. Contributions remitted to the trustee, 1.4 million. Okay, well, that also makes our plan assets grow, sending money to the trustee. Benefits paid, that makes both our assets and our obligations shrink. Was it 1.1? Yeah, 1.1 mil. If I pay the benefit, it comes out of the asset and it pays down the liability. Okay, I think that's everything. So let's add these up and get our ending balance in the obligation and in the plan assets for the year. We'll do the assets first. 18 million minus 1.1 million plus 600,000 plus 1.4 million. And we land at 18.9 million debit. Let's do the obligations. 20 million credit plus 1.3 million credit plus 1 million credit minus 1.1 million. That's the debit, the loan debit here. And I land at $21.2 million credit. Okay, so you can see my obligation still bigger than my assets, and it looks like it's more bigger. Is that the right word? The liability's grown here. 21.2 million minus 18.9 million. It is more bigger. I don't think that's a correct way to say that, but it is. $2.3 million credit. It started the year at a $2 million credit. So you can see it's grown by $300,000. And we're going to prove it now on the journal entry side. And we need to do the journal entry side because we need to do journal entries. So let's go through each of these items and see how this would affect our debits and credits, if at all. Current service cost, $1.3 million credit.
that's part of our pension expense. It's flat out part of our pension expense. So we're going to debit pension expense for that amount. It's sort of like a balancing thing, right? Debits got to balance with credits. You can see this line, the debits balance the credits. And we'll continue to do that throughout. Interest cost, well, guess what? That's a debit to our pension expense, $1 million. Benefits paid, the debits already match the credits. There's nothing to do over here to balance it. Debits do match credits. I'll come back to actual return on assets. That's the one that is different between IFRS, Canadian ASPE, and US GAAP. We'll do it the US GAAP way first, but let's do contributions. That's the same everywhere. When you contribute, it's a debit to plan assets. It's a credit to your cash. You contributed out of your own company cash, so 1.4 million credit. This is the last line left, and this is the one that's, again, a little bit differential between our methods. We'll do it the US GAAP way. And the US GAAP way says, okay, my expected return on plan assets was $1,080,000, 1080. It's that 6%. That's the number we have reduced our expense. It's based on our expectation. So 1080 credit goes here. It's our return on our plan assets. Now, our plan assets only grew by 600. It grew by way less than we expected. The stock market was bad this year. Whatever we invested in did not meet expectations. There might have been some economic downturn or some catastrophe causing our investments not to do so well. So in these situations, because we know if we're investing, the stock market's swingy, or whatever we're investing in is swingy, and we want to show steadier returns related to our pension in our own income statement. We put the difference, the unexpected, in this case bad returns, gets charged off to OCI. Now we'll talk about what we do with that in future questions, but for now just know, okay, we're parking it in OCI. This difference of, we expect it to be 1080, it was actually 600. We're off by 480 grand. And it's a debit, which is bad for our OCI. This is an unexpected return that we were short. We short felled by 480 grand. Okay, that's it. Now we just need to total up each of these rows, and it's going to feed our journal entry. So 1.3 million plus $1 million plus 1 million minus the 1080 credit means our pension expense is a debit of 1220. Our OCI is a debit of 480. Our cash is a credit of 1.4 million. And so what do we do here? Well, 1220, it's just debits got equal credits. The balance goes to pension asset liability. In this case, it was a pension liability. 1220 debit plus 480 debit is $1.7 million in debits minus 1.4 million in credits means we're left with 300K in credits here. And that, look at that, it adds both ways, right? It works across, but it also works down. 2 million in credit. We're going to credit this thing 300 grand and we end at 2.3 million. So it does work both ways. That's why this is sort of an elegant solution. And that just feeds our entry. So our entry is just debit and credit these accounts in the order, well, in whatever order we wish, really. It's December 31st, 2031. We're going to debit pension expense. 1220000. We're going to debit OCI. And this is on the asset loss or unexpected asset loss, right? We lost more. We didn't make as much as we thought, I guess, on our plan assets. 480. We're going to credit cash. 1.4 mil. And we're going to credit a net pension liability. And the amount there is going to be 300 grand. Okay, at that point, we're done this from a US GAAP perspective. So US GAAP folks, you can hit the thumb, say goodbye. IFRSers, Canadian GAPers, stay tuned. Really, we're just going to
change this line, this actuarial, or actual rather, return on assets. Actuarial, no, actual. The word actuarial comes up a lot this chapter, but not there. Okay, so I'm just going to copy this, and we're going to work from here because it's just one little tweak. And the tweak is that one line that I'd mentioned. So I'm going to erase that part of the line. I'll change ink to green ink, and you can see the only difference is going to be IFRS. When they calculate the expected return on assets, you can't use some different amount. Your expected return on assets is based on the discount rate. So you go, okay, it's 18 million times 5%. It's 900K. That's our expected return on assets for IFRS. I'll just say expected return. We plug our expected return in here, just as we did under US GAAP. And then we go, oh, it doesn't work. It's off by 300 grand. The US GAAP one was off by more. So we go, okay, I got to fix this. It's going to take a $300,000 debit to OCI. And that's it. You plug that in. Obviously, this total is going to be a little different. 1.3 plus 1 is 2.3 minus 900,000 is 1.4. And hopefully this all adds. Yeah, I can see it actually does add. 1.4 debit. And this is a $300,000 debit. So our journal entry for IFRS, same entry, debit pension expense. 1.4 mil. Debit OCI, 300K. I forget, I think they call this a remeasurement loss. Credit cash, 1.4 mil. And credit net pension liability, for 300K. Okay, last one we'll do. And so IFRS folks, you can say goodbye. Canadian ASPE, I would think most professors will have you do this the IFRS way. I think it's pretty unusual for somebody to have a defined benefit pension plan and use ASPE. Those things just seem like an unusual series of events would land you there. But if you're doing it under ASPE, it's pretty easy. Just nothing goes to OCI. So you do it the exact same way you did under IFRS, but you just move this number back into the OCI column. So I'll cross that out. It's not 1.2. It's 600,000. Credit goes there. So this number becomes 0. This number, if I add it up, 1.3 plus a million, it's 2.3 minus 600,000. It's 1.7 mil. That's it, right? Everything else is the same. So our pension expense, 1.7 mil. Nothing goes to OCI. And the thing balances, and there you go. We've done it under ASPE. We've done it 3 ways. If you made it all the way to the end, one thing left to do, hit the thumb. Thanks for watching. See you in the next one. Let's jump into problem 26A. We're looking at a plan amendment. So typically this is downstream of a union contract. The union has negotiated better pension benefits and it's applied retroactively. And so our actuary comes back and says, well, based on these better pension benefits, your employees have already earned a big chunk of dough and our liability just jumped a big chunk. How do we account for that? Stay tuned. Well, in fact, this big jump represents an increase in our liability. US GAAP says take that increase into OCI. IFRS and Canadian GAAP say it's an immediate charge to the expense. Let's deal with it. So we'll do US GAAP first, and then we'll do IFRS, and last, Canadian GAAP. But let's jump into the problem. Castlegar Foundry sponsors a defined benefit pension plan for its unionized workforce. Effective January 1st, 2031, Castlegar amended the plan to increase the benefit formula for all years of prior service. The actuary determined that the amendment increased the obligation by $1.8 million as at January 1st, 2031. The following additional information relates to the plan for the year ended December 31st, 2031. And there is some additional info. So let's
the task here is going to be to complete the worksheet and, do the journal entry. Let's go ahead and complete that worksheet. We're going to start with pension obligation opening balance of 1.5 million. Now you can see that's the number before the amendment, and we need that number. So if not 1.5, 15 million. So I'm going to say 15,000 K, and that is, of course, a credit balance. Our plan assets operating at 13.6 or opening at $13.6 million, and that is, of course, a debit. And so we are underfunded, as most pensions tend to be. Not always, but most of the time. We'll have a net pension liability, and we do here, of $1.4 million. You can see the next line down is for the plan amendment, and it got worse for us. Our situation got $1.8 million worse. So our pension obligation grows, gets credited by $1.8 million. US GAAP says we're going to take that charge into OCI based on, I think they call it past service cost or prior service costs. So I'll just say PSC, OCI. There are multiple types of OCI now in questions, lucky us. So we'll have to track those multiple types of OCI. But that is, of course, a debit to OCI. It's a charge against our other comprehensive income. Quick cough and we'll continue. Okay, let's continue up the list. So we've dealt with the pension obligation, we've dealt with the plan assets, and we have balances here. So just after the amendment, so our amended balance is not changed for the asset. Our asset didn't change, but our liability grew to 16.8 million. And you can see, this is bad news for us, the company. We're now 3.2 million underfunded. We started 1.4 million, and we just made the pension more generous, and now we're really behind the 8 ball. Okay, let's read on. Discount rate is 5%. We know what to do with the discount rate. It grows our obligation. So our pension obligation was 16.8 million, and that's as of January 1st. Our obligation grows by that discount rate, 5%. So times 0.05, it's going to grow by 840K. I really shouted the K. I really leaned into it there. 840K, and it grows, right? So it's a credit to our pension obligation, and that interest cost is one component of our pension expense. Continuing down the line, the expected return on assets. This is a US GAAP convention, not relevant for Canadian GAPers, IFRSers, but US GAPers. You take that 13.6 million, your plan assets, and multiply by 0.055 to get 748,000. Your pension expenses reduced by the growth of those assets, or the expected growth of the assets, I should say. So I put it in this row, actual return on assets. And I know that's not our actual return, but this is where this goes. And we'll deal with the actual return in a minute. It also goes in that line. Okay, so we've dealt with that. Current service cost. $1,050,000. Well, no calculations there. My current service cost, 1,050K, and this is a credit, of course, growing my pension obligation. So did I get the number right? 1,050. Yes, I did. The debit is to pension expense, 1,050K, debit. Okay, let's continue. 816 is the actual return on assets. So that's what my assets actually grow by, 816K. Debit the assets by that amount. Now, here's where we get into this concept of unexpected gains versus expected returns, or unexpected returns versus expected returns. We actually made 1,816 grand on our investments. Our plan assets grew by 1,816. We expected to grow by 748. The difference is unexpected. It goes into OCI. So 816 minus 748 means we're off by 68K. Now, is this a debit or a credit to OCI? Well, debits need to equal credits. I got 800 grand of debits, 700 of credits. I need a credit to make this balance. And that's good, right? It means my unexpected amount was a gain. I made more than I thought. Okay.
Continuing on, amortization of past service costs, we'll leave that till the end. We'll discuss it at the end. Contributions remitted to trustee, 1.3 million. Well, when we remit contributions, it's out of our pocket. We give up cash, 1.3 million, credit to cash, and the debit is to our plan assets, 1.3 mil. The second to last line here, 950 grand benefits paid to retirees. Well, what do we pay them? We pay them out of our assets. They don't come out of our normal bank account. They come out of the trust's assets. And the pension obligation reduces by 950K. So it's 950K debit to the obligation, 950K credit to our assets. Last one, amortization of past service costs. So under US GAAP, we put our past service costs into OCI and we amortize our past service costs. Now, there's multiple methods to do this. There's a complex way called the years of service method. If you have to do that, I'm going to leave that to your professor and your textbook. We're going to do the most basic way you can imagine. We're going to amortize this straight line, which is totally acceptable. So we have this $1.8 million OCI amount, and we're going to amortize it over the 12 years of the average remaining service life of our employees. 1.8 million divided by 12 is 150 grand. So we're amortizing our past service cost at 150 grand. And the idea is we had this big plan amendment. We have to bring it into income. We have to show it in pension expense sooner or later. We're going to do it slowly over the 12 years. So it's a $1.8 million charge. We're going to take 150 grand out of OCI and put it into pension expense over 12 years. 150 grand a year. So debit pension expense, 150K. Credit OCI, 150K. And I think that's it. So let's add everything up. I always do the obligation and the assets first. So 13.6 million was our asset, minus a credit of 950,000, plus a debit of 816,000, plus a debit of 1.3 million. And we get 14,766K, and this ends in a debit as we would expect. Let's do our pension obligation, starting with 16.8 million. I'm starting at the subtotal. I could start at the top and deduct out the one, or add in with the 1.8 million, but 16.8, I'm starting at the subtotal. Add 1050, obviously credits add to credits. Add 840, credits add to credits, and deduct 950, take away the debit from the credit. We're at 17.74 million credit. Okay, and what's the net here? Well, $17 million credit minus a 14,766 debit leaves us with a credit of 2,974 credit. So you can see it got worse, as you might expect. Let's add up all these other ones, and we're going to be left with a blank in the journal entry. We're sort of looking to fill in this blank, but let's add up our pension expense. So debit of 1050 plus a debit of 840 minus a credit of 748 plus a debit of 150. I end up at 1292 as my pension expense. And of course, a debit is what we expect to see there most often. The plan amendment, $1.8 million debit, minus 65K credit, or 68K credit, minus 150K credit. We end up at 1582 debit here. Well, this one's easy. 1.3 million debit. I think I added one too many zero, or credit. Jeepers, I keep saying the wrong thing. I think you got the idea though. So, okay, I'm missing a big credit. I got to credit this for some amount. Now, I can look here and just go, oh, I'm going to credit it for like 1574. I can see that, right? To go from 14 to 2.9 million, but it should work both ways. In fact, it must work both ways. If it doesn't work both ways, we screwed something up. So 1292 debit plus 1582 debit minus 1300 credit. It is 1574. That's exactly what I thought it would be. The birds are singing, the sun is shining, and yeah, our worksheet is working. Now, not a guarantee we got it right, but definitely a good sign. Let's do the journal entry, and the journal entry is just right there, the bottom line here. So let's go ahead and do that journal entry. It's a little trickier when you have multiple OCIs. I forgot to mention this OCI is like the OCI gain, right? Our unexpected gain, where we had 860 in actual return. We expect to have 748. The other one is related to past service cost, prior service cost, and we'll deal with that in due time. But let's start with our pension expense. Debit. Pension expense, and the amount is $12.92. Okay, dealing with OCI, you got to split it into two pieces. We have a $68,000 unexpected gain. So I'm going to credit OCI, I'll just say gain, and it was $68K. Now we also have a debit to OCI for the past service cost, and the net amount, 1.8 million minus the 150 grand in amortization. It's 1650. Next, we got a credit to cash of 1.3 million. And last but not least, a credit to our net pension liability for 1574. This is dated, what is it dated? December 31st. 2031. Okay, I think we've got ourselves a beautiful entry. I think that's the US GAAP side of the problem done. I think you like and subscribe and you say goodbye, you US GAPers, you IFRSers or Canadian ASPE folks. Stay with me. Let's do the IFRS way. I'm just going to edit right on the US GAAP sheet. So we're just going to continue on from there. And there's two things that US GAAP does differently. It's all related to OCI. This whole OCI column is about to blow up. And it's going to change our pension expense. All this stuff over here remains the same under whatever method. So let's go ahead and deal with it. So the big first difference is this past service cost. The past service cost under IFRS isn't in OCI. It just goes into the expense. 1.8 million debit goes over here. As a consequence, there's no amortization of a past service cost from OCI into the expense. It's already in the expense. So that line just disappears. The other thing that's done differently is, as we mentioned, US GAAP uses expected return on long-term assets. IFRS says don't use 5.5%, just use the discount rate to do your expected return. Other than that, it's the same. So use the discount rate, 13.6 mil. Times 0.05, the discount rate, and the IFRS expected return is 680K, and then we just treat it the same as the US GAAP did. So we go, okay, it's 680K. Actually, let's leave the US GAAP number there. I'm going to cross it out. 680K goes in here, and so 680K credit was our expected return. Our actual return was 816, so we have a bigger gain. Right? We have a bigger, I forget the name, I always forget the wording, remeasurement gain. So our remeasurement gain under IFRS is 816 minus 680. It's 136. That's it. So those are the differences. Everything else is the same. Let's add up those green lines that have now changed. All other lines should remain the same. Let's crunch the numbers. 1.8 million under pension expense debit plus 1050 debit plus 840 debit minus 680, our expected IFRS return, and we get 3010 debit, 3010K. And it is a debit. So much larger pension expense, but that's expected because we took the whole plan amendment at once into pension expense. The OCI, much easier. It's just the remeasurement gain, 136K. And this, of course, is a credit. So a little bit different, right? It's a credit there. There's a debit total under US GAAP. Everything else is the same. And you'll note it's going to work, right? If I go, let's add up our debits, deduct out our credits. 3010 debit minus 136 credit, minus 1.3 million credit, minus 1574 credit, and we end at 0, right? Because the journal entry is going to balance here. So what does it look like in terms of an entry? Debit pension expense. US GAAP or IFRS says 3010. Debit or credit OCI for 136 for our OCI gain, remeasurement gain. Get rid of this debit to OCI under PSE, and that's it. Everything else is the same. Okay, last. So that's it for you IFRSers. Goodbye. Hit the thumb. Last one, Canadian ASPE. My fellow Canadians, we've got it easy. If you've sung in this far, the Canadian ASPE is dead simple. Everything's the same as IFRS. The only difference is there's no such thing as OCI. So this OCI number gets lumped in there. So we just go, oh, it was 816 debit. Well, our gain or our return on assets has got to be 816 credit. Everything else is the same. So this goes away. And this is, well, what's 3010 plus 816, 3826 debit. And that's what the Canadian ASPE would say. So in terms of a journal entry, we get rid of the OCI gain, the pension expense for Canadian ASPE, 3826, and you're done. Now, you can really smash that button because we've solved it 3 ways, but obviously only one way likely mattered to you. And there you go. We've done it the ASPE way. As always, thanks for watching. See you in the next video. Bye for now.
Let's jump into problem 2010A. It's a big old pension worksheet with a lot going on. Now, please note, this is for US GAAP only. If you're looking for IFRS or ASPE equivalents, that's in problem 2011A. Elk Valley Mining sponsors a defined benefit plan for its workforce and prepares its financial statements in accordance with US GAAP. Effective January 1st, 2031, Elk Valley amended the plan to enhance benefits for prior service. Okay, so there's a prior service amendment, past service cost amendment. The actuary determined the amendment increased the obligation by 1.6 million. I always like to size up the obligation, and I can go, oh, we're already like 20 million, so we're going to be 21.6 million, 18.5 million in assets. So this is underfunded, right? We have a net pension liability at the start of this, and that liability is getting bigger by 1.6 million. It gives the following information, and it asks us to complete the worksheet. Let's start with our opening plan obligation, which was $20 million, and of course that's in a credit. Our opening assets, $18.5 million, and of course that is in a debit. So a $20 million obligation and $18.5 million in assets means net, we have a $1.5 million pension liability, net liability, and so therefore it's a credit. We have a plan amendment, so let's fill in this line. Our obligation is growing by 1.6 million. That's a credit. Our assets are unchanged here. So a new subtotal here, 21.6 million. And that's a credit, and 18.5 million in assets. So this just got 1.6 million worse. We're sitting at 3.1 million credit after the amendment. When we make our amendment, we also have to, there's a journal entry to do the amendment. In IFRS and Canadian GAAP, we put it right into pension expense. In US GAAP, we put it into OCI and amortize it into the expense over time. So we're going to put 1.6 million debit in OCI, and then every year that goes by, we're going to amortize a little bit into the expense. And in fact, it's going to start this year, right? This happened on January 1st. Our fiscal year ends December 31st. We're going to have to amortize this over the average remaining service period, and you can see there's a 10-year number here. So I'm going to divide this by 10, and there'll be an amortization expense a little bit later on in the question. Okay, let's continue down the list. Discount rate of 5% is given. What do we use the discount rate for? We use it to grow our pension obligation. Now, not this 20 million, this 21.6 is going to grow. So 21.6 million, our adjusted obligation total times 5%, 1080. So our interest cost here is 1080K. and that's a debit, and our obligation grows by 1080K, and that's a credit. Next, the expected return on assets is 6%. That number is used as the credit to our pension expense. So interest on the debt increases our pension expense. Interest or earnings on our assets decrease the pension expense, and so that's what we're going to do here. Now, we base it on our expected returns, and you'll see what we do when the actual returns are invariably different. That difference goes to OCI, as you should know by now, as we're on question 2010A. You've seen this before. Okay, so under actual return on plan assets, I take that 6%, the expected return times 18.5 mil, times 0.06, I get 1110, and that, of course, is a credit. Now, our actual return is going to go here under the plan assets when we get there, and the difference is going to go to OCI gain loss. Where are we? Current service costs, that's where we are. Current service costs, 1.1 mil, so 1.1 mil debit. Credit the pension obligation, 1.1 mil. Now we're on to actual return, 950. So we got a bit of a problem here. We actually had 950. Our assets actually grew by 950. We're expecting them to grow by over $1 million. We fell short. So this is OCI loss. So 1110 minus 950 is a 160K debit, and of course debits are for losses, credits are for gains, but to make this thing balance we needed a 160 debit. Next, actuarial loss on the obligation, 500K. Okay, so our actuarial loss of 500K means our obligation is growing by 500K. So let's make our obligation grow here, 500K credit, making our obligation go up, and this goes to OCI, gain loss, it's an actuarial loss, 500K debit there. Next, so that's that one. Next, contributions remitted to the trustee, 1.4 million. When you make a contribution to the trustee, it causes your assets to go up, of course, that's what you're contributing. So 1.4 million debit, and it causes your cash to go down, 1.4 million credit. Next up, benefits paid to retirees, $1 million. Okay, if I pay benefits, the obligation goes down, 1 million debit, and the assets go down, 1 million credit, right? We're paying them out of our assets. Okay, we're almost there. Just two more. Amortization of past service cost or prior service cost, and amortization of the gain or loss through this corridor rule. Well, since we've already discussed the prior service cost, let's do it. So we said our obligation went up by 1.6 million. It's going to be over 10 years, and this is the past service cost. There was no opening balance, so it's 1.6 million. Over 10 years, it's 160 grand a year. Let's do that. So it's 160 grand to our pension expense, debit, and we credit the OCI. We take it back out of the OCI, and we'll have that much carrying over to our AOCI. The last piece, now this one's the corridor rule piece, accumulated other comprehensive income, AOCI, at January 1st, 2031, included an accumulated net loss of 2.3 million. So we take that opening number, 2.3 million, and no unamortized past service costs. So it's the AOCI of this gain loss, it's 2.3 million. And it says the corridor test is based on balances as of January 1st. So this is our balance as of January 1st. Now, what is our obligation or assets? Like, how do we test this? Well, we take whatever's bigger, the obligation or assets, after the amendment. So it's which one's bigger here? And the answer is my obligation, 21.6 million. I take 10% of that, 2.16 million. And I compare to my AOCI balance in the accumulated net loss versus, so 2.3 million. So is my accumulated loss inside the corridor? If it is, I don't do anything, but it's outside, right? It's bigger than my corridor rule number. So it's $140,000 outside the corridor. I misspelled corridor maybe, but anyway, we're going to amortize this 140. And the amortization expense is not 140. We take that 140 and we divide by, again, the average remaining service period. So divided by 10 years means it's 14K per year. And I don't know how I ended up switched over to green ink, switch back to the red. Our amortization here is 14K. So 14K debit here because it's a loss. And we are going to reduce the loss by, or the OCI by crediting it. 14K credit. And I think at that point, we're ready to go. That's everything. So let's add everything up. I'm going to add up my assets and liabilities here. 18.5 mil in opening balance of assets, plus, or actually minus $1 million credit. There should be a K there. Minus a $1 million credit, plus 950K debit, plus 1.4 million debit. We get 1985. Actually, 19.85. I was off by a little bit there. 1985. Okay. And this is a debit, of course. Okay, on to our obligation. We'll start with that amended balance, 21.6 million, plus 1.1 million. Add in credits, we'll deduct debits, plus 1080, minus $1 million, plus 500. We end up at 23,280. And that is a credit, of course. And you can see the credits way outweigh the debits. 23,280 minus 19,850 means we're left with a net credit here of 3,430. And we started the year at like 1.5 million. We end at 3.4 million. This is a big change in our net pension liability, and it got way worse, right? 1.9. The difference there, 1.93 million from the very beginning of the year before the amendment to where we ended. And let's just keep that number in the back of our minds. Okay, so now we want to do the journal entry, and we're going to feed the journal entry by subtotaling all of these and putting in the journal entry row. $1.1 million debit plus 1080 debit minus 1110000 credit plus 160K debit plus 14K debit, and I land on 1244, and that is a debit. This one, 1.6 million minus 160K means we're at 1440 debit. This one, 160 plus 500 plus 14, 674. Oh, no, sorry, minus 14. Let me just redo that. 160 plus 500 minus 14, 646. And that is a debit. Last one, 1.4 million credit. So now we can just figure out where we're at. I'm expecting this to be 1930, but let's make sure in our journal entry, our debits equal our credits, and we're missing this number, so we got to fill that in to make it balance. So I got 1244 debit plus 1440 debit plus 646 debit minus 1,400 credit, or 1.4 million credit, and the missing number is 1930, right? I solved it two ways. 1930K credit to our net pension liability. So let's go ahead and punch this into a journal entry. We're going to, on December 31st, 2031, debit pension expense, 1244. We're going to debit OCI, past service cost or prior service cost, 1440. We're going to debit OCI loss, $646. This is our actuarial loss and our unexpected loss and the amortization of the corridor loss there. Well, all kind of combined into one. We're going to credit cash, 1.4 mil, and we're going to credit net pension liability for 1930. And at that point, I think we've solved it. We're done with 2010A. As always, if these videos help, I hope you'll consider hitting a thumb. See you in the next video. Bye for now. Let's jump into problem 2011A. We're doing a pension worksheet, this time from the perspective of IFRS, and at the end we'll do ASPE. If you can do IFRS, ASPE is dead simple for my Canadian viewers. Elk Valley Mining sponsors a defined benefit plan. Effective January 1st, 2031, Elk Valley amended the plan to enhance benefits for past service. The actuary determined the amendment increased the defined benefit obligation by $1.6 million. Well, we'll know IFRS and ASPE agree on the treatment here. Past service costs are expensed immediately. So they don't go to OCI. They don't end up in AOCI with any issue there. They are expensed immediately. The following information relates to the plan, and we're going to slot it into the table. So let's start with our obligation, and our obligation is $20 million. Credit, of course. Our plan assets open at $18.5 million, and there is a plan amendment for past service costs. The plan amendment said it was $1.6 million, and it was increasing our obligation, right? Increased the defined benefit obligation. So, okay, $1.6 million credit here, and it's a $1.6 million debit over here to the expense. No other changes, so we can subtotal 18.5 mil debit under the asset, 21.6 mil credit under the obligation. Our opening net asset was 1.5 mil. I said net asset, it's a liability, right? Where our obligation is outweighing the assets. And after that adjustment, we're at like 3.1 mil to the bad, right? We are a much bigger obligation because, we amended our plan and it was more generous in terms of what we were paying out. And yeah, it gets brought into the expense immediately. Okay. Let's continue down the line. So our discount rate here, 5% on the obligation, and our obligation, 21.6 million times 5% is 1080. So our interest cost here is 1080. That's a debit to our pension expense, and that grows our obligation by 1080. What about this expected return? Well, any expected return is a US GAAP concept. Under IFRS, and this is one of the differences between IFRS and Canadian ASPE, we don't use the expected return. We just use the discount rate, and we say, okay, our plan assets are expected to grow by the discount rate, 18.5 mil times 0.05, and 925K. Now that goes here under pension expense, and it's a reduction of our pension expense. So we have this liability, it grows by this much. We have this assets, they're expected to grow by this much. Now, what do they actually grow by? They actually grow by 950. And so you can see they grew by more than what we were expecting. The difference under IFRS goes to OCI. Since there is no OCI in Canadian GAAP, we just put the 950 all into the credit to pension expense. Here, though, the other 25K credit to make this thing balance goes under OCI gain loss. In this case, gain, right? We made 25 grand more than what we expected to. Okay, I had skipped over, so we dealt with that. I skipped over the 1.1 million current service cost. That's one of the easy ones. You just put 1.1 million debit under current service cost and $1.1 million credit under pension obligation. Actuarial loss on the obligation, $500,000. What does this look like? Well, actuarial loss of $500K. Now, this is another one where we are different between Canadian ASPE and IFRS. IFRS says put this in OCI, gain loss. It's a debit, of course, and credit your pension obligation by $500K. Canadian ASPE, when we get there, we're just going to move this over because there is no OCI, so we'll just move it under the expense. Okay. Next up, contributions remitted to the trustee, $1.4 million. Okay, so that makes our assets grow by $1.4 million. Plan assets go up. And cash goes down. We contributed cash from the company and put it to the trust. Benefits paid to retirees, $1 million. Well, what does those do? What does that do? Well, it reduces our assets, of course. We're paying out assets, and it reduces our liabilities. So we're paying off the liability, debit a liability to make it go down, credit an asset to make it go down, and we are in balance. Okay, that's all of these. Now it talks about AOCI's opening balance and might hint at, like, is there some amortization here? The good news for us in Canada and IFRS places is we don't have to do any of this nasty amortization stuff that our American cousins have to do. Corridor rules and amortization. OCI under IFRS, it goes in and it doesn't amortize out. It just sits in OCI. Under ASPE, it never goes into OCI. So we don't have to worry about either of these. These do not apply. Not applicable. That makes our life easy. And once that's done, we've sort of filled in every cell. We are done. We just need totals. So let's total up our plan assets. 18.5 mil minus $1 million. Plus 950,000 plus 1.4 million lands us at 1985, a very good year. 19.85 million. Let's do our liability. I'm going to start at 21.6 mil, plus 1.1 mil, plus 1080. Minus $1 million. It's a debit there. Plus 500,000. We end up at 23,280 credit. And you can see the credits are much larger than the debits. 23,280 minus 19,850. And we end up at 3.43 million credit. 3,430K credit, and it's again a net pension liability. No surprise our liability grew by so much because we had this like $1.6 million past service adjustment, right? So and a negative one for the plan. But even with that 1.6, we still went down by more. Looking at the start of the year to the end of the year, our liability grew by 1.930K, right? Like that's the change in liability, 1.5 to 3.4. And that number is going to come into our journal entry here. I'm going to sort of solve it a different way, but I'm looking for that number. 1930 credit is what I'm expecting to see. Now, how do I get there? Well, we just add up our journal entry and this will be a missing number to make it balance. So the cash totals to 1.4K. Credit, or 1.4 million, I should say. This one is 475K debit. And this one, I need a calculator, 1.6 million plus 1.1 million plus 1080 minus 925. We land on 2855 debit. And so, okay, when obviously nothing here, the past service cost doesn't go to OCI. This is a US GAAP relic, I suppose. So let's add up our debits and credits and figure out what the missing number is here. 2855 plus 475. Our total debits is 3330. Our total credits so far is 1400. We're missing a credit of 1930. Look at that. That's the number we figured on calculating here. 1930 CR. That's what's going in our journal entry. So let's go ahead and do that IFRS journal entry. So it's just this set of numbers in debits and credits, and we'll be done with the IFRS section, and then Canadian ASPE super easy after that. December 31st, 2031, we're going to debit pension expense. I think IFRS might use different language here. What do they call it? I don't have it at the tip of my tongue, but anyway, pension expense will do 2855 K, or let's just do it in millions, 2855000. The OCI gain or loss, we would call this a remeasurement gain typically under IFRS and ASPE. OCI, well, not under ASPE, I should say. under IFRS remeasurement loss. And the amount of the OCI loss, $475K. Cash credit of $1.4 million. And last, net pension liability. Credit of $1930. And there we have the IFRS entries done. We've completed our table, and this table feeds a lot of other information. Where our OCI and AOCI balances, what's our obligation balances. This feeds into other questions we could ask, but this is like the cornerstone in my mind of the pensions chapter. Okay, let's move over. If you're just doing IFRS, like and subscribe. If you are a Canadian ASPE person, you'll know this is pretty easy. All we do is eliminate the OCI stuff and just move it into the expense. So this 925, this 25 gets canceled. This becomes 950 credit. And of course, it's perfectly matching that as we would expect. This 500K just moves over here. Therefore, this number becomes 0. And this one goes up by 475K, just the total here. So in fact, I'm just going to add 475, 2855 plus 475. It's 3330 is the total of this column. So we eliminate that. We change this to 3330,000. And look at that. The number balances. There's our Canadian ASPE one done. So very quick, very easy for us Canadians. Thanks for watching, my fellow Canadians, and thanks for making it to the end. I'll see you in the next video. Bye for now.
Welcome to Module 21 of our Intermediate Financial Accounting class. This module is the cash flow statement module, very similar to an intro class cash flow statement module. We're going to do lots of examples of cash flow statements, but here we add intermediate concepts in that just wouldn't have been on intro balance sheets and intro income statements. So we have more complicated accounting going on, and therefore we have more complicated cash flow statements. I'm going to give you a high-level view of what's on a cash flow statement. You should know this by now, but cash is important, right? It gets its own financial statements because cash is king. If a company runs out of cash, they're dead. They cease to exist. They are bankrupt. They can't pay their bills. They're not going to be in business for long if they don't have money. And so investors are very interested in cash because the health of the company depends on a healthy cash flow situation. And investors also love cash flow because they know us sneaky accountants. There's that famous joke in accounting. It's a hilarious joke. Get ready to roll and laugh. Here's the joke. You're hiring for an accountant. You say, what's 2 plus 2? And the accountant says 4. You don't give them the job. If you say, what's 2 plus 2? The accountant should say whatever number you want, because accountants can do magic with the numbers, right? They can manipulate numbers by, through GAAP. GAAP is wide enough that you can make choices and estimates that change your profits. Well, investors don't like that, and investors say, well, cash is a pretty true number. So if I just follow the cash flows, that tells me a lot about a company. And if you're in finance, you'll know cash flow is everything in finance. So cash flow statement, I'm justifying its existence. You're in intermediate accounting, it deserves to exist. The other reason is, if you presented with a cash T account, you go, oh yeah, there's a cash T account. I can look at the cash in and cash out. But of course, a real cash T account, because that's an accounting class cash T account, is like pages and pages and pages and pages of debits and credit. It continues on. And so you have to organize it. And the cash flow statement is our attempt at organizing these debits and credits to cash in a rational way. So we split it into 3 sections. Operating really summarizes the changes in the current assets and current liabilities, and it tries to reconcile net income. It says net income is like our day-to-day business, that's our revenues and expenses. We work backwards from there. We look at the change in our short-term assets and short-term liabilities to see how that affected cash. That's our operating section. Investing is all about long-term assets. So did we buy or sell equipment? Did we buy or sell investments? That's our investing activity. Financing is about liabilities and debt, long-term liabilities. So did I borrow money from the bank? Did I pay back the bank? Did I issue new shares or buy back shares? And finally, did I pay any dividends? That's what the financing section is seeking to answer. Now, operating can be presented in two ways, and we're going to learn both. The direct way, which I prefer, but the indirect way, which the world seems to prefer. So we'll focus more on the indirect way, but we'll do both in every problem that we do. Now, I could have done this intro for an intro class. Like I could have done the same conversation for an introductory class. What makes this different is we have intermediate concepts, things like deferred income taxes. Well, how do I deal with that in the context of a cash flow statement? Convertible bonds. If I convert a bunch of bonds into shares, how do I deal with that in the context of a cash flow statement? Intangible assets. How do I deal with amortization of a patent, right? How do you deal with these new expenses and new balance sheet accounts in the context of a cash flow statement? The answer is often pretty similar to how we would have done it in intro, just they're new concepts. So I've got, I think, 5 or more problems, like, and A versions and B versions. That's tons of practice for you. The best way to learn anything in accounting is to practice. I'm so glad you're here with me. I can't wait to get started. In the next video, lots of examples. See you in the next video. Bye for now. We're about to tackle problem 21-1A. I want to remind you, you can find the problem and the template on my website, tonybell.com. To find the problem, just click the PDF link for Intermediate Financial Accounting 2. Templates can be found right here, and this is Intermediate FA Cashflow Template.xlsx. Hopefully that helps. Let's jump into the problem. Let's jump into problem 21-1A. We're doing a cash flow statement. Now, we've done these before. In this class, we've done this in previous classes. This is an intermediate level cash flow statement, and they get harder from here. If you're working through this and you're like, this is too hard for me, go back and watch some of my intro material. It will be useful to you. This ladders up from there. If you've done that, this is the starting point, though. The financial statements of Shoe Swap Outfitters, Inc. are presented below. And as usual, we have a comparative balance sheet, an income statement, and some additional information. And the question says, do a cash flow statement, doing either the direct or indirect. We'll do both. I'll start by doing the complete indirect financial statement, the indirect cash flow statement. And then at the end of the video, I'll do the direct method for the operating section. And after that, investing and financing are the same. So let's start with the title, Shoe Swap Outfitters. Shoe Swap Outfitters. We are preparing a statement of cash flows for the year ended December 31st, 2031. And as promised, we are going to do the indirect method. The indirect method, we start with net income. We work backwards from net income to reconcile some non-cash expenses or revenues. And then we look at the change in working capital accounts, the change in current assets and current liabilities. So let's start with our net income, $95,000. This template, by the way, is available on my website, tonybell.com. Now, use with caution, right? On your midterm or final exam, your professor may or may not give you a template. So just be cautious about overly relying on it. I'm going to use it to fill in, and I'll discuss as we go. But most cash flow statements can kind of fall into this template. There might be quirky 1 line or 2 lines that don't fit based on what's in your textbook. You don't have to squeeze them in. But obviously my questions all fit in here. Okay, so we've done net income. Always we're adding back depreciation. We deduct depreciation expense to arrive at net income. Depreciation expense doesn't involve cash, so we're always adding it back. Now, depreciation is an operating expense, and our operating expenses are $298, but what's our depreciation? Well, it has to tell us somewhere, and it tells us right here. There are questions where you'll have to calculate depreciation, but we'll do that in a future question. I think 22, we do that in going forward. Anyway, it's given $41,000, so we add back depreciation. Now, if we had any gains or losses on sale of equipment, on sale of investment, we have to reverse them. So if we had a loss, we would add it back just as we did depreciation. We have a gain, so we're going to deduct that gain on sale of, equipment, $6K. And so we deduct, of course.
Let's see, amortization of intangible assets, amortization of discounts. We don't have that. We don't have any deferred taxes, although again, we would deal with it here. So now we're into the change in non-cash working capital accounts. And we just go down the list of all our current assets and all our current liabilities. And we say, how would this change affect cash? So for example, our accounts receivable goes down. Well, why does AR go down? Because I collected cash. AR goes down, cash goes up, 8K. So it's a positive 8K. Now, had AR gone up, we would say cash goes down. We're not collecting our sales. That's bad for cash flow. It would be negative. If a current asset is going up, cash is going down. If a current asset is going down, as is the case with accounts receivable, well, cash goes up. Let's do inventory. Inventory goes up. All right, well, why would inventory go up? Because I bought more inventory. I have more cash tied up in inventory. It's $27,000 negative to my cash. Prepaid insurance goes down. I have less cash tied up in my insurance policies. I always think of it the other way. If prepaid insurance went way up, why would it go up? Because I bought more insurance. Here we're buying less insurance. We have less money tied up in our insurance policy, and therefore that's 2K positive for the cash flow. That appears to be it for current assets because these are long-term assets, and long-term assets go in the investing section. So I think we can safely leave this piece behind. There's no other current assets that we have to worry about. And we're on to accounts payable. And again, we'll just go down our current liabilities. Accounts payable goes up. Why does it go up? We keep the money in our pocket. If accounts payable goes down, why does it go down? Because we pay the bill. So accounts payable going up is actually positive for cash flow. We're not paying our bills. We're keeping the cash in our in our pockets. Salaries payable goes up, also good for cash flow, plus 4K. Dividends payable goes up. That is good for cash flow. However, dividends don't belong on this section of the cash flow. I mean, that's our the one exception at this point. There are the odd exceptions here. Most of our current assets and current liability changes get tracked here. Dividends, though, are at the very end. So we'll do that in the financing section. So we'll just leave that for now. Interest payable goes up. Well, why does a payable go up? Because we're not paying it. We're keeping the money. Again, I always think of it the other way. If interest payable goes down, why? Because I paid the interest bill. Interest payable goes up because I'm not paying the bill fully. So plus 1K to cash. Unearned revenues goes up. Well, why does unearned revenue go up? And the answer is because what is an unearned revenue? It's when a customer pays me in advance. So why would unearned revenues go up? I got more money. They paid me in advance more. 5K is the difference there. A lot of pluses here. We've got a minus. Income tax payable goes down. Why does it go down? Because I paid my taxes. 3K. Why does any payable go down? Because you pay. And that's it for I'm just reading down the balance sheet. That's it. But now we're into bank loans and stuff. We should assume bank loans are long-term. Hence, we'll deal with that in the financing section, and equity accounts get dealt with in the financing section as well. So let me add up this list of numbers. Here we go. 95 plus 41 minus 6 plus 8 minus 27 plus 2 plus 7 plus 4 plus 1 plus 5 minus 3. I get $127,000, 127K. $127,000 is a key number. Now we'll do this again, the direct method, but I'll save that for the end of the video. Let's continue down and do the investing section. And the investing section, the focus here, let me minimize that. The focus is on long-term assets. So what do we have for long-term assets? Right there, we just have buildings and equipment. And what accounts are involved in our buildings and equipment and our accumulated depreciation? Well, it's the buildings and equipment, it's the depreciation, and it's the gain on sale. Basically, everything I've got circled are the key accounts here. Let's now, generally speaking, these questions are going to give you a little bit of additional information. They're going to say, we bought some equipment, we sold some equipment. They'll give you some flavor here, particularly if the company both bought and sold. Now, if it doesn't give you any information, you can infer some things and calculate some things. And we'll do that, I think, in 21.5, where it really doesn't give us much information. We just have to infer things. But here it does give us information. So bullet points 4 and 5 are the ones that kind of come up. It says equipment was purchased for during the year for $96,000 cash. Well, that's that simple. Cash paid for equipment. 96. Now, it is possible we could have multiple purchases of equipment, in which case we would just total them. It says equipment was sold for cash during the year. The original cost was 58. The accumulated depreciation was 9. All right, so equip of 58, AD of 49 gives us equipment net of 9. We sold equipment with a net book value of $9,000. Did we get paid $9,000 cash? And the answer is no. And how do I know? Because of this gain on sale. If I sold equipment I thought was worth 9 and I had a gain of 6, I must have got paid $15,000. So we're going to add the gain, 6K, to get cash received when selling the equipment of 15. That's our number, plus 15. Had we lost, it would just be a minus. Okay, negative 96 plus 15. Heaven help me. I should be able to do this in my head. I'm struggling right now. I think it's 81. Shouldn't have struggled that mightily with that. And it's 81 negative, of course. On to the final piece, the financing activities. The financing activities, think debt and equity, long-term liabilities, and think dividends paid. Debt, equity, dividends paid. So bank loan payable going down. Why would it go down? Because I paid off the bank loan. I would think cash paid to pay down debt, $10,000. Now, that's what I would think, but I'm wrong. So my knee-jerk reaction is, that's what I can infer. I paid off $10,000 of debt. However, it says during the year, the company repaid $30,000 of the bank loan and borrowed $20,000. So this is actually going to create two line items. We borrowed $20,000 and we paid back $30,000. The net is negative $10,000 as we suggested, but we want to separate them, and that would be a mistake, just putting negative $10,000. Even though we'd get the right answer at the end, it would be a mistake. So we borrowed $20,000, cash received on borrowing, $20K, cash paid for reducing debt, negative $30K. Okay. And of course, the net effect there is 10. What about common shares? Okay, common shares went up by 25 grand. My knee-jerk reaction is to say we issued common shares for 25,000 cash. And bullet point 7 confirms common shares were issued for cash. There's no other bullet points about common shares. I think the fair assumption is to say that 25K positive here. Oh, on issuance of shares. I was in the wrong line. Last one, cash paid for dividends. If it doesn't give you the amount, and it says dividends were declared, doesn't say that they were paid, doesn't give you the amount, you've got a two-step process here. First, we got to say, how does retained earnings work to figure out the amount of the dividends? This is like a statement of retained earnings from, intro class. So you go, my retained earnings beginning, 383, add net income, 95, subtotal, 383 plus 95 is 478, minus dividends declared equals retained earnings ending. And we know our retained earnings ending is 426. So I can work out by working backwards what my dividends were, right? 478 minus X equals 426. X has got to be 52. Our dividends declared is 52. 478 minus 52 is 426. The math would be 478 minus 426. That's the math I did in my head. Wow, what a great mathematician you are, Tony, is what you're probably thinking. Yes, thank you. Okay, so that's the dividends declared. That's not necessarily the dividend. What an ego. That's not necessarily the dividends paid. And it's not the dividends paid. How do I know that? Dividends payable changed. If dividends payable went down, we would have said, we paid more than 52. Dividends payable went up, so we paid 3,000 less than 52. So it's dividends declared plus decrease in dividends payable, 52,000 plus, the decrease, but in this case, we minus the increase. 52 minus 3 is 49. Cash paid for dividends, 49K. And I think at that point, we're good to go. Hopefully, our calculator tells us we did well here. The beauty of so much of accounting is a lot of times you can just know if it worked, and we'll have a pretty good idea if this worked in just a second. 30 negative plus 20, there's our negative 10 we discussed earlier, plus 25, minus 49 is 34 negative. Maybe I'll write it out, 34,000 negative. Now I just have to add these up. 127 minus 81 minus 34. I get 12,000 positive. I have a net increase in cash of 12,000. Well, I think I do. Am I right? And the answer is, well, let's look. Do I have an increase in cash of 12,000? And the answer is yes. Now, it doesn't mean I got it right. I might have messed up something and messed up the error two ways, or I might have done something like netting out the bank loan, borrowing and repaying, right? There's mistakes I could have made, but certainly a good sign when we can say cash beginning of the year was 43, cash end of year was 55, 12 plus 43 is 55, like the math works. So well done to us. Okay, one last step. Now, I'm pretty generous, or some professors may be generous and give students the template I've given, but I think it's very reasonable not to give the template. Also, all these calculations for the direct method, I never give to my students. So this can be challenging in and of itself. Let's see if we can work through the direct method with what we've got here. There we go. Let's start with cash collections from customers. Sales rev, 842, plus decrease in AR. Did AR go down? Let's see. AR went down by 8, so plus 8. Plus increase in unearned revenues. Unearned revenues went up 5. So yeah, plus 5. Okay, so 842 plus 8 is 850 plus 5. 855, that's my cash collected from customers. On to cash paid for merchandise, sometimes called cash paid to suppliers. COGS, cost of goods sold, 415. Plus increase in inventory. Our inventory, did it go up? Yeah, it went up by 720, or yeah, not by 720, by 27. So COGS plus increase in inventory plus decrease in AP. Did AP go down? It went up. So it's actually not a plus, it's a minus 7. All right, 415 plus 27 minus 7 is 435. Our cash paid for merchandise, 435. Next, cash paid for salaries. Salaries expense plus decrease in salaries payable. Salaries expense, 187. Now I would be looking in operating expenses, not seeing it, so there it is. Salaries expense, 187. Decrease in salaries payable. Salaries payable didn't go down, it went up. Minus 4 then, right? Decrease we would add, increase we subtract. 183. Cash paid for other operating expenses. Other operating expenses, 70. Plus increase in prepaid insurance. Prepaid insurance, where are you? There you are. Prepaid insurance didn't go up, it went down, so it's going to be a minus 70 minus 2 is 68. Cash paid for interest. Interest expense plus premium amortization. Now, that's bond premium stuff. We didn't have any bonds, so we don't have to worry about that. Interest expense plus decrease in interest payable. By the way, that's ominous. We're going to have to deal with it in future questions. Interest expense plus decrease in interest payable. Interest expense, there you are, 9K. Plus decrease in interest payable. Interest payable went up, so minus 1K minus the increase in interest payable. I get 8K for that. Last one, income tax expense, cash paid for taxes, income tax expense plus deferred tax benefit, or minus deferred tax expense. Again, we don't have deferred taxes here. Thankfully, we will in the future. It's an intermediate accounting class. So it's income tax expense, ignore that one, plus decrease in income taxes payable. Income tax expense, 31K. Plus decrease in taxes payable. Tax payable did go down by 3, so plus 3 is 34K. Okay, on to the moment of truth. We're going to add up these numbers in our cash flow statement. We'll fill them in the direct method side. Cash collections from customers, positive 855. Cash paid for merch, also called cash paid to suppliers in a lot of textbooks, 435 negative. All these cash paids are going to go in as negative. Cash paid for salaries, 183 negative. Cash paid for operating expenses, 68. Cash paid for interest, 8. And cash paid for income taxes, 34. And now we just want to add this up, and it's a real moment of truth, right? If these two numbers match, if we land on 127, doesn't mean for sure we got it right, but boy, is that a very good sign and a very good feeling in an accounting class. 855 minus 435 minus 183 minus 68 minus 8 minus 34, 127. The birds are singing. The sun is shining. Everything looks right about this cash flow statement. There's one more thing that would look right. A big thumb next to this video. Thanks for watching, and I'll see you in the next one. Bye for now. We're about to tackle problem 21.3a from my accounting workbook, Tofino Supply. The complication of Tofino Supply, well, there's a couple. They sell two pieces of equipment, not just one. And, well, there's a couple more. They have patents. We haven't seen that so far in our statement of cash flows. And the big one, the one that I think is the trickiest, is they have a deferred tax liability. And we haven't had to grapple with deferred taxes just yet. I don't think any of this is that complicated. I just think it's our first time seeing it. And so that requires a little bit more attention. So we're asked to prepare a cash flow statement. I'm going to do the indirect method first, then we'll do the direct method after. But let's get started. Let's start with a 3-line title, Tofino Supply. We're doing a statement of cash flows for the year ended August 31st, 2031. We start as ever with net income. Our net income, $155,000. We're then asked to add back depreciation. This is very standard indirect method cash flow statement stuff. And I look for my depreciation expense. Well, it's in operating expenses. Operating expenses are expounded upon down here. It says the operating expenses of 455 are composed of depreciation. That's what we want. Amortization of patents. Amortization of intangibles is treated exactly like depreciation in the cash flow statement. So we're just going to be adding that back. Salaries and other. And it notes salaries are 289. And it says you're going to need to calculate the rest. Okay, lucky us. Well, we kind of know how to calculate depreciation, so let's start there. So let's do a depreciation expense calculation. And it's based on accumulated depreciation, right? The change in accumulated depreciation. So in the absence of other information, you would just go, accumulated depreciation went up by 9, our depreciation expense is 9. But we do have additional information. We know we sold some equipment, so that can't be right. We sold a bunch of equipment, that's never going to be right. And there's a bullet point about it. 2 pieces of equipment were sold for cash during the year. The first had cost of 54 and AD of 26. AD is what we're after. Second had cost of 85 and AD of 23. Okay, so to figure out the depreciation expense, you start with your beginning accumulated depreciation. Then you say, how did it change during the year? Well, it would have dropped by 26 and it would have dropped by 23 as we sold both of those assets. Now it's $49,000 it would have dropped by. So after selling those assets, it would be sitting on our books at $299, our accumulated depreciation. And yet we end the year at $357. Well, how did we get from $299? That's where we'd be sitting after we sold the 2 assets. How did we get that from there to $357? Depreciation expense. So it's $58,000, right? The missing number, right? $299 plus 58 is $357. $357 minus $299 is $58. Our depreciation expense, $58,000. That's obviously a key number. Another key number is patent amortization. And just in terms of bullet points, it talks about patents here. It says no patents were purchased or sold during the year, and yet our patent value fell by $6,000. Well, why did my patent value fall? Because some account somewhere went debit amortization expense, credit patent, right? Remember, that's how we amortize a patent. We don't use an accumulated depreciation account. We just credit the asset directly. Debit amortization expense, credit patent, $6,000. So our amortization of our patent is 6. Now, what about other? Well, other is just, we know the total operating expenses is 455. We know 58 plus 6 plus 289 plus whatever other is 455. Let's figure out what it is. So to get there, you go 455 minus those other ones, minus 289, minus 6, minus 58. Other, in this case, is 102. Okay, I think we've got enough preamble out of the way. Let's work on this. So our depreciation is 58. Add back depreciation. Gain loss on sale of, well, what did we sell? We sold some equipment. So gain on sale of equip was, 7. So I'm going to add 7. Of course, we add our gains. We deduct, or don't add our gains. We deduct our gains. What am I saying? Deduct our gains. We're going to add back losses. Our loss was 11. We add that back, 11K. Amortization of patents, we just calculated that. Our amortization of patents was 6. And deferred taxes, we do have deferred taxes. Now, again, I have income taxes showing here of 52, but what are my deferred taxes? And there's no... Well, is there a note about this? It says the company accounts right here. The company accounts for income taxes using the deferred tax method. The change in deferred tax liability relates to the deferred tax expense. Well, what did our deferred tax liability do? Deferred tax liability went up by $6,000. That means we have a deferred tax expense of $6,000. Now we're looking to reverse it here in this section, right? We're adjusting net income to net operating cash. Why would that be? Well, if I have deferred tax expense of $6,000, deferred taxes never involve cash. We're not sending a check to the government for that deferred tax expense. That's like some future income tax cost we're going to be paying down the road. We're not paying it today. It's nothing to do with today. So because of that, it's a non-cash expense. So we're going to add it back here. So it's very much like depreciation in that it's a non-cash expense. $6,000 expense this year. And why $6,000? The difference between our deferred tax liability last year and this year. Our current year deferred tax expense is $6,000. I guess that's all of those. So now we're into the change in non-cash working capital accounts. Hopefully this is getting to be old hat, right? So we just go through all of our current assets and current liabilities and say it went up or it went down, and how does that affect cash? So our accounts receivable going up by 21 grand is bad for collections. It's bad for cash flow. Any asset goes up, cash goes down, minus 21K. Change in inventory. Inventory went down. Well, inventory went down by 22K. Cash goes up. A few less money tied up in inventory. Change in prepaid insurance. Prepaid insurance went down. We have less money tied up in our prepaid insurance. Oops, that's plus to cash. Pardon me. Plus 2K to cash. Now we're on to building and equipment. Well, that's long term. That is investing activity. On to accounts payable then. 88 to 97, it went up by 9K. Cash goes down by 9K. No, the cash goes up by 9K. What am I? I've got these all backwards in my mind right now. Sorry. A liability goes up. That means cash goes up. Liability goes down because you're paying it off. That means cash goes down. Salaries payable went down. Cash goes down. 6K. Dividends payable. Well, we'll deal with that when we go to pay our dividends. And dividends are in the financing section. So that's one that we just have to know, and you'll know by now. We leave that off for now. Interest went up. Interest payable went up. Cash goes up. Payables go up. Cash goes up. Deferred tax liability, you might think, well, what about that one? That is a non-current asset. It doesn't get dealt with here, right? This is a long-term asset, liability. It doesn't get dealt with in this section. Unearned revenues is next on my list. I don't see it. I missed income taxes payable. Income taxes payable went up by 4. Well, that means cash goes up by 4. And there's just no other current liabilities to deal with. That's everything. So let's add up this list and see where we're at. Where's my calculator? There it is. 155 plus 58 minus 7 plus 11 plus 6 plus 6 minus 21 plus 22. Did I do that right? I'm feeling shaky. Well, we'll see. Plus 2 plus 9 minus 6. I feel like I fat fingered my keypad. Plus 1 plus 4. I do have a check figure, so it should come out to 240, and it does. That is good news. Okay, so our cash inflow from operating activities is 240. On to investing activities. That was the hard part of this. We're done the hard part. Investing activities very much like what we've seen before. Did we buy any equipment? Did we sell any equipment? Well, we did both. Equipment was purchased during the year for $216K cash. Bullet point number 4, cash paid for equipment, $216K. Equipment was sold, and this was that 2 pieces of equipment got sold, one at a gain, one at a loss. Let's figure out what that equipment is worth. We got 2 pieces that sold. One with cost of $54K and AD of 26, 54 minus 26. One equipment that its net book value was 28. Equipment number 2 has net book value of 85 minus 23. What is that? 62. And we sold them both. One of them experienced a gain, the other experienced a loss. Doesn't matter which is which for our calculations here. Let's put the gain on the first one. So plus 7 for that one. We'll assume it was sold for 35. And the loss is 11 on this one. So minus 11. So we're left at 51. Now, why doesn't it matter? Well, we're going to combine them anyway. So we're left at 86. If we had flipped these and said this one lost 11 and this one gained 7, you end up in the same spot, right? 28 minus 11 is 17. 62 plus 7 is 69. 69 plus 17, it's 86 that way also. So it doesn't really matter which one you apply the gain or the loss to, as long as you calculate it correctly, which I think we have. So cash received on sale of equipment, $86K. There's no investments, just looking at our assets, right? Looking for investments there. I don't see any. So because there's no investments, negative 216 plus 86, it's $130,000. Onto the financing section, and again, the financing section is straightforward. The operating section was the hard part, and in fact, the hard part I find was just right up there. Cash paid to reduce bonds or long-term debt. Well, let's see what happened to our bank loan. Bank loan fell by 25 grand, so I would think minus 25 grand here. And it says the company repaid 25 grand of the bank loan. Okay, so 25 grand cash paid to reduce a bank loan. Some of these, there's like 2 items working against each other. This appears just to be the one. What about our common shares? Looks like we issued 30,000 of common shares, and notes common shares were issued. All right, well, in the absence of other information, we assume for cash. And now we got cash paid for dividends, which is that classic retained earnings calculation. We take our retained earnings beginning plus net income, subtotal, minus divs declared, not paid, but declared, equals retained earnings ending. Okay, retained earnings beginning, 614. Add net income, 155. Subtotal, 769. Minus dividends declared equals retained earnings ending. Retained earnings ending, 698. All right, 769 minus what is 698? Looks to me like 71. Yeah, I think. I used my calculator. I'm feeling shaky on this one for some reason. Let me get the calculator out. 769 minus 698. I should have had courage in my conviction. It was 71. So that's the dividend we declared. Is that the dividend we paid? Well, remember, it's dividends declared plus decrease in dividends payable. Our dividends payable here increased, and so that means we didn't pay the full amount, right? If our payable is going up, it means we're not paying the full 71. We're paying 71 minus 4. We're paying 67. I'm not going to do a 6-7. I can't help myself. There we go. Got it out of my system. And again, when a middle-aged accountant is doing that, you know it's truly over. I'm sorry. There was a thing, chicken jockey was a thing in my house. I started doing it, and that ended that really quickly. Negative 25 plus 30 minus 67 is negative 62. And there we go. Let's add up our list here. Oops, I should have put that one in brackets, of course. I'm glad I caught it now. 240 minus 130 minus 62. I get 48K as an increase in cash. 48K positive. Did cash go up by 48K? The $48,000 question sure looks like it did. 57 to 105. That is an increase of 48,000.
I think we're good. 57 to 105. Feeling very good about our indirect method. Let's do the direct method, and we can really confirm that 240 is a solid number. Okay, so here is the setup. Cash collections from customers, sales plus decrease in AR plus increase in unearned revenues. Well, we didn't have any unearned revenues, so sales plus decrease in AR. Sales are 1348. Decrease in AR. AR actually went up by 21K, so minus 21 is 1327. Cash paid for merch, cost of goods, 672. Plus increase in inventory. Inventory did not increase. It decreased by 22,000, minus 22. Plus decrease in AP. AP increase, so minus, what is that, 9,000? Minus 9,000. All right, 672 minus 22 is 650, minus 9 is 641. Cash paid for salary. Salaries expense, that was given 289. Plus decrease in salaries payable, 18 to 12, that is a decrease of 6, bringing us to 295. Cash paid for other operating expenses. Other operating expenses, 102. Increase in prepaid insurance, whereas prepaid insurance, it didn't increase, it decreased, minus 2. We're sitting at 100. Cash paid for interest. Interest expense on the income statement is 10. Plus premium amortization, that's on a bond with a discount or a premium. No. Plus decrease in interest payable. Interest payable, where are you? You went from 3 to 4. You didn't increase. You didn't decrease, rather you increased. Minus 1, so it's 9K. Last one, income taxes. Income tax expense, 52K. Plus deferred tax benefit minus deferred tax expense. We did have a deferred tax expense. Deferred tax liability went up by 6,000, so our deferred tax expense was 6,000. It's just this number. We had calculated this earlier in any event. Where is it? It's over here somewhere. Deferred income tax is 6. Yes, so it's minus 6,000, and that means of our total expenses, 52,000, 46,000 relates to the current year, right? 52 minus 6, and 6,000 is deferred taxes, which again shouldn't affect our cash flow, which is why we are taking it out here. Plus decrease in taxes payable. Well, that will affect our cash flow. Our taxes payable, where are you, taxes payable? Right above it, 13 to 17. It's going up, so it's going up by 4,000, so it's actually a minus 4K. 46 minus 4K is 42K. We have 6 items, 1, 2, 3, 4, 5, 6 that need to find their way onto our template. Let's have them find their way onto our template. 1327 minus 641 minus 295 minus 100,000 minus 9 minus 42. And we're hoping when we add this up, we land on that magic $240,000 cash inflow. 1327 minus 641 minus 295 minus 100 minus 9 minus 42. We did land on the number. The birds are singing. The sun is shining. Our statement of cash flows worked the indirect way. It worked the direct way. And I have more good news. The question asks us to say, what is the note disclosure around any non-cash investing or financing activities? So that would be things like trading one asset for another or issuing common shares for an asset that is not cash, which can happen. Didn't happen in this question, so there is no note disclosure requirement, although that's an ominous sign of things to come, but it wasn't there in 21.3a. We've solved it.
Thanks for watching, and I'll see you in the next video. Hit the like button when you say goodbye. Goodbye. Let's jump into problem 21.5b, another cash flow statement. This time, Wells Outfitters. The key issues with this one, well, we've got some deferred taxes. We've got convertible bonds, and we have short-term investments that are so short-term, we're going to call them cash equivalents. So a lot of moving pieces for us to grapple with, but let's first grapple with a title. Wells Outfitters. We're asked to prepare a statement of cash flows for the year ended June 30th, 2031. As always, we'll do the indirect method top to bottom, then we'll fill in the direct method afterwards, starting with net income. And we add back depreciation expense. Now, as always, we're looking in our operating expenses for depreciation. These questions don't tend to give depreciation to us. They make us work for it. I want to just zip through the additional info, make sure everything's sort of clear in our head before we get going. Operating expenses 474 are composed of depreciation, salaries, and other. And salaries are $311K. Prepaid insurance related to other operating expenses. That'll be helpful in our direct method. Short-term investments consist of 90-day federal treasury bills held to meet short-term cash commitments. We're going to call that a cash equivalent for our statement. And so we're not actually working from 38 to 73. We're working from, let's total this. 38 plus 25 is 63. Yeah, from 63, we went up to 125. Those are the numbers our cash flow statement will be working towards. All equipment purchases during the year were paid in cash. Normally, these questions have been telling us how much cash we paid. Here, we got to work for it. I just have a quick cough. Equipment with the original cost of 88 and AD was of 61 was sold during the year, and again we can calculate the amount of cash received on that sale. The company accounts for income taxes using deferred tax method. The change in deferred tax relates to the income tax expense. Okay. During the year, holders of convertible bonds converted into common shares. The shares were recorded at carrying value of the bonds converted, and the bonds had been issued at par. There was no discount or premium, so we don't have to worry about discount or premium amortization getting in our way. Common shares were issued during the year. Company repaid $40,000 of a bank loan, and dividends were declared. Okay, so a lot of moving pieces. There is actually, this isn't the hardest question of the chapter for sure, but there's new quirks for us to wrestle with. Let's start with the depreciation expense. So again, the operating expenses were composed of depreciation, salaries, and other, and we have to calculate depreciation. So as I've often said, well, the difference in accumulated depreciation would be our depreciation expense if we hadn't sold some equipment, and we did. Equipment with cost of 88 and AD of 61 was sold during the year. So we had AD of 437, but we sold equipment with AD of 61. Get my calculator out here. 437 minus 61, meaning before we did depreciation expense for the year, before we recorded our depreciation expense, we had equipment of with AD of 376. Looking at the year-end AD, 455. We went from 376 to 455, and the difference here is depreciation. What is that, 79? Yeah, it's got to be 79K of our depreciation. Let me just do it in my calculator before I make a terrible mistake. 79K, yes. Okay, so our depreciation expense, 79K. What about our other operating expenses? Well, we know the total, 79 plus 311 plus whatever that is, equals 474. And 311 plus 79, 390 on the left side, 474 on the right side. The difference, 84,000, not negative, but it's 84,000 in other operating expenses. Okay, so let's put that in. Depreciation expense, 79K. Now, you know, when we sell assets, when we sell equipment or investments, we'll have gains or losses. And here we had a gain on sale of equipment. And in the indirect method, we deduct gains, we add back losses.
So let's deduct our gain on sale of equip. Did we have any losses? No. Did we have any other gains or losses? We have no investments. I'd be looking for investments as well. No investments. So that's the only one. Amortization of intangibles is what we're looking for here, or amortization of discounts or premiums on bonds. We did have bonds, but it was clear to note there were no discounts or premiums on the convertible bond. So nothing to worry about there in terms of amortization. There's no intangible and no bonds. And were there deferred income taxes? And the answer is yes, unfortunately. I see the deferred tax liability. Okay, the liability is going down. What does that mean? It means there's actually a deferred tax benefit, right? If the liability goes up, it's an expense. If it goes down, it's a benefit. Okay, so there's a deferred tax benefit. Well, what is a benefit? It's a revenue. So just like a gain, we minus the gain. Well, deferred tax benefit, we're going to minus the deferred tax benefit, and it's $5,000, right? The difference there in the deferred tax liability. Okay, that's the hard bit for the operating section indirect. Now the easy bit where we just look at the change of all of our current assets and current liabilities and see how that would affect cash. So AR going way, way down here, $38,000 decrease in AR. Why does AR go down? Because I collected the AR. An asset goes down, cash goes up. Inventory going down. Well, less money tied up in our inventory, $47,000, cash goes up. Prepaid insurance goes down, cash goes up. Everything's going up here. All right. Any other current assets? The answer is no. There's just the long-term assets and the short-term investments, which we've said we're treating as if they're cash. So we're treating it as if it's cash. We're going to call it cash and cash equivalents. And equivalents. And, so our cash balances, we're going to treat as cash and cash equivalents balances. Anyway, carrying on. We're on to the liabilities. Accounts payable goes down. Well, if AP goes down, cash goes down. And the amount there is $13,000. Why does it go down? Because we paid the AP. A liability goes down, cash goes down. A liability goes up, cash goes up, $5,000. Interest payable goes up, cash goes up, $2,000. Unearned revenues we don't have. Income tax payable we do. Income tax payable goes up by $3,000, cash goes up by $3,000. Dividends payable I skipped right over, but we do skip right over the dividends payable because we deal with dividends at the bottom here in the financing activities. So dividends, interest, income tax, deferred tax liability we've dealt with. Deferred tax liability, by the way, long-term in nature, but we deal with it right here. So that's where the change in deferred tax liability comes in, or deferred tax asset. And so it gets dealt with here, but it's not non-cash working capital because it's not working capital. And then we're into our bank loans and convertible bonds. That's long-term. So I think that's it. Let's add up this list and see where we end up. Well, this calculator app is just, it hides on me in ways that new to me. 170 plus 79 minus 12 minus 5 plus 38 plus 47 plus 4 minus 13 plus 5 plus 2 plus 3. I land on $318,000. That is my net inflow from operating activities. By the way, huge, huge. I'm guessing there's going to be some outflows coming. We're on to equipment, and it is literally just equipment because we have no investments. So cash paid for equipment, cash received on the sale of equipment. And for once, we're not giving cash paid for equipment, right? All equipment purchases were for cash, but we don't get told how much. And so we just have to track the change in this account. We have to go, okay, I started at 1047, I ended at 1103. Clearly, we're up by $56,000. Did we buy $56,000 in equipment? Actually, we bought more because we sold equipment with cost of $88,000. So we have to consider that. So we started, and you just tell the story of the asset, right? We started with 1047. I sold $88,000. Equipment with cost of $88,000, and it's just the cost. 1047 minus 88 You might be saying, well, what about the AD? And the answer is, well, we dealt with the AD over there, right? So the AD affects the AD account, not the buildings and equipment account. 1047 minus 88 is 959. So I was down to 959, but then I must have purchased equipment because I end up at 1103. How much equipment did I purchase, right? What's the missing number there? 1103 minus 959, 144K. Okay, so I must have bought $144,000 worth of equipment. Let's fill that in. Cash paid for equipment. What about cash received on the sale of equipment? Well, this one's old hat for us by now. We had equipment that had a cost of 88, an AD of 61. 88 minus 61 means the net book value is 27. Now, did I get paid exactly 27? The answer is always no. There's a gain or loss. If there's a gain, I got paid more than 27. If there's a loss, I got paid less. I got paid $12,000 more than 87. I got paid $39K. That's my cash received on the sale of equipment. So negative 144. 144 negative plus 39. We end up at negative 105, a cash outflow from investing activities. Okay, on to the final section here. So we're interested in, did we borrow new money? Did we pay back? So let's start with this bank loan. Our bank loan goes down by 40 grand. My intuition says we paid 40 grand to pay off our bank loan. Now, maybe something else happened, but let's read the notes. It says the company repaid $40,000 of the bank loan. So yeah, I think that's very clear. Cash paid to reduce the bank loan, 40K. The balance sheet agrees with what's in the notes. So I think that makes sense. Cash received on the issuance of new loans? No, we didn't have that. What about this convertible bond, right? It went from 90 to 30, so it went down by 60. Did we pay that off? And it says, during the year, holders of convertible bonds converted into common shares. Shares were recorded at the carrying value of the bonds converted. The bond had been issued at par. So this looks to me to be a non-cash financing activity, right? We converted from long-term debt to equity, but cash didn't change hands. There's just a conversion causing us to go from 90 to 30. That's how I would read that. And that means it doesn't land on the balance sheet, although it will be noted as a non-cash financing activity. Okay. So what then happened with our common shares? We have way more common shares, but I have to say, okay, we went from 230 to 315, right? 230 is our beginning. 315 is our ending for common shares. Now, 60,000 of that is the convertible bond, right? 60,000 new shares comes from the convertible bond, and that was non-cash. But how did I get, so that's how I got from 230 to 290, 60 grand shares converted. How do I get from 290 to 315? Well, 25K more must have been issued during the year, and it notes common shares were also issued for cash on top of the conversion, and it's $25,000 worth of common shares that got issued. Last one, the dividend. All right, let's figure out the dividend. So we do this little retained earnings dance we've been doing. Retained earnings beginning plus net income, subtotal, minus divs equals ending retained earnings. Retained earnings beginning, 537, plus net income, 170, subtotal. What is that? 707. Minus dividends, we don't know dividends, but we know our ending retained earnings is 568. So 707 minus X equals 568. Can't do that math in my head. Let's see. I'm going to try 139. How'd I do? Let's see. I think I'm right. We'll see. I've been getting these wrong a lot lately. 707 minus 568. 139. All right. Let's go. Okay, so that's our dividend declared. Is that our dividend paid? Of course not. Dividends payable went up, meaning we didn't pay the whole thing. So I'm going to subtract the increase in dividends payable. Had it been a decrease, I would add it, but I subtract that increase. 139 minus 3 is 136. Cash paid for dividends, 136, and that's it. So 40 negative plus 25 minus 136. I get 151, and it's negative, and that's my cash paid for, or cash outflow from financing activities. Okay, so 318 for operating, negative 105 for investing, and negative 151 for financing means my increase in cash and cash equivalents was $62K. Now, did my cash and cash equivalents actually go up by $62K? They did. They went from 63 to 125. That's plus 62. And again, we're lumping cash and those short-term investments together for this purpose. So cash balance and cash equivalents beginning of year was 63. End of year, 125. And there we have it. Let's move over now. So that's the indirect method done. Let's move over to the direct method, and it's always the same 6 numbers we're after. Let me hide this. Starting with cash collections from customers. Sales plus decrease in AR plus increase in unearned revenues. Thankfully, no unearned revenues. So sales plus decrease in AR. Sales were $1,386. Decrease in AR was, it did decrease by, what was that again? 38,000? Is that right? Yeah, 38K. You'd be surprised how many videos I get to like this point and I make a mistake and I have to like re-record the whole thing. It's a nightmare. 1386. And it's like something like this where it's like, I miscalculate 1386 plus 38. 1424 is our number. COGS. Oops. Cost of goods, 688, plus increase in inventory. Inventory decreased, so it's going to be minus this number, minus 47, plus decrease in AP. AP did decrease by 13. 688 minus 47 plus 13. Once again, need the calculator. 688 minus 47 plus 13, 654. Cash paid for salaries, salaries expense, plus decrease in salaries payable. Salaries expense is 311 just from note 1. Decrease in salaries payable, it increased. So I'm going to minus 5 there, minus 5K. 311 minus 5 is 306. Cash paid for other operating expenses. Other operating expenses were 84. We calculated that again in note 1, but we had to do some work to get there. Increase in prepaid insurance. Prepaid insurance did not increase, it decreased. Minus 4. So we land on 80K there. Next, cash paid for interest. Interest expense, 17. Thankfully, no discount or premium amortization. There's no discount or premium on the bond. Plus decrease in interest payable. What did interest payable do? It increased. So minus 2 is 15. Last one. Income tax expense plus deferred tax benefit. Now, you just have to remember, we did have a deferred tax benefit. Our deferred tax liability went down by 5. So I'm going to plus 5 here. Our income tax expense was 49. 49 plus 5 plus decrease in taxes payable. Taxes payable increase, so minus 3. Is that right? Taxes payable, yeah, 8 to 11, so minus 3. So we end up at 51K for that one. Okay, so I have 6 items, 1, 2, 3, 4, 5, 6, and I have 6 slots to fill in on my template. Let's fill them in. 1424 for my cash collections from customers, 654 negative, cash paid to suppliers for merch, 306 negative, cash paid to employees for salaries, 80K is my cash paid for operating expenses, 15K cash paid for interest, and 51K cash paid for taxes. This is where we add them up, and we hope we get 318. 318 is the number we're shooting for. Let's see if we get there. 1424 minus 654 minus 306 minus 80
minus 15 minus 51. We end up at 318. The birds are singing, the sun is shining. It looks to me like our cash flow statement is working. One thing left to do, and it just says, hey, you're going to have to make a note about any non-cash investing and financing activities. And the note there is pretty simple. You just say, during the year, and it's the conversion, right? The company converted $60,000 of convertible bonds into common shares. And maybe the company is the wrong operator here. During the year, maybe, I'm just like linguistically, during the year, $60,000 of convertible bonds were converted, because the company didn't do the converting, right? It was the bondholder, were converted into common shares. Just thinking out loud. I'm speaking this one as we go. That to me is enough. Now, again, there's sometimes another sentence here that says, I'm going to read it. This transaction did not involve cash and therefore is excluded from the statement of cash flows and disclosed here. I think I wouldn't require that of my students, but this would be what I would require them to say in the note. Maybe that extra line I wouldn't need though. Okay, so we've made it to the end. 21.5b is in the books. Thanks for watching, and I'll see you in the next video. Bye for now. Welcome to Module 22, the last module of our Intermediate Accounting 2 course. Holy mackerel, you've made it. I like this module. Changes and corrections. So company wants to change an accounting policy. They want to change an accounting estimate. How do we do it? We're going to learn that this chapter. And also, company screws something up. They make an error. How do we correct our errors? And it's particularly tricky when it was an error from a couple of years ago. So we're going to learn how to do that this module. Let's discuss the types of changes we should expect to see this chapter. The first is a change in estimate. You bought a car. You said it's going to be useful for 10 years. You've driven it a couple of years ago. This is not going to make it 10 years. It's only going to make it 6 years. How do you do that in accounting terms? It was a $100,000 asset divided by 10. It was $10,000 a year. You've depreciated a couple of years. What do you do now? Well, with a change in estimate like that, you change it prospectively. You say, where are we today? Okay, it's only 6 years from now, or whatever number it is. You sort of take it up to today and go, the past is the past. We made our best guess. We were wrong. Going forward, we're going to do it this way, and it's called a prospective change. So changes in estimate are done prospectively, and those are easier than the alternatives, which are, well, for changes in principle, US GAAP calls it principle, Canadian GAAP IFRS calls it a change in policy. Those are done retrospectively, and let me give you an example. So let's say it was my policy to use FIFO, first in, first out, for inventory, and I switched to weighted average. That's a choice I'm making. Now, that's not an estimate, right? Those numbers are calculated and true numbers, but they just produce different results. If I want to voluntarily change my policy, I would say, I think actually this inventory is better tracked by weighted average than by FIFO. I want to switch from FIFO to weighted average. I have to do it retrospectively, which means I adjust my previous records. I adjust my opening retained earning balance. And it's a more major undertaking than just saying prospectively, from now on, we're going to do it this way. Retrospectively means I got to go back in time and track my inventory records as if I had been doing weighted average all along, or whatever the principle or policy change was. And you'll see as we do it this chapter, it's harder. Those are the big two. The third one is a US GAAP only concept, and it's unusual, even in the US GAAP context. It's a very unusual situation. It's called a change in reporting entity, and it says
we have an investment in another company. We've been reporting it one way and we're switching to consolidation now. If that's the case, we do it retrospectively. But the reason it's a little weird is it's not like, hey, we bought a bunch more shares in the company and we're going from equity method to consolidation method, which is very normal. You would do that prospectively. It's something else. It's like there's a group of companies, and within that group of companies, we're changing the reporting of two of the, subsidiary companies to be consolidated with each other. It's a little bit more convoluted. Most chapters don't actually do anything with this other than to tell you it exists. So I'm telling you it exists. We tackle it a little bit in the first problem of the chapter, but very little. It just means we're switching to consolidation under weird circumstances, and when we do it retrospectively. Again, US GAAP concept only. But those are the three types of changes, and I think what you're going to find is the retrospective changes are the tougher ones. The prospective changes, pretty straightforward. So that's the first half of the chapter. The second half of the chapter, as the name suggests, corrections. And what would you want to correct? Errors. Now, correcting errors is actually trivially easy. If you figure out what the error is, you just fix it. You reverse the bad journal entry, you make the right journal entry, you're done. What makes it hard this chapter is it's not the errors that happened this year that we're particularly worried about. You just fix the bad journal entry. It's the errors from last year or the year before or the year before that, where we've already done everything. We've issued our financial statements. We've closed the books on that year. And I got to go back and fix something back then. That's a little bit trickier. And you'll find we use the retained earnings account a lot. There's some expense that was overstated or understated in the past, and you go, well, I can't fix the expense because that expense is closed from several years ago. I can't fix a 3 years ago expense. But what would happen is the expense would flow through to the balance sheet through retained earnings, and what I have to do is fix my retained earnings. Now, this chapter, we're going to learn two types of prior period errors we're going to come across. The first, probably the more common, is a counterbalancing error. And a counterbalancing error is one that fixes itself the next year. And you might think, oh, that's good. It fixes itself. I don't have to do anything. No, it means there's two errors. There's one error last year, and then this year, when it fixes itself, it throws this year's numbers off. So we still have to do some fixing. An example here might be, I forgot to accrue the salary expense, right? So last year, I didn't accrue the salary expense, debit salary expense, credit salaries payable. And so this year, when I pay the first salary, I debit salary expense, credit cash, but in reality, I should have debited salaries payable because, it was last year's salary. So I screwed up last year's salary expense by not having enough, and I screwed up this year's salary expense by having too much because the first pay period involved some of last year's salary. And so the double screw up works against each other and ends up a year from now, it's totally fine. But it's not fine in the here and now, and we're going to learn how to correct those types of prior period errors, the ones that work themselves out. Non-counterbalancing errors are ones that don't work out from one year to the next. An example would be I called something a repair expense, but I should have called it an asset. It changed the life of the asset, determining whether it was a capital expenditure or not. I called it a repair, but it was actually I should have debited the asset. Well, if that's the case, the asset maybe lives for 10 years, this error is going to be working itself out over the next 10 years. It doesn't just flip the next year. So that's a non-counterbalancing error. Now, both counterbalancing and non-counterbalancing errors are fixed retrospectively. So it means we have to go back in time, go back through our old records and put the records in place as if we had never made the mistake. Similar to if we switch from FIFO to weighted average, I have to go back in my old records and say, well, what would these old records look like had I been doing weighted average all along? Fixing errors is, what would my last year's financial statements look like had I not made the mistake? And so we'll learn how to deal with that. And as I suggested, retained earnings is a regularly debited and credited account this chapter. As I always say, the best way to learn anything is to work through practice problems. And I've got tons of them. I can't wait to get started, and I'll see you in the next video. Bye for now.
In this video, we'll tackle problem 22.1a. Before we jump into it, I want to remind you to download the workbook from my website, tonybell.com. You just click the PDF link. There's no sign in, no sign up, nothing like that. Scroll down, find the problem, and get to work with me. Let's jump into the problem. Let's jump into problem 22.1a. We're here, the final chapter of our intermediate financial accounting course. And we're looking at classifying changes and errors, accounting changes and accounting errors, and how to deal with them. And this problem just says, is this a change? If so, what type of change is it? Is it an error or is it something else? So it gives us various situations. And then, regardless, how do we treat it? Like, what do we do about this situation? So let's read through it and see how to deal with it. Penticton Distributors is preparing its December 31st financial statements. A newly hired controller has flagged the following 10 independent items encountered during the year-end close. So there's 10 items we got to look at. One bonus US only one. It says for each independent item above, classify it as being a change in accounting principle. That's a US GAAP term. Under Canadian GAAP IFRS, we call it change in accounting policy, but they're exactly the same thing, just different language. Is it a change in estimate? Is it a prior period error that needs correcting? Or is it something else? Or is it nothing at all? Non-issue would sort of class it under other. Part B says, okay, well, you've identified it. Now what to do about it? Do you make a prospective change? That just means change it from now on. Do you make a retrospective change? Do you go back and fix that old error and go back and fix the old statements and any knock-on effects coming forward? Or is it just like, if it was other and it was a complete non-issue, you just count for it like something normal. So that's what current basically means. Okay, let's get into it. Let's go through these and we'll classify the type and the treatment of each one. Effective January 1st, 2031, Penticton changed its inventory cost formula from weighted average to FIFO, concluding FIFO better reflects the flow of the goods. Okay, so they've changed an accounting policy, an accounting principle around inventory methods. Is a very common example of a principle/policy change. Right, it's not an error here, and what was our other option? It's not a change in estimate. It's just a change in how we're going to treat this, and it's our policy or our principle around inventory. So any principle policy change, your default position, unless there's some specific thing in the question, your default position should be retrospective. And that's the reason that companies don't often change these principles and policies, because retrospective adjustments can be difficult, much more difficult than prospective. Equipment purchased in January 2027 was being depreciated over a 10-year life. Based on usage experience in 2031, they said, oh, actually, it shouldn't have done 10 years. We should do 7. Well, remember, the 10 years was an estimate. The 7 years is an estimate. We're changing our estimate. Change in estimate. I'm just going to put EST for change in estimate. Changes in estimates are changed prospectively. And that just means we change it going forward. We'll do examples of both of these in this chapter. During 2031, Penticton discovered that the December 31st, 2029 physical inventory count double counted goods in one of the warehouses, overstating the ending inventory for 2029 by $240,000. This is an error, right? We made a mistake. There's an error in the old statement. If there's an error in the old statement, you got to go back and fix it. Retrospective, I should say, fix. Effective January 1st, 2031, Penticton changed depreciation on its delivery fleet from the declining balance method to straight line, reflecting a change in the expected pattern in which the fleet's benefits are consumed. This one's a little bit quirky. It boils down to it's a change because depreciation is an estimate. So we are changing our estimate. Yes, we're changing how we estimate it. There might be an accounting policy change underneath it all, but it's an estimate. A change in estimate, I should say, and it's to be applied prospectively. U.S. GAAP, there's often, if you are in a U.S. environment here, it'll often call this a change in estimate driven by a change in principle. But know that the change in estimate is the overriding thing. That's why it's done prospectively. During 2031, Penticton began selling a 3-year extended warranty contracts for the first time and adopted a policy of recognizing the revenue over the coverage period. Okay, it's a new policy for us, but the answer isn't policy principle. It's just the normal accounting thing, right? You can have new things happen all the time at a company. There's no special change. You just go, oh, okay, I'm going to start accounting for that and follow GAAP when I do it. So the answer here is other. It's none of those changes or errors. And it's just like current accounting. You just like account for it properly and you're done. It's not a change or an error. In years prior to 2031, Penticton incorrectly recognized, okay, I think I know where we're headed here, incorrectly recognized revenue from a category of customer arrangements when cash was received. During 2031, it began recognizing this revenue as the related performance obligations are satisfied. Okay, so they recognize revenue on a cash basis, apparently, well, it says incorrectly, so apparently violating GAAP, and now they're recognizing it as it's earned, as the performance obligations are satisfied. Well, we got to go back and fix the old stuff. This is going to require a retrospective fix because it is an error. We were incorrectly handling it before. Based on deteriorating collection experience, they increased the rate of estimated uncollectible accounts, their bad debt expense, from 2 to 3% of sales. This is a change in estimate, right? We're estimating future collections, change in estimates, and change in estimates are done prospectively. Penticton's adopted a new accounting standard effective January 1st, 2030. Now, this is important. It's not a new policy that we're choosing to adopt. It's a new rule, right? New GAAP. Like there's new rules that come in and they tell you when they make a new rule, they tell you what to do. Is this prospective, retrospective? How do I bring it in? So let's read on. The standards transitional provisions require retrospective application. So it could have just as easily said prospective there. So this is a new principle / policy. So it is a change in principle policy because there's a new rule. Again, principle, US GAAP terminology, policy, IFRS, and Canadian GAAP. And new principles / policies typically are done retrospectively. This could be the exception. If this literally just said prospective, we would do it prospective. Whatever the standard setter says, that's what you do. And they will tell you when they make a new rule, do this prospectively, do this retrospectively. During 2031, Penticton discovered a $180,000 machine purchase in January 2030 was expensed. Okay, so it should have been capitalized. It was expensed. This is an error. And errors are fixed retrospectively. Last one, and this is a US GAAP concept. So when they talk about, well, let's read it. Through 2030, Penticton presented non-consolidated financial statements. Beginning with 2031, it does consolidated statements. So when they talk about a change from non-consolidated to consolidated in the US GAAP context, this is a change. So we'll call it other. It doesn't fit any of the first three. We call it change in reporting entity. I think it's sufficiently unusual that you'll get introduced to the concept and you won't see many examples of it in your textbook. At least I haven't seen it in the US textbooks I've read. They just sort of want to make you aware that it exists and to be on alert for it when a non-consolidated company starts consolidating. It's to be done retrospectively, and it's actually more complicated than I've made it sound here. So just know that when you're in this context of like accounting changes and error corrections, there's this other category called change in reporting entity, and it's basically when you read something going from non-consolidated to consolidated, you should be on alert for it. It is retrospectively applied. One other thing to be on alert for, your like and subscribe button. Thank you for watching. We got to the end of the problem, and I'll see you in the next one. Bye for now. Let's jump into problem 22.2a. We're accounting for a change in estimate. There's a depreciation change in this problem. So with the change in estimate, just in the back of your mind, you should be saying, oh, change in estimate, those are done prospectively. I don't need to retrospectively adjust prior financial statements. I make an adjustment going forward. And these are the easier types of adjustments to make.
Summerland Orchards operates a fruit picking facility on January 1st, 2027. Summerland purchased automated sorting line, so a piece of equipment for $840,000, signing a 10-year life and $40,000 residual value. So always, like, every accountant should be doing this, going, oh, it's $840 cost, the residual value is $40, so its depreciable cost is $800,000. We're doing this over 10 years, so our depreciation rate, because it is straight line, is $80,000 per year. Quick cough. At the beginning of 2031, after 4 full years of use, management concluded that a rigorous maintenance program and slower than expected technological obsolescence justify revising the sorting line's total useful life, this is important, total useful life, to 14 years. So that's not 14 years from now, it's 4 years later. It's saying we've used it for 4 years. We're going to get 10 more years out of it from now. And that phrasing is really tricky, and you'll see it phrased different ways in different questions. So this one says, revising the sorting line's total useful life to 14 years from the date of purchase, right? The total useful life is 14 years from the date of purchase, not from today. Management also reduced the estimated residual value to $30,000, reflecting the equipment's age at the end of the longer service period. So we're going to be able to sell this or salvage from it $30,000 at the end of its life. We used to think 40. Okay. It asks us to calculate the depreciation expense. How do we do this? Well, you have to say, where is the asset now? Like, what is it sitting at on our books? So its cost, and when is now? Now is the beginning of 2031 when we make the change. So on January 1st, 2031, we showed a cost on this asset of $840,000, just what we paid for it. Our, not residual value, our accumulated depreciation so far was how much? Well, we had 4 years worth of depreciation. We bought it in January 2027. So 2027, 2028, 2029, and 2030, bringing us to 2031. Its 4 years have elapsed at $80,000 per year. That's $320,000 is 4 times 80. So 840 minus 320 means we show a net book value. We show an asset on our books worth $520. And now, because it's prospective, we go, we're not going to fix those old, the fact that our estimate was off. We're just going to say that happened. Going forward, what do we think is going to happen with this asset? Well, we just go, okay, well, I have a $520,000 asset. Its residual value is $30,000. Estimated residual value changed to 30, so its depreciable cost is $490. And how many years do I have from now? Well, it was a 14 years from the date of purchase. It's 10 years from now, right? We're 4 years in. So you just got to be careful with your reading of how many years and from the date or whatever. It's 10 years from now. The fact that it's 10-year useful life initially and it's 10 years from now is just a strange coincidence. Don't think much of that. Those numbers, I wouldn't expect this number to match this number very often. It did here. 490 divided by 10, $49,000 per year in depreciation expense. So debit, depreciation expense, credit, accumulated depreciation for $49,000. That'll be our year-end adjusting entry on December 31st, 2031. I think I've fully answered the question. It said calculate depreciation expense, $49,000. Prepare the December 31st, 2031 entry, debit depreciation expense, credit AD, $49,000. Determine the carrying amount of the sorting line. Okay, well, at the start of the year, the line is being carried at $520. Well, what about at the end of the year, December 31st, 2031? Cost of the asset remains the same. The accumulated depreciation was $320. We added $49,000 in depreciation, so we're at $369. $840 minus $369 says, well, at the end of this year, it's being carried at $471,000 after adjustments. Next, it says explain why the depreciation recorded for 2027 through 2030 is not adjusted. Okay, why don't we do an adjustment to fix the past years? And the answer is this is based on an estimate. And so we have estimates all over accounting, and our estimates are always going to be wrong. If we had to go back and adjust every estimate that turned out to be wrong, that's all we would do. So there's sort of an acknowledgement from the accounting standard setters that say this is normal. Financial statement users understand when we estimate the life of an asset, we go, this asset's going to last me 17 years. You know, it's never going to last exactly 17 years. So you change your estimates frequently enough that you just go, these types of changes are very normal in accounting and they can be done going forward. It's not like an error where you got to fix a mistake. It's just a wrong estimate, which is very normal. How is this reflected in the financial statements? Well, obviously our depreciation expense will be different. Our accumulated depreciation will be different as a result of this. And there will be some note regarding the change in life, right? We will disclose that likely in our capital assets note where we discuss our depreciation. We'll say we changed the life and give some justification for it. Last one, calculate the effect of the revision on the income before tax compared with the amount that would have been reported under the original estimate. So originally we said, original depreciation expense for this year would have been $80K if we stuck with the original numbers. Our revised depreciation expense is $49K, so the difference here is $31K. What does that $31K mean? Well, our income before tax is going to be $31K higher because our expenses are $31K lower. So again, exp is $31K lower, income before tax is $31K higher. There you go. That would be my answer to part D. That would be my answer to 22-2A. And if you make it to the end, I hope your answer is to hit that thumb. Thanks for watching. See you in the next one. Bye for now. Let's jump into problem 22-3A. We're changing depreciation methods. Let's jump into it. I got a lot of thoughts on this one. Merit Rocks operates a rock crushing plant. The primary crusher was purchased on January 1st, 2028 for $760,000. It's got a 10-year useful life and a $60,000 residual value. It's been depreciated on a straight line basis. Okay, so first, just like little calculation you should be doing at the start when you read facts like this. You go 760 is our cost, 60 is our residual value, therefore our depreciable cost is 700. We're doing it over 10 years straight line, so that's 70K per year. Pretty straightforward. Early in 2031, after winning a multi-year highways contract, Merit concluded that the wear and tear on the crusher is driven by throughput rather than the passage of time. Effective January 1st, 2031, the company changed to the units of production method. Management estimates the crusher's remaining productive capacity, so not overall, but remaining productive capacity, is 2 million tons. So we're going to get a cost not per year, but per ton. And there's a revised residual value. It's $50,000. During 2031, it crushed 380,000 tons. Okay, so let's read the question. It says, state how the change would be classified and how to apply it with a one-sentence justification. Okay, when you change depreciation method, yes, you are changing an accounting policy or accounting principle, but it is driving a change in estimates. Remember, depreciation ultimately is an estimate, so we're changing an estimate calculation here. A change in estimate is changed prospectively. It's changed going forward. And why is it changed going forward? Well, when we bought the machine and depreciated straight line, we estimated our depreciation with the best information we had at the time. A few years later, we got better information and changed our estimate. So that's why it's changed prospectively. Okay, that was maybe more than a one-sentence justification, but there you go. Calculate depreciation rate per ton, depreciation expense for 2031, and prepare the 2031 adjusting entry. This is kind of interesting. The question says do 2031. In order to do 2031, we got to depreciate for 2028, 2029, and 2030 to get us to 2031. So we got to do 3 years worth of depreciation. Good news is it's straight line. It's pretty easy. It's 70K in 2028.
2029, and 2030 to bring us up to 2031. So it's straight line. So it's just 70K a year. And that means we've had 210K of depreciation so far. So where is our asset sitting? Our assets cost was 760. Our accumulated depreciation, this is as of January 1st, 2031, the big change, right? So that this has brought us up to January 1st, 2031. Our accumulated depreciation is 210 up to that point, and 760 minus 210 means we have equipment net book value of our rock crusher or whatever, 550, and that is our net book value of our piece of equipment. So on the day we make the change, we go, okay, I have this asset worth 550. What's the residual value and the expected life from now? Well, it's 550. The residual value is 50. So our depreciable cost, therefore, is 500. Now, we're not going to divide by a number of years because we're using units of production. We're going to divide by a number of tons, which is 2 million tons. Okay, so $500,000 divided by 2 million tons means the revised rate is 25 cents per ton. And so that's how we depreciate the thing. So then we go, okay, well, how many tons did we process? And we processed 380,000 tons. 25 cents times 380,000 tons means our depreciation expense this year is $95,000. And again, the math there was 380,000 tons times 0.25. That's how we got to our $95,000 depreciation expense. And that's how we answer this piece. Our depreciation expense, $95,000 on December 31st, 2031. Debit. Depreciation expense. Credit accumulated depreciation for $95K. And we've answered B. C says, what's the carrying amount of the crusher? Okay, well, the crusher was on the books on January 1st for $550. On December 31st, our cost is still $760, but we just credited AD by 210. Not by 210, but by 95. So what is it? $305. So 760, hopefully my math is right. Yeah, I think it is. Minus 305, it's 455. So that is our carrying amount. Last, calculate the effect of the revision on 2031 income before tax, comparing with continuing under straight line using the original estimates. Okay, so if we kept going straight line, we would have been at 70K a year, so it would have been 70K for 2031, and units of production says no, it's 95K, our depreciation expense. So the difference between the two is 25K, right? Depreciation expense is 25K higher under units of production, and if depreciation expense is 25K higher under units of production, income before taxes will be 25K lower. So that's the answer. Income before tax is 25K lower due to the change, right? Because we changed from straight line to units of production, that was the result. And there you go. Hopefully this was a good video. Due to that, I hope you'll hit me with a thumb or a sub. Thanks for watching. See you in the next one. Bye-bye. Let's jump into problem 22.5a, change in inventory method. We're going from weighted average to FIFO, and when a company changes their inventory method, this will typically be considered a change in accounting policy / a change in accounting principle. And when we make a change in policy or principle, that means it's going to be done retrospectively, and that means it's a minor pain in the rear end for us accounting students or for us accountants. So let's jump into the problem and see what we're up against. Caramia's Produce, a fruit and vegetable wholesaler, began operations January 1st, 2029. It's used weighted average cost formula since inception. Effective January 1st, 2031, so a couple of years in, they changed to FIFO. They conclude that FIFO better reflects the physical flow of perishable goods and provides more relevant information. Karamis presents one comparative year in his financial statements, and income taxes are to be ignored. And it gives us ending inventory had they been doing FIFO, that's here, and weighted average what they were doing, and they're switching to FIFO. So the first thing I like to do is sort of think, like, how would this change matter, right? They're going from here to here. Well, what does that mean for our ending inventory? And for 2029, our ending inventory is going up by 40K. Well, if inventory goes up 40K, COGS must have decreased 40K as a result of this change. And if COGS decreases, net income, COGS is an expense, net income goes up 40K. So that's sort of how I look at those changes. Now, here's where it gets weird. When you have multiple years, you don't sort of look at them in a vacuum. I don't say, okay, well, this one, the difference is, what is that, 75K? Yeah, 75K different. I don't get to say, well, it's ending inventory 75K higher. I'll put it in, but this is wrong. Don't write this. Up 75, and obviously COGS down 75, and net income up 75, because I know I've got to fix it. And if I go all the way back to the beginning and I fix this year, right, I fix 40K of this 75, well, that means to go, it's already up 40, it's got to go up 35 more, right, to get to a total of 75. So you kind of have to be careful how you accumulate these changes. But that's how I think of it anyway. Our COGS, if we're fixing it, is going to go down by 35K that year. And our net income is going to go up by 35K that year. And you can see that is 75K overall across the board. Okay, so that's sort of one of the quirky things here that you just have to wrap your head around. Let's continue. Net income previously was reported as 520 for 2029 and 610 for 2030. And that was under weighted average, but we're switching to FIFO. Under FIFO in 2031, net income is 700 grand. And then it gives us dividends for all 3 years, 2029, 2030, and 2031, which will be relevant for us calculating retained earnings much later. Okay, first, state how this change would be classified and how it's applied. So this is a change in principle. That's for my U.S. students, and for my Canadian students, we call it a change in policy. And IFRSers will call this a change in policy. How is it applied? Retrospectively. Okay, calculate the effect of the change on net income for 2029 and 2030 and the restated net income for each year. So we got 2030 and we got 2029. We've got original net income. We got the change, and we got the adjusted net income. So let's do 2029 first. 2029, the original net income is 520K. Oops. 520. How does it change? Well, it changes by increasing by 40K if I make this change. So plus 40K gives me 560 as my adjusted amount. 2030, my original net income, 610. I said it's got to change in 2030 by 35K. Bringing me up to 645. That's it for B. On to C. It says, determine the cumulative effect of the change on opening retained earnings at January 1st, 2030 and January 1st, 2031. Okay, so if 2029, my net income goes up by 40 grand, what does that do to my January 1st, 2030 retained earnings? Up by 40 grand. So my opening retained earnings up 40 grand. And for, now it says cumulative effect. So cumulatively, my January 1st, 2031 it'll be up 35 grand that year, but overall it's up 75 grand. So that's what the cumulative effect was meant to hint you at, or hint at, I suppose. Okay, next, D, prepare the journal entry. Journal entry is pretty straightforward. our inventory's got to go up 75K. So I'm going to debit inventory, debit 75K. And the credit here is to retained earnings, right? Our opening retained earnings has got to go up 75K. Our opening inventory goes up 75K. This COGS net income all winds its way into retained earnings. And there you go, retained earnings credit to make it go up by 75K, and that's January 1st, 2031. There's our entry. The last piece, I think by far the most difficult, is tell me what's going on with retained earnings and actually make a statement of retained earnings. So it says, prepare a comparative statement of retained earnings for the year ended December 31st, 2031 with 2030 comparatives using as previously reported, as restated presentation. I'll show you what that means when we get into it. So let's do it. It's a 3-line title, Carameus Produce. We're preparing a statement of retained earnings. And this is for the year ended December 31st, and then we're doing a comparative 2031 and 2030. So it's as previously reported, as restated for the opening balance. So how do we do the opening balance? We say retained earnings, January 1st, as previously reported. Then we're going to say, how do we adjust that as previously reported statement, or as previously reported retained earnings, adjustment due to inventory policy change. Basically saying we changed from weighted average to FIFO, so we've adjusted. And then retained earnings January 1st as restated. So just a disclosure thing, right? We're telling people, here was our, on previous financial statements, this is what we showed retained earnings as. Here's the adjustment we made, and here's where we sit. Quick cough. Okay. So let's do 2030. I think I've maybe over-talked this one. January 1st, retained earnings as previously reported is not given. And so we actually have to figure it out. That's what makes this a harder problem, is you actually have to puzzle your way through it a bit. So what would be our retained earnings January 1st, 2030? And the answer is, well, we open 2029 with a new company. So it starts at 0, add net income, deduct dividends for 2030. So, and again, there's no adjustments. So just add net income, deduct dividends. For 2029, rather. So net income for 2029 was 520, and dividends for 2029 was 100. So 520 minus 100 means our opening balance for 2030. It opened 29 at 0, add net income, deduct dividends, plus 520 minus 100 is 420. So we opened 2030 at 420. Let's do the same thing for 2031. Again, assuming that we were doing it the old way. Well, we started 2030 at 420. We're going to add net income, which is 610. We're going to deduct 2030's dividends, which is 120. And we get 910 as our opening, as previously reported, 2031 opening retained earnings. We'll talk about that more in a minute. Let's do 2030. The adjustment to opening retained earnings is, and the good news is we've solved this already, right here. The adjustment to January 1st, 2030 retained earnings is plus 40K. So let's use that number, plus 40K. So our new opening retained earnings is 460 after having made that adjustment. From here, it's a very normal statement of retained earnings. We're going to add net income, subtotal, and deduct dividends to get our retained earnings December 31st. Okay, so let's add net income. Now for 2030, we're going to add our adjusted net income here of $645. 460 plus 645, 1105. What's our dividend here? The amount of the dividend in 2030 was, where are you? I've circled too much. Let me erase all my highlighting and circling. For 2030, it was right here. It was 120 grand. So 1105 minus 120 gives us our ending retained earnings, $985,000. And there we have our 2030 in the books. On to 2031. We start with our opening retained earnings as previously reported. So we have to just build that up from zero, right? We start with our year zero, add net income minus dividends. We get a 420 is what we got. Then we start here with 420. We ignore all this stuff, right? We're just going to ignore this stuff. And we go, well, what was our old net income and our old dividends? Dividends didn't change. We add net income, deduct dividends. We get to 910. And now we go from here. So our adjustment to opening retained earnings, we solved in part C. We said our adjustment to opening retained earnings, $75,000. So I'm going to add 75K. We'll see a deduction in part B of this. 910 plus 75 is, and we can certainly very easily have a deduction due to an inventory policy change. Add net income, and the net income for 2030. Oh, one other note. These match, right? And they have to match. So anyway, add net income. Our net income for 2031, no adjustment needed because now we're on the new policy and we're doing it appropriate on the new policy under FIFO, 700K. So add 700. 985 plus 700 is 1685. We're going to deduct dividends, and our amount of our dividends were 150. 1685 minus 150 gives us a closing balance of 1535. And there we have it. We have successfully completed 22.5A. One thing left to do, hit one of those buttons. Thanks for watching. See you in the next one. Bye for now. Let's jump into problem 22.6A. We are looking at a change in inventory methods. We're going from weighted average to FIFO. And as you know, when we go from weighted average to FIFO, that's a change in accounting principle. Well, U.S. GAAP terminology, IFRS and Canadian GAAP, we call it a change in accounting policy. Either way, we treat it retrospectively, and to make matters tougher on us, we're going to deal with taxes here too. Osoyoos Vineyards, a wine producer and distributor, began operations on January 1st, 2029, and has used weighted average since inception. Effective January 1st, 2031, Osoyoos changed to FIFO. Concluding FIFO provides more relevant information for its financial statement users. Osoyoos presents one comparative year in its financial statements. Okay, so we're switching from weighted average to FIFO. Again, a change in accounting principle and therefore retrospective change. For tax purposes, Osoyoos has always used and will continue to use weighted average. What does this mean? Well, taxes are just going to follow weighted average. Our books are going to be FIFO, and that's a good old-fashioned temporary difference. Think back to your tax chapter. When we have temporary differences, it creates deferred tax assets and deferred tax liabilities. What do we have here? A deferred tax asset or a deferred tax liability? Time will tell, but we will have one of those things. The change does not affect the tax basis for inventory or the amounts payable to tax authorities. Of course not, because we've stuck with the same method all along. The tax rate's 25%. Okay, so when I see a table like this, I just want to know what the change is from one method to the other and, what its impacts will be. So let's look at the change here. If we go from weighted average to FIFO, which is what we are proposing to do, the change in inventory balance in 2029, it's going to be an increase of 30K, right? Our inventory is going up 30K. If our inventory goes up 30K. Our COGS, I like up arrows and down arrows more than pluses and minuses. Our COGS is going down 30K. Again, we have 30 grand more in inventory. It didn't change our purchases, so it's got to change your cost of goods sold. Okay, if COGS goes down 30K, pre-tax profit, our pre-tax net income, our income before tax is going up by 30. If our income before tax goes up by 30, well, our taxes are also going up now. We're dealing with taxes. 30K times 25%, 7.5K is our increase in taxes. Okay, so before taxes, our profits were up 30 grand, but caused our tax bill to go up 7,500. 30 minus 7,500 is 22.5. That's the increase in my net income. My net income's going up 22,500. My arrows are ugly, but hopefully you're following along. On to the 2030 change. 2030, our inventory balance is going up by 48K. Now, it's not going up by 48K all at once, right? If we sort of made the change in 2029, we said, oh, we got to adjust our inventory up by 30K. Well, then there's only 18K left to go up, right? This is the difference, 48 minus 30. So there's 18K that it still needs to go up. So our total is 48K. If that's the case, COGS is going down by 18K. Again, 48K in total. Pre-tax profit up by 18K. 48K in total. And now taxes are going up, of course, 18 times 0.25. Taxes are going up by 4,500. Overall, taxes are going up 12K. And net income is going up 18 minus 4.5. What is that? 13.5, I think, but I better do it in the calculator. It is 13.5. Whenever I don't do it in the calculator, I get it wrong. It drives me insane. 48 minus 12 is 36K. Our net income is going to go up overall by 36K over the course of 2 years for having made this change. And again, we got to retrospectively go back and fix this, right? These changes will come into effect retrospectively. Net income, so I'm just reading on, net income previously was 360K after tax for 2029 under the old system, under weighted average. 415 for 2030, again, under weighted average. In 2031, we switched, and so it's going to be 470 under FIFO. There's dividend amounts, and it says, first, required A, state how the change is classified and how it's applied. I think we've discussed this enough. It is change in principle. US GAAP calls it change in principle. One of the few like LE ones. Of course, Canadian GAAP IFRS will call it a change in policy. It's retrospective. And why is that retrospective? Well, it's optional, right? We chose to do this, first of all. Second, it's not an estimate. These amounts are hard and solid, right? Whether you do FIFO or weighted average, it's a known amount. It's just a different choice, a different accounting choice. And so because it's a known amount, because we opted into it, it wasn't imposed on us by standard setters, and standard setters didn't say one way or the other. As a consequence, it's retrospective, right? We opted into this change in policy, change in principle. It's retrospective. Let's continue. Calculate the pre-tax and after-tax effect of the change on net income for 2029 and 30 and the restated net income. So we got to do three things. Pre-tax net income, after-tax net income, and the restated net income. Pre-tax net income, I should say change. After-tax net income change. It's asking for changes there. So for 2029 and 2030, the good news is we've basically done most of this. Our pre-tax net income change for 2029 is plus 30K, just reading this column here. Pre-tax for 2030 is plus 18K. Oops, I did the wrong row there, plus 18K. Our after-tax for 2029 is the net income one, up 22,500 and up $13,500 for 2030. So our restated net income, our net income was 360 for 2029, and we're saying no, it's got to go up by 22,500. So it's going to be 382,500. For 2030, it was 415. And we said it's got to go up by 13.5K, so it's going to be 428,500. Okay, so there is B. C, it says determine the cumulative effect of the change on retained earnings at December 1st, 2030 and 2031. Very straightforward. It just changes by the amount of the net income change. So we don't need to worry about any of this stuff over here. It's just this one column, the net income column. We just go, okay, well, the cumulative effect as of 2030, January 1st, 2030 is it's up 22.5K, right? That's the change in net income. The cumulative effect as of 2031 is the total of the 2 years. It's 36K, like 22.5 plus 13.5. It's cumulative, so 36K up. It next says, do the journal entry to record the change as at January 1st, 2031, including deferred tax effect. Okay, well, let's do the journal entry. I always start with inventory. Inventory is going up by 48K. So on January 1st, 2031, let's debit inventory by 48K. Now, what's the credit? Well, for sure, net income is 36K. So for sure that affects our retained earnings. We're going to credit retained earnings for that amount. 36,000, and you can see we're off by $12,000, and wouldn't you know it, the taxes are 12,000 increase. This is deferred taxes. Now when it's a credit, it's going to be deferred tax liability. If it were a debit, it'd be deferred tax asset. It's deferred tax liability, DTL. Why though? Like, let's sort of think this one through, puzzle this one through with me. We got our taxes over here. The weighted average is the tax amount. We got our books over here. The FIFO is our books amount. Let's just look at 1 year. This goes, our weighted average amount says our inventory amount is lower than our books amount. If your inventory amount is lower, it means your cost of goods sold was higher and your taxable income, your income before tax, was lower. So it's a temporary difference. Our income before tax on our tax records is temporarily lower, meaning in the future, it's going to have to be higher. This is going to reverse back out. That's why it's a deferred tax liability. I'm paying lower tax now. Again, our inventory number is lower now, meaning our profits are lower now on the tax side of it. I'm paying lower tax now, but I'm going to have to pay higher tax later because this is temporary difference. It's a deferred tax liability. Okay, last piece. It says prepare a comparative statement of retained earnings for the year ended December 31st, 2031 with 2030 comparatives, presenting the opening balance adjustment net of tax. Okay, so let's get going. We're going to need a 3-line title, name of our company, Osuyas Vineyards. Osuyas, a very beautiful part of the province of British Columbia. There are lots of vineyards there, a very warm place. Name of the statement we're making, statement of retained earnings. I don't drink wine. I don't drink really, so it's kind of lost on me, but my wife likes to go there. Statement of retained earnings. And this is for the year ended December 31st, 2030 and 2031. So we'll do 2031 over here and 2030 over here. So we start with our opening retained earnings before any adjustments were made. So we say retained earnings January 1st in brackets as previously reported. So to calculate the January 1st, 2030 retained earnings, we say, okay, well, what was it in 2029? 2029, it was a new company. We started at zero. It was a brand new company, began operations. So our opening retained earnings in 2029, $0. Add net income 2029. Net income 2029, 360,000. So plus 360. Dividends for 2029 are 60. So 3 plus 360 minus 60, it's $300,000. So our opening retained earnings for 2030 is $300,000. Next up, we're going to make an adjustment. And why are we adjusting? Well, because we changed our accounting principle. We changed our accounting policy for change in inventory policy or principle, whatever you choose. And what's the amount of the adjustment? Well, we did part C for this reason, right? We said, determine the cumulative effect of the change on retained earnings at January 1st, 2030. Well, it is January 1st, 2030 that we're looking at. And we've said it needs to go up by 22.5K, needs to be added 22,500. So the subtotal here is 322,500. And we're going to call this retained earnings January 1st as restated, right? And it's just restated after the adjustment. From here, very normal kind of statement of retained earnings. We're going to add net income, subtotal. We're going to deduct dividends, and we're going to get our retained earnings on December 31st. So let's go ahead and do that. So the 2030 net income, we don't take from here. We don't say, oh, it's 415. We take it from here. We take the adjusted, restated net income, 428,500. So add 428,500. Our subtotal, 322,500 plus 428,500, $751,000. Our dividends in 2030 were, 2029 was 60, 2030 is 80. So I'm going to deduct 80, and I'm going to get 671 as my ending retained earnings. This 671 needs to be the number here. Now we'll see if we actually calculate it properly. Let's see how we do. Okay, so the opening balance of retained earnings, we just need to work through. So just as we did, we said last year, we opened at 0. Our net income for year 2029 was 360 minus dividends of 60. That's why we started at 300. Well, now 2030, we start at 300, and this is what we would have previously reported. Add net income, the old net income, which was 415. Deduct the dividends, which are 80, and we start at 635. Oops, I moved something. There we go. We start at 635 here. Now, what's our adjustment? And our adjustment is right here. We said adjust up by 36K. So let's go ahead and do that. And look at that. It did indeed work. The math worked. The birds are singing. The sun is shining. Things are seemingly working. Let's add net income. Now, we don't need an adjusted net income here because we did it the right way this year. We did it the FIFO way, and it's 470 grand. 671 plus 470 is 1141. We're going to deduct our dividend from 2031. Our dividend was 95 grand. And we end at 1046,000. Dollar sign at the top, dollar sign at the bottom. And I think that's it. Is that it for the question? It is. So there is our statement of retained earnings. There's the entire question on the screen. We've finished 22.6a. As always, there's one thing left to do. Hit one of those buttons. Thanks for watching. See you in the next video. Bye for now. Let's take a look at problem 22.7a. We're talking counterbalancing errors. This is when you make a mistake, and even if you don't do anything to fix it, the mistake fixes itself.
the next year. So you forgot to accrue a salary payable. So you missed recording debit salary expense, credit salary payable. Well, that mistake works itself out when you just go and pay the salary. The timing's off, but the mistake works itself out of the system. That's what we're talking about with counterbalancing error. It's an error that happens one year, clears off the next, and so 2 years later there's not like nothing happened, but those 2 years are wrong. There's a timing error across those 2 years. That's a counterbalancing error. Enderby Hardware uses a periodic inventory system. While preparing its December 31st 2031 financial statements, Enderby discovered the following errors, all originating in 2030. So here we are, the end of 2031, and we spot a bunch of errors from last year, a year where we've closed the books, we can't go back and fix it, and we're going to be asked to fix it now. So no corrections have yet been recorded. Income taxes are ignored. So there's 3 errors, and for each error, we're asked, tell me the net income effect. What's the effect of net income? Is it overstated or understated? And, it's going to be like overstated in 2030, understated in 2031, or understated in 2030 and overstated in 2030. Like if it's over in one year, it's going to be under in the next, and vice versa. So we'll have to figure out what is the net income effect. We're going to analyze the error and say, okay, other than net income, what else was overstated or understated? And there will be things overstated and or understated. An optional but helpful step is, what journal entry should they have made in 2030? If they on December 31st, 2030 looked at this and said, oh, our books are still open, we can fix this error, what would they do to fix it? And that's going to help us with our actual error correction. And this is like the real journal entry, and this is important. So this optional step just helps me get to this one. Okay, let's jump into it. Let's do the first error. Accrued salaries of $35,000 at December 31st were not recorded. Okay, so we failed to accrue some salaries. The salaries got paid, of course, in January 2031, and the salaries and expense was recorded at that time. So what's happening here? We didn't record December 31st, 2030, some salaries to be accrued, some salaries expense. So what does that mean for net income? It means my expenses in 2030 were too low. I didn't record it, right? So I overstated net income because I understated my expenses. My expenses are too low, and therefore my profit's too high. Now in 2031, the opposite is true. I recorded that expense in 2031 because when I paid the salary, I recorded the expense, but that expense belonged to 2030. So in 2031, my expenses are too high, and therefore my profits are too low. My profits are understated. So what accounts in 2030 are overstated or understated? Well, salaries expense we didn't record, so that's understated, and salaries payable also understated. We don't need like 1 O, 1 U. We can have 2 U's, 2 O's. It's going to be 2 accounts every time, but they can both be understated, they can both be overstated, or we can have 1 of each. So there you go. Salaries expense is understated, salaries payable is understated. Okay, optional but helpful. What should we have done in 2030? If we spotted this error, if we caught it, we didn't. But if we did, what would we do? Well, pretty straightforward. We just do the journal entry. Debit salaries expense, credit salaries payable. I've forgotten the amount. It was for $35,000. And that's what we would have done on December 31st, 2030, if we had the wherewithal to catch the mistake. But we didn't have the wherewithal to catch the mistake. This didn't happen. So we're trying to fix it a year late, a day late, $1 short. How do we fix it? Well, there's already been a kind of a second error, right? In 2031, we paid the salary. So we went debit salary expense, credit cash. Had we done this properly, we would have gone debit salaries payable, credit cash, but we didn't. Okay, so how to fix it? Well, if you, in the prior year, should have debited an expense and you didn't, that closes to retained earnings. So we're going to debit retained earnings for $35K to fix this. And interestingly, remember what we said. We said in 2031, we recorded a salary expense that didn't belong in 2031. So we got to get rid of that salary expense. So we credit salary expense, $35K. And what we're going to find is this little trend in these error correction entries. Let me find my pen. I've lost my cursor. We're going to find if we debit an expense here, we're going to tend to credit it in the correcting entry. And had we credited an expense or a revenue account here, we're going to debit it in the correcting entry. So you're going to see that trend over and over again. Keep your eyes peeled for it. And let's see how we do. Let's carry on with the next. So next one, number 2. The December 31st, 2030 physical count included a block of goods twice, overstating ending inventory by $60K. The 2031 physical count has been completed and cost of goods sold has been recorded. Okay, so we overstated our ending inventory. What does that mean for net income? Well, if our ending inventory is too high, it means our cost of goods sold was too low. And if our cost of goods sold is too low, it means our expenses are too low, lower than what they should be, and it means our profits are too high. Our net income for 2030 is overstated. And what does it mean for 2031? Well, 2031, again, our inventory for 2030 was overstated. So our beginning inventory in 2031 is overstated. So when I write it down at the end of the year to the actual, my COGS is too high, my profit's going to be understated. So you got to kind of puzzle your way through these ones. These are like error corrections. You really have to know how these accounts work, but that's how it works. Let's look at the 2030 error. So which accounts are overstated, which are understated? Okay, well, clearly it said inventory was overstated. And COGS, as a consequence, is going to be understated. Now, again, think about how periodic inventory works. You count your inventory, then you adjust your inventory level down to or up to whatever that level is, and you adjust it through cost of goods sold. So if my inventory is overstated, it means I didn't adjust COGS enough, and my COGS is understated. Okay, optional but helpful. What's the journal entry that would fix this? Debit COGS because it's understated, credit inventory because it's overstated. So had I counted things right and made this adjustment, I would have debited COGS, credited inventory to fix it, right? At the very last minute, if I said, oh, my inventory actually double counted that, debit COGS, credit inventory to put it right. So how am I going to put it right in 2031? Well, I always look at what was, there's generally going to be an expense here that's off or a revenue account. I look at the income statement account that was off, and COGS is our income statement account. And I go, all right, how do I fix that? Well, I can't go back in time and debit the expense. So I have to debit retained earnings to kind of catch that expense, $60K. And my credit, just as it was before, is to COGS. I take whatever the income statement account is and I credit it here. Now let's think about why that might be in 2031. So we can sort of follow that rule and just do it, and we've done it. Why do I credit COGS here? And the answer again comes from understanding how inventory works. Our inventory was $60K too high starting the year. Right? And so when I write down my inventory at the end of the year, if it starts from a base that's $60K too high, it means when I write it down to its actual level at the end of the next year, my COGS is too high. And so my COGS in 2031 is too high. I got to credit it to make it lower. That's what's happening. Let's move on to the last one. This one's the trickiest. A 1-year insurance policy premium of $24,000 covering October 1st through September 30th, October 1st, 2030 through September 30th, 2031 was paid on October 1st, 2030 and expensed in full at payment. Okay, so immediately we should have said debit prepaid insurance, credit cash. We went debit insurance expense, credit cash. So mistakes made. No insurance entries at all have been made in 2031. Okay, so first of all, what's overstated or understated as far as net income? Well, I expense something I shouldn't have expensed, so my expenses are going to be too high. My profits, therefore, are too low. My profits, net income, is understated in 2030, overstated in 31. What accounts are in error here? Well, insurance expense is too high. and prepaid insurance is too low, right? I put something to insurance expense, it should have gone to prepaid insurance.
Okay, so our insurance expense is overstated, our prepaid insurance is understated. How would I fix it in a journal entry? Well, if prepaid insurance is understated, to put it back to normal, debit prepaid insurance. If insurance expense is overstated, to put it back to normal, credit insurance expense. Now, this is the hard part of the problem, and this is sort of the puzzle your way through it. I like it. It's like solving a puzzle. Remember, we're saying, let's pretend we were fixing it on December 31st, not fixing it when it happened. We're fixing it on December 31st. Well, how much prepaid insurance do I have on December 31st? And the answer is not $24,000. That's what makes this a little bit tricky. The amount of prepaid insurance I have is, well, some of this has expired by December 31st. October, November, December, 3 months worth of prepaid insurance. That's 25%, 3/12. So it's a 12-month policy, or $2,000 a month. It's $6,000 of insurance that's expired. So my prepaid insurance is not worth $24,000. $6,000 of it's expired. $18,000 of insurance is left. So debit prepaid insurance, credit insurance expense for whatever prepaid insurance we have left. Again, remember we had said debit insurance expense, credit cash. That was wrong. But by year end, actually $6,000 of insurance expense does exist, right? Because, 3 months has expired. So that's why we only credit our insurance expense by $18,000 rather than the full $24,000. That $6,000 of insurance expense actually is correct at the end of the year. So that one's a little weird to wrap your head around. Once you've got that, though, the final entry, pretty straightforward. We sort of follow the trend here. We look at which one of these is our income statement account. We're going to credit retained earnings for that amount, or debit retained earnings, whatever that was. So here it was a credit of insurance expense. Here we credit retained earnings for $18,000, and then we debit the expense account, right? We sort of follow the trend we've been following. So we're going to debit insurance expense for $18,000. Now, I hope it's clear why we're debiting insurance expense in 2031, and the answer is that other $18,000 of insurance, it expires in 2031, so that's the required adjustment. So there we go. That last one I get is a little trickier, but we've done it. Well done to us. We've completed 22.7a. If these videos help, I hope you'll help me with a thumb or a sub. Thanks for watching. See you in the next one. Bye for now. Let's jump into problem 22.8. A non-counterbalancing error. So this contrasts with counterbalancing errors, which are ones that reverse themselves the next year. So we make an error one year, and by the end of the next year, it has reversed back out and things are on track. We still have to do corrections. Non-counterbalancing errors are ones that don't reverse the next year. We make an error and it's with us for years to come. Creston Millwork manufactures custom cabinetry. While preparing its December 31st, 2031 financials, Creston discovered that a CNC routing system purchased and placed in service on January 4th, 2029 at a cost of $150,000 was charged to repairs and small tools expense at acquisition. So, okay, let's sort of here's what we did. And we debit, I'm just going to call it repairs expense for $150,000, credit cash for $150,000, and obviously that's a mistake. Very common mistake for us to be looking for, but here's what we ought to have done, what we should have done, which is debit, what is this? I'm going to call it equipment, CNC machine. Equipment, $150,000, credit cash, $150,000. But as a consequence, and this was, when was this? This was in 2029, January 2029. Well, today it's 2031 and we discover the error, right? Well, preparing the December 31st, 2031 statements, we figured out, oh, shoot, we called something repair expense when we should have called it capital, like 2-3 years ago. So we got to fix the error, but it's an old error. So that's what we're kind of up against. The system has a 10-year useful life, no residual value. Okay, so there's knock-on effects, right? What we should have done was debit equipment, credit cash 150, but we also should have depreciated the thing. So December 31st, 2029, we should have recorded depreciation expense. Depreciation expense, credit AD. And for how much? Well, it's 150 grand over 10 years, no residual value, it's 15 grand a year. So 15K, 15K. And we should have done that December 31st, 2030. Debit depreciation expense, credit AD, 15K, 15K. And in fact, we're going to have to do it on December 31st, 2031. Debit depreciation expense, credit AD for 15K. We haven't gotten to the required yet, but this is like floating around in the back of my mind. Here's what we did. Here's what we should have done. Oh my goodness, we're pretty far apart, aren't we? Crest and depreciate such equipment on a straight line basis. Because the system was never recorded as an asset, no depreciation has ever been recorded on it, including for 2031. The 2029 and 2030 books are closed. 2031 books remain open, meaning if I want to do a prior period adjustment, it's these items and this item that needs adjusting. This one I can just do a straightforward journal entry for because, it's still 2031. The books are still open, so I don't, not a lot of drama with that one. No corrections have yet been recorded. Income taxes can be ignored. It says prepare a correcting entry, assuming that the books are still, the 2031 books are open. 2029, 2030 books are closed. Okay, so let's go ahead and do the correcting entry. So we've got some issues. We've got to put equipment on the books for what it's on the books for. So here's the correction. So again, it's December 31st, 2031. We're going to put the equipment on the books because it's not on the books. So let's debit equipment for 150K. We're going to have to put the accumulated depreciation on the books. Now, I would just do these two. I'll do this in a separate entry. I've seen it where they combine them, but I'm going to just do the sort of books closed entry in one and then the books open entry in another. So let's put the AD on the books because we need the AD, and it's 30K of AD up to the opening of this year. Now, what of the other 120K? And the answer is retained earnings. Credit retained earnings for 120. Now, why credit retained earnings for 120? Well, we debited an expense for 150. That ends up in retained earnings as a debit to retained earnings of 150. And what we look through our other entries and we go, well, this expense would end up in retained earnings. This expense would end up in retained earnings. So 30 grand ending up in retained earnings is okay. 150 grand ending up in retained earnings is not. So 150 minus the 30 that's okay means we got to fix 120 grand worth of debits to retained earnings by crediting retained earnings. That's the fix. Now, what of this last entry? Well, we just do it. Like December 31st, 2031, we go, okay, well, we got this year's depreciation, debit depreciation expense, credit AD for 15K, and it's fixed. That is all she wrote. We have fixed the issue. Our equipment's on the books for 150K. Our AD at the end of this year is 45K. We've reversed out the effects of that mistake. We'll have to fix the retained earnings in our comparative statements if we recast them, but our books are now up to date and everything is as it should be. Now it says, state the correcting entry that would be required if the 2031 books had already been closed. So maybe we discover this in early 2032 and the books are closed on 2031. Well, everything's the same except for this piece. We're not going to debit depreciation expense. So it's also going to, well, I'll show you. So let me I'm looking for my pen here, make it purple. I'll do it here. So we basically are doing the same correction entry, December 31st, 2031. We want to put equipment on the books, debit equip for 150K. We want to put AD on the books. Now, our new AD that we want to put on the books because the year's closed is 45K. It's those three. And the balance goes to retained earnings. retained earnings for 105. And I think we're all set. And again, the reason being we debited repairs expense for 150, meaning 150 got debited to retained earnings. As we depreciate, though, it's 15, 45K would be debited to retained earnings anyway in those 3 closed years. So because of that, our retained earnings is only off by 105. And so that's why we fix it by 105, just 150 minus the 45. And there we have it. We made it to the end of 22.8a. As always, if these videos help, I hope you'll help me with a thumb or a sub. Thanks for watching. See you in the next one. Bye for now. Let's jump into problem 22.9a, a big error analysis problem. The fundamental concept here is the error counterbalancing or non-counterbalancing? If it's counterbalancing, it will treat it slightly different than if it is not counterbalancing. Let's jump into the problem and see what we're up against. Remembering what counterbalancing errors are. They're errors that sort themselves out the next year. We make an error one year, and if we just leave it in the system, it fixes itself the next year. But because it was wrong this year, in fixing itself, it also caused our books to be wrong the other year. So we do have to do a journal entry fix. We can't say, oh, it sorted itself out. That's a different type of error than a non-counterbalancing error, which is one that's with us for years to come. Doesn't just work itself out of the system. Fernie, Alpine Supplies, retail ski and mountain equipment using a periodic inventory system. A new controller hired late in 2031 uncovered the following errors while preparing the December 31st, 2031 statements. The 2030 books are closed and the 2031 books remain open. No corrections have been recorded yet, and income taxes are to be ignored. So we got 4 errors, and for each we're going to do correcting entries, and we're also going to say, is it counterbalancing or not? Let's go look at the first one. Ending inventory was overstated by $42,000 at December 31st, 2030. Let's actually stop there. There's actually 2 errors here, and it was understated the next year. So these are 2 separate errors. Let's start with our first error, though. Ending inventory was overstated by $42,000 at December 31st, 2030. Is this a counterbalancing error? And the answer is yes. This is an error that will work its way through our system within a year. Inventory is a current asset, so when we sell through that miscounted inventory and we recount the next year and adjust to the new count level, that error will wipe itself out. It'll work itself out. So these are counterbalancing errors. I'll put a big C there. How do I deal with counterbalancing errors? This is something I do that not every text does, but I do recommend is I say optionally, and I do this optional step, I say, how should we have fixed this? And in brackets, if we found out in time. And okay, I'll explain what I mean by that. 2030 has come and gone. If I could get in a time machine and go back to December 31st, 2030, what journal entry would I do to fix this? That's a good thought exercise that will feed my required, which is how do I fix it now? And I'll say belatedly, right? We're a little late to the party. We're like a year late. It's a prior period error. That's what makes it a problem. If it's a current period error, I think they're easy to fix. Prior period errors are a pain to fix. So how would I fix this prior period error if I could go back in time to the prior period? Well, let's read it. Inventory was overstated by 42 grand. Okay, well, inventory is overstated. How do I fix that? I credit inventory. So credit inventory to make it go down 42K. And what would we generally adjust inventory through? And be right if you said cost of goods sold, right? If we counted lower inventory, we're using periodic inventory system. Our inventory count is actually lower than what we thought. Debit COGS for that amount. And that would have happened on December 31st, 2030. Sadly, the year has gone by and we didn't fix this. Let me change the color of ink here. I was planning to do this one in green. Let's make it green. There we go. So we can't go back in time and fix it. We just have to fix it this year. So how would I fix this on December 31st, 2031? Well, any income statement account that was debited or credited just put it to retained earnings. So if it's in the fix, and this is an income statement account, in our current year fix, we got to say, okay, I wished we could have debited COGS last year. To fix it this year, you debit retained earnings, right? This is an error correction. It's retrospective. So we go, okay, if we had fixed it last year, it would be in retained earnings now. So debit retained earnings now, $42K. Now, this is where counterbalancing errors are weird, because you might think, oh, debit retained earnings, credit inventory. No. We are going to credit COGS, cost of goods sold, $42K. Now, let's just mechanically, you're going to always do the same thing for a counterbalancing error. So you find the income statement account in the previous correction, the optional correction, you go debit retained earnings, and then credit that income statement account, or had it been a credit, vice versa. And we'll do that in future steps. So mechanically, you can get the hang of it. But why on earth are we crediting COGS now? And the answer is ending inventory was overstated. So we came in with our inventory balance too high to this year. Well, if our inventory balance entered too high, and now we write it down to what our inventory level is at the end of the year, we just count our inventory and put it to whatever it is, because we started with inventory balance too high. By the end of the year, it's our COGS that's too high, because we write it down by using cost of goods sold. So our COGS is overstated this year. Our inventory was overstated last year. Our COGS is overstated this year. So how do I make COGS go down? I credit COGS. So that little theme you're going to see throughout in counterbalancing error correction. You sort of will be, what should have been, what should we have done to fix this? Debit COGS, credit inventory. Well, how do we fix it now? Debit retained earnings, credit COGS. You'll see that sort of theme throughout. Let's move on to the next one, or the next part of this one. It says, ending inventory is overstated by $42,000 at December 31st, 2030, and understated by $28,000 at December 31st, 2031. Okay, so inventory is understated this year. How should we have fixed it if we could go back in time? We don't need to go back in time. We can just fix it in the present, because the books aren't closed. So there's no going back in time on this one. We just say to ourselves, okay, well, how do I fix this now? I understated my ending inventory by $28K. The answer is, well, if I understated inventory, debit inventory, $28K, and credit COGS, $28K. Now, we could combine these into one, like have a big credit to COGS. I like them separated. I think that is plenty good. And there we've done it. We fixed last year's here, and we fixed this year's error here. We fixed it. So no need for the optional step in the second part, because the books were still open. Let's continue on to number 2. Number 2 says, accrued utilities of $13,000 at December 31st, 2030 were not recorded. Okay, so we had a utilities expense we didn't record. The amount was paid and expensed in January of 2031. Okay, how would I have fixed it? If I could do it, if the books were still open on 2030, I would have gone, oh, I need to record a utilities expense. Debit util expense, credit AP, or credit, utilities payable or something like this, $13K. All right, well, the books are not still open, unfortunately. So how do I fix it now? December 31st, 2031, I put this debit to utilities expense to retained earnings, because that's where it would flow through. So had I gone back in time and done that, my retained earnings would be debited by, when I close the books, and the credit, as with the last one, to utilities expense. And let's discuss why. $13K. So $13K here, $13K there. Why is this the case? The amount was paid and expensed in 2031. Well, we should not have recorded utilities expense in 2031. We did. We shouldn't have recorded it in 2031. So we got to credit it to say that didn't belong in 2031. We're fixing it now. Next, rent. Let's see what's going on with our rent. Rent of $36,000 covering January through June was paid in December 1st, 2030, and expensed in full at payment. This is prepaid rent. This shouldn't have been rent expense. No rent entries were made in 2031. Well, we do have rent expense in 2031 as we use up our prepaid rent. So a couple of errors, right? The error last year was we debited rent expense credited cash. We really should have debited prepaid rent credit cash. So what's the fix? We shouldn't have called it rent expense. So credit rent expense. 36K, and we should have classified that as prepaid rent instead, right? Debit prepaid rent, 36K, and that's December 31st, 2030. So that's what we should have done to fix it if we had thought of it in the moment. Well, what do we do now, December 31st, 2031? We say, okay, well, whatever we put to an income statement account, in this case, rent expense credit, we're going to credit retained earnings for that amount to say, okay, let's pretend we had gone back and done that fix, credit retained earnings, 36 grand, and the debit is to rent expense. Why again am I debiting rent expense this year? And the answer is, well, because we were renting this place January through June 2031. This is a 2031 expense. Yeah, we paid the bill last year, but the expense doesn't get incurred until 2031. So it makes sense in terms of just mechanically, like, oh, okay, what should we have fixed entry? Whatever I do here, I just reverse it like in the next year, because it is counterbalancing. It reverses itself. We have to do that entry. So mechanically we can do it, but it also, the story it's telling makes sense, at least to me. I hope it makes sense to you. Last one, and this one is a non-counterbalancing. Spoiler alert. So let's read it and I'll discuss how I treat non-counterbalancing items. So these three had been counterbalancing. This fourth one is not. Delivery van purchased and placed in service on January 2nd, 2030 for $64,000 was incorrectly expensed to delivery expense in full at acquisition. So we bought a van. We should have gone debit van credit cash. We went debit delivery expense credit cash. Whoopsie. Fleet policy is straight line depreciation over 8 years. So we should be depreciating this over 8 years. No depreciation has ever been recorded because we didn't set up an asset, we set up an expense. Whoops. So here's how I deal with, maybe I'll do different color ink here. So these were all counterbalancing. I do it in those two steps. I say, what should we have done to fix this? What journal entry should we have done to fix it? And here's how we're going to fix it now. By the way, this is the answer to the required. When I have a non-counterbalancing error, I do what we did, what we should have done, and how do we fix it now? So that's how I lay it out, and I do it by journal entries. So what was the journal entry we did when we bought the van? We went debit, delivery expense, whoops, credit cash, 64K. What we should have done, we should have gone debit van or delivery van, 64K, credit cash, 64K. Now this has knock-on effects because we didn't do any depreciation, obviously, but we should have, right? We should have gone, so this was on, when did we buy it? January 2nd, 2030. Jan 2, 2030. Here's what we should have done on Jan 2, 2030. Then on December 31st, 2030, we should have gone debit depreciation expense, credit AD for 8K. And we, on December 31st, 2031, we should have gone debit depreciation expense, credit AD for another 8K. So pretty big difference, right? And it's just getting more and more different each period. And so it's an issue. So how would I fix this now? And the answer is I fix it in 2 steps. So now is December 31st, 2031. How would I fix it now? I fix everything before this year, and then I fix this year's error separately. I do it in 2 steps. So how would I fix everything up till now? Well, obviously I need a van on my books. debit van 64K, right? I need a van to exist that isn't on my books. So let's put the van on the books. I need all the accumulated depreciation on the van to exist as well. So let's journalize the accumulated depreciation. Now the difference here, 64 minus 8 is 56K. The difference is going to go as a credit to retained earnings. Why credit retained earnings? Well, we debited delivery expense. That was wrong, right? I debited my expenses too much. So why am I not crediting retained earnings by 64K? Well, this depreciation expense is right. So it means our debit to expenses is off 64 minus 8. It's off by 56 grand. So we have to fix our retained earnings by 56 grand. This year, I screwed up my I screwed up by not having this journal entry for depreciation. Okay, let's do the journal entry for depreciation. Because my books are open, I just depreciate the asset. So debit depreciation expense, 8K, credit AD, 8K. So that's the fix for this year's item. It's all in one entry. And there we have our part 4 in the bag. So big problem. There are, what are they called? Non-counterbalancing errors, this one, and there are many counterbalancing errors, and you just have to treat them differently and think through them differently. As always, if you make it to the end, I appreciate a thumb. Thanks for watching. See you in the next one. Bye for now.
Holy cow, you've made it. Congratulations on getting to the end of what has been a very long and surely challenging course. Good job by you. I always love to give these behind the scenes thank yous and goodbyes. Thank you so much for watching. And as a reward, here's a picture my daughter drew when she was a little kid hanging on the wall. There you go. Thanks for watching. Bye-bye.